the downside to 26,400 on the upside. The data indicates that expiry for Nifty is likely to be between 26,200 to 26,350. Sentiment as far as is concerned, sentiment is looking bullish, but upside is capped for now. On the downside, don't see Nifty falling below 26,100 if you go by the options data, because there has been a call writing on the upside, while put writers are covering their old positions. As far as the flows are concerned, in the index futures, we have seen FIs buying more than rupees 400 crore. In the stock futures, they have sold, and that figure was more than rupees 2,500 crore. Now, FI long exposure remains around 11%, while on the short side, the exposure is at 89%. Come to the options data, 26,300 and 26,250 most active call options. Both these options have seen an increase in the open interest, but premium for both these options has fallen. But on the put side, 26,300, 26,250, 26,400, all these put options have seen a fall in the open interest, but premium for all these options has seen a rise. That's the reason I'm telling you that downside also is like Nifty is unlikely to fall below 26,100. So support 26,000 after, because it's the 50-day moving average major technical level. Resistance 26,370, that's the record high. For Nifty Bank, support will be around 59,850 and resistance would be around 60,440. That's the record high. Two stocks are in the band, Sale and Sammaan Capital. Some of the stocks that I'll keep an eye on. PGI Electroplast has been seeing fresh longs for the last 2 days. It's been higher, and Prestige States also has seen fresh longs. On the short side, Jubilant Food has been seeing fresh shorts.
We'll keep an eye out on these names. Sudarshan, thank you for that update there on the FNO space. Take a short break. Continue our coverage on the developments in Venezuela on the other side. Stay tuned. Welcome back. Now, days after the Venezuelan President Nicolas Maduro and his wife were flown out of their country in a U.S. military operation to face narco-related charges and cocaine importation conspiracy charges in the U.S., the deposed leader, appearing before the U.S. judge, has pleaded not guilty to charges of narco-terrorism. Here is a Reuters report.
Protesters gathered outside a New York federal court on Monday, where inside, toppled Venezuelan President Nicolas Maduro stood before a U.S. judge to face charges that could put him behind bars for life. Through an interpreter, Maduro said, "I am innocent. I am not guilty. I am a decent man. I am still president of my country," before being cut off. Maduro faces 4 U.S. federal criminal counts that include narco-terrorism conspiracy, cocaine importation conspiracy, and possession of machine guns and destructive devices. His next court date is set for March 17th. His wife, Celia Flores, faces the same charges except for narco-terrorism. She also pleaded not guilty. Prosecutors alleged that as president, Maduro directed cocaine trafficking routes, used the military to protect shipments, sheltered violent trafficking groups, and used presidential facilities to move drugs. He was first indicted in 2020 as part of a long-running narcotics trafficking case against Venezuelan officials and Colombian guerrillas. The 63-year-old has long denied the allegations, saying they're a mask to take Venezuela's rich oil reserves, which U.S. President Donald Trump has made no secret of wanting.
We're in charge.
On Monday, the UN Security Council debated the implications of Trump's raid, which Russia, China, and leftist allies of Venezuela condemned. Venezuela's UN ambassador, Samuel Mancado, said Maduro's arrest has threatened international norms.
Aceptar esta lógica.
Accepting this logic implies opening the door to a profoundly unstable world where countries with greater military capabilities can decide by force the political and economic destiny of other states.
De otros estados.
While world leaders and U.S. politicians grappled with the extraordinary seizure of a head of state, an emergency order in Venezuela, published in full on Monday, ordered police to search and capture anyone who supported Saturday's U.S. attack. Also on Monday, Venezuela's vice president and oil minister, Delcy Rodriguez, was formally sworn in as the country's interim president, with words of support for Maduro, but no indication she would fight the U.S. move.
Meanwhile, Russia and China vociferously denounced the U.S. action in Venezuela at an emergency session of the United Nations Security Council on Monday, calling for the immediate release of Venezuela's deposed President Nicolas Maduro and his wife from U.S. custody. I quote, "There is no and can be no justification for the crimes cynically perpetrated by the United States against Venezuela," end of quote, and that came from Russia's representative to the UN. He also said that the capture and extraction of Maduro breached all international norms. Now, China's deputy UN representative called on the US to release Maduro and his wife, saying that it was deeply shocked by the unilateral, illegal and bullying action taken by the US. He demanded that the US change its course, cease its bullying and coercive practices. Cuba has also condemned the US action, stating that the military action against Venezuela has no justification whatsoever, and this is an imperialist and fascist aggression with objectives of domination. Meanwhile, the US ambassador to the United Nations, Mike Waltz, said that there is no war against Venezuela or its people. Listen into what he had to say.
There is no war against Venezuela or its people. We are not occupying a country. This was a law enforcement operation in furtherance of lawful indictments that have existed for decades. The United States arrested a narco trafficker who is now going to stand trial in the United States in accordance with the rule of law for the crimes he's committed against our people.
Meanwhile, British Prime Minister Keir Starmer maintained his position of a peaceful transition to democracy in Venezuela. Listen into what he had to say.
The position of this government is that what we need in Venezuela is a peaceful transition to democracy. That was our position before this weekend. It remains our position. The president was illegitimate and caused untold misery across Venezuela. International law is the framework, is the anchor or the benchmark against which we judge the actions of all other governments. And it is, of course, for the US to justify the action that it has taken. It is not straightforward, it is complicated, and even today there are further developments. But I won't shy away from the fact that international law is the framework and is the benchmark.
Let us also now listen to some experts reacting to the current situation between the US and Venezuela.
I think it's going to not turn out well, not turn out to be a wise decision from the perspective of American policy or for American interests. We tend to forget that it's much easier to break things than it is to build things. And it's much easier to topple a regime than it is to replace it with something better. And I don't want to be too haunted by history, but I think if we look at the recent experience, let's say even the last 3 decades for the US, if we look at Afghanistan or Iraq or other instances in which we thought a bad regime was bad, which certainly Maduro was, but that we could engage in regime change successfully, we failed. And I think in the end, this will turn out to be a failure.
The real question is to what extent is there a meeting of the minds between the successor leadership in Venezuela and the Trump administration? I mean, let's just take a step back for a second. Whatever else happened over the last few days, it wasn't regime change. It was simply leadership change. Mr. Maduro got shipped out We now have his former vice president running things. And the question is there a meeting of the minds between, say, her and Marco Rubio on such things as American access to energy reserves, participation of American companies? Is there an understanding on drug trafficking, perhaps on Venezuelan support for Cuba, and so forth? And if there is, my guess is the administration will simply work out a new relationship with this successor regime. And if there's not, then the administration faces some really difficult choices about what it's prepared to do and whether it's prepared to escalate pressure or escalate its involvement.
Most nations end up being poorer relative to the United States after they discover oil or other commodities. So there's a real curse of commodities also to add to Venezuela, that having too much oil is in fact not a good thing, because it is what sows the seeds for economic mismanagement, much more corruption. The nations that truly succeed are those that function on manufacturing, technology, and stuff. So I'm not that optimistic on what Venezuela itself is going to do. But yeah, it's been such a basket case that from here, I guess there's only upside. And the Venezuelan bonds have begun to price that. In fact, they were sniffing this action that was happening. And so from here, I do see a better path for Venezuela. But in general, I'm not a big bull in the long term on investing in nations that are rich in commodities, because that's what sows the seeds for economic mismanagement and corruption.
On to action from Wall Street then, which completely shrugged off all of these weekend developments and the economic concerns as well. At the Dow Jones ending almost 600 points higher at a record high level intraday. It also crossed the mark of 49,000, while the S&P 500 and the Nasdaq also saw gains of close to 0.7%. Almost all the energy stocks were higher in yesterday's session as well. Now, let's also now listen in to Neil Kashkari, the President and CEO of the Federal Reserve Bank of Minneapolis, as he shares his outlook for the U.S. economy in 2026.
I think the unemployment rate is pretty clean at 4.6%. When I talk to businesses in my region, they also say they're not hiring very much. So I think that that's a clear signal that the labor market is cooling. At the same time, inflation is still too high. I think the most recent inflation data I don't take that seriously because there's some issues with the data collection with the shutdown. I think inflation is still too high. And the big question in my mind is, how tight is monetary policy? Over the last couple of years, we kept thinking the economy is going to slow down, and the economy has proven to be far more resilient than I had expected. That tells me, well, monetary policy must not be putting that much downward pressure on the economy. And so my guess is we're pretty close to neutral right now, and we just need to get more data to see which is the bigger force. Is it inflation or is it the labor market? And then we can move from a neutral stance.
We'll take a short break here on Power Breakfast. Cues from the commodities market on the other side. Welcome back. On to cues from the commodities market. Manisha is here with all of those updates. Manisha, good morning. Never a dull day.
Never ever, yes. And if you look at the metal prices, those are the ones that have gained the most and the best overnight markets. If you look at platinum, that was up 6.5% overnight. Copper gained 5%. Silver was up 5.5%. Gold gained almost 3%. So that's the kind of move that you've seen come in for tangible commodities. But also remember, these are fund allocations. There is index rebalancing is happening as well, which always does in the first half of January every year. So we're looking at money coming back in many of these metals. Copper is hitting record highs on LME in Shanghai and in the UK markets as well. There are concerns over potential US tariffs coming back into the market. And then there is a strike at Chile's mine as union members seek larger share of profits. Remember, copper gained 45% in the last year. So these kind of negotiations will start coming up and you'll see support in copper because of that. But not just copper. Aluminum is trading at a 3-year high. You have nickel trading at a 1-year high. Iron ore prices, which fell in the previous year, also have started 2026 on a positive note. And then you have zinc trading at a 14-month highs as well. So it clearly is metals all the way today morning.
Metals all the way indeed, as has been the case for the last month or so now. Manisha, thank you for that update there. Take your leave on this edition of Power Breakfast from me and the team. Thank you so much for watching. Bazaar Morning Call on the other side to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. Well, yesterday was sort of a tentative kind of session, but today the cues are looking a lot more optimistic.
A lot better.
A lot better, yeah.
And precious metals and commodities, all the rage.
Absolutely. Metals continue to shine. One wonders when that demand will get hit because of the kind of rise that we've seen in pricing.
Yeah.
But I guess for the time being, it's ride metals with momentum, and that seems to be playing out.
Riding the tiger.
Indeed.
Anyway, let's just take it from the top, right? And commodities is going to be a big part of it, what we're going to discuss here over the next 2.5 hours or so. I mean, it's a relatively straightforward session that we're reporting to you this morning. I mean, actually, it's a repeat of what we've had for the bulk of 2025, when U.S. markets kept making newer highs. I think there were about 40 new all-time highs in 25. So S&P 0.6% higher, the Nasdaq about 0.69 higher. You had a bit of pressure as far as yields go, 4 basis points lower, but I mean the absolute levels are still around 4.1, 4.15. And I think, I mean, the 4 basis point came through as ISM manufacturing index hit the lowest level since October 2024. It's not as if it's plunged or anything, but it's just, I mean, a data point. Oil prices went up 2%. Now, eventually, the consensus view is that, you know, as more Venezuelan oil supply comes to the market, but that'll take time. Oil prices, it'll put a substantially more oil in the market, which means lower prices. But for now, as we look at last night's session, 62 on Brent. By the way, Chevron, which is the only U.S. oil company in Venezuela, and which has been basically, by the way, allowed back, was up about 5.5%. But that's a very company-specific, fact that we're looking at. But a bunch of other U.S. Oil companies were also higher. Chevron, of course, is the biggest and the one which is actually there. Now, metals, as I said, big moves. Copper trading above $13,000. Silver prices 7%. Gold prices 3.5%. So this is, I mean, just an absolutely gangbuster kind of move that we've had through 25. 65% on gold in 25, 150, 160% on silver in 25, and you start the year like this. What can you say? In terms of President Trump's activity on social media, etc., he posted on X and he basically said that U.S. will soon be receiving more than $600 billion in tariffs. Remember, if you remember, in 2000, around the Liberation Day period, which is April of 25, estimates were that the U.S. essentially will collect about $350 billion in tariff-related revenues. And President Trump now saying that $600 billion is the revenue they will intake on account of tariffs. Now, I'll come to the market here. Nifty sold off, but that's just the Nifty. Broader market, broader volume/price action looked much better. Actually, it was not bad at all. Even though numerically market breadth looked pretty negative, but you just count what was down on volumes and what was up on volumes, and I think you've got to give it to the bulls, at least in the broader mid and small cap space. Third quarter business updates continue to pour in. Axis Bank has put out an update and look better. Trent perhaps maybe slightly sideways. L&T Finance looks strong, and so much more, which we will discuss in our top 10 segment in a bit from now. I'll just put out the 20-day moving averages. Not very much by way of change from yesterday. 26,013. We're still 150, actually almost 200 points away on the Nifty from the 20-day. For the Nifty Bank, that level is at about 59,290. Remember, bulk of Asia has started 26 on a pretty strong note. This is the time of this year, early January, when markets generally trade pretty well. We'll just have to see if India will be part of the mix this time around, because 25, we were not part of the mix. We were huge underperformers by a mile compared to most global markets. And I'm not even talking about the top performing markets like Korea, etc., which went up massively. GIFT Nifty up on your screen, 60-odd points higher is the implied open. Nigel has walked across to the wall with the F&O positioning and what the data shows. Nigel, over to you.
Well, Prashant, just taking a cue from what you said, in yesterday's trading session, though we ended in the red, it wasn't such a bad trading session. And one fact on the Nifty and the Nifty Bank is we made a higher high and a higher low. Normally you like that, and that's what makes my bias leaning more towards the positive side for the remainder of this month itself. Getting to the flows, well, yesterday the institutions were net buyers. The FI participation is gradually picking up. They were mild sellers, but very, very mildly so, though the participation will gradually pick up as the course of the week does progress. What did the FIs do on index futures? Well, there was some covering of some short positions, but clearly on stock futures, there was unwinding of long positions as we saw, and some shorts getting into the system. And post this move that we saw yesterday, well, the long-short ratio for the FIs on index futures doesn't change much. Shorts hold at around 89%. Moving to what they did then in the option side of things, well, yesterday they actually wrote calls and they unwound some of those puts that were written earlier. So, that's the kind of move that we saw. Aggressive call writing was back into play. Remember, the contract expires today because today is Tuesday, which is the weekly expiry. And you had the 26,300 call, 26,250 call. Well, there was aggressive writing that we saw on both those two strikes, and the premium has come down to around 25 to around 40 rupees. So just looking at the options data, you'll get your levels, and I'll get to that in just a bit. But one point that we made yesterday is the PCR is moving towards the upper end of the range. And when the PCR moves to the upper end of the range of around 1.5, 1.6, that's when you see some kind of cooling off in the market or maybe some kind of consolidation. I think that played out yesterday, and the PCR has come back down to around that 1 odd mark. So getting to the levels, going by the options data, this 26,325 to around 26,375, that's going to be the important mark that you're looking at. The 26,375 is the high that we saw yesterday. So that's going to be the important mark that you're going to be looking at. That's the range you're looking at on the upside just for the day. On the downside, for the next few trading sessions, where the 20 DMA is at, where the 50 DMA is at around the 25,950 to around 26,000, that's going to be the important mark. The Nifty Bank had a bit of an off day yesterday, primarily because HDFC Bank did come in for some profit taking. But as long as it holds above that 20 DMA, you'll still have to say that this one is good for more. So that's the important mark, close to around 500 points away from the 20 DMA. The stock that we highlighted in the final hour of trade yesterday was Sammaan Capital. There's a possibility it goes in the FNO ban is what we said. And by the end of the day, well, that was confirmed because that one's come back into the FNO ban. So we'll keep an eye out on Sammaan Capital as well.
Thank you very much for that. So Sammaan Capital is the new addition to the FNO ban, while SAIL continues to remain in the ban. 3 things to watch today. 1, as Nigel said, it's the Nifty weekly contracts expiry. 2, GM Breweries comes out with their Q3 earnings. And 3, on the IEX market coupling case, Aptel's next hearing is today. So these 3 things on the tap. Let's tell you the equity calls that we've got this morning. It's Vikas Jain of CLSA who says reduced relative premium to peer markets after India's record underperformance in 2025 should improve the acceptance of India as a portfolio hedge for foreign investors against global risk from consolidation in the AI bull market or an unwinding in the yen carry trade. But he argues that India's extended absolute valuation could keep the absolute returns muted yet again in 2026. He says this year, India may also lack new policy news, but this depends on the benefits from the announcements already made in 2025. What does he like? He favors consumption, rate-sensitive and IT segments, and they're boosting their consumption exposure by adding Eternal and Avenue Supermarts to their India-focused portfolio, and they're exiting Reliance and Nestle. All right, let's get in Matt Orton, the Chief Market Strategist at Raymond James Investment on the show now. Matt, thank you very much for joining in. U.S. markets completely shrugging off the geopolitical headlines coming out of Venezuela. To be fair, it doesn't affect the theme which is dominating the U.S. trade, that is AI. That still continues to remain intact. But as we begin 2026, give us the big calls that you're taking on the U.S., on India, and even India's position in the emerging markets.
Absolutely. Well, good morning, Rima, and a very happy new year to all of you. And I think the U.S. looks poised to continue to grow, as do all global markets. I'm quite optimistic on where we go in 2026. And while I like artificial intelligence, we've talked about this over the past year, my enthusiasm and my belief that we were not in an AI bubble, I do think 2026 is going to be a year of differentiation and more of a show me year. It's going to be very important, especially as we head into earnings season, given how much so many of these AI companies have moved, that the higher quality names that are not seeing deceleration or facing that law of large numbers, those are going to be the winners in the AI trade. And those who are not able to continue to push EPS growth higher, I think they're going to be challenged given the strong performance they've had. So When you extend that to a global perspective, I think leaning into cyclicality is a winning play for 2026 in the US. That means leaning into financials and industrials, even those associated with data center buildouts, but also those just based around manufacturing and beneficiaries of fiscal policy. In emerging markets in Europe, I think it's a similar trade. Leaning into cyclicality with respect to financials, I think continues to look very, very attractive. In India, same thing. HDFC continues to be my top overweight in the financial space. ICICI looks like it's starting to pick up a little bit too, and I think adding a little bit more there, especially heading into what should be a good earnings season, I think looks attractive. And the rest of Asia as well. I think there's a lot of opportunities to lean into that trade and also use downside opportunistically because there's going to be increased volatility given where geopolitics is, given where valuations are. So you don't need to chase the market as an investor. Let it come to you, but be prepared to put money to work because I think the fundamentals support continued upside.
You know, in India, IT services, for example, Matt, good morning and Happy New Year, have been actually the two sectors, real estate and IT services, which are, I mean, you know, double-digit down in 25. IT, you know, as the conversation moves away from the infrastructure companies and the AI to the adopters, you think, I mean, there's underperformance aside, I mean, that perhaps is a necessary condition for outperformance, but do you think, you know, the ability of IT companies to sort of play into the theme of adoption, to cut costs, to use AI, enables them to do well this year?
You know, Prashant, that's a really interesting point, and it's one I've been spending a lot more time discussing with clients and doing a lot of fundamental research on because I do think this is going to be the year of AI users as well as the AI enablers. And I think companies that are able to integrate AI to preserve their margins in the face of, I'd say, more persistent inflationary pressures, I think that's going to be a really important theme, not only this year, but in the next few years to come. And so when you look at Indian IT services, it's been an awful place to be over the past year, but you're starting to see a change of hearts. And I don't know whether that's because some of the charts are just so washed out that investors are trying to dip their toes in. But you look at some companies like Tech Mahindra, where the CEOs put new plans in place, even Infosys, given its global exposure, especially to asset managers who are benefiting in this environment, you're starting to see the outlooks change and turn a little bit more optimistic. And so I have my eye on the space. I'm not quite ready to go all in, but I am looking at dipping my toe because things are so cheap there. I think there could be opportunities, but again, it's a show me market. You have to prove yourself before I think investors are going to put more money to work.
All right, Matt, good morning and wishing you a cracker of a year in 2026. You know, I recall when we chatted last, you were looking at some of these companies, Swiggy, a case in point. I'm sure they had a rocking New Year because, you know, deliveries are very, very high. There's a bit of a conflict going on as well on ground out here. But what's your view? These stocks have come off the top, Swiggy, Eternal. Have you got into them?
Yeah, so Swiggy is a name I own. Eternal is a name I have owned for a while. We talked about Apple AI as well. And I think when you look at all of these, I'll call them more, you know, higher beta names, but especially the Swiggy Eternal that are related to the consumer. When I look at the names, Swiggy in particular, there's a lot of ground competition for sure, but that can't last in perpetuity. There's only so much cash these companies can burn. And what I like about Swiggy is that it has shored up its credit lines. It has money it can put to work to invest in higher value propositions. You're seeing returns from some of its cart enhancements that it's made. So I do think we're going to see a little bit of a turn, and hopefully the GST reforms really start to positively impact consumption as well. And so I like being exposed to the Indian consumer, and I think Swiggy looks fairly cheap. It's had a rough go in 2025, and I think it's set up to do well looking into Q1, Q2 in 26.
Matt, the other big talking point are the monster rallies that we continue to see in base metals, not just precious metals, which had a banner year last year, but look at copper, look at aluminium, platinum, going through the roof. What are the implications for global equity markets with this kind of a rise?
is bullish, Rima. I think the moves in base metals is certainly a signal back to that cyclical element we talked about at the beginning. I think it highlights that global growth remains resilient. So I take that as a very positive signal, while maybe some of the moves in silver, for example, which does have industrial purposes, might be a little bit extended. When I look at the moves in copper in particular, I'm very enthusiastic about copper and copper miners moving forward, because copper isn't just used for very, call it CapEx heavy areas. It's also used in data centers. It's used in chips. It's used in more EVs that China continues to invest in. And so I think there's a lot of use cases for it, along with significant underinvestment on the part of the miners. So you actually have increasing demand that's outstripping the increase in supply that we have. So I think copper looks like a very constructive market. And I think that's the story for some of these base metals going forward. So I do think that's an area to look for, maybe a positive surprise in 2026 across the commodity complex and other miners outside of the gold miners.
Matt, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for joining us here. Happy 26, and I hope you continue to do well. We'll take a quick commercial break here. What we're going to do is get you a quick snapshot view of what's coming up here. And the interviews and the chats. So 8:35, management of CSB Bank stocks done very well, especially yesterday, and of course, over the last few years, really. So third quarter business update, and we'll talk to Pralay Mondal on that. 9:20, Venugopal Gare of Bernstein is our market master of the day. He's got some interesting opinions. 9:35, the management of Oil India has talked to us on the company's outlook for 26 and more. And we put the spotlight on the cement sector with Goldman Sachs' Pulkit Patni at 9:45 a.m. Towards the end of the program, Lata in conversation with Sunil Singhania, founder and fund manager at Abacus, on what to expect from markets in 26.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Kotak Mahindra Bank, Axis Bank, L&T Finance, Adani Ports, IEX, Dabur and SAIL. They'll be reacting to positive news flow, while we have Trent, IndusInd Bank and Tata Motors PV, which will be reacting to negative news flow. Take that break, get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to tell you the stocks that you need to have on your radar. This Tuesday morning, our entire research team is standing by with CNBC-TV18's list of top stocks for the day. Good morning, everyone. Gaurav, again, another busy day for you. Lots of quarterly updates coming through from the banks.
Well, yes. If you look at banking updates, first let's talk about Kotak Mahindra Bank because the growth has been phenomenal once again. The growth has been at around 16% on a year-on-year basis. Remember, this was the number in the last quarter as well. And when it comes to deposit, there also we saw a growth of around 14.6%. Now, CASA growth, that remained flat. Remember, last quarter was the quarter when we saw CASA growing at 7% on a sequential basis. But in this quarter specifically, on a sequential basis at least, CASA growth has remained flat. But at the same time, what we should watch out for is that the segments which are actually leading this growth, and second is that the NIMs for the quarter. Now we will get only during the quarterly results, but for now good set of numbers in terms of pre-quarterly updates from bank. Apart from that, Axis Bank, now this bank came up with the quarterly updates, and if you look at the growth, loan book growth is at around 14%. Now for Axis this is very important, and the reason being that if you look at the trajectory of Axis, for the last few quarters, we have seen Axis Bank actually struggling with the growth. Last quarter, we saw Axis Bank actually got into double-digit loan book growth, and the 14% growth trajectory is something that we had seen back in first quarter of FY25 and days before that. So this is actually the first time when Axis Bank is reporting 14% plus growth after first quarter of FY25. Other than that, deposit growth, that also remained healthy at 15%. Another thing to highlight is that throughout this pre-quarterly updates, we have seen actually banks' advances growth was higher than the deposits growth for most of the banks. But for Axis Bank, deposit growth is higher than the advances growth. So that is also something that we should highlight. So these were some of the bank updates. And on the back of that, Axis Bank also is likely to open in green today.
Okay, all right, Gaurav, thanks a lot for that. But you've got a few more updates, I believe, that you're tracking today. IndusInd Bank and L&T Finance as well.
Well, as if you look at IndusInd Bank, we are seeing some kind of decline in the loan book growth. Actually, the loan book declined almost by 13% on a year-on-year basis, and this, in fact, this also reflects into 2% decline on the sequential basis. When it comes to deposits, deposits also degrew almost by 4% on a year-on-year basis. So basically, we saw actually the balance sheet shrinking on a year-on-year basis for IndusInd Bank. So that is something which is negative for the bank, given that we are, or rather, all the investors are expecting some kind of pushback and banks' asset and advances to go up. But it seems that third quarter at least is not that quarter where will we see the growth, at least in terms of advances. Apart from that, L&T Finance. Now, if you look at the quarterly updates, they look very much strong for the company, and the reason being that retail loan disbursement, now that has increased almost by 40% on a year-on-year basis, and also this reflects 20% growth sequentially. When it comes to retail loan book, that increased almost by 21%. Remember, actually, company has given a target of more than 25% growth in FY26. Last quarter, if we see the growth, it was at 18%. This quarter, it is at 21%, and the street is expecting around 20% growth. So definitely, it is higher than the street's expectation. Specifically, if you look at gold segment, now that is also growing because gold loan disbursements, they came in at around 1400 crores versus what it was at 983 crores. Remember, this was a business that they had acquired in fourth quarter of FY25, and this is also showing some kind of growth. So all in all, a very good set of numbers from L&T Finance in this quarter.
Thank you very much for that. So three positives: Kotak, Axis and L&T Finance. IndusInd Bank, though, has had a soft quarter. Vivek is now joining in with more on Adani Ports and IEX.
Well, that's right. You know, December monthly update as well as a Q3 update coming in for both Adani Ports as well as IEX. Adani Ports, December 2025, the cargo handled by the company went up almost 9% on a year-on-year basis at 41.9 million metric tons. December 2025, the container volumes actually aided the growth, up almost 18%, and the logistics volumes was largely flat. Now, talking about YTD FY26, the company has handled close to 367.3 million metric tons of total cargo, implying 11% year-on-year growth when you're comparing the 9 months of FY26 to last year. Just an alert, this is compares against the guidance that the company has given for FY26 cargo volume growth that is expected to be in the range of 545 to 555 million metric tons, which includes the NQXT Australia acquisition as well. Now coming to IEX, remember, apart from the operational update, today is an important day given the fact that at APTEL today there will be another hearing regarding the market coupling case, and any development there will be material as far as IEX is concerned. Now talking about the Q3 FY26 update, almost 34.8 billion units of electricity was traded. Volume actually saw 11.9% year-on-year growth. But this is despite the fact that the day-ahead market, one of the key markets for IEX, actually degrew 2.8% for this particular quarter. For the month of December, total volumes went up 2.8%, but the DAM segment volumes fell 11.6%. Internal slightly soft, but this could be overshadowed by the news that could come out of Aptil today.
And we'll talk more about that news, that Aptil thing, which is coming up today in a little bit from now. Thanks very much, Vivek, for that. Tata Motors passenger vehicle is the next one we have on our radar. Sud is here with details. Good morning.
Morning, Prashant. So Tata Motors passenger vehicle has given the update for JLR, and this is for Q3 of FY26. And as expected, it's a weak update as far as the volume is concerned. If you talk about the wholesales, there the drop is more than 46%. If you talk about retail, there is a drop of almost 25%. And for whole year, that is 2025, wholesale volumes have fallen by more than 26%. And the drop is seen across the markets. And major two reasons why there is a big drop. First, there was a production stoppage because of cyber incidents that company had reported in September of 2025, and after that production got to normalcy only by mid of November. And the second, the planned wind down of legacy Jaguar, that is also impacting the total volumes. As far as the major contribution is concerned, it came from three major models, and those are Range Rover Sport and Defender, and these three together have contributed more than 75% to total wholesale volumes, and that is up almost 400 basis points year-on-year and down 240 basis points on a sequential basis. I'm going with mild red because of the recent underperformance on the stock, and also there is an improvement as far as the India passenger vehicle business is concerned.
Okay, all right. Thanks a lot for that, sir. Hopping across to Mangalam, he's here to tell us about Trent. Mangalam?
Well, I'm going with mild red on Trent this time around as well, because now the street seems to be, adjusting itself to a lower growth scenario for Trent. They've given their third quarter update where the revenue has grown 17%, 16.9% to be precise, close to around 5,200 crores. And remember, this is a number that they've netted off GST, because had it been for the GST cuts, then the realizations would have been lower, similar to something that we saw in the case of Avenue Supermarts yesterday. But similar to, again, what we saw in Avenue Supermarts, the store addition was a positive. So they've opened 17 Westside stores and 48 Zudio stores during the quarter. And if you equate the number of stores that they've opened between last year and now, it so appears that maybe the revenue growth is led entirely by stores, and there is a decline in same-store sales growth, and at the same time there is a decline in sales per square foot also. And this trend has been on the declining side. You look at the first quarter where the revenues grew 19%, second and third quarter the revenues growing 17%. No meaningful pickup in growth out here. This despite the management saying that on a long-term basis, they are looking at between 20 to 25% CAGR. And the last three quarters, these numbers have actually disappointed what the management had guided for as well. The only reason I'm going with mild red and not a bigger red is because the stock has been an underperformer in all of 2025. After doubling in 2024, it's fallen about 40%. So a bit of the slowdown is in the price, but how much, we don't know. As of now, going with mild red.
Okay, all right, Mangalam, thanks a lot for that. Well, I'm looking at SAIL, and the stock has done very, very well of late. Yesterday as well, it ended at the high point of the day. They put out their update for the month of December, and it looks quite good. They say that the sales volume number is up by close to around 37% on a year-on-year basis for December, and they've recorded the highest ever December sales. They go on to point out that they've seen a surge across various categories. Focusing on April to December, the sales number that they've disclosed is up close to around 17% on a year-on-year basis. The management also adds that export volumes also recorded significant growth. We'll have to get the kind of contribution that's coming out there, smaller part of their business, but growth. So going with a tinge of green on this particular one as well. Going back to Mangalam. Mangalam, what about Dabur?
Well, Dabur is mild green. The reason why I say that is because, consolidated revenue growth is picking up, seen in mid-single digits. The EBITDA and net profit continue to grow ahead of estimates. The stock ended at the low point yesterday. So, the street was anticipating mid-single digit sort of revenue growth, but EBITDA and profits growing ahead of that is a positive, which means there is margin expansion. Consumer sentiment, the company said, improved in urban and rural areas. Rural still outperformed urban, which is better for Dabur because they have a higher share of revenue coming in from rural than all the other FMCG players. Home and personal care business, that grew in double digits. That's a positive. Healthcare, low single-digit growth, but that's a sequential improvement. The only reason why the business was impacted was because of the beverages portfolio, which got impacted understandably by adverse weather. So to that extent, I'll also look at Varun Beverages this time around because their portfolio could also be impacted by heavier than expected winter. But for Dabur, it is a positive. A mild green is what I expect from the stock today.
Thank you very much for that. Let's quickly recap then of the top stocks then. Stocks with positive news flow are the banks, the big large banks, Kotak Mahindra Bank, Axis Bank, L&T Finance, Adani Ports, IEX, Dabur and SAIL. Stocks with negative news flow are Trent, where Mangalam says it's going to be a mild red, Innocent Bank and Tata Motors. Well, moving on to the other important story that we'd like to highlight, Reliance Industries has clarified and denied the Bloomberg report, which claims the 3 vessels laden with Russian oil heading for Jamnagar refinery. The company's statement reads, and I quote, "A news report in Bloomberg claiming the 3 vessels laden with Russian oil are heading for Reliance Industries' Jamnagar refinery is blatantly untrue. Reliance Industries Jamnagar refinery has not received any cargo of Russian oil at its refinery in the past 3 weeks approximately and is not expecting any Russian crude oil deliveries in the month of January." The company goes on to say, "We are deeply pained that those claiming to be at the forefront of fair journalism chose to ignore the denial by Reliance of buying any Russian oil to be delivered in January and published a wrong report tarnishing the image of the company." End of quote. Well, let's move on then.
Just a quick word, Rima. It's an important clarification. I mean, because it's not just about Reliance, right? I mean, it's essentially about tariffs and all
Flouting
of that,
it, yeah.
flouting it, etc. So, strong denial, and we don't usually see this kind of thing coming through. But I think perhaps the company felt it needed to be said and loudly for everyone's consumption. So, it's a very, very closely watched thing. The amount of, we had HPCL, for example, yesterday with us, and we asked them how much of what's the mix of oil, etc. It's come down very, very dramatically. So this report certainly, going against that, and that strong sort of denial and clarification from Reliance Industries. Well, Manisha is here with a quick roundup of all that is happening in commodities, and a lot is base metals, precious metals. Manisha, what's top of the list? Hard to pick.
Oh, thank you for that. Well, it's not too much of a movement that we've seen in the crude oil prices, but it is metals, the tangible commodities, which really seem to be doing quite well as January has begun. So copper, I want to start with that one, has hit a record highs. There are concerns of potential U.S. tariffs, but for copper, it also is about strike at Chile's mine, which is adding premium to prices. Not just copper, you have aluminum trading at a 3-year highs. You have nickel prices trading at a 1-year highs. Iron ore, which closed 2025 on a negative note, has started 2026 on a very positive footing there. And then you have zinc prices trading at a 14-month high. Silver continues to shine bright. We saw 150% of gains in the previous year, and silver has gained 10% already in 2026. The overnight gains for silver have been to the tune of 5.5% there. So very strong gains continuing into the market there. A final word on the crude oil prices, which is quite volatile. The investors still are assessing impact of U.S. action towards Venezuela, but it really is about surplus of 2.5 million barrels that we are dealing with in this year. And then Saudi Arabia cutting selling prices for its Asian consumers for a 3rd straight month tells you that the demand is not so strong and the prices are taking pressure because of that.
All right, Manisha, thank you very much for that. More later. We take a break. We are back and we connect with Mayuresh Joshi, Director of Research at Mark Smith India, for some specific stock conversation. Lots of business updates to discuss as well. Stay tuned.
Welcome back. Hope you're having a good morning. As promised, we have Mayuresh Joshi, Director Research at Mark Smith India, who joins us on the show. Hi, Mayuresh. Good morning. First time we chat this year. Wishing you a cracker in 2026, you personally as well as professionally. Mayuresh, I wanted to ask you about a couple of these updates that have come overnight. And the one on the top of mind, I think, most interesting nowadays is Trent, because we saw that one-way move. The stock has cooled off substantially from the top. But, Mangalam tells us that still these numbers that they reported are still a little bit softish. What's your view after the kind of correction and there are still growth prospects? Your view on the stock?
Morning, Nigel. Wishing you, Rima, Prashant, the entire team at TV18 a very prosperous, healthy and peaceful 2026. When it comes to the updates for Trent, little bit softer, but I think the trend should start evolving as we head into Q4. Because in my opinion, I think even for a large part of the retail manufacturers, including the likes of a large part of the consumer discretionary universe, and including FMCG players as well, I think there will be some element of inventory rationalization which will still take place in Q3. But as demand trends start coming back slowly and steadily, and as that evolves over the next few quarters in a more structural manner, my own sense is that local and domestic manufacturers and the apparel makers with attractive price points like Trent has, like V2 Retail as an example, like Vishal Mega Mart as an example, I think they should start incrementally adding to better volumes with better margins, and therefore the bottom line growth or the EPS ratings as we see it should improve. So again, a little bit softer than expected, but my own sense is that from Q4 you should see some element of a transitional change happening for all these players.
Trent, 2025 was the year of big price correction in the stock, 41% lower last year. And FI has also trimmed their position. The FI holding in Trent in September of 2024 was 26%. And in September of 2025, it came down to 17%, a little below 17%. So FI's trimmed their position quite drastically, 10% plus in Trent in the last 1 year.
Remember, 25 was, as you said, big price damage.
Yeah.
24 was big price gain.
Yeah.
It was, I think it was up, did it double? It closed 23 at $3,000. Yeah, it doubled basically, right?
It doubled.
It closed 24 at 7,000. And from 7,000, it closed 25 at about 4,300.
Yeah.
So, yeah. I mean, as they say, right, what you do in the future depends on what you've already done. So, yeah, there is that element, certainly.
Yeah, it's just that the company's now gone from a phase of hyper growth to a normalized healthy growth. And I guess the valuation is still, resetting to, for trends, maybe slow and steady kind of a top line growth. But again, standalone revenue growth at 17% is still very, very strong. Mayuresh, three big banks, private sector banks came out with their quarterly updates. HDFC Bank dipped yesterday. Post the announcement today, we've got Axis and Kotak Mahindra Bank. I know you like ICICI Bank, at least what you've shared in the past. But between these three, which stands out for you? Would you look to add or, to any of these three top banks?
Morning, Rima. So you're absolutely right. I think ICICI is something that we carry in our local and global portfolios. But within the other top three, I think HDFC Bank is something that can be kept on radar. I think a decent update that they had come out with. I think for the larger private sector banks, deposit accretion is going to be key over the next few months. And therefore, I think with the asset base that they're probably carrying, as deposit accretion probably accrues in a more stronger fashion, and what kind of advances growth then takes place, because the credit deposit ratios will remain relatively stronger for a large part of the banking universe. And so will be the other elementary parameters that you probably look at, asset quality pressures looking stable as we speak. But I think deposit accretion is going to be the key. And I think the banks which are probably able to do that better might present better earnings. I think HDFC Bank might just stand out on that aspect a little.
Mayuresh, talk about in the financial space, L&T Finance has done so phenomenally well, right? And over the last couple of years, the new, not the new, but not so new CEO has put out clear roadmap in terms of very, very granular details about what they want to do to the portfolio. I remember we had them, I think, in the last 1.5 odd months or so here on the program. Any thoughts? Do you have a view, L&T Finance? Again, a company which posted a business update.
Morning, Prashant. I think a strong business update. And again, for NBFCs as a space, I think Q3 should be the start where a large part of their earnings deterioration should largely be left behind. You have obviously seen the interest rate curve go downwards. And therefore, I think the better rated NBFCs will have the added advantage in terms of better borrowing costs. And that will lead to better and stable NIMs and spreads as we head into the next few quarters. Similarly for banks, I think NBFCs with a stronger capital adequacy will stand to gain. And again, I think the diversified portfolio is something that will aid these NBFCs going forward. And therefore, I think better rated NBFCs, leadership NBFCs should continue doing well. Our top picks have been Shriram Finance, as I've been saying. Bajaj Finance, in our opinion, probably looks strongly placed as well. They might have those tailwinds in terms of the diversified base that they've probably got, the cross-selling opportunities that present itself, the cost optimization that they're probably doing. So these two probably remain on top of the rack, followed by L&T Finance and to a certain extent Chola Finance, which has obviously been in the news. But Shriram and Bajaj Finance remain top of our rack.
Okay, Mayuresh, I wanted to ask you about some of these FMCG names. They've actually been relative underperformers, but yesterday, they were outperformers. Nestle, HUL. HUL has been a rank underperformer, but yesterday was showing some signs of life. Any of these stocks you like?
So Nigel, within the pack, I think Marico is something that we continue holding. Decent update from Marico as well that has come out. And therefore, as I said, Q3 might be a quarter where a large part of that inventory rationalization might take place. But Q4 onwards, as demand starts coming back, and as it trickles down with input costs remaining far more stable, you should see far more stability in terms of the reported EPS numbers. Having said that, I think outside Marico, Nestle had reported a very strong Q2, and they had pointed out that Q3, Q4 might also be relatively better. So I think out of the large caps, Nestle India had a very strong show, and if they continue that show, I think the momentum can very well continue. And one stock that we've kept on our radar is Tata Consumer as well. The India tea business, branded business doing well. Sampann, the portfolio itself is expected to pick up, and therefore the Indian food business expected to remain strong and stable. The international coffee business obviously is facing some headwinds and challenges in terms of rising coffee costs. But I think expectations is that they might do a price hike in Jan, followed by one in March, to probably ensure that the margins are probably protected for their international coffee stroke beverages businesses. So this is one stock that we probably kept on.
Mayuresh, we reported yesterday, I mean, just to kind of move away from some of the business updates, etc. My colleague Yash reported yesterday that the government, Department of Financial Services, has sent letters to both the Life Insurance Council and General Insurance Council as a way to reaching out to specific, I mean, basically all companies which are part of these councils on the life and general side, asking them for commission details. This, of course, after the RBI raised concerns, IRDA and its annual report has raised concerns. And of course, I mean, the DFS himself, the DFS secretary himself told us that, IRDAI is going to be coming out with draft regulations soon. That's the story. Any thoughts around this? I mean, because insurance, again, will be in focus on the bag of earnings, but there is this commission bit which perhaps will keep things, capped for now, for specific companies like PB Fintech maybe.
Absolutely, Prashant. And I think that's where the fear of the market is. I think if earnings probably remain capped to a large extent, the kind of valuation re-rating or the P multiples probably getting revised, the probability of that probably gets revised on the downward side. Having said that, I think we've all spoken about opportunities that both the life and non-life segments present itself. Private players making strides in terms of market share gains. However, I think this bit is something that might cap off the kind of incremental gains that would have been expected over the next few years. And obviously, I think the new income tax rules, how does that probably veer savings towards life insurance products, which is essential. But I think what probably happens in terms of growth for new policies, how does that impact the new premiums, and how does that impact the value of new business margins is to be seen. Out of the life insurance pack, I think SBI Life still has a relatively better parameter in terms of the cost dynamics. their commissions and other expenses are capped to higher single digit compared to the rest of the pack, including HDFC and ICICI Approved, which are probably around that 18 to 22% mark. So that is that advantage that SBI Life probably has.
Right.
Outside that, our own sense is that it might largely be a neutral in terms of earnings sensitivity.
Okay, all right. Mayuresh, I know you have to go. We had more questions, but maybe later. Thank you very much for joining us. It's always a pleasure. Well, CSB Bank management is now with us as promised. Third quarter business update came through. Stock was, it ripped higher yesterday. So gold loan segment, of course, has been doing very, very well. Deposits also grew about 21%. Pralay Mondal is MD and CEO at CSB Bank. And Pralay, good morning. Great to have you, as always, here on CNBC TV18. Wishing you a very happy 2026.
Good morning, Prashant, and happy New Year to you, Nigel and Rima, and all your viewers. Wonderful meet again. Thank you.
Thank you very much. You know, just for our viewers, Pralay, let me just put out the three things we're going to talk about. Will the gold portfolio continue to shine further in coming quarters? Will net interest margins grow further towards that 3.9%? And number three is asset quality reflecting scope for credit cost reduction. So broadly, I mean, we want to sort of, cover these three things in this conversation. Pralay, 46% jump in your gold loan book. It's now 51% of your sort of overall book. Of course, underlying gold prices have done so well. International prices up 65%, rates start to 26. So talk to us a little bit about your comfort level here. What is LTV now at? I'm assuming LTV would have fallen, right? As prices continue to rise. And any risks you see here at all? We had, by the way, Muthoot with us, I think, last week, and I asked them, in a way, the same question. And I asked them about risks as well, whether it's a segment which is kind of I don't want to use the word overheated, but heated certainly. So are there any risks at all from regulatory side? Go on.
Yeah, Prashant, I think what you're saying, we are all cognizant of that fact, and we are all taking our own kind of a risk mitigation to that extent. Depends on the risk appetite of respective institutions and banks. For us, we are not using pricing of the LTV as a kind of a component of growth, because our LTV, as you rightly said, has come down almost below 60% now. So we have a comfortable 15% margin on that LTV. Plus, for agri gold loans, it is much higher. So to that extent, we are sitting on a very, very high cushion and safety, and we are not taking growth at just because the prices are rising. So that's one. Secondly, the tonnage is also increasing. It's not that it's only growing by the growth. While LTV is falling on one side, the tonnage is increasing. So to that extent, and also these are short-term loans. So to that extent, we do our kind of a sensitive analysis of 10%, 15%, 5%, 3 kind of pricing. If it falls, what happens, what tenor, etc. And we are taking our tenors down. So to that extent, all risk mitigations are in place. So I don't see any risk at all in our particular portfolio.
Could you take us through, good morning, through the stress test then? If gold prices fall by 10%, they fall by 15%, they fall by 20%, the collateral buffer also vanishes. As you said, you've been constantly doing these risk analysis. Can you tell us what it throws up for your portfolio?
So, Rima, would know that now, as per the new regulation, the interest also is inbuilt into the LTV. And these are relatively shorter tenor loans, anything within 6 months to 1 year. And to that extent, if you take even a 5% kind of a fall or a 10% kind of a fall, we are within the LTV, well within the LTV. And let's not forget that LTV 75%, after that, there is another 25% margin. So that's the average. I think where the challenge will be for respective players is not looking at the average, but what is the marginal portfolio which is above, let's say, 75%, especially on the agri portfolio. And that's what needs to be monitored carefully. But for us, it's looking very, very safe right now.
Okay, so even a 5 or 10% fall in gold prices, you will still be within, at least for the gold portfolio, LTV of 75%. So that makes you comfortable. Also, one question, this 46% gold loans, what percentage of that came in from top-up loans? Because your existing borrowers can also borrow more against the collateral that they've given to you versus the new fresh loans on the gold side.
So as you know that this renewal or top-up is something new as per regulation, but Generally, the customer will close the loan and open the loan. So to that extent, within the system, it will show as a new loan, irrespective. And that's why we'll see that the disbursements per quarter, even if it's existing customer, is quite high. And when they take a fresh loan, the top up will be based on the LTV comfort which we have, which I've already shared in terms of what kind of LTV comfort we have. So to that extent, we don't measure that top up because they come it as a new gold loan. But next year onwards, I think rollovers and top ups we will start, and then we don't need to close and open loans again. So we'll figure that out next year.
All right. Hi, Mr. Mondal. Good morning and good to see you. And as always, I recall a conversation we had 18 to 24 months ago when I was trying to understand the business and explained it here on CNBC-TV18. And things have moved very, very well. Your market capitalization is more than doubled since then. That said, let's understand a couple of aspects. As you mentioned, gold loan, there has been a tonnage growth as well. So if you could quantify that for us, what has been the tonnage growth?
Tonnage growth has been relatively low. It is somewhere low single digits, I'll say. But definitely what I mean is that there is also a tonnage growth and new customers are coming in. So to that extent, it's low single digits. Yes.
Got it. All right. Now, gold is a large proportion of your book. And in the past, you have mentioned in the years to come, I think around 2030 odd, you were talking about the proportion of gold coming down as a percentage of the mix. How do things stand? And in the near term, going by the way gold prices are moving and the kind of interest you're seeing, maybe the gold percentage actually goes up, maybe towards 60%, and then it comes down. So tell us, as a proportion of business, how do you see it move?
So, Nigel, gold is a tactical play for us, but the real strategic play is building the wholesale, the SME, the retail, and all of these other franchise. And the big update about the bank is the entire tech transformation, which you have done, which I've been talking for a while. And now with 52 surround systems and core system migration to FC, Oracle, and with OGL, OFSA, many other things which are doing around it. I think we are now ready as a full-scale bank to launch the new products. For example, this quarter, you'd see when we give segment-wise analysis, when we show the results, is our wholesalers run very well, for example. So various franchises are starting to pick up. Having said that, we take it when there is an opportunity, and that's tactical from a gold loan perspective. But our future, we are not depending on gold loan. The second part is that also part of this growth you're seeing in gold loan because of a regulatory change which happened this year, which is repledger business. After 1st of April, we cannot book it. So what we did is we strategically are moving out very fast of that portfolio, which comes under retail. And hence, we are seeing some growth coming down in retail, but that's effectively gold loan, which is getting replaced by normal retail gold loan. So to that extent, I think our long-term commitment remains. We have to build our liability franchise. We have to build our branch banking. We have to build our wholesale SME and retail. But gold is a tactical play. Yes.
All right. Talking about it being a tactical play, I'm noticing that a lot of competition as well is eyeing this portfolio. So tell us about the competitive intensity. How do you see that panning out? And also, since there is so many new entrants coming in, there's so much of focus on the gold loan portfolio. Do you think that yields could come under some kind of pressure? Yes, you're a far cry away from the core gold financiers. But yet, do you think it could put pressure on yields?
I don't think so, because we are anyway much lower than where some of the other NBFCs and banks are in terms of yields. So to that extent, we are in a safe zone from that perspective. But Nigel, I'll tell you what interesting phenomena which is happening in this gold loan business is that ticket sizes are going up, and these are coming from SMEs. And a lot of these business loans are getting replaced by secured gold loans. And I think now the realization of the value of gold and from the SME working capital perspective is coming up. So my original thesis that we'll bring down gold below 20%, we are setting up a separate kind of a play on this new segment which is picking up, and that is something which will focus very, very strongly, which is working capital loans where gold is a collateral. So I see, and gold, how much locked-in value is there in the country today, including the SMEs and everybody. So to that extent, I think there is a large play out there.
Yeah, okay. Just to complete that point on gold, Pralay, you said gold tonnage growth is low single digits. What about members in terms of the member base?
The numbers of customers we are not growing that much because we are increasing the ticket size. not based on pricing, but based on the segments which are covering more and more, because the smaller ticket size generally don't come to us. They go to the higher yielding kind of NBFCs and institutions.
But Pralay, you're saying that tonnage growth is very low. The number of customer growth is very low, but loan growth value is very high. So is that, how should one read it?
So tonnage growth is around, what happens is tonnage growth, it's not that when gold prices comes down or remains stable, then tonnage growth will also pick up, because finally tonnage is based on what working capital or what requirement you have. So people will give more gold to you to get higher kind of a loan. So to that extent, it's not directly correlational to the tonnage to the value. And my thesis is that once the gold prices starts coming down or stabilizes, the tonnage growth will automatically pick up. Customer addition is our own play. It's not that we are not adding customers. We are adding different segments of customers where the ticket sizes are larger. And as I said, that our LTV is pretty low, and new LTV is actually around 60%. So to that extent, I think we are not taking that play so much on the pricing. We are taking the risk parameters pretty well.
What is the average ticket size for you?
Average ticket size will be, I think, between 3 to 4 lakhs.
3 to 4 lakhs. Got that. We quiz you a fair bit about gold and gold loans, but that's the segment which is doing phenomenally well for you. We wish you all the best of luck. Thank you very much for joining us here this morning and running us through what you see going forward. So that is CSB Bank has done extremely well. We'll take a break. We're back. Hormuz with us with the big movers from yesterday. Stocks with price action and volume action as well. We'll also connect with Sudarshan Sukhani and Mitesh Thakkar on technical trading ideas. Stay tuned. Coming up.
Welcome back. Let's prep you up for today's trading session with the big movers yesterday, which saw very heavy volumes, price action. And let's see what the momentum can continue in these stocks. Harmis.
Rima, and CSB Bank, you just heard from the management, but the price action yesterday was something to tell. 16% higher on the stock yesterday. It was the biggest single-day gain since its listing back in 2019. The Monday's volumes, they were the highest since its listing day, which was back in December of that year. Close to 1.5 crore shares were traded, a 20-day average of around 4 lakh shares. 22 lakh shares marked for delivery compared to a 20-day average of just around around 2 lakh shares. And the stock in the last 12 months has gone up by almost 75%, including yesterday's move. Tourism finance was a stock in focus yesterday, remains in focus today as well. Ekta Halwasia has remained a buyer for the second day in a row. Monday's volumes were 2.5 times of that of Friday when the stock ended in a lower circuit. Yesterday the stock ended in an upper circuit, and almost 11 crore shares traded, 20-day average of around just 80 lakh shares, and out of those 11 crore, 3 crore were marked for delivery, the 20-day average of around 36 lakh shares. And over the last 12 months, the stock has almost doubled in value. And lastly, Sai Silks Kalamandir, the stock was down 12%, is the top loser on the small cap index yesterday in reaction to its business update. And the stock, the biggest single day fall since September of 23. Monday's volumes were the highest in the last 3 months. Almost 62 lakh shares were traded yesterday on Sai Silk, 20-day average of just 6 lakh shares. And out of those 62 lakh shares, 24.5 lakh shares were marked for delivery. Their 20-day average is just around 2.5 lakh shares. And as a result of yesterday's fall, the stock is down almost 40% from its IPO price, which is around 220 rupees.
Thank you very much for that. By the way, Asia is continuing and extending the global rally. Strong gains yet again. Hang Seng up 1.5%. Nikkei, that's the Japanese market, which closed up with a gain of 2.5%, has added on another half to 1%. And Taiwanese markets too, gaining close to about 1%. GIFT Nifty, there you have it, up 50 points. Get into break. On the other side, we'll get you more on the pre-opening rates. We'll connect once again with Sudarshan Sukhani and Mitesh Thakkar for some technical trades.
Welcome back. Sudarshan Sukhani is with us, and so is Mitesh Thakkar with what they'd want you to do as far as trades this morning go. Gentlemen, good morning. While the Nifty sulked yesterday, broader mid and small cap price volume action did not look discouraging in that sense. Actually, it was a pretty buoyant screen. What would you do? Sudarshan, you go first. What's the sense? Indices first.
Yeah, good morning. See, we had two big, large range days of big rallies last week. So the markets will have a pause. They will do some corrections of some kind. Sometimes they become choppy intraday. And that we have to accept. It's something very normal. So the trend continues to be up. Any index that makes lifetime new highs should be bought into. Now, 2026 could be different because normally we have that Santa Claus rally, which we talked about. Apparently, we could be having it post Santa Claus. I would be a buyer in the Nifty. The Nifty has been making higher lows. It's making a lifetime high. All the environment is ready for a decent up move. Every dip is a buying opportunity.
What about Mitesh? Come in. What's the call on the Nifty for today, for the near term? Any trades?
Yeah. So, yesterday we had some kind of a decline, but looking at the structure, to me, this looks like a pullback. For example, Nifty, had multiple tops around the levels of 26 to 20. And I mentioned upper end resistance, which is the upside sloping line at about 26,400, 425 zones. So we kind of came back from 26,370, but did not break below this 26,200, 220 zone. So unless until we break that, I think this will be a buying opportunity. We will have a stronger breakout in case the Nifty, starts to go up and close above 26,430. Then I would even look at 26,950, 27,000 as the target area. But for the time being, around 26,220, longs can be taken with a 50-odd point kind of a stop.
What about stocks, Mitesh?
Yeah, I have 3 buys and a sell. On the buying side is Bosch. It had a big breakout kind of a candlestick move, which happened on Friday, and then yesterday was more of a subdued movement, sideways activity, but it should resume its uptrend again. So buy here with a stop at about 38,750 for targets of 40,000. Chola Finance is a buy with a stop at 1754 for targets of 1815. Also a buy on Cipla. Keep a stop at 1507 and look for a short target of 1545. And one sell call. I think Cummins has had a breakdown kind of a chart structure. So sell on a mild pullback, say around 10-20 points higher, 43.20, 43.30 being the selling range. Keep a stop at 43.75 and a target of 4225 is what I would.
Okay, all right. Got that, gentlemen. Sudarshan, what about you?
Well, it's an all buy list. Siemens is a buy with a stop under 3,030. Balkrishna Industries is a buying opportunity, stop under 2350. MFSL Max Financial is a buy with a stop under 1675. And finally, BSE is a buying opportunity with a stop under 2625. My algos may be having a position in BSE, but generally I'm on the long side.
Eastern pre-open, HDFC Bank is suggesting a further downtake, so that's down 1.5%. And that's the reason why the Nifty and the Sensex are also absolutely flat. It's not showing the optimism that the GIFT Nifty showed. And Trent could weigh on, on the markets today. Trent in pre-open is down nearly 3%. Gentlemen, technically, Trent, Sudarshan, go first.
Trent is a complete avoid. I would not go for it. It's not done much. It's been a dismal underperformer in different periods. So it's a complete avoid for me.
Mitesh, is there a trade either on the downside or is there an opportunity to buy into the correction when it comes to Trent?
Yeah, I think the stock has corrected big time from 6,200 to about 4,000 and then it's trying to bounce back. Now today will be a pullback to the short-term averages. In case I get an entry closer to about 4,300, I think that's when a long entry is what I would recommend. And on the upside, it will be very difficult for the stock to get past 4570, 4600 zones, but that could be the target area. So try to buy it around 4300, take a 70, 80 point kind of a stop loss, and 4570, 4600 is the target area.
Okay, all right. 10 minutes to go for the market open. Pre-open is kicked off, and we'll have some of those rates come up for you in just a bit. From 60 points lower, 26,190 on the Nifty. Well, what are the brokerage calls of the day and what you should pay attention to? Sudarshan is here with exactly that. So over to you.
So first one is Jefferies has initiated coverage on MV Photovoltaic with a buy call and target. Here is rupees 320 per share. It says solar installations are set to grow at a 24% CAGR over FY25-28, and company's early entry into TopCon superior DCR-driven profitability and healthy balance sheet give competitive advantage to the company, and also industry profitability should normalize by FY28. It projects 56% EBITDA CAGR over FY25-28 and price company at 9 times forward EV to EBITDA. Next one is on Maruti. HSBC has a buy call and target has increased to 18,500 per share. It says market share for the company has normalized and it's back to 40%. And with all these stars are aligned, Q3 and Q4 margins will be very critical. If company reports margin below 10%, that would be disappointing for the market. But as far as the demand is concerned, it remains very strong.
Okay, all right. Thanks a lot for that, Sir. Hop across to Ekta. Citi has written a note on Divi's Laboratory. Ekta joins in to tell us about that. Ekta?
Well, yes, Citi has a buy with a target price of 9140. What they've said is that 2026 can be an inflection year for Divi's. The company has a strong pipeline of catalysts over the next 12 months, notably GLP-1 as well as contrast media products. Various custom synthesis products are also maturing, according to them, and may be commercialized in the near term. The generic segment too is expected to witness a recovery in 2026. The quarterly numbers may experience volatility and present forecasting challenges, according to them. Medium to long term, the story remains intact. They believe Divi's revenue EBITDA can expand by 3 times to 4 times over FY25 to 30. FY27, FY28 EPS is estimated to be 10 to 8% ahead of consensus, respectively.
Okay, all right. Top pick in the pharma space for 2026 from Citi. Ekta, thanks very much for that. Petronet LNG is the next one in focus. I'm not sure if it's great news here. Sonal is here with what's happened. Sonal, over to you.
Good morning. Yes, it is not so great news, but it is just a draft. So to put things into perspective, PNGRB, which is the regulator, came out with a paper. They've analyzed various costs for all the oil and gas players. It would be something like the upstream segment, transmission segment like GAIL, marketing, regasification, the taxation aspects as well, to figure out whether they need to see more compliance in different players or not. They have made some recommendations now, basis the cost analysis. It would be around APM allocation for all the city gas distribution companies, rationalization of taxes that are seen across the value chain, and also regulation of regasification. Now remember, gas is imported in liquefied form. It is regasified and then transported in the country, which is done by Petronet LNG, the regasification bit, which is now not regulated by the PNGRB. It is basis the market forces, but they are now talking about regulating it. So Citi says it is once again underscoring the PNGRB's belief that even regasification terminals should come into regulation. And that is something which the investors might not like, because it would create a lot of compliance issues. Plus, there could be some caps as well on tariffs across the board. They maintain the view that regulatory and competitive dynamics could shift the bargaining power in the favor of competitors of Petronet LNG's off-takers, and not so much beneficial for Petronet LNG itself. Potential renegotiation risks are there to Dahej regas tariffs for the renewed Qatar contract, because there could be a possibility of tariff caps, and that is something which will not be good for Petronet LNG. Just a paper yet. If it does get finalized, Petronet LNG will be in focus.
Thank you very much for that. Back to Trent could once again be the stock of the day, down 3% in pre-open. Manglam, you were telling us 17% growth doesn't quite cut it.
Well, it doesn't, and in fact, the stock is now settling 5% lower in pre-open. The volume's also decent, but we'll have to see where it goes when it actually opens, for the simple reason that the stock, one, has corrected about 41% in 2025, but at the same time, from its lows of around 3,900, the stock has also seen a rally of about 10%. So just to once again reiterate those numbers, it's a 17% growth that the company has reported on a standalone basis. What's good about this quarter's update is that you have a higher number of Westside and Zudio stores added than expected. So store addition is a positive. But if you took all the stores that were added in the last 1 year, it would appear that with the revenue growth of 17%, there is a negative same-store sales growth and reduction in sales per square foot also. The company at the start of the financial year had said that maybe 20 to 25% is the sort of revenue CAGR that the street should adjust itself to. That itself was lower than the over 35-40% CAGR that the company was reporting in the previous 3-4 years. So the street was adjusting to that, and just as that happened, the last 3 quarters, the revenue, including the third one, have not crossed 20%. It's between 19, 17 and 17% itself. So where it grows from here is something that the street will definitely eye. Another aside on Trent, at peak, the stock was trading at around 140 times earnings, a little more than that as well. And the street was comfortable with that because the growth, the EPS CAGR was much higher, and as a result of which the price earnings growth, the PEG ratio, was a lot more comfortable. But now as we speak, even if we're looking at EPS CAGR of about 25%, the stock trading at 70 times, the PEG ratio is a lot lower than what it was when the stock was at 140 PE, which is what explains the disappointment on Trent stock.
All right, Mangalam, thanks very much. But Dabur is the other one, right? This one also maybe needs a bit of a Chyawanprash boost.
Chyawanprash boost, or maybe some bit of Dabur Active juice as well. The reason why I say that is because the weakest part of the portfolio this time around has been beverages. The other parts of the portfolio have done well, which is why the company has reported mid-single digit sort of consolidated revenue growth. The EBITDA and the net profit have continued to grow ahead of revenue, which means there is margin expansion. So these numbers aren't particularly bad. My sense is that Dabur will see a recovery because the third quarter also saw an impact of trade, taking out inventory, high-price inventory in the month of October. November and December is where consumer sentiment saw improvement. Home and personal care business actually reported double-digit growth. At the same time, we saw decent growth come by in their healthcare business as well, maybe because of the Chyawanprash. But the beverages business, the juices portfolio, took a hit because of adverse weather, which is why the stock is settling mildly lower in pre-open. But let's see where it goes from here.
All right. Thanks very much for that. That's Dabur, which is in focus. Let's look at a few other names, right? Maybe why not just look at the top 10 list of stocks that we put out in the morning for a quick pitch. So maybe IndusInd Bank should come up. Yeah, there you go. Kotak Bank, Axis is up about 1.5%. L&T Finance is up about 1.25% or so. And there is IndusInd, which is down about a quarter. Tata Motors passenger vehicle business also came through. And there is some amount of pressure there. What else? Adani Ports is down about 0.25%. IEX, where there is a case comes up in the appellate tribunal. Dabur, of course, Mangalam just highlighted as part of the list that we put out in the morning. So that's a bunch of stuff coming through. I suspect, once again, with the overnight rally we have in commodity prices, especially copper, and we should look at, maybe Hindustan Copper should come up on your screen.
Hindustan Zinc.
Hindustan Zinc is the other one. Silver, right? Of course, the entire commodities complex, Vedanta, Hindalco, Nalco, etc. have done phenomenally well. Already, it's about 6 days into 26, and they've already, I think, notching up gains. So keep an eye out in the metals pack once again as we start.
2025 was the first year since 1980, if just going by what articles say, where gold, silver, and copper all simultaneously hit record highs. But usually, because copper and precious metals give you contra signals on the macro front. Copper does well when growth is higher, you're positive about the economy, and generally precious metals did well when you were negative and you feared recession and it was seen as a safe haven buying. But last year was the only time since 1980 when all three hit record highs. By the way, just one word on IT. Yesterday, it was a cautious note by CLSA where they said trim positions in IT after a 14% rally seen in the Nifty IT index in the October to December period. Today, Jefferies has come out with a note, and they're saying the risk of earnings downgrade still remains. So their argument is that in FY27, growth will pick up, but it picks up only to 4.7% on an aggregate basis at the headline level. But this is still lower than consensus expectations of 5.5% to 6%, which means there is a risk of earnings downgrades, which could then put pressure on the PE multiples. So that is just the limited point, as we kickstart the earnings season from next week for IT.
Yeah, no, absolutely.
5 seconds to go.
5 seconds to go. First rate starting to come up, and we should be on our way. What do we have? First rates in 70 points, 85 points lower on the Nifty. The Sensex is down about 300 points, and Nifty Bank down about 0.18. So just starting slow and sideways. The small cap index is up about 1/3%, and the mid cap index should come up on your screen is down about 0.16 as well. So no great shakes. It's a quiet, grinding kind of start, at least on the indices. Let's see what's the picture like as far as the Nifty 50 heat map is concerned. How many up and down, and then we look at individual single stocks and how they are all starting. What do we have? HDFC Life on one end, Tech Mahindra, Kotak Bank, Hindalco, Bajaj Auto. Very few names in the red. So bulk of the Nifty stocks are higher, and the Nifty itself is down 25 points. Trent and Reliance, I think the fact that RIL is down as a heavyweight, perhaps adding to a bit of pressure at this point. But it's not much. I mean, it's just about 20 points, less than 20 points now. So coming up very, very fast, very, very quickly. But this is the first minute and a half we're talking about as far as market opening goes. Rima.
Well, let's just delve a little bit more in the Trent's price rate. Trent is now down 8% at opening, taking its one-year loss to 42%. The street does not like the moderation in growth. In Q3, top line went up 17%. In 9 months, FY26, the top line growth is about 18%, lower than the 20-25% that the company was signaling in terms of a long-term, medium-term kind of an earnings growth, and much lower than the 39% top-line growth that they clocked in the period of FY20 to FY25 when the company was a growth beast. So the street is punishing Trent, still down 7.5%. The other problem is Reliance Industries. Reliance Industries is down 2.5%, and HDFC Bank has lost close to about, 4% now, 4% plus in the past 2 days. Yesterday also it was down more than 2%, and it's seeing follow-through selling pressure. Tata Motors passenger vehicles December update in terms of sales didn't look good, and that stock is under pressure. Adani Ports has had a flat opening. They too came out with their update for the month of December. Well, the key takeaway is that container, which is the growth engine, is doing very well. That's up 8%. But the overall cargo growth is at 9% because bulk rail is seeing a bit of a sluggish growth. On the way up, it's the two banking names, particularly Axis Bank and ICICI Bank. Let's get the early rates up. Now it's settling. Kotak Mahindra Bank is up over 1%. Axis Bank has a gain of about 0.6%, but they're being supportive. Commodities are having a good start to the trading session. Hindalco is one of the top gainers today. It's hit a fresh 52-week high, 950 almost on Hindalco. Tata Steel opens up in the green. We should pull up SAIL as well, where the quarterly update looked pretty healthy. And HDFC Life, Apollo Hospital count as some of the other big movers. And ICICI Bank too. In fact, the entire private sector complex minus HDFC Bank is having a good start.
Well, that's right. Exactly a month ago, we here at CNBC-TV18 had put out this piece on aluminium stocks. And from there, some of the stocks that Rima mentioned, Vedanta, Hindalco, as well as Nalco, they're up between 18 to around 24%. So that's the kind of move that we've seen on aluminium. And the reason we covered aluminium was because, there are more number of stocks with exposure to aluminium. For copper, the sole player on copper is Hindustan Copper, and that one in fact is up close to around 2.5%. A few more stocks on the broader markets that are calling for attention. KSH International stock is moving up on massive volumes. They came out with their Q2 numbers yesterday actually. That's the Q2 FY26. Revenues are up by close to around 50%. EBITDA is up, I think, by close to around 74%, and the EBITDA per ton has gone up by 40%. So KSH, that's one stock that's buzzing in trade. Another one is the stock that Sudarshan mentioned. Jefferies, they have initiated buy on MV Photovoltaic with a target price of 320 rupees. The street is taking note of that. That stock is well in focus today, reacting to the Jefferies note, MV Photovoltaic. So let's get that one up for you on the screen. Kandar Oil, well, that's a stock that was up, I think, 16-17% yesterday. It's building on the gains today as well. Stock is up another 6% as we speak. So big up move is what we're seeing out there. Cupid, well, that stock has bounced back now after a couple of days of drubbing. It's up close to 7%, one of the top volume movers in today's trading session. I'll tell you what, on the Nifty, if we have to see a recovery, two of the large weighted stocks will have to give their underperformance. We have Reliance Industries that's down close to around 3%. That's weighing on the index, and HDFC Bank for the second day running. So the Nifty, if it has to recover, then we'll have to see both these two cut off their losses, because put them together, that's more than 20% of the index that's down 2.5 to around 3%.
Even Dabur is down, 2.5%. It's reported they're expecting a mid-single digit kind of a top line growth in Q3. Rural demand is outperforming. Street doesn't like it because you're still not seeing a full-fledged, full-blown FMCG recovery despite all those GST revisions. So I thought they were okay, but the street is hitting Dabur right now.
Well, I think, across it's basically slightly sideways, right? 60 points down, and we're now starting to settle in. So the cheer we are seeing around global markets in Asia, etc., and most global markets have had a pretty strong start to 26, which is a repeat of what we've had in 25. And here in India, we're kind of repeating what we've done in 2025, which is not very much. So sideways, 26,200 with a 50-point dot cut. Market breadth is 1,100 up and about 1,300 lower. That's the NSE tally at this stage. I think the outsized pressure is coming from Reliance, which is down 3% this morning. So RIL is, I think, largely the reason why we are seeing this pressure, which is come through. It's a stock which has basically started the year with high hopes. Almost, I think, did we get to all-time high in Reliance? So the high was about 1609. We made a new all-time high. We made a new all-time high yesterday. 1611, 1612 was a new all-time high in Reliance, and now we're turning down a little bit. So about 3.33% down on this one. Trent, of course, we've highlighted. Vari is another one. Swiggy is down 3%. CSB, but CSB, etc., had such a vertical rally, right? From 400 rupees to about almost 600 in 10 trading sessions. So that is understandable, a bit of a pullback. Premier Engines and and more. Godfrey Phillips is down about 1.5%. Saman Capital is down 1.5%. KPI Green, Petronet Sonal was highlighting 1.5% lower. Devyani, where there's been news flow, 1.75% down as well. More down than up, certainly.
Even Merck Electronics, Nimesh was highlighting it
Yeah.
in dealing room chatter, where there is a possibility of a management rejig. Yesterday, stock was locked in an upper circuit of about 10%, and today as well, lots of buying, stock up nearly 5-6%.
Yeah.
Merck Electronics, there you have it.
Yeah. Okay, well, let's get in Venugopal Gare, who's with us. He's Managing Director, India Head of Research at Bernstein. Venu, good morning. Good to have you with us here. Wishing you, your team, your family a happy 2026. Look at sell side. We've had upgrades, not downgrades, after the lackluster performance in 25, Venu. So your call in that sense stands out. So run us through, although if I look at the Nifty targets, etc., it's not as if others who upgraded the view are expecting, a big year in 26. They're all expecting 10-12% kind of growth. I think your target gives us about an 8% upside. So that's the short preamble. I'd like you to explain, Venu, what led you to this downgrade?
Yeah, so it wasn't planned as a non-consensus view. Probably it just ended up happening like that. But I'll give you a very interesting context. 2024, I'll just bring you back 2 years back when everybody was positive on the market. I had started the year with a book profit call. And interestingly, I had an 8% Nifty return target of 23,500 that calendar year. And we all know what happened that year. Things started to peak off and materially correct in the second half of that calendar year, both from an earnings standpoint and a valuation standpoint. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end and macro is going to start to recover. Rates will start to get cut. We should be selective buy. And selective buy was largely with the view that SMIDs were still very costly. Heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back, and not a book profit call or a sell call, is simply because I guess things are slightly different at this juncture, where macro, while has peaked at around 8% GDP growth rate, is going to only fade out to a 6.5% growth over the next few quarters. So we're not really seeing any major macro collapse. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth. A lot of shift of the burden of economic growth has to shift to private sector, which may not yet be ready to handle that. Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. And lastly, the main point is this, that even this 28,100 Nifty target 8% return was after factoring in 13.5% earnings CAGR over 2 years and using a 19x multiple on 2-year forward earnings. So by the way, that's not like, conservative at all. And yet you get a very modest return. So that was a challenge we were finding at this juncture to get returns.
So Street was banking on earnings growth to provide the fillip to the Indian markets to play catch up versus the rest. But clearly 13.5% earnings CAGR over the next 2 years is not going to help us give very strong return. Wanted to get your view on real estate, because you've upgraded real estate after the underperformance seen in 2025. Now, the question is, from 2020, which were the post-COVID lows and bombed out, real estate gave exceptional returns from 2020 to 2024. And we've had only a 1-year period of correction last year where the Nifty Realty Index and stocks were down 15-20%. I mean, has it corrected enough? What is the call behind real estate?
Yeah, so I'll bring this to a very interesting situation. When you expect broadly high single-digit or meager returns in India, it becomes very interesting in terms of how to essentially pick stocks. One of the key things that we saw last year, there was a separate report we wrote in terms of decoding 2025 performance, was the aspect of catch-up trades. So catch-up trades did meaningfully well, which is essentially stocks which didn't do well in 2024 but started to recover in 2025. And honestly, there wasn't an earnings growth anchor or an earnings revision anchor. These are just catch-up trades. Now, interestingly, when we saw last year, there were two sectors which were absolutely the worst performers, which was IT services and the second being real estate. So what we felt is this, that real estate broadly, if we were to just contextualize it, is usually when cycle starts, it lasts for 6-7 years. We saw a period of positive activity, and that's because it came after several years of a downturn. And you have a period of digestion. But when you look at earnings growth over the next 1-2 years, they are very different, or rather in a positive sense, still positive and a decent growth compared to what you would have probably seen during the phase of downturn. And you've essentially seen a major correction in terms of stock prices. There's the worst performers last year. Plus, the fact that these are also considered as interest rate sensitive sort of sectors. So as rates continue to moderate, we expect another 50 basis point rate cut this year as well. We think that probably this sector would see some degree of a lift. Remember one thing, that overarching return expectations are not very high for us across the board. So even in a positive return sector, we're not expecting a 30 or a 40% return. It will be better than the 8% Nifty returns.
Okay. All right. Hi, Venu. Good morning and good to see you, Ben. So you're guiding for returns on the Nifty for the next couple of years at around 7.5 to around 8% or thereabouts. And that's how we get to the target of around 28,000. Got that. The other, debatable issue is what's going to happen next and how soon are we going to get a deal with the United States? How big a positive catalyst will that be? And will that alter your view from this neutral stance?
Yeah, so we have factored India-US trade treaty to get signed this year, and that too within the next few months, based on whatever sound bites we've got. Fundamentally, the challenge that I sort of see at this is that it is a narrative or a positive narrative only for a few days than anything else, not more than that. And simply because what we've learned over the last 12 months is very simple, that unless you are, as a country, associated with a particular camp, which is US, I don't think this trade treaty can be believed to be sustainable. It can continue to change through the year. So that's a fundamental issue I have, that that this is going to be just a point trade treaty than anything else. Also remember from a relative perspective that the broader deal with China has continued all the way till November of this calendar year. So it's not that from a relative perspective, we're going to be primarily viewed as a country where FDI should improve, or there'll be massive swath of manufacturing because India identified as the next China plus one. I don't think all of that is going to happen. So this treaty is essentially going to lead to two things. One, a small up move in the market, currency to appreciate a bit, which is rupee, just a bit, when it happens. That's basically it. And the way I'm hedging primarily this particular event is through the IT services overweight trade.
Yeah, that's an interesting viewpoint, right? I mean, so we know what you're saying is you've got to be unambiguously, clearly in the US camp otherwise it's more transactional and it'll go up and down through the course of the year. Even if this, some sort of an agreement takes place in the next couple of months.
Yeah, so I don't have, look, I would love to have this as a sustainable trade treaty, but I don't get the comfort today that 2 months down the line, something changes. So that policy volatility has been a feature of the last 12 odd months.
Yeah. No, absolutely. Just a quick word, Venu. Lots of global thinkers are of the view that 25 was the year of, AI infra kind of names, right? I mean, the actual, the chip makers and the data center guys, I mean, physically and otherwise. And now it'll start to turn into, maybe it'll not happen this year, but next year, maybe it'll start this year. It's going to be AI adopters, cost optimization, etc. People are already starting to attribute, different percentages to, growth per se because of this. Cost ration. It's basically at the expense of labor costs. You think that will work out here in India? Have you thought about it? And which segments will benefit the most?
Prashant, the interesting thing is that we are way far behind at this juncture with respect to AI implementation across the board. If at all you're seeing AI implementations in a meaningful perspective, probably happening only in the technology world, which is tech companies adopting it first. Real world implementations are extremely meager. So what it means to me is that this is not a 12-month story or a 24-month story also, in terms of being able to generate or eke out enough efficiencies for you to see margins improving, or for you to see enough positives that can be deployed by companies to get volume growth. Not at all a story for the next 24 months. I think for India as well as globally, it's going to be a very slow adoption. A lot of adoption probably in 3 to 4 years will become meaningful. A part of that is also because technology itself and AI solutions itself haven't stabilized. So you need to see a situation where corporates are fully convinced that this is what we need to implement.
You don't think, Venu,
Otherwise, you don't
financials, for example, financials is the area? I mean, at the end of the day, you need large data sets, right? And who is larger data sets than banks and financials generally? I remember having this conversation with the L&T Finance Management, and they spoke about AI quite a bit and how they've implemented it. You don't think that's a pack kind of sort of which comes up first? They've already adopted in many ways, but maybe it'll get done more.
I mean, we call it AI now. It used to be machine learning earlier. So this is just a change of a name than anything else.
You know, one counter argument for a bullish view on IT is that increasingly companies are still spending a lot on hardware. Memory prices, for instance, now have gone through the roof. They've practically doubled. So basically, they're just crunching what would have otherwise maybe come to services, and that hardware spend by companies will continue. So again, just prolonging when discretionary spending for Indian IT services will make a comeback. But you've also downgraded, Venu, to consumer. You've downgraded consumer staples. Now, you know, one part of the camp believed that with the interest rate cuts, the GST rationalization, the tax cuts, all this will flow through and benefit the consumer staples. Volume growth will slowly pick up. Rural was anyway doing okay-ish, but even urban will now show some signs of life. So explain to us the rationale behind the cut in the downgrade in consumer staples.
Yeah, so it's a very interesting theory I had. So I was a bit non-consensus when I upgraded consumer staples sometime in April or May of last calendar year, just ahead of the monsoon season. And broadly, it's about volume growth. It had nothing to do with GST because we didn't really know at that point of time that GST would get cut, but the idea was policy will be pro-consumer. Now, fundamentally, if I were to just think about it, the sector has done nothing much, through the year. Volume growths I guess, will inch up a bit, but not material enough for me to get excited. That's number one. So there will be an inch up in volume growth as you see the quarter or two pan by. But fundamentally, the challenge is that this year, when I look at the fundraising happening in, for example, the quick commerce sector, so Swiggy has raised money, and I think the third largest player has also filed a prospectus for raising money. So a lot of money flow will happen on quick commerce investments, which is not essentially that positive for incumbent consumer brands because it does create a pathway for, smaller brands to also be visible in terms of presence. So this competitive angle as well sort of, questions and worries me at this juncture. The other part is I don't know how rural and monsoons will shape up this year. Initial sound bites have been very mixed. So that's another concern today. So it's very hard to take a proactive, positive view at the beginning of the year, especially when valuations are not cheap at all.
All right. Venu, one quick word. The RBI has turned pro-growth, right, for the last many policy meets that we've had, the commentary as well as, the cuts. How many cuts are you all penciling in for this year?
So for me, roughly 50 to 75 basis points depends on, quantum of cuts, but whether it is 25 each. So that's the number that I have in mind. I guess it's going to be difficult to do anything meaningfully beyond this. Part of that is also to do with currency and how well you want to manage your currency.
All right. So 8% CAGR returns on the Nifty. The contra bets will be tech as well as real estate. And in the consumption pack, you prefer discretionary over staples.
So leave us with a slightly upbeat something here. This is like
I call in a very simple way that 8% return is a great return, number one. Number two is this is not...
That's not helping. That's not helping. 8%. Go on. Sorry, I'm joking. Go on. Finish the point.
So I have a lot of buy sectors still, right? Financials is a positive sector. Telecom is an overweight sector. Consumer tech is an overweight sector. And two more sectors, IT and real estate, have moved to a mild overweight. So, I mean, honestly, that's a good enough broader, aspect. The second positive, if at all, is the fact that economy is not like in a very bad shape. Ignore the 8% context of where GDP is, because it doesn't feel like a 8% GDP. But if you look at a lot of data points in the near term as well, things have been okay in the economy. Yeah. So we're not falling apart. Remember, this is very different from 2024. We are not collapsing in terms of macro or earnings. We're just in a stable situation. That's basically it. And remember, there's a lot of IPO and fundraising activity this year. Think of it in positive lens. Of course, it does impact valuations for the broader market, but you get a lot of new opportunities to invest in. So if you want to leave on a positive note, perhaps you get a lot more new stocks to assess and invest in this year.
That just sounds like more work to me.
No, absolutely. But yeah, I mean, it's how you frame the question in your head. But, numbers, returns, we will track. And we'll invite you back, Venu, through the course of the year. This is the first conversation of 26, many more to follow. Venu, thank you very much for being here on CNBC-TV18. So that's Venu Gopal Garre of Bernstein, with that perspective on markets. But we had HPCL yesterday with us, and we have Oil India today.
Indeed, Oil India is the next management on the show. The stock is down 8% in the last 1 year. In fact, the company had cut down the oil production guidance to 3.55 million tons versus 3.8 million tons in Q2. To discuss this, the impact on the U.S. action on Venezuela, we're now joined by Dr. Ranjit Rat, Chairman and Managing Director at Oil India. He's also the Chairman of the Numaligarh Refinery. Thank you very much. Happy New Year to you, your family, and the entire team. What we'd like to discuss with you is that will more crude supply come to the market post the U.S. action on Venezuela? Just get your thoughts in on what's happened geopolitically, the production targets for FY27, and finally, the crude pricing outlook. But Doctor, just beginning with, what's happened with respect to Venezuela, because you all have a very small, I believe, 3.5% stake in Carabobo project through your subsidiary. Do you all have dividends which are stuck? If yes, can you quantify what is the amount that it's been, stuck in sanctions? And if, indeed, this project now resumes with, U.S. taking over, what would be the new investments you will require? Would you be asked to pay up your share of CAPEX?
Okay. First of all, thank you very much for this longest answer. I will break it into small pieces and then able to answer you. And yes, a happy new year to all of you in the studio and to all your viewers on behalf of Oil India Limited. The first question is the future outlook of crude. Can I take that first or the other one?
No, let's start with Venezuela and your presence there, exposure.
All right. So yes, we have a stake, 3.5% in Carabobo field. The current investment exposure is about $60 million US. And yes, one thing is for sure, while we will wait and watch the developments there, the production possibilities now looks better, and which is good for our investment terms. And should there be a requirement, we would like to enhance our investment, because that's what is needed to enhance production from this excellent field that Venezuela is having. The prospects are good. So I am sure it will take some time to stabilize, to kickstart the production or to ramp up the production. So we will wait and watch. And should there be a need, yes, we will invest.
Okay. And when you say your exposure is $60 million in the Carabobo, is that the stock dividends?
No.
Or is the amount that you've invested so far?
Invested so far. Okay. What is required is we have to ramp up the production first. So the current production level is at very low. So we do foresee there is a good opportunity sitting there.
Okay. And are there any stock dividends? Because we understand some of the other, none for you.
Nothing pertains to Oil India Limited.
Got that.
Okay. All right. Hi, Doctor. Good morning. And good to see you, Ben. Let's talk about the operational efficiency then. You drilled around 32 wells in the first half of the year, which is in line with the target. What is the target for the remainder of the year? And how much will you be able to do? Give us your guidance with regard to production targets, both on gas as well as on oil.
Okay. Excellent. I'm glad that you have started the question with drilling, which is closest to my heart. Slight corrections. As we speak, we have already completed 50 plus wells. And I should be able to explain you a bit. When we say drilling, the drilling component comprises of three parts. One is the rank exploration, which is currently going on in our exploration license fields, which includes our offshore exploration efforts, both in Kerala Konkan and in Andaman shallow water. As far as near field exploration is concerned, that's where we do exploration and exploratory drilling to resurrect or to kind of ensure accrual of additional oil as part of our reserve replacement ratio. As far as development drilling is concerned, that remains our focus in order to enhance our production. Therefore, these three buckets of drilling, this year our target is 80. And just to give you a perspective, 3 years ago, we were drilling about 30 to 35 number of total wells. This year, our target is 80. We will definitely cross 70, 75, that's for sure. Because as we speak, we have already completed 50 plus wells. Having done this kind of drilling, we are looking at two things. One, we should be able to maintain the production level. But before that, I must tell you, being part of mature fields that we operate on, we encounter a decline of pressure decline rather, which leads to production decline about 10 to 12%. So first is, as part of our reservoir management principle, we undertake very aggressive workover and development drilling, which leads to arrest of these production decline 10%. And on top of it, our guidance this year would be about 2 to 2.5% more. Last year, we did 6.71 million metric ton of oil and oil equivalent, which is both oil and gas included. Highest ever. And this year also, we aim to surpass that number.
Okay, all right. And to split it up, sir, earlier you were talking about oil production, I think 3.55, and gas, I think it was around 3.6. So ballpark, that should be the guidance, right?
That will be the guidance.
Okay.
The best part is we are also looking at cost optimization, which you touched subtly, as part of our efforts to enhance a kind of financial prudence.
Okay. All right. All right. Doctor, just one more point I wanted to ask you with regard to the Numaligarh refinery expansion, the timelines, the expected distillate yield. What is the capex that it's been made? How much more is expected? And how is the ramp up expected on this particular refinery?
Okay, good. I've got a good news to share. This is already a public information. As far as the commissioning of the 9 million ton capacity expansion is concerned, we have kick-started the commissioning on 31st December as promised.
Yes.
That means the mother unit, that is the crude distillation unit, we are already having crude in. Now, as you would appreciate, the entire process of commissioning of all the units will take about 6 to 9 months, and then another 1 quarter or so for stabilization. As far as capex is concerned, we are looking at a total capex of about 40,000 crore, which includes the refinery, 9 million ton complete, the Paradip Numaligarh crude oil pipeline, 1640 kilometer, 1635 kilometer complete, a polypropylene unit, 360 KTPA, juxtaposed to the current refinery expansion complete. So that is the bouquet of investment we are looking at.
Okay. Got that. Dr. Rao, that's very helpful. Good morning, sir. Happy 2026 to you, your team. Prashant here.
Yes, Prashant.
It's fascinating stuff, what you're describing to us. But, we're talking about oil, and you would agree with me, the last 1 year has been about geopolitics and oil, and both are kind of linked at the hip. So can't get away too much. So, my colleague Rima asked you about Venezuela. Let me turn your attention towards the other hotspot, which is, of course, Russia. Has Oil India been able to repatriate some of the stuck dividends from your joint ventures in Russia? Some $300 million in dividends were stuck. Has that come in?
So I'll give you a perspective. As oil and gas operators, we are well prepared for geopolitics. That becomes one of our building blocks of decision making. As far as investments in Russia is concerned, we have got two investments. One is Taas Uriak and the other one is Vanker. As far as Taas Uriak is concerned, we have already got 100% dividend out of our investment. Now it's on a self-actualization mode. Vanker, it's about 90% of dividend we have already received. Now, what is struck is the money which we have received, but it is in our account of SBI CIBIL. So we are not worried at all in terms of the value of the money which is there, because it is with us. It's only a matter of time we will figure out how to get this money and then ploy it back in some other overseas investments. So we are not worried at all.
Yeah. So this is basically an SBI account, your SBI account in Russia.
Yes.
And it's stuck because of capital controls, SWIFT-related restrictions, etc.
That's okay.
Okay. But it's been about a year now, right? That this is
fine. As far as our capex requirement is concerned for our exploration and development purpose, this money doesn't come to our play. But yes, once we get a clarity on the transaction issues, we will definitely utilize this money for our overseas investment purpose.
Yeah. So the two assets that you mentioned, right?
Yes.
Vankoneft and Taas Uriak. So you own stakes in these assets along with other Indian oil companies.
Correct.
Are you divesting these stakes, sir? Because
no, nothing of that sort right now. It's a India Inc. which is invested, so we don't foresee any divestment as we speak.
Okay. There's no pressure. You've not got any.
No, absolutely
ministry,
not.
Nothing at all. Okay.
Absolutely not.
Are these assets linked to? At the other part, on the other side, your partners are Rosneft, etc.
Yes.
The reason I'm asking you that, sir, is that the US, I think this was a couple of months back, designated Rosneft and I think one more entity as a specially designated entity, right? I mean,
yeah, absolutely.
Which means anyone doing business with those entities or subsidiaries of those entities can also be sanctioned. So there is that risk.
Absolutely. There is absolute clarity with us. There is no sanction on our operations.
Okay, but that risk has it been? Have you discussed it internally, or it's something?
Prashant, I told you, when we go to overseas asset acquisitions, we are well prepared. It's more important that are we prepared? Are we aware of the risks that we are going to encounter? So as long as you are prepared, I don't foresee there is any problem.
Okay, all right. Fair enough. So no plans at all to divest out of these assets. I think so IOC, Oil India, BPCL jointly hold 24% in one asset and about 30% in the other asset. In that sense, and you're holding on. And that money is in your account, the dividends, and at some point when these restrictions go away, you'll be able to use it.
Absolutely.
Got that. Just leave us, Dr. Rath, with some perspective on what will be the production increase that we should expect in FY27, FY28 from Oil India, sir?
See, there are two ways of being an oil operator. I would answer your question in two parts. One, given the fact that we are on an active and aggressive exploration, purpose-driven activity now, should there be a discovery, then it's a different. The production enhancement is concerned from our mining lease areas. We do foresee that we will enhance our production. Last year, we did 6.71. This year, we will surpass that. While two parts to that production effort, we will definitely arrest the decline, which we have been successfully doing in last 3 years. So that will be one piece of our effort. The second part is, by virtue of next year, our plan is to drill 100 wells. And we have already created an inventory of 200 plus wells for our next 3 years target. So when you drill as many wells as 80 and 100,
you increase your chances. Yeah.
You are bound to get more production. At the Assam Self, the place where we are operating, still have about 30 to 35% of yet to find resources.
Got it.
We are absolutely pretty comfortable as far as our production outlook is concerned.
So just to wrap this interview, and I want to go back to one point about the Numaligarh refinery, and congratulations on the commissioning. So in FY27, what is the expected utilization of the entire expanded capacity, and what can it add to your bottom line? What is the expectation on margins?
Okay. So as far as Numaligarh refinery is concerned, all of you know, last 2 years or so, we have been having 100+% of utilization.
Correct.
This year also, we definitely going to have 100% plus capacity utilization. The distillate yield will continue to be 87% plus. The refinery, we will definitely have a good margin. As far as 2027 is concerned, we will not be able to have the full utilization of 9 million ton. That's the process requirement, because first 6 months...
So 40-50%? Is that a fair assumption for the full 9 million tons?
I would look at a number of 40 to 50% capacity utilization, but let's wait for that stabilization process. Because when you migrate from a 3 million ton refinery to 6 million plus to 9 million, 2 trains, and you have to run a crude oil pipeline of 1640. So we would wait. But yes, it's a fair assumption of 40 to 50% capacity utilization.
All right. Dr. Rath, we'll leave it there. Thank you very much. Our first conversation of 2026. I hope we can make it a regular feature through the course of the year to get updates from you, sir. Thank you very much.
Very
really
much.
a pleasure.
Thank you very much.
Okay. We'll take a quick break here. We are back. We focus on the cement sector. Pulkit Patni of Goldman Sachs on the other side. Stay tuned.
Welcome back. Let's focus on the cement sector then ahead of its Q3 earnings season. Goldman Sachs expects the Q3 demand to pick up after a subdued showing in the first half of the fiscal. They remain skeptical though on price hikes due to the capacity coming on stream. To discuss this and more, we have Mr. Pulkit Patni, the India Industrials Analyst at Goldman Sachs, who joins us on the show. Hi Pulkit, good morning and good to see you, Ben. Well, I was going through your note and you're sounding a little bit more optimistic on the volumes front, at least for Q3. That said, getting into Q4, what kind of assumptions you're making, both on the volume parameter front, because there will be that risk, right, of the year-end phenomena of pushing through volumes that will actually weigh on pricing. So your expectations on both volumes and cement prices from here on.
So, good morning and thank you for having me. I'll rephrase that a little bit. What we are expecting for the industry is to look at a weak third quarter from a profitability perspective. From a volume perspective, we've been actually positively surprised that what started off as a weak October picked up at the margin in November, and December volumes have turned out to be really strong. So I would expect that momentum to actually continue all the way till the end of the fourth quarter. So we are pretty optimistic that volume from here on should pick up. The other piece that we've touched upon is that we've seen early signs of some attempts of price increases, and we do think that at the early part of fourth quarter, which is now, anytime, we expect price increases to be attempted. To the point that you made, absolutely towards the end of the fourth quarter, given that everybody pushes volume, we do expect some bit of impact on pricing to be negative. Net, we expect a weak third quarter because of prices and a much better fourth quarter supported by both slightly better prices as well as better volumes.
All right, Pulkit got that. Pulkit, in the next couple of years, the EBITDA estimate that you're working with for the industry is expected to improve by around 200, 250 rupees per ton. So what are the assumptions you're making both on pricing, volume, and I think input cost or the measures that have been taken where various companies will help in cost saving? So how do you see this 200, 250 rupee EBITDA per ton for the industry increase?
Sure. First of all, FY26, we have a pretty favorable base, right? This has not been the best of the year for the cement sector overall, whether it comes to pricing and even volume in the first half of the year. So A, you're working with a profitability number that's actually itself subdued. Now, when we look at the next couple of years, I'll break it down into two parts. The first part is the first part of the next 2 years, which is the next sort of 6 to 9 months. We do expect a lot of capacity to get added, which will have some negative impact on pricing. And to that extent, we do expect the first half of next year to see some subdued prices. Having said that, I think the bigger picture in cement remains intact, which is one, we expect demand to hover around the 7 to 8% range CAGR over the next couple of years. Secondly, we've spoken about this earlier, but cement is becoming a big boys club, where the larger players are all working towards the cost, which is whether it is converting their power supply to more green power, more waste heat recovery systems, whether it is them working on logistics, converting road to rail, etc., and the overall operating leverage that is going to come because of the size and scale. For the industry, and especially the large players, to get to about 200 rupees EBITDA per ton improvement from here on is something that we think should be relatively easy. What will support in the process is consolidation, and that I think is going to be the additional lever for profitability improvement in the cement sector.
Do you think bulk of consolidation, though, is behind us? I think the top 4-5 players from ballpark around 50-51%, I think they moved to around 65%, early 60%. Bulk of the consolidation, though, is behind us?
Yes, the last 4 years have seen significant consolidation. We could still see more players coming in because ultimately it's cause and action, right? If you see cement companies not taking profitability or adding a lot of supply in the near term, there will be some small players who will feel the heat of profitability, and there could be more coming in. Plus, I think what we have to fully appreciate is that the larger you are, the benefit of scale, size, cost come to you, and which over time will make the smaller players a lot more inefficient, in which case I would say maybe not the same scale, but you'll see consolidation as a theme may continue in this sector for a slightly longer period.
And what's the last accounted number when you talk about the big players holding most of the market?
We'll say we'll probably get to, as an industry, we can get to about close to 65 to 70% just with the larger players.
The top 5 players?
Yes.
How do the return ratios change now, in this sort of a scenario in terms of when pricing is a little bit weakish, though volume push is coming about? When normally you put up a cement capacity, I think the matrix was ROC should be early teens. That number could have dipped a little bit, right? So how has that changed of late?
In a cyclical business, you'll always have periods where when companies are buying capacities, their capital employed goes up, and it takes time for them to improve efficiencies in the acquired capacities. The good news in this sector is that cost of acquisition has gone down from $140, $150 per ton to more like $100, and greenfield capacity expansions are happening anywhere between $60 to $70 a ton. So I would say while ROCs have been subdued in the cement sector for the last few years, we do expect with consolidation, those ROCs should actually start inching up. And somewhere, because the valuation in this sector, while it's corrected, it's still at the higher end of the range, is because market does expect consolidation to bring in better return ratios for the cement players as well. So we would expect, and we do have that in our numbers, that ROCs should trend up as utilizations improve over time.
All right, and geographic preference between the north as well as the south. The last many years, north has been doing much better. But now you have new players that are going out there. The capacity addition as well will be fairly high, while the south has been hovering around lower capacity utilization levels. So what is the preference geographically?
Absolutely. This is something that we have touched upon in our report as well. Yes, that north has been historically one of the best regions to be in. But given that bulk of the capacity addition coming from the large players, including entry by a few smaller players, is all happening in North India, we are looking at almost about 22 million tons of capacity getting just added in North India over the next sort of 18 months, which is why our preference would be for South and West. West as a region seems fairly strong, not much capacity coming in. Demand drivers, particularly real estate in cities like Mumbai, will be strong drivers. So yes, we do believe that North will see capacity utilizations dip down by about 600 basis points, and which could have impact on profitability.
Okay, all right. Final couple of questions then. The long-awaited merger was announced in the Adani Group between both those two entities, though they were almost operating as one. So the synergy benefits could be limited, though the management claims otherwise. Do you believe that this is a big kicker, or this would help them work as one, and ACC, Ambuja, Sanghi, Orient, all of them coming together?
Nigel, while we don't comment on individual stocks, the point that I made that consolidation in the sector will continue, and consolidation comes with its own benefits in terms of, using limestone one versus the other. There are other benefits of brand exchange, etc. So that, I think, as a theme will continue, but I'd not be able to comment on company-specific situation.
Okay, and you would rather stick to the biggest cement player, going by your note, right? The big daddy, UltraTech Cement. People thought that the new challengers are coming in there, but the big daddy is your top pick.
Yes, UltraTech is our top pick in the space.
It's been good speaking to you, Pulkit. Thanks a lot for joining in. You've given us a fair idea with regard to how do you see demand, supply, as well as volume trends that will pan out. Appreciate you joining in. Look forward to chatting with you as 2026 does progress.
Thank you for having me.
Well, time to slip into a short break. On the other side, Manisha Gupta will turn the spotlight on the commodity sector. Stay tuned.
Welcome back. It's a flat market that we have on our hands. Nifty Bank, though, is doing better. The Nifty Bank is up 200 points, led by strength in ICICI Bank, Axis and Kotak too, managing to show some gain. Chandan Taparia, Motilal Oswal Financial Services is now joining in to give us some 10 a.m. technical calls. Chandan?
Yeah, good morning, Rima. Thanks for having me. So to start with Nifty, it has been holding the support. So till it holds above 26,100, overall bullish stance could continue, which can take it towards 26,500. Talking about Bank Nifty, declines are being bought with support of 59,750. We are looking for 60,750 to 61,000 marks. Now, looking at the stock ideas, first that is buy on MCX. Major trend of the counter is positive. Longs are intact. Rollovers were better and all set for a consolidation breakout. So one can buy with support of 2210 for an upside target towards 2350. Second trading idea, that is buy on Chola Finance. Most of the financial counters are doing well, and Chola Finance has seen a role reversal. A strong recovery was seen from 1550 and now giving a fresh breakout. So one can buy with support of 1780 for upside target towards 1900. One more trading idea, that is buy on BDL from defense spec. It has bottomed out, negated lower top, lower bottom. So we are recommending to buy with support of 1535, and here target is 1620 marks.
Okay, all right. Those are trades, Chandan. Thank you very much. Good speaking with you, and we'll talk again. Well, let's talk about commodity markets. Manisha is here with what's top of mind. It's all buzzing, especially base metals, precious metals. Manisha, what are we talking about?
Oh, base metals, absolutely, because that's an area that continues to buzz and very, very strongly. And we're looking at multi-year highs, record highs in many of these commodities. This is what we've done in the overnight markets. And as you can see, it has been a phenomenal move there coming in there. So platinum gained up by 6.5%. Silver was up more than 5%. Copper, record highs, 5% of gains coming in there. And gold prices gained up 2.5% as well. This is what we've done in this year till far. And as you can see, it has been a very bullish, strong start to many of these metal prices therein. So anywhere between 5 to 10% of gains in 2026 so far is what we've done in sense of commodities. Let me remind you that all of these commodities in last 1 year have given you tremendous returns. Platinum has returned 136% on your investment. Silver has gained up by 155%. It has been more than 45% of gains coming in for copper, and gold has gained nearly 70% in last 12 months as well. So strong gains continuing, while it has been about fund buying, fund allocation, and of course tangible commodities doing quite well, speculative bullishness as well. But many of these commodities also have individual fundamentals working for themselves. For copper, we are trading at all-time highs because there is concerns over potential US tariffs that could come in the first quarter of 2026 itself. Apart from that, it also is about strike in Chile's Mantoverde mine, as union members are seeking larger share of profits, with copper prices trading at all-time highs, gaining 45% in last year. This is something that you would perhaps see in various mines where they would want a share of profit with the prices running where they are. Take a look at aluminum then, and the LME prices are trading at a 3-year highs. We're looking at China set to breach 45 million tons of a cap that they had put in 2026. So that tells you that the China production will continue to be curbed. Apart from that, it also is about Indonesia facing higher energy costs, local regulation risk. That is something that has been supportive. We've been talking about lower availability of bauxite, lower ore grades as well. That has been supportive for aluminum. And in any case, you have been looking at key smelters facing issues in various countries like Iceland, Mozambique, Australia, etc., supporting aluminum prices, so much so that investors and bankers have been telling us that number 1 is copper, number 2, absolutely aluminum in your portfolio as a place there. Take a look at the nickel prices. Well, they have been underperformers, but we're looking at prices at a 1-year highs for this one as well. This is after Indonesia has proposed a 34% reduction in output in their 2026 budget. So that means lower nickel or lesser nickel availability going forward for this year. Iron ore, which ended 2025 on a weaker note, has started 2026 on a positive note therein. Overnight has been 2% gains, and the markets believe that China's steel makers are restocking ahead of the Lunar New Year holidays in the month of Feb, supporting prices. Zinc should come in on your screens because that one is trading at a 14-month highs. The global inventories are the major reason here, which are at under 2 days of global consumption. even as we have seen the inventories increase, they're not really much when you look at the demand in front of that. So on December 1st, the inventories were at 52,000 tons. On 2nd of Jan, in a month later, we're looking at 100,000 tons. Even as they have doubled, 104% of an increase there, still at a 2-day of global consumption there. Finally, silver should come in on your screen. 5% of gains in the overnight market, and we're looking at heightening geopolitical tensions, China export restrictions, and then China, remember, produces 60 to 70% of all global refined silver. So whichever way you look at, individual fundamentals, macros, all of that has been quite supportive for precious metals and base metals.
All right, Manisha, thanks very much for that. Absolutely. Starting 26 on a strong note after a super 25. Well, we'll take a break. Lata will connect with Sunil Singhania, founder and a fund manager at Abacus, on what to expect from markets in 2026. That's a conversation you don't want to miss, coming up in just a bit.
Fly Emirates, fly better.
Here's wishing all of you a very happy new year. Well, my new year is starting a little late because of a longer holiday. So my new year pledge was that in my first show, I will get you the best of all investors, one of the most intelligent investors in India. And fortunately, he obliged. May I welcome Sunil Singhania, founder and fund manager of Abacus Asset Management. Sunil, thank you very much indeed for obliging, and a very
for very flattering words, and happy new year to you, all your colleagues and all the viewers of CNBC-TV18. Have a great 26.
Thank you very much, Sunil. Every word was well deserved. Well, let me get to the matter at hand. You know, 2025 was a bit of a disappointment for us. 10% returns is not bad, but we underperformed practically all the major DMs and EMs we compare ourselves with. What's the outlook for 2026? Our poll, let me just tell you, a majority of the participants, about 55%, see a 10 to 20% return, basically over 10% returns. Your take?
I think you're right. 25 was a modest year, and as human beings, we always want to have more, and we always keep on comparing ourselves with the markets which have given the best returns, or the asset classes which have given the best returns. But we also have to take into account, Lata, the fact that between 2020 and 24, I think we outperformed by a big margin. In fact, whoever was positive between 20 and 24 ended up having the best 4-year block of returns ever. So, that was the context. I think as we head into 26, there is a little bit higher optimism. Obviously, the economy is starting to get back on its feet. Interest rates have been cut. There is enough liquidity in the system. Balance sheets of corporates are pretty decent. And corporate profit growth, which had fallen to only 3-4% last September of 24, has now come back to 10%, and hopefully it should trend up towards the 14-15%, which is the long-term trend of profit growth which we see in India. There are a few headwinds. I think the biggest of all is the tariff thing, and I think that keeps on playing, in our heads always. So I think 26 is going to be a very interesting year. We are optimistic. At the same time, given the fact that we continue to be, I would say just above fair value in terms of the multiples, I think I would agree that we are going to have like a low to mid-teen kind of returns from equities in 26. But more importantly, I think it's going to be a year where one has to make less mistakes, because, the lure of momentum is so high. Everyone wants to, buy into stocks which are moving in terms of prices, not necessarily fundamentals. And therefore, at least from our perspective, we are very clear that this is not the year where you can afford to make too many mistakes.
Okay, then, I had other questions on fundamentals, but let me come to that you're raising. What are the avoids sectors? What are the momentum mistakes?
I would not say avoid sectors, but, by nature, Lata, we are very clear that when you invest in equities, you become partners in the business. And we would like to become partners in a business where what you pay today will be more than repaid back to you by way of future profitability. We are not saying that everything which is new age or new economy is bad, but, I think there also one will have to distinguish. And we are very clear that we would want to give capital to companies which will use that to grow, not to burn. And therefore, perennially loss-making or cash flow burning companies are something which we should avoid. The other thing is it is very difficult to value these companies. And, more often than not, one gets sucked into a momentum kind of a thing. So I think that is where I would say that we have to basically be a little bit careful. Obviously, there are some sectors where we have a slightly, I think, defensive view, IT services being one of them. We continue to believe that the days of 10-15% growth rates are behind us. And on top of it, we are also looking at a lot of disruptions, the visa issue being one, tariff, the US being the other, AI-related disruptions being the third. Obviously, the tailwind in terms of currency or rupee depreciating has helped them a little bit. But I think that is, again, one sector where we will be slightly more defensive. But I would say that generally avoid companies where prices are moving up, not necessarily because of fundamentals, but because of a lot of FOMO into them.
Yes, I take your point on that. But, this IPO frenzy, that's where I guess a lot of disappointment has come with a record number of IPOs not getting back even to their offer price. And we're going to have a bunch of IPOs coming in as well. I think Zepto, Oyo, Boat, all of them have lined up with DRHPs. What is your advice? Is IPO the wrong way to start investing? Generally avoid IPOs because everything is known about them. There's no alpha over there.
I won't agree, Lata. I think in a growing economy, and I always go back, when we grew from $0 to $1 trillion in terms of economy, that was contributed maybe jute and cotton and, textiles and some utilities, some steel. 1 trillion to 4 trillion, the path in terms of the economy, I think the contribution came from private sector banks, IT services, pharma, a lot of consumption-oriented sectors. And it is very clear that when we move from 4 to 8 trillion, I think a lot of these new age businesses will contribute a lot to that journey of 4 trillion to 8 trillion. So you can't write them off. And typically to invest in these companies, I think they necessarily will have to invest on the listed side through the IPO route or once they get listed. So you can't write off everything. But at the same time, on the listed space, the temperament, the philosophy, I would say the volatility bearing capacity of investors is very different from the private equity side.
Yes.
And therefore, one has to be very clear what you're betting on. And it's not like a short-term roulette which you're playing, but companies where you believe they're going to sustain and survive for the next 5-10 years. I think on the digital side, the new age businesses which you referred to mostly, winners take all. So, you have to find companies which will survive, and the companies which survive for 5-7 years, obviously they will create value. The other thing obviously is the valuation. It's very difficult to value because these are not traditional businesses. So the valuation is all about, demand and supply, what the investors are willing to pay for when the IPOs come. So we are looking at them, but we are very, very, very selective.
No, I take your point. I mean, I was not going against the digital companies. I'm only saying that at IPO, they come at valuations which seem to have everything in the price. And I take your point. I mean, Grow has done very well. And therefore, this network or winner-take-all effect is something, for which we have to pay a price. But Sunil, if you are willing to speak about stocks, that would be most welcome. But what sectors, since you normally shy away, will say Pharma has been one of your favorite sectors, if I remember right, you have. Will that continue to perform? Because some of them did very well in 2025.
So no, we were positive on 3 sectors and we continue to be positive. 2 of them have worked out well. So all kinds of financials, including some NBFCs, non-fund-based financials, predominantly asset wealth management companies, insurance companies, I think they have done very well. Banks also have been doing reasonably well. Growth rate obviously have slowed down to maybe, low double digits, but very good asset quality. Metals have done phenomenally well for us. And to some extent, we were lucky because it got helped by what is happening globally in terms of metal prices.
Yep.
Pharma is one sector where we are positive, which has not worked out in the way we would have liked to. But I think there is a lot of moat there, both domestic pharma, global pharma. I think there's a little bit of overhang of any negative news which can come in from the US front. But Indian pharma has a lot of moat. So I think pharma is one sector where we would like to stick our necks out and be a little bit more overweight. I think engineering also has not done well after a phenomenal 2-3 years. 25 has been a year of I would say normalization. Stocks had moved up significantly, beyond fair value. They have corrected quite a bit. And rightly so, because one, valuations were very high, and second is the growth which the street was expecting did not come true. Largely also because a little bit of slowdown in Indian economy is also the fact that because of tariffs, exports also got hit. But I think specialized engineering particularly has a lot of legs, and that is again one sector where one has to keep an eye on. And that would also include opportunities which come from the domestic side, which would include, the defense, railway, and so on, and also on the export side.
Yeah, precision engineering clearly has done very well. Sunil, what about commodities? I mean, that seems to be a herd trade now, but you think it has legs?
So one good thing about commodity companies in India, particularly metals, is that the companies' balance sheets are phenomenal. It's not the kind which we used to see 10, 20 years back when one bad cycle used to take these companies into losses.
Yep.
I think the bounty which they reaped between 20 and 23 helped them clean their balance sheets. Their debt equity is well under control. They have become one of the lowest cost producers across, in the world.
Are you including ferrous? Are you including steel when you say metals?
Yes, steel is slightly lagging behind non-ferrous, but there also I think the government is ensuring that the steel industry in India survives, because if you just allow imports to come in from China, India will stop manufacturing steel. So I think rightly so there has been support from the government and which has helped them. Obviously, non-ferrous companies are doing much better because of the spurt which we have seen in the price of aluminium and copper and now nickel and zinc and so on and so forth. But ferrous is also pretty stable. Obviously, non-ferrous has had a great last 3-4 months. They continue to look good. However, these are deep cyclicals. And at least from our side, we try to restrict the weightage of deep cyclical companies to like less than 10% in the portfolio.
Okay, fair enough. Well, a final question, because I'm running out of time. What should we be worried about? I mean, this Venezuela event has absolutely shaken us and looks like geopolitics will dominate. Can that have a very negative impact on markets at all? How do you parse? And more broadly, what are the risks to markets?
Well, Lata, very funnily, people were very worried about interest rates hike in Japan. And when the interest rates were hiked in Japan, Japan went up the highest.
Yes.
And yesterday, Venezuela markets went up by 17%. I think so these kind of geopolitical events, now we have to live with it. We are in a world where there are very strong personalities governing most of the countries. It's a period of not laymen, but he-men. I'm very sorry, a little bit more this thing. But, and these events are going to continue. I think from India's perspective, what we have to watch out for, we can't afford this tariff thing to get out of hand. We need a resolution because all said and done, US is the largest economy in the world. And we do export almost $100 billion worth to US. So I think that is something which we need to watch out for.
Oh, yes, we have to play our cards very, very carefully. It's a dangerous world out there now. Thank you very much, Sunil Singhania, for lighting up the start of our new year with your advice to investors. Thank you very much for joining us. Have a great 2026.
2026 again. Thank you.
Okay, so that's some wise words coming in, sectors that you should watch out for, and the hope that this mid-teen earnings and market returns is likely to be our lot in 2026. That's a very big wish. We can live with it. We wrap up on Bazaar on that note. Chartbusters coming up.
Trent's revenue grows 17% in the third quarter, below the guided 25% compounded growth, also below its 5-year CAGR of nearly 40%. The stock, the top Nifty loser, with a cut of 7%.
Copper prices surged to record highs. Hindustan Copper is up another 4%, continuing its rally after doubling in the last 6 months.
Bajaj Auto, one of the top gainers on the Nifty. Brokerage MK has upgraded the stock to an ad rating, raised its target price to 11,100 from an earlier 9,500, citing attractive risk reward and strong export momentum as key demand drivers.
Jefferies initiates a buy call on MV Photovoltaic with the target price of 320 rupees, expecting a 56% EBITDA CAGR till FY28 on the back of valuation discount and a competitive advantage over its peers. This stock is up 10%.
Dabur, mildly lower as the company's guidance of mid-single-digit revenue growth disappoints the street in the third quarter.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the market's a little under the weather, down close to around, 18 to around 20 points. A couple of heavyweights are under pressure. But otherwise, Mangalam, I think it's par for the course.
Par for the course, Nigel. The good part is that despite, an absence of up move coming in on HDFC Bank, the Nifty Bank is higher by about 0.4%. Couple of key private banks doing extremely well for them. Case in point, something like an ICICI Bank, which is doing extremely well. And we have some traction coming in on other private sector banks. And, the up move that we're seeing in some of them as well. IndusInd Bank, the loan growth was lower in the third quarter. But how much of that is in the price is the big question. The stock has moved higher. But if there's one genre of music that the market is playing this morning, it has to be heavy metal, Nigel. It's the kind of move that we're seeing in a lot of these commodity-backed names. Hindalco, Nalco, Copper, Hindustan Copper has moved so much higher.
Well, that's right, Mangalam. And, exactly 30 days ago, we here at CNBC-TV18 had presented a piece on aluminium, because we have 3 listed companies, which is Nalco, Hindalco, as well as Vedanta. All of them are up actually 16 to around 22% in that span itself. And the point that we're noting is that, demand growth could outpace what supply growth is at. And more importantly, particularly for aluminium, China is at around 96-97% of their utilization levels. So you always fear that there'll be additional supply that will come in there. At least for for aluminium, the China element at least may not plague in the near term. So aluminium as well has done very, very well. And Hindustan Copper, only way to play copper prices, valuations have gone out of whack. But you play momentum, and that's why Hindustan Copper has done so well.
Big move is what we're seeing out there, though some profit booking coming in for some of these oil marketing companies, BPCL, HPCL, all of them lower. We've seen a mild spike in crude prices, but nothing really to cause that kind of a decline. But remember, if you notice, sometime last week as we moved towards the year end, there were big up moves on these counters. So now they're coming off. Let's welcome Dharmesh Mehta of ICICI Securities for a quick technical check on the market. Dharmesh, the Nifty seems to be back in that range, consolidating near record high levels. Volumes back in full flow as well from yesterday. Where do you expect the index to move from here on? What's your today call and the very near-term call?
Yeah, so good morning, Mangalam. Yes, definitely, I think so. The market seems to be facing some bit of a resistance near the live high of around 26,300, 400. But we believe, I think so, the way the market has run up in the last few trading sessions, almost 500 points rally from 25,700 to almost 26,300. It looks like more of a temporary breather or a normal retracement of a rally. But we believe, I think so, 26,000 to 25,900 should hold in this current corrective phase. And eventually, we believe market should head towards 26,800 is likely target for the month of December. As far as short term is concerned, yes, definitely, I think so. In the for today's trading session, we expect Nifty to hold the current panic low, which was formed in the early morning around 26,150, 170 should hold, and eventually I think so market should trade in this range of 26,150 to 26,230 to 40 levels. I think so is likely the trading range for the day. But if you look at the market from the medium term perspective, the breadth, which is again a good indicator to understand the sentiment of the market, has improved a lot from last 2 weeks, if you look the percentage of stocks trading above 50-day moving average has improved from 27% to 52%. So it looks like it's more for broad-based participation. Definitely today's move is something related to few large caps, which seems to be putting pressure on the market. But we believe, I think so, this is a part and partial. Corrections are part and partial of the bull market. And eventually, I think so, we should be looking for a target of around 26,800 for the month of January.
All right. And we take that point. Do you have any stock pick or none?
Yes. Absolutely, in Mangalam, I think so. We remains to be more positive from the looking at the market volatility. I think so. Stick to the large caps. I think so. It's something the best strategy at the current market price. Where L&T remains to be our topic now. L&T again, the capital goods as a sector looks to be in limelight ahead of budget, and we believe, I think so, the way the L&T seems to be relatively outperforming even in this current corrective phase, clearly indicating, I think so, 6 weeks of a long consolidation breakout witnessing in L&T looks for a target of around 4,500, keeping a stop loss of 3,800. Apart from L&T, I think so, the metal as a space also looks more constructive, positive from the current levels, where again NMDC remains to be our top pick. Again, the weekly time frame, the stock seems to be forming higher top, higher bottom formation, and on from the medium term perspective, for last several weeks it has been trading in this range of 77 to 72. Finally, seems to be witnessing a breakout with strong sets of volumes, expecting NMDC to head towards 94, keeping a stop loss of 76. So NMDC and L&T remains to be a top pick at the current market price.
Okay, all right. Thanks a lot for that, Dharmesh. Well, time to focus on a couple of other banks then. We have the CEO of J&K Bank, Mr. Amitava Chatterjee, who joins us on the show. Hi, Mr. Chatterjee. Good morning. Wishing you, your team, a very, very happy New Year and a rocking 2026.
Thank you very much. Thank you for having me here. Good morning and a very happy New Year to all the viewers and you entire team.
All right, just coming to you in a bit. We're just going to focus on the top points that we're going to be talking about to Mr. Chatterjee about. Will strong loan growth seen in Q3 continue from here on? Also, what's the update with regard to the fundraise plans? And finally, whether the net interest margin and ROA are set to expand from here on. Well, Mr. Chatterjee, let's focus on the growth first. I think you were guiding for growth, but it appears from your update that actually that has come as a pleasant surprise because it's better than expected. You end the year at what, mid-teens?
In fact, if you remember, the last quarter I said what I had expected to happen in December had already happened in September for the bank as a whole. So obviously, I had given a guidance of 12% on loan growth, but I had said that there are chances of 15% upwards. So that has happened. I'm very happy that the way we had planned the year for advances growth, that has actually happened. Going forward, I believe there are certain high-ticket loans which are getting repaid in the fourth quarter. But still, we have a very strong pipeline to not only counter that, but exceed. So I believe that we will be having somewhere around in between 12 to 15% year-end advances growth.
All right, 12 to 15% year-end advances is what you are targeting, which will be a pleasant surprise for the street because up until now, you were holding on to your guidance of 12%, but you did give a hint the last time you spoke. You said that you are absolutely certain of 12%, and after this update that has come by, you are now upping that or increasing that range by saying it's between 12% to 15% itself. Quarter on quarter, the CASA has come down by 1.5%. Year on year, it's improved. Loan growth target of 12% stands up to 12 to 15%. And that's the major takeaway from what you've said so far, Mr. Chatterjee. Let's focus on NIMs and ROA as well. If you could give us a sense on where your NIMs are likely to go from here on. And by the end of this year, what is your return on assets target? Because, with the cuts that have come in interest rates, the street believes that maybe there is a bit of an upside potential for NIMs for players like you.
I won't say that, of course, last time also I said that the NIMs will slightly improve. I believe it will improve gradually because the deposit rates, the change in the deposit rates takes some time to factor in the entire system. So this quarter, we might see a little bit improvement in the NIMs, but again, there has been a rate cut. So NIMs will always be under a lot of pressure. ROA, I would say that we will stick to whatever we had last year. I'm not very sure that because of the current situations and the kind of pressure we have on deposits, all banks, it's not very easy to improve the NIMs and ROA at the time. But I believe that whatever we have been correcting and improving in the bank, that has taken shape now.
So just to close that
going
loop,
forward,
sir. So just to close that loop, NIM guidance for the end of this year was 3.7 to 3.8%. Will you hold on to that? And ROA guidance was 1.2 to 1.25%.
I will hold on to that. 3.7 would be the NIM and 1.25 around will be the ROA. That is what I'm expecting.
Take that point. Sir, just request you to stay on. We'll take a short break, come back, continue our conversation. Meanwhile, we'll try and fix the audio issue that is there with Mr. Chatterjee as well. Take a short break, come back, we continue our conversation.
You want to talk business? Meet me in the On-Board Lounge.
All right, Mr. Chatterjee, thank you for waiting by. So far what we've gotten from you is 3.7% NIMs for this year, 1.25% ROA, and loan growth between 12 to 15%. Since we're, speaking numbers, if you could give us a sense on the impending fundraise plan for you, because with the kind of loan growth guidance that you're giving and the troubles around CASA that you're speaking about, at some point you may have to tap the market to raise additional funds. So to that extent, where does your CRAR stand at right now, and at what point would you require funds, and by when are you looking to tap the markets?
See, if you look at the current CRAR, it is comfortably placed above 16%. But yes, you are right, because we are looking at a very robust loan growth, and we already have a approved fundraise from our board. We are likely to go to the market probably in the fourth quarter, or maybe a quarter next to that. But we are definitely in line for a fundraise. That is for sure. We already have an approved fundraise plan for the bank.
And the quantum will be 750 crores in quarter four?
Probably 750 crores, yeah.
All right. Just one point with regard to your CASA. I think earlier you were talking about 48%. I think it's hovering around 44%. And it's an industry-wide problem, in terms of the CASA. Realistically, where do you end the year?
See, it's difficult, but I must say that we have introduced a I'll just share something which is unique to this bank. We have a geography all to ourselves. So this is where we can actually leverage. And there were certain initiatives that we had not yet taken. So we have started those initiatives. I believe that we will be able to make up quite a bit of CASA in the last quarter of this year. 48% may be a little bit challenging, but definitely it will be an improvement on what it is now.
Could you quantify that? Would that be possible for you?
Plus 45, maybe 46 around.
All right, 45, 46. So what other steps are you taking to, mobilize deposits right now? Because it's getting difficult, right? People are not finding it a lot more attractive to put money in savings account for banks or even fixed deposits for that matter, because there are many other avenues, including equity markets and commodities, that are giving them better returns.
See, what has happened with the retail depositors, where all the bankers would depend on, they have now become net borrowers, not net savers. Now, what is happening is whatever surplus liquidity they have, they are just using it to either pay EMIs or get higher returns than what the banks offer. So the deposits coming to the banks have quite dried up. But then again, I said, we as a J&K Bank, we are uniquely poised, and we have a very strong senior citizen customer base in Jammu and Kashmir. So looking at their risk appetite profile and all, I believe that in Jammu and Kashmir, we will be able to manage the deposit part at least for one and a half years more. After that, I'm not very sure.
Okay, and what about final word with regard to asset quality? It's been slipping. Credit cost is almost zero. Gross NPAs were around 3.2%, I think. Where does that number head?
It will be. I had given a guidance of less than 3. It will be that.
All right, we take that point. And you don't worry about the recovery, etc., right? Because you did say that people are becoming net borrowers rather than net savers. So at some point, will that hit?
It shouldn't. It shouldn't. The leverage is quite high at the moment. If you look at the NMI to EMI ratios, they are at all-time high in all salary accounts. But still, I believe that all banks, including ourselves, we have put a check into that. So that will save the situation as far as I believe. And the situation in Jammu and Kashmir was not very good in the first 2 quarters, whatever happened. So because of that, we have had this special rehabilitation package approved by the Reserve Bank, and we have applied that. So that would have cost us a little bit of additional provisioning, but it has saved us a lot of stress in the accounts. So overall repayment, I am very comfortable with.
Take that point. Thank you so much for joining in and giving us an update on your business and the outlook for the near term. Wish you and your team a very happy new year and good luck for 2026 as well. Take a short break, come back, get you more news and updates on the markets on the other side of the short break.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV18. Well, let's hop across to Sudarshan. He's here to tell us about Bajaj Auto. That's one of the top gainers. MK has gone ahead and upgraded the stock. Sir?
So in 2025, this stock was one of the underperformers if you talk about all the two-wheeler names. But since in the last 10 days, the stock has gained almost 10%. Today, MK has come out with a note upgrading the stock to buy from add, and it has increased target price to 11,100 from 9,500 rupees per share. And that implies an upside of around 15 to 17% from current levels. And it has also upgraded FY. The reasoning it has given first, as far as the domestic two-wheeler market share is concerned, it believes it has bottomed out and there is a slight pickup in the last few months. Also, export trend, if you talk about in the last consecutively for third straight month, Co has seen 2 lakh units of export sales. And third, company is looking to launch a new Pulsar, and that would be like in 2 to 3 variants that already Rajiv Bajaj has talked about. And another positive point is about the rupee depreciation against dollar that is going to aid to margin. And company has talked about that if there is a fall of 1 rupee against dollar, it helps in EBITDA by rupees 300 crore if you talk about annualized basis. An electric three-wheeler portfolio has scaled up meaningfully, and EBITDA has been achieved break-even in this segment, and there has been a gradual turnaround as far as KTM is concerned. So considering all these factors, MK has upgraded the stock.
Right, we take that point. Thanks a lot for that. 2.5% higher on that stock as well. But let's move on to an important issue. The RBI has issued amended directions for lending by financial institutions to related parties. What does that mean, and who gets impacted? Ritu joins us with all those details. Ritu.
Well, Mangalam, a whole host of amendments that have come in compared to the draft that was issued sometime last year. There is easing in some of the provisions, which is in line with what banks, etc., have been asking. But the definition of related party itself has been broadened. That is important. And, RBI is now mandating more board oversight with some transaction level thresholds that have been brought in when it comes to related party lending. But overall, there is also more alignment between banks and NBFCs when it comes to this rule. Now, to begin with, these rules come into effect from the 1st of April, but importantly, RBI has given banks, NBFCs, all of the entities time for all related party transactions that are non-compliant at the moment with the new rules to continue until their contractual maturity, provided there is no renewal, repricing, or any kind of change in the terms and conditions. There are also certain categories of NBFCs, specifically those that are not really public fund facing, they don't have a customer interface, or CICs that are only involved in group lending, they will be exempted from these directions. Importantly, equity investments when it comes to related parties have been excluded from the scope of the directions, but debt instruments is very much still covered. RBI has also expanded the definition, as I was saying, to align more with the Companies Act and the IBC rules as well. So it now includes the promoter of a company, directors, all the key managerial personnel and their relatives, and also shareholders that have more than 10% equity in the company, and also where, other entities where these people exercise control or significant influence. All of that is now going to be covered under related party lending. There's also materiality threshold, which RBI has introduced for these loans. So broadly, if you're a larger institution, you'll have a higher ceiling. And if you're a smaller one, you'll have lower limits. So, for instance, banks with assets of more than 10 lakh crores will have a ceiling of 25 crores. Those with assets of 1 to 10 lakh crore will have a ceiling of 10 crore rupees and so on. Again, in NBFCs, the upper and top layer NBFCs have a higher threshold of 10 crore. The base layer will have 1 crore. So loans that are fully secured by government securities, FDs, LIC, life insurance policies, etc., also going to be exempt. But any related party loans that are above these thresholds that RBI has defined will now have to be specifically approved by the board of the bank or NBFC to be cleared.
Okay, all right. Thanks a lot for that, Ritu. But you didn't tell us how was the party last evening. Hope you had a very, very good birthday.
And no sweets or cake came our way.
No, it is. It's due. I'm sure Ritu will not disappoint.
Well, it's due on Saturday, and that's where we meet to party. But it was as
that party is on the company, not on you. Come on, you got to do that.
Thanks a lot, Ritu. But you stay on. We'll wrap up on this edition of Chartbusters. Stay tuned. The team of Trading Hour is waiting by, Ritu included.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. Mangalam Malu is me, along with me, Hormaz Fatakia, and Ritu Singh as well. It's on the back foot, the market right now. 26,200 thereabouts, closer to yesterday's low as well. Where we go from here will be extremely crucial, largely because, one, it is the weekly options expiry today. And secondly, despite underperformance from HDFC Bank, the Nifty Bank's doing well, led higher by ICICI Bank. So will we see this outperformance of the Nifty Bank continue or not is the big question. From the broader markets, more stocks declining than the number of stocks which are advancing. For the second day in a row, that trend plays out. Ritu.
Well, yes, a bit of pressure on the markets today, Mangalam. Earlier today, we saw Nifty consolidating around those record high levels, but now we've seen it sit below.
All right, Ritu, I think there's a bit of a smidge in your audio. We'll try and fix that. But let's go across to Hormaz, who has the top movers this hour.
There's a very choppy start to the weekly expiry session on the index, but there are plenty of movers in the broader markets, and you start off with something that you track very closely. Swiggy is one such name. It's continuing to extend losses in today's session, as is Eternal, but Swiggy is the bigger underperformer, down almost 4.5%. Now, it's the second worst performer on the Nifty 500 index, with the stock having traded on very strong volumes as well. It's the third straight day of losses for the stock. 85 lakh shares have been traded compared to a 20-day average of 30 lakh shares. So it's 3x its 20-day average. And as a result of this recent fall, the stock has now moved below all of its key moving averages. And not just that, the stock is now also trading below its QIP price, with which it raised around 10,000 crores very recently. That QIP price was 375. So it's trading below those levels. It's trading below its IPO price as well, which was 390. And from that post-listing high that the stock had made, which was close to 620 rupees, it's down almost 40% from those levels. The other one making headlines is Ola Electric, and that stock had now gone significantly higher over the last three sessions. So it snapped a 3-day losing streak today. It's off almost 8% from the highs of the day. So it was higher in today's session as well, and then seen a sudden sharp fall just a few minutes back, and it has snapped a 3-day gaining streak. The stock in those previous 3 trading sessions was up almost 22%. There was significantly higher moves that the stock had seen, and today's volumes are already 50% of what they were last Friday and on Monday as well. So both those sessions had similar sort of volumes, and even in today's volumes as well are seeing that kind of volumes in today's session. So almost 16 crore shares have been traded on Ola Electric already, compared to a 20-day average of just around 4.5 crore shares. And the next important level on the upside is the 100 and 200-day moving average, which is at around 48 rupees. So it's come off those levels as well. And lastly, metal stocks, they are the ones that are in the limelight, as they have been over the last month or so, be it Nalco, Hindustan Copper, Hindustan Zinc, all of them trading higher. Nalco is at record high levels as well today, and it's trading on very, very strong volumes as well. So more than 1 crore shares have already been traded on Nalco. The 20-day average is around 37 lakh shares. Hindustan Copper as well on, well, slightly higher than its 20-day average. But Hindustan Zinc, the gains that have come today are on lesser volumes. The volumes of around 35 lakh shares. It is lower than the 20-day average, which is close to 60 lakh shares. So barring Nalco, the other two names are not seeing as significant volumes as Nalco is. But there are enough and more movers in the broader markets to keep the market participants interested, Ritu.
Yes, enough and more movers, and some of them we'll specifically focus on over the course of the next hour through Trading Hour. But yeah, the Nifty Metal Pack, one of the top gainers, Nifty Pharma, PSU Bank, banking index, despite that pull down from HDFC, with concerns on their high credit deposit ratio, which we'll focus on. These are some of the packs that are doing well, while FMCG, realty, energy, media, dragging the markets down. Keep an eye on rupee as well. It's made a bit of a recovery today, now trading at 90.15 to the dollar. But let's get more stock specific. Divi's Laboratory has surged in trade on the back of a positive note that has come in from Citi, and Ekta joins us now with more details on what that note had to say. Ekta.
Thanks for that. Well, yes, Divi's Labs is in focus because Citi has written a note. They have a buy with a target price of 9,140. They think 2026 can be an inflection year for Divi's. The company has a strong pipeline of catalysts over the next 12 months, notably in the GLP-1 and the contrast media space. Now, various custom synthesis products are also maturing, which may be commercialized in the near term, according to them, which would be an opportunity for Divi's Labs. The generic segment, too, is expected to witness a recovery recovery in 2026. The quarterly numbers, according to them, may experience volatility and present forecasting challenges, but the medium to long-term story remains intact. They believe that Divi's revenue EBITDA can expand by 3 times to 4 times over FY25 to FY30. FY27, FY28 EPS is 10 and 18% ahead of consensus.
Indeed, and that's a positive note coming in on Divi's Laboratories, and that price target as well from Citi is the highest on the street. In fact, by a distance, the second highest is only from Jefferies, which is at close to 78.50 levels. So a target in excess of 9,000 for Divi's Laboratories. Ekta, thank you for that update there. Doing well for itself is Divi's Laboratories. But what's not doing well today, and unsurprisingly so, is Trent. And that becomes the big story of the day today. Almost 7% lower now on the stock. And the question among investors across the board is, what is the key reason behind the fall in the stock? Now, it has been making fresh lows every quarter. It's now trading, in fact, below its lowest price target as well. Mangalam is here to decode that big story for us on Trent. Mangalam.
Well, you know, the big story of the day is Trent out of trend. Let's look at it from multiple angles. The first part, why is the stock lower? Remember, they reported their third quarter updates. The revenue grew 17%, 5,220 crores odd. The first 9 months of this financial year, the revenue has grown 18%. The company had said that on a sustainable basis, they can compound revenues at around 25%. That hasn't happened. The first 3 months, of the first 3 quarters rather, the revenue growth hasn't even crossed 20%. And this compares to that 5-year revenue CAGR of 38%. So on all parameters, the growth has really slowed down. And what are brokerages saying now after this big decline that we've seen? Citi has reiterated their sell call. Their target is 43.50. Remember, the stock is at around that 4,100 odd rupees as well. And if you look at the reported standalone revenue growth at 17%, was slightly ahead of their estimates of 15.3%. What was positive was the number of stores that they added. But at the same time, if you look at, Citi's own estimate of average revenue per square foot, that is down by about 15.5%, and that means that there could be an impact on their operational performance in this quarter as well. Now, one would say that, okay, after this 40% decline in the stock all of 2025, is that in the price? If you look at it, at peak, the stock was trading at 140 times. The 5-year average was 95 times prior to earning, and now the stock is trading at 72 times. So on a PE basis, it seems like, okay, it's making sense right now. But, well, here's what the catch is. When the stock was trading at peak valuations, the 3-year sales CAGR was around 55%. The profit CAGR was a lot higher. So if you look at just that, the PE to growth ratio, the PEG ratio, it was at around 2.5 times. Now, if you look at it, after this correction, while the PE is around 70 times, the first 9 months sales growth has been around 18%. So to that extent, the PEG ratio looks a lot more expensive at 4 times. So while the PE has corrected, growth has corrected faster, which implies that on a PEG ratio basis, the stock hasn't fallen. In fact, it's become a little more expensive. And that brings us to the next few triggers from here on. What are we going to track? Same-store sales growth in Zudio and Westside. Recovery in sales, given boost to consumption. Has sales growth actually bottomed out? And the growth in newer formats of the company like Star Bazaar, Utsa, or Burnt Toast, etc. We also need to watch out for a couple of risks, further slowdown in sentiment. And when Zudio had the head start, we didn't have players like Ustar, Shane, Intune owned, all of them. Now they are coming to the fore, and they don't have any presence in online fashion. Are they looking at that as a growth trigger or not as well? Or will that impede their growth or not, will be the answer. The question rather. And the question once again, is Trent out of trend?
Well, let's ask that question to Jiganshu Ghor from Bernstein, who's joining in now to take this conversation forward. Firstly, Mangalam, thank you for explaining that to us as lucidly as possible. Jiganshu, good morning. Thank you for joining in. As you heard Mangalam highlight Trent, there was a time when the market was appreciating the fact that the company is growing at 35-40% every quarter. Now it's still growing at 20%. It's still not 35 to 40, but it's still 20 nonetheless. Is the market still taking time to accept the fact that this might just end up being the new normal, and that 35 to 40% expecting that to continue growing at that for a longer term is a little unrealistic?
Thank you for having me. It's always a pleasure. But I fully agree. I think a large part of the stock price reaction on Trent has been recalibration of expectations on both the sell side and as well as the buy side over the last 12 months for the growth trajectory to what I would say normalize to a more sustainable level, given the size of business this Trent has created in such a short time. So at this size of the business, which is close to 20,000 crores, a 20% growth company, in my view, with stable or marginally expanding margins from here is still positive. But the the investors have taken time to adjust for it to be not an internet growth company, but a more traditional apparel growth company or a fashion retailer company.
Jiganshu, what is a broader takeaway in terms of, consumption slowdown or how the urban story especially is playing out? Even in terms of the store count, while that has increased quite a bit, the revenue per store has also fallen. So, just a broad sense of whether this aggressive store expansion strategy is something that is still viable.
So I think there are two questions. Let's address them separately. On the broader consumption slowdown, our views since late last year, when we looked at the October and November UPI data of transactions as well, has been that despite all the efforts that the government has made, it has not necessarily resulted in better expenditure or pickup of a broad-based nature on consumption for discretionary categories. It has not happened. We don't expect it to be automatic in 2026 as well. So we are a little bit cautious and believe the consumption will remain soft. And that is the backdrop that Trent is operating in. In terms of its growth, I think the store growth is not a concern in my view. The revenue growth has been hampered because they've over cannibalized their stores last year. And we've seen a change in their strategy over the last 12 months, where a lot of stores were going into same pin codes, same locations, and hence cannibalizing their existing stores. We've seen that change. And second is these smaller stores, or these younger stores rather, and stores in tier 2 and tier 3 come with a lower revenue per store, with a lower revenue per square feet. Not necessarily lower margins, but you will see an optical reduction in the revenue per square feet and revenue per store as they open more tier 2, tier 3 stores.
All right, Jiganshu. Right, we get that point. Just one final question on Trent before we move on to other topics as well. You said that the street needs to recalibrate its expectations on Trent. The company itself has said after growing, 40% CAGR that a sustainable growth is around 25%. The last 3 quarters, that number hasn't come by. Assuming that, this number settles somewhere between 20 and 22%, what would be the right multiple and the right valuation to ascribe to this stock at current levels?
So we believe the right way to think about a growth is a 20% CAGR of revenue and maybe a 22% kind of a CAGR on profits over the next 3 years. The increase in profits will largely because of operating leverage. At that, we ascribe it a valuation of 5,000 rupees for 15 months from here, so which is sort of March 27 number. And that 5,000 rupees implies a multiple of around 60-65 on earnings, which we feel is lesser than the 3 peg that you just mentioned earlier and much lower than the 4 peg that you are talking about. Somewhere around the 3 peg, 5,000 rupees.
Got that. Currently, it's at 4 peg and 2.5 is what it was at peak. And that's what the basic, trend has been over the last few quarters. But if you believe that it grows to around 20-22%, then the peg obviously moderates. But that's about Trent. We'll obviously, speak more on this as we go along. The numbers come by and we get a lot more detail here as well. But apart from that, a couple of stocks which are not doing well belong to the quick commerce space. So we have Swiggy, which is down about 5% right now. Eternal is also lower. And yesterday I put out a piece where I stress tested the model with, the contribution margins, how that, moves with an increase in gig payout workers as well. Currently, the price is close to around 50 rupees per order on an average, which equates to about 70 to 120 rupees in terms of earnings per hour. And if that number were to increase to about 60 rupees or 70 rupees, the break-even points for average order values will increase from 700 rupees immediately to 800 rupees and all the way up to 1,000 rupees as well. So do you think that the conversation around this gig worker payout, etc., is could be a bit of an overhang on these stocks? And that an increase out here, if that were to come by, it would be an adverse reaction on these counters?
I would say I'm more concerned about their ability to meet growth expectations of investors because that is the first milestone that most investors are looking for, is how big is the market really, versus thinking of where the stable unit economics lie, at least in the next quarter or so. So I think the bigger overhang is if they disappoint, if the stocks disappoint on growth rather than this. Rather than just on specifically on gig economy workers. I also think that the gig economy workers is a more economics question, and really approach it from economics perspective rather than any other angle. From purely economics, I think it's demand and supply, right? And it's a demand and supply in the workforce environment. Till that situation changes, I don't expect it to really negatively financially impact any of the quick commerce players.
So you're more concerned about growth out here. What's your call on these stocks? I mean, everyone's raised money. They're sitting on similar cash piles now, Swiggy, Eternal and Zepto, obviously having filed their confidential DRHP. What's your thought process here? What's your call?
So I would say both of them should both meaning Eternal and Swiggy, which we formally cover, should be able to continue growth at least for this fiscal year, and even maybe a couple of quarters of next fiscal year. Overall, though, the challenge will be a volatile 2026 for both of them, given the amount of effort that competition will play. This is one sector which does not depend on my earlier statement about broader consumption being stressed, because they are largely enabling channel shift from existing to new channels, but they are more affected by the competitive scenario. And that, given the size of the price, we think that will remain intensely competitive going through 2026. And hence, that is again the second big overhang again versus profitability. So it's growth and competitive dynamics. So we expect the sector to remain volatile, Mangalam. I don't expect a massive upside, significant immediate upside on either of the two names.
So, Jiganshu, do you see a similar kind of volatility in these hypermarket retail chains as well? See, be it V-Mart, be it Avenue Supermarts. V-Mart's update was on the softer side, as was D-Mart. And of course, the smaller players as well, such as V2 or even the Vishal Mega Marts. What do you make of the space over there?
So we've last 2-3 years, the players who have been focused on slightly middle of the pyramid consumers and consumers in tier 3, tier 4 cities have done better, because the inflationary environment there has been softer. And we've written about it. So I think that base is now going to challenge those players. So whether it is Vishal Mega Mart, which we formally cover, but V2, V-Mart, Style Bazaar, which we don't cover, they will have a more pressure from base effect. And we believe the consumption environment remains. They are more affected by the broad-based consumption environment being weaker, both on staples as well as on discretionaries, than the internet names are. So we think the softness will continue.
All right, we'll take that point. Thank you, Jinanshu, for joining in and speaking on a whole host of sectors and stocks. Apart from just Trent, that was the big story of the day, but you've given us enough fodder for thought for our next conversation as well. Meanwhile, before we take a short break, do not lose sight of Reliance. That's the big loser right now on the Nifty. In fact, it's down 5%, extended its cuts. And as a result of which, when we started the show, the Nifty was at 26,200. It's fallen further 50 points. It'll be prudent to perhaps pull out, the contribution chart to give you a better picture on what kind of impact Reliance's decline has had on the Nifty. As you see, the Nifty fell through the cliff, down almost 50 points in quick succession, and that is because Reliance fell as well. And there you have the contribution chart. 145 points is the drag on the Nifty by Reliance. Had it not been for that counter or the decline on that stock, the Nifty would have actually been higher by about 50 points. So that's the story of the morning so far. We'll obviously come back, focus on the markets and focus on individual stocks. Take a short break, come back. And while we speak about the markets, also get in the bond market action from Manisha Gupta. Stay with us.
Fly Emirates, fly better.
A 100 points lower on the index now. 26,150 has been taken out as of now, and Reliance Industries being the big drag as Mangalam was also highlighting just before going to break. There's a 145 point drag coming in from Reliance Industries, so 5% lower on the stock now, trying to defend levels of 1500. Remember, the stock made a record high in yesterday's session, crossing levels of 1608 before it cooled off from those levels, and it has now slipped further in today's session. What's also turning out to be a bigger drag is HDFC Bank, and that's the second straight day of losses now for the stock. It was the big drag on the index in yesterday's session, and in today's session as well. The stock has now slipped to the lows of the day, almost 1.75% lower. The other big contributor to the Nifty downside today. So two major Nifty heavyweights putting the index lower, and trying to offset these losses is ICICI Bank, and that's possibly the only reason why the Nifty Bank too is currently in the green, and the stock currently trading with gains of around about 2.5%, and that too is seeing some bit of cool off is the Nifty Bank. But shifting focus to the bond markets then, Manisha Gupta is here with the latest. Manisha.
Well, thank you so much for that. We'll start with the bond street, where we are looking at almost 5 trillion rupees of state bond issuing calendar that we have seen for the quarter there. So the round one is today, and we understand that the 9 states will raise 301 billion rupees as in today. It will be in few minutes that we would understand the final calculations of what the states really have been able to raise in sense of bonds there. Interestingly, it also is that the state-owned banks, that is, in the secondary market were able to raise almost 92.55 billion worth of gilts there. If you look at the overall market, well, the participants do tell us that the 10-year gilt is expected to trade between 6.6 to 6.66 of a range in this week itself. The focus clearly is going to be on the inclusion announcement of the Indians bond in the Bloomberg's Global Aggregate Index next week. Well, markets do believe that this is not going to be an issue at all, and it's getting priced in as well. This is after the S&P Global Ratings has upped the long-term sovereign credit rating on India to BBB in 2025. The first advance estimates of the GDP 25-26 are also expected on 7th of January, and this is going to be yet another factor that the street will watch out for in sense of course, movement in rupee and bonds as well. I also want to take you through on what the companies have been able to get approved in sense of raising their debt. So we have nearly companies like Satin Finserv, 400 million through July 7, 2027 bonds is what they are looking at. The other company on my radar is Trent Pharma. Well, they're looking at an approval from board at 125 billion via NCDs. REC also has its board approving 1.55 trillion rupees via NCDs as well in the going days. You also have to take a look at other companies like JSW Steel, 50 billion via NCDs is what they have an approval from their board as well. And then it also is about Axis Bank, 350 billion via debt for this one. There's Bank of Maharashtra also getting an approval to raise around 100 billion rupees via infra bonds for FY26. Interestingly, we were talking about Adani Enterprise Limited yesterday on how they have come out with a 1,000 crore bond as well. And what we do understand is that they have seen 1,000 crore fully subscribed within 45 minutes, and the base issue of 500 crore was done in 10 minutes itself. So good going when it comes to the Indian bond markets therein.
Manisha, thank you for sharing that update from the bond market with us. And take a short break here on Trading Hour. On the other side, market technicals with Rajesh Palvia of Axis Securities. Along with it, his top trading bets as well. Stay tuned.
Welcome back to Trading Hour. Markets continue to be under pressure. The broader index trading with cuts of about 85 points and the Sensex with cuts of almost 400 points. Reliance, HDFC Bank, these are two of the big laggards that we've been telling you about. On the flip side, ICICI Bank and SBI lending some support. But good time to invite Rajesh Palvia, the VP Technical and Derivative Research segment from Axis Securities, for a quick technical check of the market. Rajesh, thanks for joining us today. We saw, of course, individual stocks dragging down the Nifty, but overall we'd seen it consolidate earlier around the record high levels. We'd seen around 26,300. What is your short and maybe a 3 to 6 month target and top stock picks?
Hi, morning. So it's a weekly expiry and Nifty's consolidating in the range of 26,000 to 26,300 since last couple of trading session. Looking at the derivative data, also the major call writing activity has been witnessed at 26,200, 300 strikes. So these levels are likely to create some pressure for the near-term perspective. But on the other hand, 26,100, 26,000 are attracting major put-based concentration. So I think market is likely to remain in the range for next couple of trading session. Any breakout about 26,200 may attract short covering action, and then Nifty can scale up further higher. But in today's market, the major pressure is coming from the Reliance as well as from the HDFC, which is dragging the Nifty on the lower side. But some of the pockets like metal, pharma, banking, these three pockets are showing sign of buying interest. So, and I think the trading opportunities are there in these three sectors, as this sector is clearly outperforming compared to other sectors. So I think one can focus on these three sectors for near-term to short-term perspective. Looking at the market outlook for next 2-3 months, we are projecting target of Nifty towards 26,600 for next couple of months. On the downside, buy and accumulate would be the strategy until the Nifty not breaks below 25,800. So that's the major support area for Nifty on the downside. Bank Nifty is clearly showing a sign of strength, and the way Bank Nifty is holding above 60,000 mark, I think here we could see further more continuation of up move. So Bank Nifty can scale up to the next target of 60,500 to 60,600. So one can remain on the long side of trade with stop loss of 59,800 at this juncture. Moving to the stocks, we are focusing two stocks at this juncture. One is from the healthcare space, that is Apollo Hospital. If you look at the weekly structure, stock managed to give breakout of its falling channel resistance area. And looking at the reversal on the near-term chart, we believe that this upward momentum can extend further, and possible target towards 74.50 to 7,500 we could see in the near-term perspective. So one can buy with stop loss of 7,200. Another stock is from the banking basket, that is IndusInd Bank. Very strong buying action in last couple of weeks. Stock has already bottomed out on the near-term, short-term chart. So looking at the breakout above 900 mark, I think stock has potential to extend its gain. 945 to 950 we are projecting target with stop loss of 902.
Rajesh, a quick word on Trent as well. Every time the stock has an update, it falls 7-8%, then sees a bounce, then another update, and it's back to the same levels of around 4,000.
Yeah, stock is moving in, down sloping channel on monthly chart, which is a clear sign of, sustained supply pressure is taking place. Series of low top, lower bottom formation. Stock is trading below to all its near-term, short-term moving averages. Looking at the fall again, stock is, approaching towards its previous swing low, which is almost at around 4,000 level. That is very crucial for this correction. If at all stock breaks below 4,000 mark, I think stock may correct further towards 3,800 also. So at this juncture, until unless stock not able to regain above 4,300 mark, I think sell on rise would be the strategy for Trent.
All right, sell on rise strategy on Trent. As we speak, the 4,100 put extremely active on Trent, and as the 4,000 put on the way up is the 4,200 call, which is equally active as well. So even if we do see some support here, unlikely to cross past that 41, 42.50 mark from here on is what the options data is indicating. But more on F&O in just a bit. In the meanwhile, we do have Sudarshan joining in on Tata Motors PV. Sudarshan.
So the company has released the quarterly update for JLR, and as expected, the update is weak. Wholesales and retail volumes both are sharply lower. So wholesales are down more than 43%. Retail also has fallen 25% Q3. And if you talk about 2025, wholesales are down more than 26%. In all the markets, volumes have fallen. Some of the markets like North America, volumes are severe. There is a fall of more than 60%. Now, what's the reason behind this fall? First, there was a production stoppage because of cyber incidents. And second, there's a planned wind down of legacy model of Jaguar. That's the reason the sharp fall in the volumes. If we talk about the contributions, three major contributors are Range Rover Sport and Defender. And these three together have formed almost 74% of total volumes that company has reported. And the contribution is up 400 basis points year on year. But on a sequential basis, there is a fall of 200 basis points. And that's the reason there is a fall of more than 2% in the share price.
Not doing very well for itself is Tata Motors. But Sudarshan, what about Bajaj Auto? It's received an upgrade today.
So last week we were talking about when the company had released the monthly sales, the sales numbers were largely in line with estimates. But one segment that has been doing very good for Bajaj Auto is the export segment. For third straight month, company has reported export sales of 2 lakh units. Now today, MK has come out with a note upgrading the stock to buy from add, and target has increased to 11,100 from the earlier target of 9,500 per share. It says that implies an upside of 17% on an account of upgrade in the EPS for both FY27-28 in the range of 4 to 9%. Now, what's the reasoning behind it? First, is that domestic two-wheeler market share for Bajaj Auto has bottomed out in the last few months in its focus segment of 125cc plus. It has gained market share. As of November, its market share in that segment had increased to 23% versus 21% earlier. Second, export, as I've already talked about, the trend has remained strong for the last 3 consecutive months. And second, companies looking to launch new version of Pulsar. There can be 2 to 3 variants of Pulsar in 2026. Rajiv Bajaj last month, while talking to to us had talked about this. That can also be the that can also aid to the growth. And next one is the currency depreciation. In 2025, rupee had fallen 5% against US dollar. So in Q2 FY26, dollar realization for Bajaj Auto was 87. That had increased to 89 to 90. And if there is a fall of 1 rupee against dollar, it helps EBITDA by rupees 300 crore on an annualized basis. And last one is electric three-wheeler portfolio has also scaled up meaningfully. And for this, EBITDA has already achieved break-even.
All right, so it's a positive cues for Bajaj Auto. Thanks very much for joining in with that. The stock up 2.5% in trade today. On that note, we'll slip into a short break. But up next, we're going to discuss the market fundamentals with Nikunj Doshi, who's the managing partner and CIO PMS from Bay Capital Investment Advisors.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. There is some marginal recovery from the lows on the index. You're back at that 26,180 mark as we speak. So finding some support at that 26,150 mark. But time for CNBC-TV18's new offering, the macro signal. The aim is to isolate the macro forces that matter for the day and explain how it translates into market moves. Now, Ritu is here to tell us the loan to deposit ratio and the cues the market can take from that. Ritu.
Well, yes, the banking system is flashing an important liquidity signal that we should take note of, and that is the loan to deposit ratio, or LDR, what is also sometimes called the credit deposit ratio. Now, it has climbed to an all-time high of 81.6% as of the latest data from December that RBI has released. And simply put, it is actually a measure of how much of the bank's deposit is being lent out. So a high ratio like this shows, yes, there is strong credit demand, which is usually good for the economy, but it also comes with trade-offs. If it's too high, it can limit future credit growth and also squeeze profit margins. And that's why economists and investors keep a very close eye on this LDR ratio. So why has LDR climbed so high? Because on one hand, you have credit growth, which after, a bit of a lackluster FY25, it has picked up momentum again and now at 12% kind of levels because of, higher auto loans, unsecured retail credit growth, gold loans, MSME lending, all of that picking up on the back of the GST cuts and the festive season demand. But on the other side, you have deposit growth, which is lagging, and it is now in single digits because households, as we heard the JNK Bank also talk about earlier, moving money from bank deposits traditionally traditionally into, higher yielding assets like your mutual funds, stock markets, etc. So this gap between loans and deposits, it has steadily pushed the system-wide LDR from 75.8% in June 2023 to 81.6%, today, which is a structural shift and not just a blip. If you look at data, the provisional data that has been released by banks and some of the study done by Macquarie, it shows deposits lag the loan growth by 250 to 300 basis points in this quarter so far, and that is reversing the brief stabilization that we had seen in 2025. And it's not just system-wide. Individual banks are seeing very similar trends. For instance, HDFC Bank's LDR, it rose to 99.5% in Q3. And despite reporting relatively stronger business momentum, you've seen why the stock has been under pressure simply because of the concerns on this high LDR. For other private and public sector banks as well, if you pull up on your screen, we've similarly seen a rise in this ratio. Now, why does it matter and why are we focusing on it? Because a high LDR can limit future credit growth when you've already over-leveraged your deposits. It can weaken the rate cut transmission from RBI and, of course, put pressure on your net interest margin for banks because they might have to hike deposit rates to attract more deposits. Now, that said, immediately, there is no cause for alarm at all because banks still have excess SLR. The liquidity rules with the new LCR norms kicking in will also be eased from the 1st of April, and asset quality is pretty stable for the system. Even credit growth is very demand-driven and not very speculative. So no cause of concern there, but still, it is a slow burn risk. While there's no strict regulatory cap on LDR from RBI at the moment, levels above 80% are generally considered a tight liquidity zone. And if you have sustained LDR above these levels, that can gradually erode margins for banks. It can curb loan growth and weaken policy transmission even without any sudden crisis. So an important macro signal to keep on our radar. So that is as far as the macro Q is concerned, but let's invite Nikunj Doshi, the managing partner and CIO PMS from Bay Capital Investment Advisors, to discuss market fundamentals and his top sectoral picks. Nikunj, thanks very much for being with us here. I see financials is one of the key themes apart from digital that you focus on. And, given what we've seen so far with the provisional business updates and this issue of a very high credit deposit ratio, how bullish do you remain on the sector with these mixed cues that are coming in? On one hand, healthy balance sheet, record low, NPA levels, but on the other hand, cues like this emerging.
So, good morning to you. Just first of all, I think I would take credit growth as a bigger signal, positive signal than the LDR ratio, because after a long time, we are seeing credit taking off, and that signals private capex is picking up. So I would be more positive because of that. And I think LDR can be addressed, and RBI is trying to address that by easing liquidity in the system, as well as I think GST cut will give more in the hands of the consumers, and we'll see deposits also growing at a later date. So I think I would take credit growth as a bigger positive and not worry too much about LDR at present.
All right, we take that point, Nikunj. Thank you so much for joining in. So that's about the banking space, the LDR. You're positive on the loan growth. But I'm looking through your investment strategy, and you have been investing in a lot of these new age consumer companies. I just wanted to understand what your investment approach here is. Are you looking at it as a portfolio and hoping that one or two really make good money? Or are you looking at it as a stock-specific thing, notwithstanding the valuations as well? Because there are two approaches here. What are you looking at, and what are the kind of stocks that you like here?
So I think in digital space, why we are bullish is basically because of the digital as an economy is picking up, and the businesses which are using digital channel as a leverage, they are going to see a hyperbolic growth in the coming years. So we are focusing on companies which have got a larger TAM. Secondly, unit economics wise, that makes sense. And thirdly, we are looking at the valuations from, say, 3 to 5 years perspective. So immediately one may think that it's expensive at present. But if you take 3 to 5 years kind of view and the kind of hyperbolic growth expected in earnings, then it makes sense to invest at the current level. However, I would just caution for the new listings in the digital space, I would say one should look at digital means new listings perhaps after 6 months of their listing, because after 6 months, most of the lock-ins open and the 2 quarters of growth post-listing also is visible. So I would advise to look at these digital listings companies post 6 months of their listing, because that's where we'll see selling pressure also emerging, and 2 quarters of growth also will be visible in the numbers.
Since you spoke of new listings, Nikunj, you speak of some of the not so new listings as well. We are on the cusp of another earnings season, and just before the earnings season has come up, there have been a lot of mixed / divergent views on the Indian IT space. Some of it, read a note from CLSA yesterday which said that you should trim your positions. They downgraded a couple of names as well. Today, Jefferies has come out with a note saying that there is a risk of earnings downgrades in FY27. With the kind of moves that you've seen in the IT names, do you think that the market has already priced in the worst and things that can only look upward from here?
So in IT services, basically, we are not too much focusing on IT services as a investment opportunity. And we are more focusing on the companies which are likely to benefit from the AI trend. Because what we have seen is that most of the global tech companies have invested in AI infrastructure, creating infrastructure. But now the companies which are using AI will see tremendous benefit emerging from efficiencies and productivity gains. So I think we are focusing more on the companies which are likely to benefit from AI trend in the coming years.
You know, Nikunj, the other bit that has been the big talking point has been the rally in the metal names that you have seen, be it Nalco, be it Hindustan Copper, Hindustan Zinc. With the kind of rally that you have already seen, stocks doubling in 6 months and so on, does metals still remain a tactical / cyclical play? Or do you believe that, okay, there is a start of a super cycle and there is still more to come, barring the occasional dip?
See, frankly speaking, we are not tracking commodities as such because commodity is unpredictable and we can't predict what's going to happen. But I remember one thing when Hindustan Zinc IPO came years back. That time, all the analysts had prediction of zinc prices going up like this. However, it never happened. So when the market is bullish in commodity, people try to predict the linear growth in commodity prices. However, it never happens. So I would be skeptical on commodities.
Sparing time and joining us today with your views on the markets and on some of the important talking points as well that are currently ongoing. Take a short break, get you more on the markets on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
So 50-point recovery from the lows of the day, as just before we pointed out, going into the previous break, a couple of stocks before we go to Mangalam. Indian Metals and Ferroalloys is one such name. It's down 12% as we speak. It's down to the lowest point of the day currently. And the other one that is also down to the lowest point of the day is SRF. That's down around 3.5% as well. But with this kind of recovery and very volatile moves, what is the F&O data indicating as we go into the second half of the weekly expiry? Mangalam has hopped over to the F&O desk.
Well, the market is down but not out. That's the exact kind of reading that one gets from the F&O space because when we are looking at the Nifty closer to that 26,150 thereabouts, from there has been a recovery. And the reason why I say that it's not out is because of a couple of factors. If you look at it, one, the Nifty Bank is higher by about 1/3%. And this despite the HDFC Bank putting pressure on it. So you pull up the contribution chart of the Nifty Bank, you would see that the HDFC Bank stock is pressurizing the Nifty Bank by about 250 points. If it wasn't the case, the Nifty Bank would have been a lot higher. And conversely, if you look at the Nifty itself, a large part of the pressure is actually emanating from Reliance. So, Reliance is taking the stock down by almost 120 points. And if you look at, X of these two heavyweights, the market's fairly well. The only thing that we need to monitor as we move further is the advanced decline ratio, where the stocks which are advancing are a lot lesser than the stocks which are declining, and that line has been widening. If you look at, supports on the Nifty as well, below that 26,150 mark, we have both the 20 and the 50-day moving average around that 26,000. So we have strong support too. Just for today's expiry, a couple of things that stand out. As the Nifty is moved towards that 26,200 mark, the 26,200 call is fairly active. That has a premium for almost 20 rupees. And the 26,150 call also has been fairly active, a premium of 50 rupees. So levels upwards of 26,200, difficult for the market to sustain. But if it does sustain, there could be case for a lot of short covering as we move along expiry. But at the lower levels, put writers are equally active at 26,150. In fact, for a market which was as low, put prices have been actually lower, which implies that there has been writing, and 3 crore shares standing at 26,150 tells you that there is support. And the put call ratio too had moderated to 0.79, now coming to around 0.84. So that's telling you that there is some semblance of sanity in the market, making headroom for a recovery from the lows. The other factor, volatility has been fairly contained. Yesterday, when the Nifty was consolidating, the VIX was higher by 7-8%. Right now, the Nifty falling and recovering, more volatile today, but the VIX is not reflecting that. So that's telling you that the market, participants are a lot more settled with today's moves than they were yesterday. And a couple of more factors as well. The big weight on the Nifty is Reliance. The Reliance 1500 put has the maximum open interest, telling you that after this fall at 1500, we still have a fair amount of support at that stock. So a large part of the decline is done on that stock. The second part on Trent as well. Yes, we've seen a big decline on Trent, but the 4100 put is fairly active for a premium of 110 rupees, telling you that around that 4,000 mark is strong support coming in for Trent. But on the way up, recovery is unlikely to be very sharp because the 4200 call is equally active, and that has a premium for almost 70 rupees. So Trent is likely to be range bound between 4,000 rupees to 4250 odd thereabouts. But for the market, it's down but not out.
Down but not out indeed.
Okay, down but not out, and we'll keep an eye on names like Reliance, HDFC and Trent. Mangalam, thanks very much for taking us through that. The Nifty Bank, though, continuing to hold on to 60,200 odd levels, while HDFC is down. You do have quite a few financials that are up and about in trade today. Some of the top Nifty gainers, you have names like ICICI Bank, State Bank of India. Then you have, NBFCs like Bajaj Finserv, all up and about. Axis Bank also gaining in trade. On that note, we'll slip into a short break, but don't go anywhere. We're back to focus on the markets in just a bit.
26,185 is where the index stands as we head into the second half of this weekly expiry on the NSE. Continue to keep an eye out on Reliance Industries, HDFC Bank and Trent. Take your leave on this edition of Trading Hour. From Mangalam, Ritu and me, thank you for watching. Halftime report on the other side.
Nifty trades lower, largely led by oil and gas stocks like Reliance Industries and the oil marketing stocks. Pharma, metals, as well as PSU bank stocks trade higher. This morning, the benchmark indices and Nifty started 2026 on a weaker footing compared to other Asian emerging markets, which are doing well.
The Trent stocks fall sharply after it reports standalone revenue growth of 16.9% in Q3. Growth has been trending lower for the company from 19.8% in Q1 and 17.1% in Q2. Banking major Axis Bank posts a 3.7% quarter-on-quarter growth in advances, leading to an over 14% YY growth, outpacing system average growth by around 200 basis points. The stock is up 1%.
Gold prices edged lower in Asian trade after a 3% rally overnight. Silver prices had also jumped 7% last night. In base metals, copper sets a fresh record high after fresh mine disruptions globally, reflecting the move in underlying commodities. Hindustan Zinc and Hindustan Copper trade 2% higher each. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra as well as Vinny Motiwala. Well, it is turning out to be a session where we are seeing some amount of tempered losses coming in for the markets at this point in time. So we have the Nifty, which is down around 80 odd points, and we have the mid-cap index, which is down around 137 odd points at this point in time. The Bank Nifty managing to hold up with a gain of around 0.3%. Maybe the updates coming in from Axis Bank has fueled sentiment on on the upside. So as you can see, the Nifty Bank up around 0.3%. A lot of stocks on the downside, so oil and gas is under pressure, and specific stocks such as Trent, which is dominating headlines. That one is the top loser on the Nifty.
Hey girls, good afternoon. We have to watch out for Reliance Industries as well. Apart from the big names that we've been tracking, that stock is down around 4.5%, a big weight on the Nifty. And despite the positive news flow in terms of the Venezuela, what's happening in Venezuela, and which would mean more crude coming to Reliance Industries at discounted rates, there is some sort of negative sentiment that is seen there. But apart from that, if we talk about the segments which are doing well, we do have the PSU Banking Index, which is batting it for the bulls. The Nifty is off around 107 points from the highs of the day. So watch out for the moves on the Nifty. It's been quite volatile. We did see some pickup around 11:30, but again, it has been sold into. And a lot of these big names which have come at the day's low. We have something like a Bajaj Finance, ITC, Geo Financial, Coal India. All these stocks are lower in trade right now. And mid-caps, Winnie, they continue to trend lower.
Absolutely. Hi. Good afternoon, ladies. So, yes, mid-caps, they continue to trend lower. We are seeing some of these names that are coming in on the broader end of the market, whether it's First Sky, that's Brain-B Solutions, Whirlpool, Inox Wind, Ola Electric, some of these Nifty 500 companies which are under pressure as well. So, that is something that we'll watch out for. A lot of updates that have come in as well in terms of Q3. So, keep an eye out on the banking side as well. Obviously, in terms of the top drags today from the banking front was HDFC Bank, but on the flip side, we have ICICI Bank, which is holding on to gains of almost 2.4%. So, other than that, PSU side, we have SBI, that's doing well. But let's put the spotlight on the big story of today, that is Trent. Now, and the questions among investors across what is the key reason behind the fall in Trent. The stock has been making fresh lows every quarter. Mangalam is joining us now to give us those details. Good afternoon, Mangalam.
Well, the way the stock of Trent has fallen, the question that everyone's asking is Trent out of trend. Let's look at it from various perspectives. Okay, why is it that the stock is lower? Well, they reported their third quarter update and the revenues grew 17% to a little over 5,200 crore rupees. But this 17% is actually a lot lower when you look at what the company's historic growth rate has been and their own past targets as well. So the 9 months of this year, their revenues have grown by about 18%. The street was expecting better growth rate to come by in the second half of this year. That hasn't happened. The start of the year, when the company met the analysts, they said that maybe a sustainable CAGR is around 25%. 3 quarters of this year, they haven't crossed the 20% mark. And the number for the first 9 months is actually less than half of the 5-year CAGR of 38% itself. What are the brokerages saying? Citi, for one, has reiterated their sell call. They have a target of 43.50 on the stock, which is slightly higher than what the stock is trading at after today's fall. Their reported standalone revenue growth of 17% is actually better than their estimates. But what the company has done over the last 1 year is increase their store footprint. While it's a good thing, revenue growth hasn't kept up. So as a result of which, average revenue per square foot has come down by about 16% as per Citi's estimates. The like-for-like growth is also lower. With Trent, the question is always valuations. At peak, when the stock was around that 8,000 rupee mark in October 2024, the stock was trading at 140 times. The 5-year average for the stock has been 95 times. And currently, after having seen a 40% decline last year and further lower, it's trading at around 70 times. But it's not just the absolute PE that you look at when you're looking at Trent. You have to look at valuations in context of growth. So when the stock was trading at peak valuations at 140 times, the 3-year revenue CAGR was 55%. Then comes the PEG ratio, which is price earnings to growth ratio. If you look at the PEG ratio, that time the stock was trading at 2.5 times. Come 2026, FY26 right now, the first 9 months, the revenues have grown 18%. Even if the stock has corrected about 50% from the top, you look at the PEG ratio, it's 4x. So while on an absolute basis, the price to earnings has come down from 140 to 70 times, the growth has fallen faster, and as a result of which, the PEG ratio has gone up from 2.5 times to 4 times. So even if the stock has traded lower in price, it's actually become a little more expensive. So now what needs to be monitored is how same-store sales growth in Zudio and West Side pan out, what the recovery in sales is, given the boost to consumption made by the government. At the same time, the newer formats, Star Bazaar, Utsav, Burnt Toast, are they likely to make up for the lost growth that we're seeing in Zudio or not? Amidst all of this, there are also a lot of risks. When the company started with Zudio, the value fashion business, there wasn't much competition. Now there is Yousta, Shein, Intune, Owned. Could there be further slowdown in consumer sentiment? And finally, Trent, as design is not present in online fashion, could that impede growth or not is the big question. So yes, the stock has fallen, but it's not particularly become cheaper. It'll only look more attractive once growth returns.
Okay, that is the big question, right? After this fall, is the stock looking attractive? But that answers most of the investors' questions. Thank you so much, Mangalam, for analyzing Trent's moves over the years and their growth patterns as well. That's about Trent. That's our big story for the day. But it's time for our movers and shakers segment, where we track a whole host of stocks buzzing in trade. Let's start with Divi's Labs first up. Ekta, we've been talking about pharma every day, be it the GLP-1 drugs. But now what's happening with Divi's?
Well, yes, Citi is bullish on Divi's, and GLP-1 is a part of that story that they like as well. So what they have said is that they have a buy with a target price of 9,140 rupees on that particular stock. They think 2026 can be an inflection point for Divi's. The company has a strong pipeline of catalysts over the next 12 months, according to them, and that includes a GLP-1 as well as contrast media. Now, various custom synthesis products are also maturing, which may be commercialized in the near term. The generic segment, according to them, too, is expected to witness a recovery in 2026. The quarterly numbers, according to them, may experience volatility and present forecasting challenges, but the medium to long-term story remains intact. They believe that Divi's revenue EBITDA can expand by 3x to 4x over FY25 to FY30, and FY27, FY28 estimated EPS is 10 to 18% ahead of consensus. So I do understand that this particular target price that Citi has is one of the highest on the street for Divi's Labs. It is, they are quite bullish on 2026. But let's go across to Mangalam. He's looking at Dabur from the FMCG space. Mangalam, over to you. A little disappointing and subdued.
Well, it's subdued more than disappointing. The stock is actually down just about 1%. We had expected a mild green uptick on Dabur today, but it's lower because the street perhaps does not like the fact that the revenue is growing mid-single digits. But there are reasons for that. All of October was, impacted by the GST 2.0 transition. There are more, positive, news pieces coming in on Dabur in their third quarter update than negative. Consolidated revenue, because of the decline that we saw or low offtake that we saw in October, the revenue has grown in just mid-single digits. But EBITDA and profit have grown ahead of revenue, which implies that there is margin expansion. The second part, the company says consumer sentiment improved in both urban and rural areas, with rural doing a shade better than urban. Home and personal care business actually grew in double digits, so that's a positive as well. The healthcare business, while it grew in low single digits, it's actually improved quarter on quarter, so that's a positive too. What put a lid on the gains this time around is also the beverages portfolio, and understandably because of adverse weather. So the beverages portfolio for Dabur comprises of all those juices and fruit nectars, etc., which does not get as picked up in the markets during adverse winters, and that's something that we saw this time around as well. So those are a couple of factors that played out for Dabur, and as a result of which the stock is mildly lower, though there are more positives in this update than negatives.
Okay, Mangalam, thank you so much for that. But let's also put the spotlight on Bajaj Auto now. The stock is as of now holding on to gains of almost 2.5%. Sudarshan is here to give us more details.
So Bajaj Auto, since the time it has announced auto sales for the month of December, has been in the focus, and in the last 3 weeks, stock has risen as high as 10 to 11%. Now today, MK has come out with a note upgrading the stock to buy from add and has increased target price to 11,100 from earlier target of 9,500 per share. That implies upside of 15 to 17%. And the reason there is an upside in the target price because it has increased the EPS estimates for FY27 and 28. That is in the range of 4 to 9%. It believes that Bajaj Auto offers attractive risk reward at the current levels. But what's the reasoning behind the upgrade? First, domestic market share for Bajaj Auto seems to have bottomed out, and in the last 1 to 2 months, it has gained the market share, especially in its focus segment of 125cc plus. Second one, export momentum continues. Recently, for third straight month, export sales have been more than 2 lakh units. Next one is electric three-wheeler has been seeing the improvement in the total sales, and also rupee depreciation against dollar is going to aid to the margin. And lastly, there can be an upside from the KTM that MK believes that will also aid to the total growth.
Okay, all right. Thank you so much for explaining that to us. But we are not done with you yet, Sudarshan. What about Tata Motors PV?
So Tata Motors passenger vehicle has released Q3 update for JLR, and as expected, the total sales, both wholesale and retail sales, were weak for Q3. Wholesales were down more than 43%, retail sales were down 25%, and if you take a look at 2025 data, also wholesales have fallen by 26.6%, and there is a reason to it. First, there was a production stoppage in Q3 because of cyber incidents. Second, there has been a planned wind down of legacy Jaguar model that has led to a fall in the total sales that company has reported in across the segments. You talk across the markets, UK, US, China, everywhere there has been a fall. In US, there is a fall of as high as 65% in the total sales. And if you talk about the contribution, it has got the major contribution from 3 Range Rover cars, and total contribution was around 74.3%. That is up 400 basis points year on year, but on sequential basis, there is a drop of almost 240 basis points.
Okay. All right, Sudarshan, thanks very much for getting us all of those updates from the auto space. Well, we need to take a break now, but a quick note for our viewers. Get ready for CNBC TV18's all-new lineup, incisive analysis, sharp commentary with CNBC TV18's brand new offerings. Watch our new segment, Cut the Balance Sheet with Mangalam and Sonal Putra. Watch Macro Signal with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts.
Welcome back to Halftime Report in CNBC TV18. As of now, the Nifty is at 26,160 leveled. Around the day's lowest point is what the Nifty is trading at. So let's keep an eye out on that. It's just around that level, slight bit of an uptick from that level. But there are a lot of stocks that are moving around in the trading session. Let's go across to Vivek to give us those details. Vivek, good afternoon.
Well, good afternoon and thank you so much. Well, when you're looking at the broader end of the market, it's been an extremely volatile trading session. Quite a few large cap names dragging both the index as well as some of the broader end of the market down as well. In terms of individual stock sectors doing well, the metal pack continues to shine, especially aluminium-based stocks. Both Hindalco as well as Nalco continues their surge upwards today higher significantly. The other stock on the radar is Apollo Hospitals. After a while, last couple of trading sessions, we've seen hospitals make a bit of a comeback, 2.5% higher as far as Apollo Hospitals is concerned. Aether Industries one name from the broad end of the markets, one of the top gainers as far as the NSE 500 index is concerned, up today on strong volumes. MV Photovoltaic, today a note coming in from Jefferies initiating coverage on this particular name with a buy rating higher by over 8%. They say that this stock is undervalued compared to its peers. On the other hand, quite a few laggards as well. The entire pack of OMCs, lower crude oil prices, nevertheless, you've seen quite a bit of a sell-off in these names, HPCL, BPCL, IOC, all of them falling significantly. Swiggy, now this particular name continues to fall, one of the top laggards as far as the broader end of the market as well as the F&O space is concerned. LJVN, the top mid-cap laggard, down on pretty high volumes today. And Wari as well as Premier Energy, both of these names continue their fall for the second straight session, overvaluation as well as analysts calling out a peak as far as pricing for them is concerned.
Okay, take that point, Vivek. Thank you so much for joining in. And earnings have finally started trickling in. GM Breweries looks like a strong set. Revenues up 22%. The profits also higher by 91%. The stock is up by 4%. It has spiked to the day's high. Looks like a good set this time. We'll keep getting analysis on this one. But yes, that stock is reacting to positive set of earnings. While we're talking about earnings, we continue to get Q3 updates as well. We're just starting that season. Gaurav is joining in now with all the BFSI updates, L&T Finance and Axis Bank. Gaurav, how did it look?
Well, first let's start with Axis Bank. If you look at the numbers, it is actually not something usual for Axis Bank to report the numbers. But if you look at the quarterly updates, Axis Bank is back on a track of growth because they have reported 14.1% growth on a year-on-year basis in terms of advances. Remember, that kind of number was seen back in first quarter of FY25 and a time before that. And after a long time, we are seeing such growth coming back in Axis Bank, which is actually a good thing because they are now growing ahead of the market. Apart from that, if you look at deposit growth, now for most of the banks where we have seen the pre-quarterly updates, we have seen deposit growth was a bit laggard if we compare it with the advances growth. But for Axis Bank, the deposit growth has been strong at around 15% on a year-on-year basis. So that is also something which is positive. Apart from that, if you look at L&T Finance, we have already seen company has spoken about their initiatives in AI. And after that, the stock has shown around 50% rally in the last 6 months itself. And if you look at the third quarter's update also, the numbers are very strong. Disbursement growth is more than 40% on a year-on-year basis. And this also reflects more than 20% growth sequentially. When it comes to loan book growth, now it stands more than 21% on a year-on-year basis. Remember, last quarter, the loan book growth, at least in the retail segment, it was at around 18% and it has now grown to around 21%. And the management has said that they want to grow at a rate higher than 25% in the retail segment. And they are also on track to achieve that retailization target. They are now at 98% of the retailization. When it comes to gold loan portfolio, there also we are seeing some kind of good growth because the disbursements in the gold loan is now at around 1400 crores versus what it was at 983 crores just a quarter ago. And remember, this is the business that they have acquired in fourth quarter of FY25. So definitely we are seeing some progress there as well. As a result, both the stocks, we are seeing some shade of green in a trade today.
Okay, all right, Gaurav, thanks very much for that. Well, just want to point out for GM Breweries, if you saw that stock, it's rallied all the way from its 52-week low of around 579 odd rupees to 1286 or 1290. So it's around 120% gain that you've seen on that counter from its 52-week low. So great going in terms of a stock performance. But as of now, also holding up and adding on to those gains up around 3.8%. 90% profit gain is what you've seen in terms of GM Breweries this quarter. But CSB Bank, it reported a strong growth in Q3 update aided by gold loans. Earlier today, we did speak to the management of CSB Bank on their business and their growth outlook going forward. Listen into the comments. The stock, however, a bit weak at this point.
We are not using pricing or the LTV as a kind of a component of growth because our LTV, as you rightly said, has come down almost below 60% now. So we have a comfortable 15% margin on that LTV. Plus for agri gold loans, it is much higher. So to that extent, we are sitting on a very, very high cushion and safety, and we are not taking growth at just because the prices are rising. So that's one. Secondly, the tonnage is also increasing. It's not that it's only growing by the growth. While LTV is falling on one side, the tonnage is increasing. So to that extent, and also these are short-term loans. So to that extent, we do our kind of a sensitive analysis of 10%, 15%, 5%, 3 kind of pricing. If it falls, what happens, what tenor, etc. And we are taking our tenors down. So to that extent, all risk mitigations are in place. So I don't see any risk at all in our particular portfolio. I don't think so, because we are anyway much lower than where some of the other NBFCs and banks are in terms of yields. So to that extent, we are in a safe zone from that perspective. That ticket sizes are going up, and these are coming from SMEs. And a lot of these business loans are getting replaced by secured gold loans. And I think now the realization of the value of gold and from the SME working capital perspective is coming up.
Okay, that's the word coming in from CSB Bank. It's time now for a break. Sachidan Uttekar of Trade Bulls will join in next with some trading strategies on the other side. Stay tuned for that.
Fly Emirates, fly better.
Welcome back. 100 points lower on the Nifty as we speak. The mid-caps too are contributing on the lower side. So it's a good time to get a technical check on the market. Sachidanand Uttekar, VP Research, Derivatives and Technicals at Trade Bulls is joining us now. Sachidanand, good afternoon. Thank you so much for joining in. We've been quite volatile since we started trade today. Do you think that could continue till the end of this trading session as well, considering it's the weekly options expiry? What are the charts suggesting?
Good afternoon, Sonal. Sonal, I think the volatility may continue, but if you look at both the indices, I think they are showing diverging signs. When we look at Nifty Bank, the support zone at 60,000 looks very confident, and we may see the 60,300 resistance getting cleared in a day or so. But if you look at the Nifty, I think it is pulling itself back towards its 5-week exponential moving average support, which is placed somewhere close to around 26,130, 120 kind of a zone. So we may see a further decline from even from this levels, but I think that will be again a good opportunity to create some long positions. If you look at the overall structure, there is no sign of any divergence in strength when it comes to Nifty. And this probably looks like a decent pullback within the overall ongoing uptrend. So I think one should accumulate Nifty towards 26,120, 26,130 zone. One can keep a stop loss at 26,080 on closing basis. And we may see a rebound back towards 26,240, 330 zone, in this particular week itself. But from a trading perspective, from an intraday perspective, we may see some relief rally towards 26,180 at the end of the day. So overall, I think it's a good, healthy decline that we are observing on the charts. And this particular decline can be utilized to create further long positions.
Okay. All right. Sachidanand, wanted your thoughts on two stocks. One is Trent, which is the top loser on the Nifty. And the other one is GM Breweries, which is seeing a good uptick post its numbers. It's moving towards that 1,300 odd mark, and a little above 1,300 is its 52-week high, previous 52-week high. So what's your recommendation on both these technically?
Well, for Trent, I think the major structure is still weak. We have really not seen any significant, price development on the positive side. Even on the oscillators front, the reading is still negative. So we are expecting that this particular move on the lower side may be capped towards, 3,600, 3,800. I think that will be a decent level wherein we may see some trend changing, signs. But if you look at the overall structure, I think it is still in that low top, low bottom sequence. So one should, clearly avoid bottom fishing at this particular juncture as well. When we look at a change, I think probably a very confident closing on a weekly closing basis above 4,600 is something that will be the immediate requisite. And until unless that level is breached, the overall trend structure for Trent remains negative. When we look at GM Breweries, I think this looks like a very confident structure. We've already seen a good, strong momentum cycle in the last couple of weeks. But if you look at the immediate level to track, I think the level is around 1,320, and until unless we don't see a closing above that particular level, don't expect any further up move. On the lower side, there's decent support somewhere close to around 1,150 levels. Even a decline towards the same can be utilized to create further long positions, but major structure remains positive. One can maintain their existing longs with a stop loss at 1,042 and review the positions closer to 1,300.
Okay, Sachidanand, thank you so much for joining us this afternoon, talking to us about the individual names as well as the market. But let's go across to Mangalam now, who's at the FNO desk to give us the latest update there. Afternoon, Mangalam.
Well, it seems like the market on expiry day has made itself a range, closer to 26,150 thereabouts is where we see purchase, and closer to 26,200 is where we see a fair amount of sell-off. 15 points here and there is what, the Nifty has been looking at as a range. The Nifty Bank is outperforming, so that's causing, some support to the frontline index, whereas the mid-cap index is an underperformer today, especially if you look at the market breadth as well. In that as well, there are a lot of counterbalancing factors. The Nifty Bank is outperforming despite HDFC Bank dragging it, and the Nifty is holding on to, important levels despite Reliance falling about 5%. So those are a couple of factors that are at play right now. As we move towards expiry, the levels that I spoke about are where the most active options action is as well. So 26,200 call, 5 crore shares in open interest out there for a premium of 14 rupees, telling you upwards of 26,200, there's strong supply which is expected. However, if the market sustains above 26,200, then all these 5 crore call writers will have to run for cover, and that will cause a big up move for the frontline index as we move towards expiry. But if you look at the 26,150 put, with the market having fallen closer to 26,150 levels, the options, premium is still down by about 4.5 rupees, telling you that there's strong selling out there. 3 crore shares in open interest, which are outstanding, and around that 26,135 to 26,140 is where support is expected by these put writers. So 26,140 to 26,210 is the rough range that we're looking at for expiry. Individual stocks, for the last 2 trading sessions, we've seen all these new FNO entrants see a lot of shorting. Yesterday it was Premier and Vari. Today it is Swiggy. 66% jump in open interest, obviously on a low base. A lot of shorting activity out there. But a lot of these capital market plays, the likes of MCX and IIFL, are higher today with a lot of open interest reducing, which tells you that shorts are caught on the wrong side and they are covering their positions, which is why these 2 stocks are higher.
Okay, all right. So those two stocks on our radar, some short covering seen there. Thank you so much, Mangalam, for joining us with that F&O setup. Time for a break now. On the other side, we'll get in Manisha Gupta, who will join in with Peter Maguire, CEO, Trading.com. Stay tuned for that conversation.
Peter McGuire, CEO Trading.com, now joins us with a sense on all of those metals that we have seen surging higher overnight. Peter, we've seen 5% of a gain for silver, 4% up on copper, 5% up on platinum. Gold is trading on the higher side. Copper is at an all-time highs. It's been a crazy start to the day when you look at metals. And if you look at 2026 itself, it has been a gain of anywhere between 5 to 10% for many of those metals. I want to start with copper because we're trading at all-time highs on US. $6 per pound has been taken off. 13,000 has been taken off on LME as well.
Absolutely, Manisha. I tell you what, it's game on, and that's exactly it. I mean, you can't argue with the numbers, and it's been extraordinary. Big night on the LME, and as we saw, even tin was up over 5%. So it's very, very strong. The overall theme, I think, is going to be 13.5 to 13,750 for copper. I think it's got the momentum to probably be there by end of month. I know that's a big call, but the overall, I think, horsepower that it's developed is very, very solid, and they're just charging at the moment, and I think that's the best way to describe them.
Oh, well, all right. 14.5 by the end of this month. I mean, that's a target that various global banks have put out for the end of this year. But I get to your point, the kind of run-up that we are looking at perhaps is unstoppable right now. Peter, also, the other thing that seems to be pushing copper is that Chile labor is now discussing about the wages there, asking for a percentage of profit. And that's not just Chile. We'll see that happen in various other mines as well if the copper prices continue to surge higher like that. And the staff would be asking for a percentage in profits.
Absolutely. I mean, this is a normal course of events, Manisha, with any resources, and that's not unusual. And I think that there'll be naturally bargaining. Each side comes to the table with a set of agendas, and then it comes down to negotiation. And if you've got unions involved, and that's just the normal course of events. So I don't think that that's unusual, considering the price point of what we're seeing. And it's just the argy-bargy of doing business, and sometimes and you've got to look after your teams, and that's very important. So yes, it doesn't all go to the shareholders; it's got to go back to the employers as well.
Oh, that's what employers want right now, and that perhaps is another premium that we are seeing building up in case of prices. But Peter, aluminum is trading at a 3-year highs. Tin, as you said, 5% of gains overnight. Nickel is trading at a 1-year highs. Zinc is trading at a 14-month highs. The list goes on.
It sure does go on. I mean, it's just 25. We build on 25, Manisha, and I think that inertia that we built is going to continue because you've got so many big themes playing out, and I think the first quarter is going to be absolutely game on. Let's not get too ahead of ourselves in the sense of where we see, third quarter, fourth quarter. I want to get through the first quarter, and really I want to get to this month and see where we are as far as price point. I've still, that line in the sand is, in my mind's eye, 92 to 95 for silver by end of month, 47, 45 for gold. I'm not changing my view. And silver's up nearly 10% since yesterday. It might be up 8 or 9, but it's approaching 10. And the overall, I think, momentum is very, very strong.
So while the momentum continues to be very strong, Peter, across board, if you had to choose a 1, 2, 3 in sense of gains going forward, what is that going to be? Are you putting aluminum first? Are you putting copper first? Silver last? How is it?
Well, I think you've got to look at copper, Manisha. I just think from the global view as far as, and plus what we saw last year, I think it'll build on that. So that's my number one as far as industrial metals. I think copper will take the charge. And, by end of year, who knows what it can be. But the overall, it's just so dynamic. And, copper, keep a close eye also on tin. It's had a big run up. And, you've got to look at zinc and aluminium also because, they all play in the same pool. And you'll do well if you're looking at miners in that space.
You clearly don't want to leave any metal out at all, but I want to talk about silver as well because we've seen, as you said, 92 to 95 by the end of this month. Where do you see the new buying come in now? And do you think it would be retail, ETFs, bigger fund allocations? Where is major money coming in from?
I think it's everything. I think certainly if you look at retail, and I've only got to see, what's happening as far as demand picture and, the lining up and buying physical in the likes of Sydney. So there's that side, and that's a global theme that's playing out. The second part is, yes, the paper market, ETFs, naturally the futures market, and then you'll see more activity as far as buying miners. And I think that awareness is really gaining momentum again on Main Street. People are now talking about it. Any age group are saying, did you see what silver did? It's no longer a silent little partner. It has outperformed and, media across the world are heralding it over 150% up for, the year. And it's just incredible.
Oh, well, yes, after not doing much in many, many years, silver seems to be the top conversation point right now across sectors there. A quick last word, Peter, on US, Venezuela, US, Iran, the conversations on Cuba and Mexico and Colombia. Where is that heading?
Well, they're geopolitical hotspots. I mean, we've got to work through the first part as far as Venezuela, Manisha, and that's a work in progress. And I think a lot of things will fall out of the bucket as far as strategy, what's happening, the likes of the big, ConocoPhillips, Chevron, and how that plays in from oil producers. We all understand it's heavy oil and it's the largest by a country mile compared to even Saudi from its reserve standpoint. The next part of, as you mentioned, what happens as far as Iran, it's very much a work in progress, and in Cuba. So I listen to the president and his team, and it seems to be they got their fighting boots on, and they're not taking a backward step, and it's a very, very different 26 to what it was in 25 from the Trump administration.
Oh, yes. Point taken. We don't know what will happen next, so watching out for that. But apart from the other global events, Peter, also want to understand what's your take on the Ashes? Do you think it'll be 4-1, 3-2? And just giving you a heads up, I'm not a cricket fan. I'm not a cricket fan. This is coming from our colleague Mangalam. He wanted us to ask you specifically.
I know it's coming from Mangala, and I'll tell him now that Steve Smith will probably get double century. So that's what we're going to look at, and I think it'll be 4-1.
Oh, right, Peter. Thanks very much for that. Maybe the gains would be as good as what we're seeing in the metal space. Thanks very much for joining in and taking us through that. But talking about metals, you know, if you just look at stocks such as Nalco, which has gained over 11% on a week-to-date basis just in the month of January, we have Hindustan Zinc as well as Hindustan Copper. All of these stocks which have already seen strong runs and are building on gains just in the matter of a week odd. They've seen gains of around anywhere between 6 to 7% and 11% for Nalco. So that's the kind of interest that we're seeing in a lot of these stocks and the metal space. That seems to be the dominant theme at this point in time. We'll take a short break, but a lot more on the markets, a lot of stocks in focus, all that and more once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. As of now, we're surely keeping an eye out on the market. Nifty is at 26,160, around that level where it's holding on to. Not much of a move from that level. 84 points down tick is what we're seeing. But it's time for CNBC-TV18's new offering, Macro Signals. The aim is to isolate the macro forces that actually matter for the day and explain how it translates into market moves. Let's go across to Ritu, and today we're focusing on the loan to deposit ratio and the cues markets can actually take from that. Ritu, over to you.
Well, yes, the banking system is flashing an important liquidity signal that we should take note of, and that is the loan to deposit ratio, or LDR, what is also sometimes called the credit deposit ratio. Now, it has climbed to an all-time high of 81.6% as of the latest data from December that RBI has released. And simply put, it is actually a measure of how much of the bank's deposit is being lent out. So a high ratio like this shows, yes, there is strong credit demand, which is usually good for the economy, but it also comes with trade-offs. If it's too high, it can limit future credit growth and also squeeze profit margins. And that's why economists and investors keep a very close eye on this LDR ratio. So why has LDR climbed so high? Because on one hand, you have credit growth, which after, a bit of a lackluster FY25, it has picked up momentum again and now at 12% kind of levels because of, higher auto loans, unsecured retail credit growth, gold loans, MSME lending, all of that picking up on the back of the GST cuts and the festive season demand. But on the other side, you have deposit growth, which is lagging, and it is now in single digits because households, as we heard the J&K Bank also talk about earlier, moving money from bank deposits traditionally into, higher yielding assets like your mutual funds, stock markets, etc. So this gap between loans and deposits, it has steadily pushed the system-wide LDR from 75.8% in June 2023 to 81.6%, today, which is a structural shift and not just a blip. If you look at data, the provisional data that is being released by banks and some of the study done by Macquarie, it shows deposits lag the loan growth by 250 to 300 basis points in this quarter so far, and that is reversing the brief stabilization that we had seen in 2025. And it's not just system-wide. Individual banks are seeing very similar trends. For instance, HDFC Bank's LDR, it rose to 99.5% in Q3, and despite reporting relatively stronger business momentum, you've seen why the stock has been under pressure simply because of the concerns on this high LDR. For other private and public sector banks as well, if you pull up on your screen, we've similarly seen a rise in this ratio. Now, why does it matter and why are we focusing on it? Because a high LDR can limit future credit growth when you've already over-leveraged your deposits. It can weaken the rate cut transmission from RBI and, of course, put pressure on your net interest margin for banks because they might have to hike deposit rates to attract more deposits. Now, that said, immediately, there is no cause for alarm at all because banks still have excess SLR. The liquidity rules with the new LCR norms kicking in will also be eased from the 1st of April, and asset quality is pretty stable for the system. Even credit growth is very demand-driven and not very speculative. So no cause of concern there, but still, it is a slow burn risk. While there's no strict regulatory cap on LDR from RBI at the moment, levels above 80% are generally considered a tight liquidity zone. And if you have sustained LDR above these levels, that can gradually erode margins for banks. It can curb loan growth and weaken policy transmission even without any sudden crisis. So an important macro signal to keep on our radar.
All right, Ritu, thank you so much for making sense and giving us that macro signal. That's all about macros, but India's domestic pharma market, it has grown by 10.6% in December 2025. As per Pharma track data, Mounjaro by Eli Lilly is ranked the #1 brand based on monthly performance. Ekta, tell us more. We're not surprised by the weight loss drugs coming in here.
Yes, absolutely. It continues to dominate the Indian market, and I'll get to that in just a bit. But the total Indian pharma market growth has been strong for the month of December. It's been in double digits at 10.6% in terms of value growth. This is from Pharma Track. Now, companies such as Sun Pharma have grown at 15.2%. Cipla has grown at 15.5%, Lupin at around 13%, Zydus at around 12.7%, and Dr. Reddy's at around 10%. Torrent has grown strong at 17%, and Mankind at around 8.4%. Now, Torrent and Mankind, remember, have a very strong domestic portfolio, and hence those stand out. Now, Mounjaro, I just want to come to that specific brand by Eli Lilly, which is basically the weight loss and diabetes drug. It's ranked the #1 brand in December 2025 based on monthly performance. So Mounjaro's MAT sales, which is basically the moving annual total sales from the time of launch, which is around March, has been 601 crores. Now, Mounjaro has in fact scaled up to be the #1 selling drug in value since October of 2025. It's been the fastest brand to scale up to become the #1 ranked brand on a monthly basis already. So that's the kind, generally brands take years to get here, but Mounjaro has managed to scale up just in the matter of a couple of months. Now, the top brands, however, as per the MAT data as of December 2025 include Augmentin, which is the popular antibiotic by GSK, it's ranked #3, Glycomed GP, which is a diabetes drug, which is ranked #4, Foracort, which is an inhaler by Cipla, maybe because of the pollution levels, that's at around #2 in December. Pan by Alchem, which is a gastro drug, which is at 820 crores. And Mixtard, which is by Abbott, which is Also, a diabetes drug is ranked number 5 in the month of December. So very interesting data which is coming in. Overall, the Indian pharma market growth was strong for the month of December at around 10.7% growth. On that note, we're going to take a short break, get you more on the markets once we're back. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, it's turning out to be a little bit of a subdued session, but if you just sift through, you will find a lot of stocks which are doing well. AB Capital, for example, that stock is at a fresh 52-week high, so that stock should come up for you. We have Ather, which is at a fresh 52-week high and gaining on good volumes as well at this point in time. We have Bank of India, which is at the best levels that you've seen in a year for Bank of India. And a couple of others such as eClerx is at a fresh 52-week high as well. So do watch out for a couple of these stocks which are managing to do well. Chola Fin has been in focus on the back of news in the past couple of weeks. So that stock has been in focus today. It's managing to hold up quite well, up around 0.3%, best levels again that we've seen for that stock in a year. But on that note, let's wrap up the show with some perspective. Earnings growth and macros are stable in the Indian economy. That's the word coming in from Venugopal Gare, who's the Managing Director, India Head of Research at Bernstein. He is bullish on financials, telecom, consumer tech, real estate and IT. Listen in to him and we'll be back with Business Lunch.
Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end and macro is going to start to recover, rates will start to get cut, we should be selective buy. And selective buy was largely with the view that SMIDs were still very costly. heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth. Volume growths have, I guess, will inch up a bit, but not material enough for me to get excited. That's number one. So there will be an inch up in volume growth as you see the quarter or two pan by. But fundamentally, the challenge is this, that this year, when I look at the fundraising happening in, for example, the quick commerce sector, so Swiggy has raised money, and I think the third largest player is also filed a prospectus for raising money. So a lot of money flow will happen on quick commerce investments. I have a lot of buy sectors still, right? Financials is a positive sector. Telecom is an overweight sector. Consumer tech is an overweight sector. And two more sectors, IT and real estate, have moved to a mild overweight.
The Nifty is trading lower on its weekly expiry session, dragged mainly by oil and gas shares like Reliance Industries and the oil marketing companies. Pharma, metal and PSU bank stocks are bucking the trend. The benchmark Nifty has started 2026 on weak footing compared to other Asian emerging markets which are doing well.
The Trent stock falls sharply after it reports standalone revenue growth of 16.9% in Q3. Growth has been trending lower for the company from 19.8% in Q1 and 17.1% in Q2. Banking major Axis Bank posted 3.7% quarter-on-quarter growth in advances, leading to an over 14% year-on-year growth, outpacing system average growth by over 200 basis points. Stock is up 1%.
Gold prices have edged lower in Asian trading after a 3% overnight move. Silver prices are also jumped 7% last night. Now in base metals, copper has hit a new record high after fresh mining disruptions globally, reflecting the move in underlying commodities. Hindustan Zinc and Hindustan Copper are also trading with gains of over 2% each. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia. With me is Arundhati Ramanan. Arundhati, good afternoon.
Hi, Hormas. Good afternoon. It's been quite a subdued session, to say the least, right? Nifty Sensex down about 3/10 to 4/10% lower. But the banking stocks doing well. Nifty Bank managing to hold in the green 0.2% higher.
And that's despite the underperformance coming in from HDFC Bank. And it's been a very, very choppy session, and as expected on a weekly expiry as well for the index. The Nifty Bank still trading 170 points higher. The Nifty finding support at that 26,150 mark, as has been highlighted all through the morning by both Mangalam and Sudarshan in their FNO checks as well, that the 26,150 put has a significant amount of open interest lying over there. So therefore the index tumbling towards 26,150 but staging a brief recovery from there. And the chief contributor to the Nifty down move today has been Reliance Industries. 130 points the Nifty drag coming from Reliance, which means that had it not been for Reliance Industries, the index would have been higher, and had it not been for HDFC Bank as well, the index would have been even more higher. So HDFC Bank, of course, down for the second day running. It was down around 2.5% yesterday. It was the primary reason why the Nifty reversed from the highs of the day. And today, Reliance Industries too contributing to that down move. So as of now, still stuck in a range, some support coming at 26,150.
Absolutely. And let's take a look at some of those sectors that are doing well, right? We've got banks and financials on top. They are leading the up move. We've got PSU bank stocks that are doing really well on the back of good business updates. You've got Union Bank, Bank of India, SBI, all of them between 1% and 3% in the green. We've got some of those private sector names that are also doing really well, which is ICICI Bank and Axis Bank. But those stocks doing well. On the downside, we've got those oil and gas names, HPCL, Mahanagar Gas and IOC, all of them lower between 1% and 3%. And as Hormas pointed out, right, some of those heavyweights like Reliance and HDFC Bank are pulling the Nifty lower. Reliance is down nearly 5%, and we've got HDFC Bank, which is down over 1%.
But one of the big movers of the day has been the big talking point as well. And the fact one of those stocks is Trent, and that is still continuing to remain near the lows of the day, still 7.5% lower as we speak. The question among investors across the board is, what is the key reason behind the fall, as it has been making new lows every quarter? Mangalam is here to tell us just that. Mangalam.
Well, you know, there are a couple of things. Let's look at it on a 360-degree basis. So one is, why is the stock falling so much after having fallen over 40% in the last year as well? So they reported their third quarter update. Out there, the revenue growth was just 17%. And I call it just 17% because if you look at the first 9 months of this year, the revenue has grown around 18%. At the same time, at the start of this year, the company had said that on a compounded basis, on a sustainable basis, the company can do about 25% growth. So it's below both those numbers. And it's actually halved from what we've seen on a 5-year basis for Trent as well. Over the last 5 years, the revenues have compounded at around 38%. So the revenue growth has come off. At the same time, brokerages aren't particularly happy with that as well. Citi, for one, has reiterated their sell call on the stock, the target of 43.50. The stock currently is below most of the target prices that there are from across the board on brokerages. While the standalone revenue growth at 17% is pretty much in line, marginally better than Citi's own estimates. Remember, over the last 1 year or so, the number of stores that the company has added on both Westside and Zudio implies that the like-for-like growth and even sales per square foot has come down, which causes the fear of the EBITDA actually compressing in the third quarter as well when the company reports its numbers. All these factors and along with the valuations are extremely crucial. Now, if you look at Trent, you know, At peak, it was trading at around 140 times. 5-year average has been just shy of 100 times. But current valuations at 72 times would beget the question, is this stock pricing in all the weakness? Perhaps not. Why? Because PE should not be looked at in isolation, should be looked at in conjunction with growth. And when the stock was trading at 140 times, the growth was around 55%. So if you look at the PE to growth or the PEG ratio, it was 2.5 times. Now, while the stock has fallen, what's fallen more is the rate of growth. Over the last 9 months, the revenue has grown at around 18%. And even if the stock is at 70 times after having halved from the top, the PEG ratio is 4 times. So yes, on a PE basis, the stock looks cheaper, but on a PEG ratio, the stock has actually become more expensive despite the fall. So what needs to happen? Growth needs to pick up. How does growth pick up? We'll monitor same-store sales growth of both, Westside, Zudio very closely, while looking at recovery in sales happening because of the government boost given in consumption. The second half of this year was expected to see a good growth, but the first half of that second half hasn't started particularly well. Growth in newer formats extremely crucial as well, while we're looking at risks like weaker consumer sentiment, no online presence, and strong competition coming in.
All right, Mangalam, thank you so much for taking us through those details. Now, Axis Bank and L&T Finance also released updates for the third quarter. Gaurav Javalkar is here to tell us more on that. Gaurav?
Well, let's talk about Axis Bank. Now, when we look at the numbers of Axis Bank in the pre-provisional update, it is not something usual, but when it comes to Axis Bank, at least in this quarter, they have actually outpaced the growth of industry. Now, the loan book growth is at around 14.1% on a year-on-year basis. Now, why this is important is that earlier, if you look at Axis Bank's loan growth trajectory for the last 6 quarters, we have seen some slowdown in the loan growth. It was the number which was seen in first quarter of FY25, where the growth was above 14%, and after that we saw growth was as low as single digits as well. But now it seems that Axis Bank is picking up the pace and the loan book growth is also picking up. Apart from that, if you look at deposit growth, now for the most of the updates that we have seen so far, deposit growth was a bit lower than the advances growth. But when it comes to Axis Bank, their deposit growth is also higher than the advances growth. Deposits grew almost by 15% on a year-on-year basis. So that is something which is positive. Apart from that, let's also talk about L&T Finance. Now, this company earlier has also surprised us with their share performance, because it is up more than 50% in the last 6 months, and they have all the reasons to gain. And the reason being that if you look at the retail loan book, now the disbursements, they have grown almost by 40% on a year-on-year basis. When it comes to their retail loan book, it has increased almost by 21%. Remember, they are targeting for 25% plus growth in their retail book, and they're actually achieving that at what it seems, because in the last quarter we saw retail growth was 18%, now it is at 21.5%. It is also a bit higher than the street's expectation of 20% growth in this quarter. Apart from that, their gold loan portfolio, that is also picking up. If you look at the disbursement number for this quarter, it is at around 1400 crores versus what it was at 983 crores just a quarter ago, and this is the portfolio they have acquired just 2 quarters ago. So definitely they are showing some kind of progress. As a result, both the stocks are actually favored by investors. Both the stocks are in green today.
Doing well for themselves are Axis Bank, and L&T Finance, mind you, was up 133% in 2025, and that turned out to be the best calendar year that the stock had since its listing, going all the way back to 2011. Take a short break. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Let's now shift our focus to the commodity space. The rally in metals is showing no sign of abating. Manisha Gupta is here with all of those details. Manisha, why are the metals rallying so much?
It is a very strong start to metals in 2026. 25 was a year that you saw all-time highs in gold, silver, copper, platinum, and that's exactly what 26 seems to be doing, building up onto those gains. So overnight has been anything like a 3 to 5% of a gain, and in this year we've seen 3 to 10% of gains come in for many of those metal prices. Copper is trading at all-time highs. This is on the back of concerns over potential US tariffs and also a mine in Chile. The workers there are now demanding a part in profit in what copper has seen. Remember, all-time highs, 45% of gains in last 12 months for copper. So labor wants a part in that as well. Aluminum is trading at a 3-year highs. You have China looking to curb production. Also, when you look at key smelters in Iceland, Mozambique and Australia, there are concerns there supporting aluminum prices. Nickel is trading at a 1-year highs. This is after Indonesia says that they're looking to look at 34% reduction in nickel production going forward. Iron ore, which didn't do so well in 25, also seems to have started 26 on a stronger note as Chinese steel makers are restocking iron ore ahead of the Lunar New Year holidays in the month of Feb. And then you have zinc trading at a 14-month highs because of global inventories continuing to decline. Silver gained 5% overnight. You have heightened geopolitical tensions and then China export restrictions in this year. All of that supporting silver prices also. Markets from here would of course look at the US non-farm payroll data that comes in on Friday. Further gains could come in after that.
Manisha, thank you for that update there. The rally in commodities showing no signs of abating whatsoever. Now, the RBI has issued amended directions for lending by financial institutions to related parties. Ritu is here with a complete breakdown of all of that. Ritu.
Well, yes, RBI has issued a whole host of amendments to related party lending rules, which now come into effect from the 1st of April. But RBI has allowed all the existing related party transactions that are not compliant with these new directions to continue until their contractual maturity, provided that there is no enhancement or any kind of renewal, repricing or change in their terms. There are certain categories of NBFCs specifically, the ones that don't accept public funds or CICs that are only engaged in group lending that have been exempted from these new directions. Now, equity investments in related parties are going to be excluded from the scope, but debt instruments of related parties will still be covered. RBI has also expanded the definition of related parties itself, and it aligns more with the provisions of Companies Act and the IBC as well. So it includes promoters, of course, directors, KMPs, that is key managerial personnel, their relatives, and all shareholders with more than 10% equity, as well as the entities where these related parties exercise control or significant influence as well. Now, RBI has also introduced a materiality threshold for these kind of loans. So broadly, larger regulated entities are going to have higher ceilings and the smaller ones will have lower limits. So for instance, banks with assets of more than 10 lakh crores have a ceiling of 25 crores. Those with assets between 1 to 10 lakh crores have a ceiling of 10 crore and so on. And for NBFCs, the upper and top layer have a 10 crore ceiling and the base layer will have a 1 crore ceiling and so on. Now, any related party loans that are above these thresholds will have to be specifically approved by the bank or NBFC's board or a dedicated committee that is looking at lending to related parties. But overall, there are relaxations on some fronts and tightening of rules on the other fronts. That overall, it also aligns the rules when it comes to related party lending between banks and NBFCs.
Right, Ritu. Many thanks for taking us through those details. Now, India's Ministry of Statistics will announce its first advance estimate of this year's GDP. This number is key because it will form the basis of all the budget calculations. Lata Venkatesh is here with all of those details. Lata?
Yes, so the Ministry of Statistics announces what it thinks will be this year's GDP. So that becomes the first step for the budget. Budget at the moment will only form policies. But once this number comes, they will assume a certain level of growth, next year's nominal GDP. Once they have a size of the GDP, they will assume a percentage of that can be taken as the fiscal deficit. Also, how much nominal GDP growth they assume for next year will determine how much tax growth you can assume. How much the economy grows, that much taxes grow. So today's the current first advance estimates of the MOSPI is very important. Now come to our poll. Okay, the CNBC-TV18 poll expects that tomorrow the MOSPI will announce a real GDP growth of 7.5%, But as I told you, it's nominal, that's more important. They are expecting that the MOSPI will say the nominal GDP is growing by 8.3%. Last year's budget had assumed a 10.1% nominal GDP growth. Oh, so will there be a problem with this year's fiscal deficit? No. And I'll tell you why. FY26, this year's nominal GDP was assumed by the budget at 356.97 trillion rupees, which is 10.1% over 324 trillion, which was FY25 assumed GDP, nominal GDP. But the nominal GDP actually came in at 330 trillion. So because the base was higher, even with the 8.3% nominal GDP growth, we are square. We don't have to make any adjustments to the fiscal deficit. So what will we be looking forward to? More importantly, what is the nominal GDP growth? The expectation is that over this year's 8.3%, the budget will assume a 9.7% nominal GDP growth, taking our GDP to 392 trillion. Well, all these are assumptions, but hold your breath. All these assumptions may pale into insignificance after February 28th because the MOSPI is going to announce a new GDP series altogether based on a new base year. However, these numbers are very important up until Feb 28.
Well, all eyes on both this evening and, of course, on Feb 28th as well. Lata, thank you for that. Of course, more importantly, all eyes will be on February the 1st if and all the budget is presented that day. Take a short break here on Business Lunch. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now, days after the Venezuelan President Nicolas Maduro and his wife were flown out of their country in a U.S. military operation to face narco-related charges and cocaine importation conspiracy charges in the U.S., the deposed leader appearing before the U.S. judge has pleaded not guilty to charges of narco-terrorism. Here's a Reuters report.
Protesters gathered outside a New York federal court on Monday, where inside, toppled Venezuelan President Nicolas Maduro stood before a U.S. judge to face charges that could put him behind bars for life. Through an interpreter, Maduro said, "I am innocent. I am not guilty. I am a decent man. I am still president of my country," before being cut off. Maduro faces 4 U.S. federal criminal counts that include narco-terrorism conspiracy, cocaine importation conspiracy, and possession of machine guns and destructive devices. His next court date is set for March 17th. His wife, Celia Flores, faces the same charges except for narco-terrorism. She also pleaded not guilty. Prosecutors alleged that as president, Maduro directed cocaine trafficking routes, used the military to protect shipments, sheltered violent trafficking groups, and used presidential facilities to move drugs. He was first indicted in 2020 as part of a long-running narcotics trafficking case against Venezuelan officials and Colombian guerrillas. The 63-year-old has long denied the allegations, saying they're a mask to take Venezuela's rich oil reserves, which UN's grappled with the extraordinary seizure of a head of state. An emergency order in Venezuela, published in full on Monday, ordered police to search and capture anyone who supported Saturday's U.S. attack. Also on Monday, Venezuela's vice president and oil minister, Delcy Rodriguez, was formally sworn in as the country's interim president, with words of support for Maduro, but no indication she would fight the U.S. move.
Meanwhile, Russia and China vociferously denounced U.S. action in Venezuela at an emergency session of the United Nations Security Council on Monday, calling for the immediate release of Venezuela's deposed president, Nicolas Maduro, and his wife from U.S. custody. There is no and can be no justification for the crimes cynically perpetrated by the United States against Venezuela, said Russia's representative to the UN. He also said the capture and extraction of Maduro breached all international norms. China's deputy UN representative called on the U.S. to release Maduro and his wife, saying it was deeply shocked by the unilateral, illegal and bullying action taken by America. He demanded that the United States change its course.
All misery across Venezuela. International law is the framework, is the anchor or the benchmark against which we judge the actions of all other governments. And it is, of course, for the US to justify the action that it has taken. It is not straightforward, it is complicated, and even today there are further developments. But I won't shy away from the fact that international law is the framework and is the benchmark.
And with that, it is a wrap on this edition of Business Lunch. Midcap Radar comes up next.
Good afternoon. Welcome to Mid-Cap Radar Live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Very close to the day's low. We are at the 26,160 mark. Mid-caps are underperforming as well. There's some green on Bank Nifty, courtesy PSU Banking Index. But IEX is in focus on the back of its December 2025 business update. The company's electricity trade volume grew 12% on a YOY basis. Remember, the Aptel hearing on the market coupling case is also scheduled to be heard at around 2:15 p.m. today. Okay, all right. Those are the top headlines that we are tracking. Some important stocks that we'll be tracking as well. Tune into CNBC TV18 at 2:15 p.m. for all the analysis on IEX as well. You've been tracking that for such a long time. And yes, there's some hearing which is expected there. But for today, a lot of reaction on Q3 updates. Nifty at the day's low as we speak, 101 points lower right now. And we are getting Q3 updates, but earnings have started trickling in as well. GM Breweries, for instance, reported good set of numbers.
That's right. Absolutely right. So, quick update as far as IEX is concerned. We will be waiting and watching, and we'll be listening in to the court case developments at Aptel. This will be regarding the market coupling development. Any development or any decision there is a material development that needs to be tracked from the context of IEX. A couple of stocks on the radar. Cummins India, that particular name from the capital goods space has now moved to the day's lowest point. It'll be interesting to see what exactly is transpiring over there. And Kotak Mahindra Bank too, one of the laggards as far as the large cap private names are concerned. But this is our special segment, Mid-Cap Movers. Sudarshan is standing by the wall to take us through the mid-caps that are moving around in the session.
So you have talked about that earnings have started trickling in, and the first company to report the earnings in GM Breweries. While the earnings were strong, but the stock move, it's currently down more than 3%. And if you take a look of the stock move over the last 20 days, ahead of the earnings in the last 2 weeks, the stock had moved as high as 30%. So there might be some profit booking after a strong set of earnings that GM Breweries has reported. IIFL Finance is higher. All the companies, banks or NBFC which have gold loan portfolio, they have seen a huge growth in that segment, and IIFL has a very high gold loan portfolio. That might be one of the reasons why the stock is higher, almost 4%. MV Photovoltaic and DV's Labs are higher in the trade, up 4 to 8% after positive brokerage notes. All the metal stocks are back in the focus, tracking global prices. All the global prices overnight have moved sharply higher. Copper is at record high. There's a sharp move in silver also, zinc price also, and that's the reason these stocks are higher in the range of 2 to 5%. Some of the other mid-cap gainers, Merck Electronics and Cupid over the last few days have been moving higher with healthy volumes, and today also both these names are up 10 to 11%. Fortis Healthcare, Aurobindo Pharma and Lupin, all the hospital names, both drug companies as well as hospital companies are trading with healthy gains today with healthy volumes. If you take a look in the Nifty also and in the mid-cap space, these names are trading with gains. Some of the mid-cap losers, both Swiggy and Eternal are lower in the trade today. Swiggy is down currently it's down almost 5% ahead of quarterly updates. Premier Energies, Wari Energies have been continuously falling, and yesterday also both these names were down somewhere in the range of 8 to 9%. Today there is a fall of 3% each in both the names, and Ola Electric has snapped 3-day gaining streak. Today this stock is down almost 5%, and Godfrey Phillips like ITC has been moving lower. Today also this stock is under pressure.
Okay, some interesting names there. Sudarshan, thank you so much for bringing us up to speed with these movers in the broader markets. With that, let's move on and talk about some technicals of the market. Shrikant Chauhan from Kotak Securities is joining us now. Shrikant, good afternoon. At the day's low for Nifty currently, do you think we could see further lows, or some of these dips could get bought?
Yeah, good afternoon, Sonal. Good afternoon, Vivek and everyone. So for market, we are of the view that it's a corrective pattern that we are witnessing. The rally that we saw from the levels of 25,800 halted at 26,300, 350. And from there all the way, we are witnessing some correction. But if we consider the entire pattern of last 2 months, then most of the time, whenever there is a rally of 400-500 points, we saw some correction. And later on, we saw equal amount of upward activity in the market. So this time also, I am of the view that 26,100, 26,050 should act as major support for the market. And again, from these levels, we can expect recovery in the market. So maybe today, because of the expiry, the market may spend some time within the range of 26,150, 26,100. But eventually, maybe in next 2 or 3 days of time, we are expecting market to move towards the levels of 26,500 or 26,700. So by and large, our view is positive, and we should look for taking long bets if there is any correction in the market.
Okay, Srikanth, and what are your individual trading bets for the day?
So for the day or for next few days, we would like to go with those stocks where there is momentum and also there is a sectoral performance. So in that specifically, we like Fortis Healthcare. It was around 1,050, 1,100 levels. From there all the way, the stock has fallen to 900, and now it is bouncing back after hitting or maybe after forming the formation of higher top, higher bottom. So while looking at its entire formation, it is very clear that the stock is heading for the levels of again 1,050 or 1,060 in the near term. So it's a buy at current levels with a stop loss close to 900 on the downside. If there is any trading position someone has to take, then keep a stop loss at 900. But overall target is close to 1,000, 1,050. The other stock on which we are bullish is Maithan Alloys. And there also, I am of the view that GMDC, NMDC, or maybe MOIL kind of stock, they are doing well. Maybe now, whenever there is a rally in such type of stocks, we see buying attraction in stocks like Maithan Alloy or a few other companies in the same segment. Currently, it is around 1,030, 1,040. But while, sorry. But while looking at its pattern, it is heading for the levels of at least 1,150 or 1,200. So it's a positional call to buy at current levels with a stop loss close to 980 for those who would like to take some short-term position. But broadly, it's a buy at current levels, more on dips with a target of 1,200.
Right. Okay. Thank you so much, Srikanth, for joining in. So metals, some stocks from that space continue to be in focus. We'll do one thing. We'll slip into a short break. When we come back, we'll get in Nigel D'Souza. He'll focus on Rain Industries. We'll also talk about Infra. These two stocks are in focus. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar, a whole host of stocks on our radar. Let's talk about Rain Industries first. Nigel is joining us with what's happening there. Nigel.
Well, aluminium stocks have been on fire. Investors, though, they're asking, will it rain? What I'm hinting at is what's the buzz on Rain Industries? Remember, the stock has spiked up nearly 40% from the lows, but it's still a distance away from its 52-week high. It's more than 20% away. Well, the street could be viewing the company as an aluminium ancillary play, as it produces calcined petroleum coke and coal tar pitch. Both of them, remember, are used for aluminium production in different proportions. And the aluminium segment itself contributes a little more than 40% of their total revenue mix. Spreads, well, they have been gradually improving. The company has actually been coming out of a very, very rough phase. They've started clocking an EBITDA per quarter of close to around 600 crores. And this after a very weak showing in calendar year 2023 and 2024. The EBITDA then could be possibly on a recovery path in 2026, going by the spreads. Well, valuations, there is some support out there. It trades at a 0.7 times price to book, and on an EV upon EBITDA basis, it's at around 5 times. This gets further support because remember, under this entity itself, they have a 4.3 million ton cement business, which contributes less than 10% of revenue, but at replacement cost, it could be valued at around 3,500 to around 4,000 crores, and they've also laid an expansion plan out for their cement business. But what is the key to track? Debt refinancing or debt reduction? That's going to be top of mind. The net debt as of the last reported number is ballpark around $800 million. The management, though, has indicated they are watching the markets closely. They're looking for an opportunity to optimize the interest costs. And they've also mentioned that there are no major term debt maturities all the way till October 2028. Now, besides debt reduction, the street will also be tracking the spread between the input, which is GPC, and the finished product, which is CPC. That's been improving gradually, and also the ramp up of the advanced material segment. That contributes currently close to around 20% of their revenue mix. In terms of fund participation, well, ICICI Prudential, under various schemes, has been gradually increasing the stake in the company. Well, time will tell if Rain Industries can serve as an aluminium ancillary stock and participate in the strong aluminium cycle.
Well, thank you so much, Nigel, for joining in and giving us all of the details and in-depth coverage as far as what the future could hold for Rain Industries. Well, one particular stock that I've been tracking is MV Photovoltaic. A very interesting note coming from Jefferies today. They've initiated coverage on the stock. They have a buy rating. The target price is at 320 rupees a share. Remember, they state that number one, MV is only the second solar PV cell manufacturer in India to actually have the higher efficiency TOPCon cells with close to 3 gigawatt capacity operational since 2014. So what they are stating is that India's solar installation is set to grow at close to 24% CAGR in the range from FY25 to FY28. So the company's early entry in this particular TOPCon segment, along with the superior DCR-driven profitability, they believe give the company a competitive edge over its peers. Not only that, they say that while they expect industry's profitability to normalize from FY28 onwards, they do expect a high teens steady state ROCE. That's something that they believe that this particular company can maintain. They project a 56% EBITDA CAGR over FY25 to FY28, and they price MV at 9 times forward EV to EBITDA. Remember, the company trades at a close to 50% discount to peers, so it's been a slightly subdued IPO as far as MV Photovoltaic is concerned, but today making a bit of a comeback, higher by 8%. But moving on, remember this is our special segment, Midcap Spotlight. Nigel joins in once again. He's focusing on Infra. The stock's been a bit of a casualty in terms of selling pressure today.
Well, that's right. Let's break down what's driving this negative sentiment around Infra. There are a couple of fears that are playing out. Fear number one, the concern comes from South Africa, which is the key global supplier of ferrochrome. And the question is, will the South African ferrochrome smelters that were shut, will they restart? The reason stems from reports that suggest that South Africa's electricity regulator, NERSA, is fast-tracking an application from Eskom, which is the country's state-owned power utility responsible for electricity generation, transmission, as well as distribution. Eskom has requested a temporary reduction in the NPA tariff for this calendar year, that is 2026. Earlier, remember, major producers, Samancor, Glencore, Merafe, they had declared hardship under the NPAs as the high cost made these South African smelters globally uncompetitive, as electricity alone accounts for close to 35 to 40% of ferrochrome production costs. Now, with these tariff relief discussions on the table, efforts are being made to revive South Africa's ferrochrome industry. So, if the tariffs are actually reduced, some South African smelters could restart. That in turn could increase global supply, which could put some kind of pressure on prices. The other fear is closer to home. This domestic ferrochrome prices, they have cooled off from ballpark around 1.2 lakh per ton. They've come down to around 1.05 lakh per ton currently. So there is some pressure on the domestic pricing, though we know Imphar mostly exports almost all of their production. Some on the street though believe that even though the prices have fallen, well, they could protect margins, and they believe that prices are actually forming a bit of a phase of bottoming out. So the reason today that Imphar is down is fears of additional supply coming in from South Africa and the pressure that we're seeing on domestic ferrochrome prices.
Okay, all right. So explains what's happening there. The stock has recovered a tad bit, but still lower by 10% in this market. Thank you so much, Nigel, for joining in with all those details. Let's take a look at more mid-caps that are buzzing in trade. We have GNA Axles, which is up around 8.5% as we speak. Aether Industries is another chemical name, which is up around 6%. Chemical stocks will be in focus, whether there's a recovery which comes by in Q3. Most importantly, what is the commentary after good Q2? Because on a low base, we did see a YY recovery come by. Embassy Developments, watch out for that one. It's up 5%. Yesterday as well, it was logged in upper circuit after they clarified that there is no outstanding liability, or they were not the guarantor for some of the insolvent companies that there have been with the NCLT for a while. So that stock should be on your radar. We also have Ipca Labs, which is up 2.5%. Nigel just spoke about Rain Industries. That is on our radar. Cupid is one stock which has been buzzing off late, 13.5% on that stock. These are some stocks which will be on our radar. Cupid has actually surged after that note was made by Nigel just a while back. We'll slip into a short break now. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. Well, I just spoke about some of the stocks which are buzzing on the upside. Watch out for these oil and gas names. Mahanagar Gas, that stock is down around 3.5%. A lot of these oil marketing companies are also under pressure today. Something like an HPCL, which is down around 2.5%. There's not been a major move on Brent right now, but these stocks have seen some profit booking from the highs of the day. We also have Navin Fluorine from the chemical space, which is lower, 3.5% lower than that one. Deepak Nitrite, that's the other name which is on our radar. So 2.5% lower on Deepak Nitrite as we speak. But a lot of quarterly updates that are coming by. CSB Bank, that the stock is under pressure. The lender has reported a strong Q3 business update. Despite that, the stock is lower. Earlier today, we spoke with the management where they expect diversified growth ahead. They do not see yields coming under pressure. Let's listen into an excerpt of that conversation.
We are not using pricing or the LTV as a kind of a component of growth because our LTV, as you rightly said, has come down almost below 60% now. So we have a comfortable 15% margin on that LTV. Plus for agri gold loans, it is much higher. So to that extent, we are sitting on a very, very high cushion and safety, and we are not taking growth at just because the prices are rising. So that's one. Secondly, the tonnage is also increasing. It's not that it's only growing by the growth. While LTV is falling on one side, the tonnage is increasing. So to that extent, and also these are short-term loans. So to that extent, we do our kind of a sensitive analysis of 10%, 15%, 5%, 3 kind of pricing. If it falls, what happens, what tenor, etc. And we are taking our tenors down. So to that extent, all risk mitigations are in place. So I don't see any risk at all in our particular portfolio. I don't think so, because we are anyway much lower than where some of the other NBFCs and banks are in terms of yields. So to that extent, we are in a safe zone from that perspective. That ticket sizes are going up, and these are coming from SMEs. And a lot of these business loans are getting replaced by secured gold loans. And I think now the realization of the value of gold and from the SME working capital perspective is coming up.
Well, that's the word coming in from the management of CSB Bank. That particular stock today has seen over a 5% fall. But remember, the quarterly update was quite strong, especially in terms of the advances. But moving on, earnings growth and macros are stable in the Indian economy. That's the word coming in from Venugopal Gare, Managing Director, India Head of Research at Bernstein. He is bullish on financials, telecom, consumer tech, real estate, as well as IT. Let's listen in to a few excerpts from that conversation.
Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end, and macro is going to start to recover. Rates will start to get cut. We should be selective buy, and selective buy was largely with the view that SMIDs were still very costly. Heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth.
Well, a lot of variable policy is what Venugopal Gare states is expected to drive growth. Well, a couple of stocks on the radar. Have a look at SBI Cards. That particular name has spiked to the day's highest point, up over 2%. On the other hand, Trent has seen further weakness, has slipped further now to the day's lowest point. One particular stock from the capital goods space is Cummins India. That particular stock today has seen quite a bit of weakness, down almost 3%. Federal Bank too has now slipped to the day's lowest point. So quite a bit of weakness seen, especially as far as the private banks are concerned. A Federal Bank, even a Kotak Mahindra Bank today is seeing quite a bit of selling pressure emerge. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra as well. Sonal, a very good afternoon. And today we're going to be discussing everything about debt funds, right?
It is Debt Funds 101, and we have a guest who will be joining in soon, because this is a category which is slightly difficult to understand. So we thought to make it easier for all the viewers, retail investors to understand when you should be investing in debt funds and how actually. So let's talk about the basics of debt funds before we toss it across to our guests for today. So basically, what are debt funds? It is a category which invests in securities that generate fixed income. What would those categories be? Be it treasury bills, corporate bonds, there are commercial papers, government securities, something that is backed by the sovereign as well. These instruments have a pre-decided maturity date, and that is the reason we have number of debt funds. That list will come up for you on the screen. Be it liquid funds, which is up to 91 days, money market funds for a shorter duration. You have dynamic bond funds. There is corporate bond fund, which would invest in corporate paper. There's gilt funds, the floater funds, where you could see some fluctuation in the interest rate, overnight funds, ultra short duration funds. We have short duration funds, low duration funds, medium duration funds, medium to long, and long duration funds. So these are the number of durations that an investor can use to their own benefit. This is because for everybody the goal would be different, and it will be different timing when they would require their money as well. To understand when an investor should look at debt funds, will it be good for your retirement, and other aspects of this category, let's get in Lakshmi Iyer, Group President Investments and CEO at Bajaj Alt Investment Management. She'll be joining us in just a bit. We also have Abhishek Bisen, who is the head fixed income at Kotak Mahindra AMC, joining us now. Abhishek, good afternoon. Thank you so much for joining in. Let's start with the most basic one. While we talk about portfolio allocation, when a retail investor is looking at a debt fund, what role should debt funds play in their portfolio, and what should they not be used for?
Yeah, thank you, Sonal. Thank you for having me on the show. Debt fund should be used as a portfolio stabilizer and to generate fixed income, predictable returns. Debt funds are known for predicting the returns and stabilizing a portfolio and trying to reduce volatility in the overall portfolio. So debt funds should primarily be used for some kind of short-term or long-term goals. You need to divide your portfolio for short-term versus long-term. And accordingly, you should use those funds. If for your short-term goals, you should use short-term funds. And your long-term goals, you should use long-term funds, because there are volatilities in the interim. And if you are able to match your goals with the duration of the fund, you are able to mitigate that risk, and therefore able to generate more predictable return vis-a-vis other options.
Right, Abhishek. Good afternoon. Could you also tell us how should a first-time investor choose between fixed deposit, a liquid fund, and a debt mutual fund?
Yeah, so first-time investors should first graduate from traditional investments to just the liquid fund to understand how the volatility and the returns behave. Once you're comfortable with the liquid funds, you will be able to understand the volatility in the returns and your investment profile in terms of your maturity. So as and when you are comfortable with those, because traditionally investors are used to a straight line kind of returns in the traditional investment options, while the mutual funds are subject to mark-to-market, which creates some amount of volatility. Liquid funds are the least volatile, and as you keep growing your investment horizon, the volatility typically increases. And if you are able to match those with your investment horizon, you are able to take that to your advantage vis-a-vis the disadvantage. So once you are comfortable, then you decide what are your investment objectives and investment horizon. Once you decide that, then you move to short-term and long-term plans depending on your investment objective.
Okay, Abhishek, just to follow up on this, for somebody who is looking at investing in a debt fund but is little confused, because we've been talking about how savings rate is around 3 to 4%, but liquid funds could give you around 6 to 7%. For somebody who's moved the money from, say, savings account to a liquid fund and then realized that maybe, okay, I want to keep it for a longer duration. How does that switch work? Is it easier? Can they keep money in liquid fund beyond that 91-day period? Understanding from a retail investor viewpoint.
Yeah, again, a good question. And this is a typical issue which most of the investors face. While they are conservative, they typically, and their investment horizon, let's say, very long. but there are conservative investors, they end up choosing a liquid fund, and effectively over a period of, let's say, 3 to 5 years, they realize that the liquid fund has typically not performed equal or higher than a short-term or a long-term fund. So moving in and out will be tax inefficient. If you move out from one debt fund to other debt fund, try to manage your duration of the fund yourself, you will be it will be an ineffective option, because the moment you move out, you are liable to short-term gain tax as per your tax profile, which will effectively reduce your IRR significantly. Therefore, you must decide your profile of your investment and objective and stick to it for a cycle of the fund. For example, if you are sticking for your long-term investment and you've chosen a long-term fund, stick to the duration of the fund, because as you keep going forward and the interest rate cycles are in your favor, typically you end up generating much superior return over any extremely short-term, like for example, liquid fund or an overnight fund.
Right, point taken, Abhishek. Lakshmi Iyer is also with us now. Lakshmi, quickly, if you could tell us, what do you think in terms of the role a debt mutual fund should play in a retail investor's portfolio, as well as, for first-time investors, between choosing liquid funds, debt mutual funds? What is your thought on that front, as well as fixed deposits?
Yeah, hi. So firstly, a debt mutual fund, the basic intent is only from a safety net perspective and not really from a wealth creation perspective. So to that extent, any contingency funds that need from a more short-term planning or something which needs to provide stability to your portfolio, I think these are the key objectives of, having, or these are the key end use that your debt funds can provide to you. And your choice of debt funds clearly is going to be a function of your risk appetite and obviously what kind of longevity you have for these kind of monies to be deployed from a debt allocation perspective.
Okay, all right. So, of course, it depends on your goal. That always remains the first step to looking at any investment, any asset class as well. And then whether you want it for a short-term period, whether you want it for long-term. Abhishek, let me come back to you, because debt funds do not, the underlying in debt funds is not fundamentals of a company, right? It also depends a lot on the interest rate cycle that you're in. So how do they behave across interest rate cycles, say during hikes, during peaks, and rate cuts as well?
Again, good question, Sonal. So, see, markets have a great ability to kind of price various points of the curve in anticipation of the future movement. Like, for example, if market is anticipating a rate cut or a rate hike 3 months, 6 months, or 1 year down the line, they will price assets assuming the rate cuts are going to get delivered. Therefore, while the rate cuts actually may happen, markets would have priced 3 months, 6 months in advance itself. Because of that, most of the time we often see while the rate hikes are happening, but yields are coming down, and rate cuts are happening, the yields are probably going up. So having said that, these create volatility. Sometimes people are able to predict and see, and sometimes not. When we are in a rate cutting cycle, typically the returns from the mutual fund, short-term or long-term, behave much better than the accrual income which the funds generate. And when we are in a hiking cycle, typically because of the capital losses which occur because of the mark-to-market, the returns are slightly lower, depending on the short-term will be better than the long-term, and accordingly. So when the rates are inching up higher, the returns are lower and lower and lower, and the rates are moving up. So your future returns are getting better, while your past may not appear to be good. So today's scenario is a classic example where markets have anticipated the tightening measures much in advance. Therefore, if you look at the past 1 year returns are suboptimal versus what kind of accrual income you would have had, and have priced in much more than what probably may be delivered in terms of tightening, if at all, which is a very low probability event. But if at all it happens, it is going to be a much lower probability. So it has already discounted. If it doesn't happen, the returns are likely to be much better than what is going to be the reality. Therefore, before the rate hikes can actually get delivered, market is already priced in.
Absolutely, markets are efficient and they normally do price in all these situations as well. Lakshmi, your thoughts on that? And, what should retail investors do? Actively switch debt fund categories based on interest rate views or stay invested through the cycle? What should an investor do?
So clearly, switching in and out of funds is not a very great idea. If you ask me from a retail investor standpoint, the initiation into debt funds is so very poor from a larger population, and B, in that, if you have to try, cycle, try to time a mutual fund or an interest rate cycle, it becomes very counterintuitive. So that's certainly not a very great idea. More beneficial would be if somebody were to probably allocate. See, there are dedicated managers in the country which are supposed to be doing that job. So you're better off identifying a strategy which is suited to your requirement and then try to navigate the interest rate cycles without really switching in and out. And therefore, I think, probably sticking around a shorter duration category where you are able to get the benefit of multiple interest rate cycles will be a better way to deploy money.
Okay, all right, looks like the line seems to be broken, and we'll connect with Lakshmi in just a bit. But for now, we'll do one thing. We'll slip into a short break. When we come back, there's so many more questions related to debt funds, right, in terms of the duration and what kind of returns can one expect. So slip into a break. We'll come back with more on the other side. Welcome back to MF Corner. Still have with us Lakshmi Iyer and Abhishek Bisen. We are discussing Debt Fund 101. Try to understand what they mean, when it should be a part of your portfolio. What happens when you want to switch from a short duration to a long duration fund? So let's take that point forward. Lakshmi, let's understand how should retail investors match debt fund categories to different time horizons, say short term, medium term and long term. You just indicated that of course switching would be costlier for an investor if they do it on their own. But if somebody wants to do it across horizons, how should they go about it?
So there are almost 16 categories of open-ended debt funds. So switching is, I would say, as I said, practically not a very great idea. So next best thing is you actually do a bucketing of your requirements, right? Starting from a one-day requirement to a 1 year or a 10-year kind of a requirement. And then, of course, these categories by SEBI are pretty straightforward now. So to be able to put your investments in each of these buckets would really not be a difficult thing in my mind. And therefore, that is a better when you create a cluster. So, a short and medium could be one cluster, and then a long term could be one cluster, and the very short and under 1 year could be one cluster. Don't try to overcomplicate things because there is just that much of window of money that you can make in fixed income. So just trying to go all over the place, spraying and praying will not really be a very great retail investment proposition.
Absolutely. Point taken, Lakshmi. Abhishek, your thoughts on that as well. And do you think, what are the real risks that actually come in these debt funds as well? Credit risk, duration risk. Which one matters more as a retail investor as well?
Yeah. So firstly, I agree with Lakshmi. If you are able to bucket your investment, it helps a lot. Instead of switching, what you can do is like the way you do in equity funds, you keep sipping. And if you are able to rebalance your debt portfolio as well with the help of incremental investment, like for example, if yields are higher and you believe it's closing to the peak, then maybe additional investments can go towards actively duration funds or high duration funds. And when yields are lower, you can stay put towards liquid and that kind of categories. But as far as the risks are concerned, primarily you have two risks. One is credit and other is duration. And both the risks can be mitigated. You can decide very, very well that whether you want that credit risk or not. You can choose AAA fund or the credit funds. And as far as duration is concerned, it is present in both the categories. And you can mitigate the risk by matching your underlying investment horizon with these maturities. For example, if you are short-term fund and you have a short-term goal, like for example, student loan or student education purpose, marriage or holiday, etc., you can very well choose a short-term fund depending on the time horizon. And if you have a long-term planning such as retirement, etc., you can choose a long-term fund and just stay put to that particular segment. You will be able to achieve the goal a much better way instead of switching in from short-term to long-term and long-term to short-term and vice versa.
Take that point. So one point forward on that, and Lakshmi, come in on this. Now that one has decided that they need it for short-term period, and this would be, say, for school fees or some short-term goal otherwise. But in that case, if sometimes debt funds give negative returns, right, even though bonds are considered safe, bonds are considered to be the one which would give you fixed income, how does an investor go about that?
So clearly, if you are going to match your investment, duration tenor closer to the duration of the fund that you're investing in, then the chances of these losses are near negligible, unless there is a credit default in your fixed income portfolio. There is no way you can have a permanent loss of your capital. I think that is something which is extremely important. But yes, because of the interest rate fluctuations, there will be a mark-to-market or a daily fluctuation on your NAV. So very classic case in point, I'll give you an example. If you're investing with a horizon of 1 year, try to find a fixed income portfolio which has a duration of close to that. If you are investing with a 1 year horizon, but if you're investing in a portfolio with a 10-year kind of a duration, then the chances of having a negative returns in the near term will definitely be higher. So I think that is something which, if you know it yourself, you can do it, or you're best, taking, some input or guidance from your distributor or advisor to plan that more seamlessly for your betterment.
Abhishek, your thoughts on the same as well, right? What should the investor do at such a point of time?
So I completely agree with what Lakshmi said. So if you are able to plan your investment well in line with the goals, the chances of delivering a negative return is very, very limited, because typically your assets are maturing or rolling over for the next maturity and delivering the YTMs. So the chance of that turning negative unless and until a credit event is as good as zero, I must say. and or there is a possibility, very low probability event, there's a disproportionate spike in the interest rates. In that case, probably there is a time to add rather than moving out, getting scared about it.
So Abhishek, after the removal of indexation, the big debate was whether debt funds still are as lucrative. Do you think they still make sense? And of course they would, but which type of investor? It would be very specific for a specific kind of investor, you think?
No, we have products for all kind of investors. As I said, debt is a very classic asset for providing stability to your portfolio, especially in times of volatility like this. We have a special category which is somewhat closely mimicking the indexation times, but provided you hold it for more than 2 years and you are able to go in the tax bracket of 12.5%. And it is a debt fund, debt hybrid, debt and equity hybrid with a risk of debt. So, which is called income opportunities and arbitrage category. You can choose that category and still enjoy very close to what we used to have in the times of indexation. So, if you are a lower tax bracket person, as it is, it doesn't matter much because you have your life doesn't change much. But if you're in a high tax bracket, this is a very classic case where you can choose this particular category and still enjoy the similar benefits which you had. But only thing is you need to hold for 2 years and more.
Lakshmi, also just a point that can debt funds actually be used for retirement planning and regular income, and how should retirees manage that NAV volatility that one sees?
There is a requirement for fixed return as far as a retiree is concerned, and fixed income do not assure guaranteed returns, nor they can assure a monthly outgo. So therefore, a better option for such investor would be something like a systematic withdrawal plan, or use yield augmenting strategies over and above the fixed income, which is part of the portfolio, because only fixed deposits can assure you, fixed returns. Everything else is completely market linked. Therefore, I would say for a retirement, a pure plain vanilla debt may not be the best solution. So maybe populating a little bit of equity towards the tail end, or as an income arbitrage, I think that will be a much better opportunity, definitely. And of course, when you're streamlining of income or regularity of income is the key question in mind.
Take that point. Lakshmi and Abhishek, it was a pleasure speaking with the two of you. Thank you so much for breaking down these concepts, making it simple for viewers, because while we talk about pure equity funds, multi-asset funds, there's so much we talk on a daily basis, debt still remains little misunderstood, right? So thank you so much for making it easy for our viewers as well. With that, we have completely run out of time on this edition of MF Corner, but remember to send us all your mutual fund queries on the email address or phone number mentioned on your screen, and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It's a relatively positive picture across most of the global indices.
It's a relatively straightforward session that we're reporting. So just starting slow and sideways.
So we're not really seeing any major macro collapse.
I think as we head into 26, there is a little bit higher optimism.
MK has come out with a note upgrading the stock to buy from add.
Well, it's on the back foot, the market right now, 26,200. The big story of the day is Trent out of trend.
Citi is bullish on divis and GLP-1 is a part of that story.
Gold, silver, copper, platinum, and that's exactly what 26 seems to be doing, building up onto those gains.
Nifty at the day's low as we speak, 101 points lower right now.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and in a bit from now, Prashant as well as Rima will be joining in. Well, for the markets itself, we're under some pressure today. The Nifty is down close to around 100 points. Second day running, we are seeing some kind of pressure. But the broader pain really is, in the broader markets. Case in point being a Keynes Technology. All of a sudden, that stock has fallen off the cliff. In fact, Dixon Technologies as well has moved lower. But there are spurts of stocks that are doing quite well. A stock that we explained close to around an hour or so ago on the channel, Rain Industries, could probably be an aluminium ancillary play. That, in fact, has made a high as we speak, currently at the high point of the day on very, very large volumes. Hey, guys.
Nigel, hi, good afternoon. And, it's quite incredible the influence that one stock can have on the Nifty. The Nifty is down 106 points, and guess how much Reliance is single-handedly putting the pressure by. It's 117 index points negative pressure coming through in Reliance. Just that one name. The second one is not even close. HDFC Bank putting another 55 point index pressure. And Trent is at number 3 with about a 16-odd point pressure at the index level. So, 100-point cut in the Nifty and almost entirely all of it just on account of that one name up on your screen now. That's what I'm referring to. Unlike yesterday when even though the Nifty slid and was sideways and was down actually, but broader market looked much more buoyant with volume price action, both, giving that sense. Today, not so much. It's 2:1 clean declines to advances, 2 down for every 1 up, and almost equally split between volume-led gainers and volume-led losers. So a little more, it's a little more sour as compared to what we had in trade yesterday. Rima, hi.
Hi, some reversal seen in banking names. So Kotak Mahindra Bank had started trade higher. The street liked the advances, deposits growth, etc. But now Kotak Mahindra Bank is down, I think, close to about 2-odd%. 1.9% lower on Kotak Mahindra Bank. I guess the street is looking at the CASA deposit, which is flat on a quarter-on-quarter basis, and that could put pressure on the margin. So Kotak Mahindra Bank has had a reversal since morning. The other one is IndusInd Bank. Disappointing numbers, the loan growth actually contracted, but IndusInd Bank has actually rebounded, and that's up close to about 1.5%, and it's holding up those gains. Maybe it's seen as a bank in transition, and therefore the street is still betting on the story to play out. A couple of the other mid-caps which are still managing some grain, MV Photovoltaic, we've been talking about it on the back of the brokerage note. Nalco in the metals pack is up. Divi's Laboratory has a gain of about 3.5%. Ekta in the morning was telling us about the Citi note. They put a target price of 9,140. They say 2026 could be an inflection year for Divi's Laboratory. They've got a strong pipeline of catalysts in the next 12 months, starting with the GLP-1 opportunity, probably in H1 or H2 of 2026. So Divi's Laboratory is up close to about 3.5%. IIFL Finance, maybe a rub-off impact of the gold loan, the strength seen in the stocks with a gold loan portfolio. So IIFL Finance too is up and about. But other than that, it's disappointing trading session, down close to about 0.5% on the benchmark indices. Let's also tell you what we've lined up for you on our show today. So the markets trade weak on the Nifty weekly expiry day. The index has slipped 0.5%, but holds on to the 26,100 mark. Big fall in Reliance Industries, way
Pockets like metals continue to see buying. Pharma too is a big gainer. Banks are flat in trade. Trent is the big accident of the day. The stock has slumped 7%. 17% revenue growth in the third quarter disappoints the street. We'll get to the details on this in just a bit. And a number of stocks are surging on the back of bullish brokerage views. We spoke about Divi's Laboratory, the City Note. MK has raised the target price on Bajaj Auto, while the Jefferies note on MV Photovoltaic has also seen the stock surge 10%. But let's begin the show with getting you the last hour trades. Mitesh Thakkar from Bonanza Portfolio is now joining in. Mitesh, what are the levels that you're watching for and the trade?
Yeah. So, good afternoon. The bad thing or not so positive thing which has happened is that the market has started trading below 26,200. Now, if we get a closing below that, I think I'll take that as a slight negative and exit the long position. So we have another 45 minutes kind of a thing to recover. Then, we might be back into the range of 25,900, 850 to about 26,300 on the upside. And therefore, right now in the middle of the range, you wouldn't want to carry any kind of directional bias. On the stock side, I have a trade which is on the one buy and one sell. On the buying side is Torrent Pharma. That's a stock which has done very well. Torrent Pharma is a buy. Keep a stop at about levels of 38.78 for targets of 4,000. And on the selling side is Info Edge, Naukri, as the stock is referred to as. That's a sell with a stop at about 13.50 for targets of around 12.75.
Okay. In fact, the top gainer sectorally is the pharma index. That's up 1.5%. IT2 has seen a bit of a rebound. That's gaining about 0.5%. But the big story today and the question among investors across is, what is the key reason behind this sharp 7% fall in Trent? The stock has been making fresh lows every single quarter now. Manglam joins in with a deep dive. Manglam.
Well, if you look at it, the question is Trent out of trend? There are a bunch of reasons for that, and we'll talk about all of them in detail. The reason why the stock is lower is because of the third quarter update, where the revenue grew 17%. Now, you would say 17% in this environment, not particularly bad. But look at how the company's historic revenue growth has been versus what they've guided for. And in that context, how does this number look like? 17% for the third quarter is actually lower than what the company has done for the first 9 months of this year. Typically, at a time in the second half, does a lot better for the consumption space. And then looks lower when you compare it to the FY26 target that the company had given at the start of the year, the analyst meet as well, saying that 25% is a sustainable compounding growth rate for the revenue. And over the last 5 years as well, the company's revenues have compounded 38%. And if you compare that to the 17%, is less than half of that as well. Brokerage is not particularly happy on a couple of things. One, Citi's reiterated their sell call. Their target is 43.50, while the revenue growth of nearly 17% is largely in line, if not marginally better than own expectations of 15.3% over the last 1 year. What's a big positive is that they've added a lot of stores. But having said that, revenue hasn't kept up with the pace of store addition, which implies that same-store sales growth has been negative and average revenue per square foot has been negative as well. Now, this could weigh down on the EBITDA when the company reports its numbers. The second part, the valuations. Now, one would argue that, at peak, the stock was trading at 140 times, 5-year average is 95 times, and the current valuations are 72 times itself. But in isolation, PE is not what determines Trent's valuations in particular. You've got to look at it with growth as well. So when the stock was trading at 140 times, the revenue growth of the company over the last 3 years on a compounded basis was 55%. Divide that by, the PE, divide the PE by growth, the PEG ratio that you get is 2.5 times. Now, the stock has fallen almost 50% from the highs, trading at 70 times, but the sales has fallen even faster. So now if you look at the PEG ratio, then it's at 4 times. So even on an absolute basis, when the stock has fallen and a PE basis, the valuations have come off as well. Growth's fallen faster, and as a result of which the stock optically on a growth basis, PEG ratio basis, has become a lot more expensive despite falling, and that's the conundrum out here. So from here on, what is it that we're tracking for Trent? Same-store sales growth trends for both Zudio and Westside, whether there will be any recovery in sales given the government boost to consumption in the second half of this year. At the same time, growth in their newer formats, which haven't yet, caught the streets fancy as Zudio did in Star Bazaar, Utsav, or even the latest entrant, Burnt Toast. And finally, nothing is fraught without risks. So you just look at, further slowdown in consumer sentiment. When Zudio had the head start, there wasn't Ustar, Shein, Intune, or even OWN. Now this place is getting a little crowded. And by design, Trent or Tata Retail does not have much presence in online fashion. Could that be a growth impediment going forward or not, is something that we'll get to know soon.
All right, that's Trent for you. And there's a 9% cut now coming through on the stock. I just want to make a quick mention of, let's put up Reliance Industries' stock, right? I mean, you'd imagine, well, no connection at all, absolutely completely different lines of businesses and et cetera, But there is, and you wonder why the stock is down 4.5%, but at some level there is a little bit of concern at the margin that maybe, and Reliance Retail, which of course is a very significant part of RIL's SOTP valuation, whether that is undergoing, is perhaps seeing a little bit of a slowdown, as is evidenced by numbers from Trent and actually others who've reported recently as well. So, I mean, that is one perhaps factor which is being talked about. I just want to sort of highlight that before we go any further. So, 1507, as I said, single-handedly largely responsible for the 100-point cut on the Nifty. Prima.
Okay, let's get in Dharmesh Kant, Head of Research, Chola Securities, on the show. Dharmesh, let's begin with Trent. What have you made? As Manglam pointed out, that even now, after the correction of more than 40%, it's trading at a PEG ratio of 4 times. But at peak valuations, when the PE valuation multiple was 140, 150 times, because growth was so strong, the PEG ratio was only 2.5 times. What from here for Trent?
Yeah, Dr. Narima, very nicely, detailed out about the trend analysis by Manglam. But I mean, we were negative on this company since they reported their September quarter earnings last year itself. From there, we have consistently maintained a negative stance, and I have been on record about this, that the stock prices will correct to the valuation multiples. And see, 17 times is the growth they have reported. Doing a 25 to 30% kind of a growth would be a Herculean task for this company. And to my mind, even if that is achievable, then also 40-45 is the PE multiple which this company will command. So having that in mind, and you can always extrapolate the earnings multiple, and then you can see the valuation. To my mind, for next 2 years, getting beyond 5,000 stock price would be very difficult for Trent. And this has to be looked in conjunction with, say, V2 Retail. They came out with a same-store sales growth of only 2%, and V-Mart only, it was a flattish kind of a same-store sales growth. So this kind of a business have a natural tendency to normalize over a period of time. After the first 3 to 5 years, they do well. And then 20%, 22% is a tough task to maintain. So to my mind, I mean, people should not be jumping to buy it for investment purpose. Trading price can still be there. And my fair valuation for Trend for, say, FY27 earnings estimate is around 3,500.
And you're saying the fair valuation multiple should be 40 times PE, and currently it's at 70 times PE. So there's still a lot more PE derating to go. Ramesh, comment on Reliance Industries. What exactly is responsible or the reason behind the sharp fall of 5%?
Yeah, it's surprising to see such kind of a fall on Reliance Industries in a single day, and without any specific news flow, surrounding the company. So, I mean, just now Prashant pointed out that maybe the retail division valuation may be under some scanner. But I would like to highlight here that if you look at the retail division of Reliance, so in SOTP valuation, what we have calculated is around 2x of what the total revenue it does. Whereas the likes of the Trent and others in the same basket commands 6x to sales in their valuation multiple. So I think if that is the reason why the stock price is correcting, it's a very good opportunity to buy Reliance Industries, which we have been recommending to our clients even today. So to my mind, I mean, this is one division which will get you a SOTP valuation higher than the Jio platform put together. So, I mean, it's a clear buy to me in such kind of a falling scenario. Till now, I have not come across any news flow which is significant enough to have such kind of a price correction in Reliance Industries.
Okay, all right. Dharmesh, wanted your view on Divi's Laboratory. That's a stock that's getting in trade. Post a bullish note by Citi. Ekta joins us to run us through that note first. Then we go across to Dharmesh for his view. Ekta?
Well, yes, Citi has a buy with a target price of around 9,140 rupees on Divi's Labs. They think 2026 can be an inflection year for Divi's. The company has a strong pipeline of catalysts over the next 12 months, notably GLP-1 as well as contrast media. Now, various custom synthesis products are also maturing, which may be commercialized in the near term. The generic segment too is expected to witness a recovery in 2026. The quarterly numbers may experience volatility according to them and present forecasting challenges, but the medium to long-term story remains intact. They believe that Divi's revenue and EBITDA can expand by 3 times to 4 times over FY25 to 30, and FY27, FY28 EPS is 10 and 18% respectively ahead of consensus.
Okay, all right. Thanks a lot for that, Ekta. Dharmesh, what's your view, Divi's Laboratory?
Yeah, hi, Nigel. I mean, no more speculation kind of analysis in this market because, you know, the note itself says they expect a volatility in quarterly numbers and it will be difficult to forecast the numbers. But medium to long term, they are having a bullish view. So I think this is not a market when you can build on hopes and try to build on numbers on that basis. The numbers which have been delivered by companies and which are doing well with the clear-cut management commentary backing that up are the ones to be, you know, looked into. And there I think Lupin stands a very good chance. If you look at last 2 quarters, Lupin's numbers, they have an excellent set of numbers with margin improvement and 25% plus growth in the profitability. And Torrent Pharma, that's the another, you know, company which we liked from the pharma space. So Torrent Pharma may be expensive on the valuation metrics, but Lupin is still cheaper compared to a Sun or a Cipla. So, and the currency benefit, the tailwind is anyways there for all the pharma space and the chemical players because largely they export. So our topic from the space would be, you know, Lupin and Torrent Pharma. Divi's, I mean, it's we'll leave it at that.
Sorry, expensive, is it, Dharmesh? Afternoon.
No, Divi's, I mean, I'm not very clear on the profitability trajectory of Divi's.
Okay. No, I was just checking there. What else? I mean, I think there's a fair bit of, I think that IEX here, I'm not sure if there's any update really which has come through, but the IEX case is in the appellate tribunal today, and some have been making the case that maybe, you know, given the stock is basically bombed out and given the fact that in the last hearing, there were those really explosive allegations, which basically said that the person who was kind of been at the helm of passing those orders on market coupling traded the stock and profited absolutely wild. And because of that, I mean, it's possible that the appellate tribunal may pass a stay and then look at the matter afresh. I mean, it's all hope, but that's a talk with regards to IEX. Dharmesh, I don't know if you have any thoughts here on this one.
Yeah, Bashar, I mean, this should be avoided because market coupling will definitely happen over a period of time. That is bound to come. I mean, the time frame may be decided by the authorities. At the same time, if you look at the kind of a grid supply with all these power companies are now doing. So this time itself, there were 13% drop down in the the per unit power rates. So, but that will again be a drawdown on the commissions which they are. So I think though the stock price has corrected significantly, but still it's not worth a look at this juncture from investment perspective. I mean, trading plays pop-up can still be there, but we are suggesting a clear avoid on this company.
Yeah, no, absolutely. A point taken. I remember when this entire market coupling issue started, it's not, I mean, you know, the government made its stance very clear. The power minister at that point is on record saying that, well, you know, they want market coupling and things like that. So, I mean, it's not just some one committee which has kind of pushed it through and now that can be voided because of the allegations. So, point completely taken. We'll wait, of course, for what the appellate tribunal says because, as I said, the case is on there. Let's talk about Bajaj Auto, which is the other stock which is up. MK believes that the company offers attractive risk-reward at current levels. Sudarshan is here to detail that up for us. So, over to you.
So Bajaj Auto, since the time it has announced auto sales for the month of December, has been in the focus, and in the last 3 weeks stock has risen as high as 10 to 11%. Now today MK has come out with a note upgrading the stock to buy from add and has increased target price to 11,100 from earlier target of 9,500 per share. That implies upside of 15 to 17%, and the reason there is an upside in the target price because it has increased the EPS estimates for FY27 and 28, that is in the range of 4 to 9%. It believes that Bajaj Auto offers attractive risk reward at the current levels. But what's the reasoning behind the upgrade? First, domestic market share for Bajaj Auto seems to have bottomed out, and in the last 1 to 2 months it has gained the market share, especially in its focus segment of 125cc plus. Second one, export momentum continues. Recently, for third straight month, export sales have been more than 2 lakh units. Next one is electric three-wheeler has been seeing the improvement in the total sales, and also rupee depreciation against dollar is going to aid to the margin. And lastly, there can be an upside from the KTM that MK believes that will also aid to the total growth.
So thanks very much for that. There is Bajaj at this point in time. What else is happening? I mean, I think it's pretty steady, but you've done about 100 odd points or so as things stand. Swiggy has been down from the morning, is down about 5.5%, and has got very, very large volumes, mind you. CSB Bank is seeing some profit booking, but had a one-way rally with the management with us after the third quarter updates yesterday. There is IMFA, which is down 9%. We've talked about this name earlier. So 1322, but again, I mean, it's a huge performer over the last many months. So just some pullback there. VATech Vabag is another one. Is down about nearly 5%, 12.23. Allied Blenders and Distillers is down about 4.5% at this stage. Gokuldas Exports is in the 600 rupee handle now, 675 on Gokuldas. So just a complete collapse, from the time, if you remember, this is late November when there was a lot of chatter that the India-US trade deal is close by, etc., etc. I mean, price had run up to about 950 or so, and it's at about 675 as things stand right now. Nigel has walked across to the F&O desk with a quick snapshot view of what trade is like and what is positioning looking like now. Nigel, over to you.
Well, as we've been pointing out, Reliance Industries, that's a big drag in today's trading session. That continues to weigh even in today's trading. If you look at the F&O picture, there are fresh shots that are seeing out there because the stock is down and open interest has surged up for a counter of this particular size. And if you just pull up a contribution chart, you'll see X of Reliance Industries, actually, the stock would have been, the market would have been in the green. Moving to a couple of other data points, the PCR, in a matter of 2 trading sessions, it's moved from 1.5. Yesterday, it went above 1.5. Currently, it's at around 0.83. That cooling off was required. That's happened as well. It's moving to the lower end of the range from moving to the upper end of the range. All this in a matter of 2 trading sessions. The lower end of the range is around 0.7. That's because the call writers, they are having a gala time today. So if you look at the 26,150 call, you see the premium crash by around 80%, 26,200 call, the premium out there is around close to around 95% or thereabouts. So aggressive writing is what we are seeing. Just going by this, the call writers, well, they'll believe that this 26,225 odd, that's the level that they can defend. But on the downside, till this 26,000 mark holds out, the bulls will believe they're in for a better time for the remainder of this series. Moving to the Nifty Bank, well, that one, in fact, is outperforming today, and it continues to hold close to 700 points away from its 20 DMA. Individual stocks in focus, IIFL Finance, one of the stocks we pointed out yesterday, they had, they have gold exposure. That's come in for a bit of a short covering bounce. It's been strong the last few trading sessions, and now the shorts are covering out. You have MCX as well that's seeing a bit of a short covering bounce in today's trading session. While on the flip side, Swiggy, I don't know what the street is reading out here because the open risk built up is massive on that particular counter, more than 50% built up, and fresh shorts are being seen in the system. So I'll keep an eye out on Swiggy from here on. Havells on the flip side, stock is corrected a little bit from the top. Fresh buying is what we're observing on this counter. Back to you.
Thank you very much for that. We'll also take the opportunity to thank Dharmesh for joining us on Closing Bell today. We will get into a break. On the other side, we'll connect with Rupen Rajguru. Stay tuned.
Okay, welcome back. I just want to highlight some information which is coming in on IEX. I think the stocks moved about $2 from the lows, where it was at about 220. And the intraday will tell you that, okay, it's moved up even more now. It's about 3.5 rupees on the day. And I think, of course, from the lows, it's come up quite a bit. But, you know, these are just observations. So the tribunal is saying that we were told that this was done, that this coupling order was done for some officers to make money. This is what their observation is, that this is what they were told. They say a lot of theatrics in making these coupling regulations. Regulations could have been done quietly by CERC. Expect CERC to be independent, above suspicion, like Caesar's wife. And they say if there is something amiss, we'd like to inquire and take action to avoid a repeat. So this is not saying this or that in terms of what they're going to do, but they're just hearing both sides and reflecting. IEX, of course, is making the argument saying even without SEBI findings of insider trading, the coupling order is wrong and needs to be set aside, which, of course, has been their point of view for some time now. We have Rupen Rajguru, Head of Equity Investment and Strategy at Julius Baer. Rupen, good to have you with us here. Thanks for joining in. So just a quick, I think our first conversation in 2026. So season's greetings and happy 26 to you, Rupen.
Happy New Year to you and the entire crew at the CNBC.
It's a bit quiet, Rupen, isn't it? While the rest of the world is still is quite doing well, we are kind of continuing on that same trajectory, which is kind of hunting for triggers and not finding too many around. Would you agree, Rupen?
Prashant, I would say these are early days, and yes, from a trigger perspective, India definitely is lacking a trigger. And if I were to just look through from a global setup perspective, so typically any global allocators, they would look into 2-3 things, before allocating money. So whether either you are a macro trade, or you are a momentum trade, or are you a mispricing trade? So does India qualify in any of these three? Probably not at this juncture. Probably the macro trade currently from a global allocator perspective is still, precious metals, which is where, a lot of money is going. Momentum last year was AI. We have to wait and see whether this year how it will pan. And mispricing, while India has underperformed, but has India gone into a valuation zone, say, at what China was a year back? Because China clearly was a mispricing trade. Probably not. So in that sense, India is lacking trigger. So probably what will change would be the earnings. And I think that's historically always been the reason why market moves up. We have to wait and see how this quarterly earning pans out. But at the margin, what we believe the earnings growth going ahead would be much better than what it has been for last 6 to 7 quarters. So that's the setup, and we have to wait and see if the earnings comes through. Definitely, we will be in for positive surprises from the market.
Rupen, Han season's greetings. Happy New Year to you. You've liked airlines in the past. It's a sector where we are seeing consolidation, lowering of competitive intensity. There was a dominant player. Now, in early and middle of December, there was a crisis unfolding at India's dominant player, Indigo. Now, at such a time, we saw the stock price also fall very, very sharply. Did you use it as an opportunity to add to your holdings in airlines, or has it changed your view on the sector?
Hi, afternoon, Rima, and Happy New Year to you as well. So overall, our view on the sector still remains positive. And while definitely the news flow around December was a little bit concerning, and there has to be some readjustment in their overall, the way they do the hiring and all other stuff. But at the end, there will be definitely an impact in the quarterly numbers. But as a theme, we continue to like it. While because of the noise, we definitely saw the stock kind of giving off some of the gains which they had done in the last year. But from the overall theme perspective, and it also adds into our overall theme of premium consumption. So we continue to like this theme, and the incumbent, the largest player, definitely from a cash flow or operating cash flow perspective, we believe next 2 years they will make a very good amount of operating cash flow, and then post correction, definitely it is a pretty attractive from an overall valuation standpoint, notwithstanding the news flow, because news flow can come, more news flow can come through, but we remain constructive on that.
So did you buy the stock into Globe Aviation during the correction?
Yeah, I would refrain from commenting on individual actions, but we will continue to remain constructive on that.
Okay, all right. Hi, Rupen. Good afternoon. Good to see you again. And it's always been good speaking to you, not just about markets. Your positive energy is something that pulls me through sometimes. So good to connect. Tell us about, the tech space, because the first earnings are going to be off the block in the next few days. Reema's going to be in business. What's your view out there? I think in the past you've been talking about that being a tactical bet. How are you placed right now?
Yeah, hi, afternoon, Nigel. Always pleasure to be on your channel. As I had mentioned earlier, tech, if usually there is a very strong positive correlation with the Nasdaq. Probably 25 was the first year in which this correlation got broken, wherein Nasdaq broke out and our Indian tech went down. And clearly the reason was the AI being the new talk of the town and the new global momentum trade, and India was probably not part of it. And also because of the overall uncertainty around tariff, the US spending also on tech and all saw a little bit of slowdown. So come this year, do we see a significant pickup in that? The answer is no. But at the same time, if there is no strong US tech spending, typically the tech stocks or the more essentially the large cap stocks will become more a tactical trade. And as I'd mentioned sometime back on your channel, the PE range of say between 19 and 21, 22. So it becomes a buy. I'm talking more of large cap IT names when it gets into 18, 19 PE and probably a sell when it becomes 21, 22 PE. So at current juncture, they are more towards the sell zone because it had gone down and it has had seen some recovery in the last quarter. But definitely there is a lot of action in the mid-cap space. And while AI is always, India has never been a what you call originator of any new themes, but India has always been an executor, an enabler. So now the big amount of spending has gone into the AI capex, the hardware side, and probably over the next 1-2 years, there will be more spending happening towards the software side, wherein the Indian guys will come into play. And historically, Indian guys always have been a play in that.
Yeah, Rupen, I just want to, apologies to interrupt. Pull up IEX. I'm not sure what has happened, but the stock's up 9% now. 9%. Is there something coming out of the courts, the tribunal? I don't know. But the last I checked, the last time I referred to those flashes, there's no addition. There was just observations. But this is another 5% jump on top of the 3% rise that I was sort of talking about earlier. And I'm not sure if, people in the court definitely know more than what we do here, but we are going to make an effort to get you details from what the tribunal says to you quickest and fastest. But it's a massive 8.5% move that we are looking at this point in time. So more in a bit from now, but we're still waiting. What we had and what we put out with us earlier was just observations. The tribunal, the court essentially saying, well, this is what we've been told and this should not happen. And, generic comments like CERC should be above any sort of questioning should be like Caesar's wife, etc., etc. So these are just observations. It's not leaning one way or the other unless there is something new which has come through from the tribunal, which we will try and get to you in just a bit from now. Otherwise, it is just fun and games. I don't know if there is anything new at this stage, and but we will, as soon as something comes, we will put it out and go across to Ashmit, who's covering this for us. Hormuz is here with the spotlight on the top movers out there. Hormuz, tell us more.
Oh, well, the one that is making the spotlight right now is IEX for sure. But other than that, of course, there are a lot of names that are moving around in the broader markets. Cupid is one such name. It's been in focus all through this week. It snapped a 2-day losing streak today. It was down nearly 30% in that 2-day fall. But volumes are now almost at par with what we saw on Monday's trading session. But for 4.5 crore shares that have been traded on Cupid, the 20-day average is around 76 lakh shares. And out of the last 7 years in the month of January, Cupid has delivered negative returns in 5 of those. So January is not a particularly promising month for the stock itself. Keynes Tech is the other one. It snapped a 2-day gaining streak today, and before the fall, the stock was trading around subpar volumes. It is still trading on subpar volumes, but they've picked up in the last few minutes. You still had the fall has come on the back of 20 lakh shares that have been traded so far. The 20-day average is around 40 lakh shares, so still half of the average, and the stock is currently trading at a 52-week low. Now, Nigel spoke about IMFA earlier in the day, just a few minutes earlier. Stock now down 12%, the biggest single-day fall since January of this year, actually January of last year now, if I may say. The second straight day of losses for the stock has declined in 3 out of the last 4 sessions. Volumes are the highest since November of 2024, and 20 lakh shares have been traded on IMFA so far, 20-day average of just under 2 lakh shares. The stock is below 50 and it's 50-day MA. The 100-day MA now on the downside is at 1180, and it's now down in the month of January after 5 straight months of gains. And lastly, Swiggy, you spoke about this just a few minutes earlier, the third straight day of losses now. Over 2 crore shares have been traded on Swiggy, 2.25 if I can say that. 20-day average is just 80 lakh shares. The stock has moved below all of its key moving averages, trading below its QIP price, which was 375, its IPO price, which was 390, and from the post-listing high that it made, which was close to 620, the stock is down almost 40%.
All right, Hormuz, thanks very much for that interesting list as always. We're putting out, of course, what we have been saying verbally, that the hearing is still on. No order from the appellate tribunal as of yet, and stocks hanging in there as we speak. Okay, we will get you more update and look at CERC lawyer. We got more, and we'll put this up in just a bit. But CERC lawyer is telling the appellate tribunal. Okay, I think we should be careful how we put it out. But they're saying that we will have to consult and seek instruction on withdrawal of the order. We wanted to make sure the coupling order is more consultative, fair, and transparent. And we'll take up the issue with CERC members. We'll take instruction on withdrawal of the coupling order. So this is what the CERC lawyer is telling the appellate tribunal. CERC, of course, is who passed the order, and now they're telling the appellate tribunal that we wanted to make the coupling order more consultative, fair, and this is, of course, we are picking up bits from the hearing which is going on. So there is a context to this. Both sides, of course, are arguing in court, but we're still waiting with regards to actual order. An actual order, but I think we can put some of this out, especially the bit about. I think this is CERC more than anything else explaining, saying, I mean, that entire bit about theatrics and whether this should have been done quietly, but essentially they're saying that we wanted to make the coupling order more consultative, fair, and transparent. I guess this is in response to the theatrics comment from the court. But they go on to say that we will have to consult and seek instruction on withdrawal of the order, and we'll take up the issue with CERC members. We'll take instructions on withdrawal of the coupling order. So we're just purely stating what CERC is telling the appellate tribunal. This is still not an order. This is still we reporting the what's happening in the court with on one side there is CERC. And on the other side, there is IEX, and we're just reporting verbatim, almost verbatim, what each side is saying. So that's about it. Stocks locked up, upper circuit. It's a 13.5 odd rupee move now coming through at this point in time.
Basically, CERC is telling Aptel that if they give the order to withdraw coupling, then they will do it, and then they will seek instructions.
Yeah.
So we still don't know whether Aptel is giving the order to withdraw coupling. But market seems to be taking a hint.
Yeah, it's as we were saying earlier, the basic, the funda was that maybe downside is limited. Zyada se zyada aapko dusri, they'll extend and say, well, the case is going to be heard another date. Or so okay, then it is unchanged.
Yeah.
On the other side, if something may come true, it's a chance. So that is how many were treating it. But once again, I just want to say. That no order yet, and we'll repeat that once again. We are reporting verbatim from the comments which are being sort of said by CERC and IEX on the other side. to the court at this point in time. We'll try and have Ashmit, of course, a little later because he'll be inside and, of course, he's sending us the information as the proceedings are going on, and we'll try and have him with us as we go on. 10% higher. I think we should take a quick break. Don't want to miss what else comes out of the course. So let's just do that. Let's take a very quick break here. We'll come right back in just a bit.
A bit of an expiry-related factor playing out. The losses, in fact, on the Nifty have now been cut down to around 60 points. There's a wee bit of a recovery that we're seeing. NTPC has spiked up a little bit. Apollo Hospitals continues to rally. Well, that stock is putting on some weight. It's moved to the high point of the day. And I think Asian Paints as well now at the day's high. Well, time to move to these. Yeah.
I think we've got more information. So the IEX thing, right? Councils on both sides, CERC and IEX, have sought more time, and the tribunal has decided to hear the case next on the 9th of January, which is in 3 days' time. Friday. Friday is when the case will be heard once again, so that's it. I mean, that's basically, I'm assuming the hearings are over and the case has been put to be heard once again on the 9th, which is this coming Friday. Stock was limit up, frozen 10%, and it's moved up a little bit more, 11.5% now. So we'll see. But no order from the tribunal, and the tribunal essentially is telling the CERC lawyer, has told the CERC lawyer, if you tell by Friday on potential decision by CERC to withdraw coupling order, we'll close the case on Friday itself. Okay, they're saying that that's what's coming through. I'm not sure what this means. So the court essentially is asking the CERC lawyer that if you tell us on your decision whether you want to withdraw the order, coupling order or not, we will rule on Friday itself. That's what's happening. But the information, the operative information, of course, is the fact that the next leg of this hearing will happen on Friday, which is the 9th of January. as at this point in time. So it's a big, massive move, and almost all of it coming through after 2:30 once we started the show. The hearing, of course, was at 2:30, and almost all of it. I mean, the low was at about, I think, 132 or so. So from 132, it's a move all the way to about 150 rupees now on the IEX stock. That's essentially the line. If you tell by Friday on your decision, we'll close the case. That's the court telling the CERC lawyer. Nigel.
Well, that's right. Now let's move across to Nimesh. He's here to tell us what he's picking up in D-Street chatter. Nimesh?
Hi, Nigel. Under pressure today, but not a bad outcome given the fact that so many large cap names are under pressure, including Reliance, and still the Nifty is down only 70 odd points. So that gives a bit of a comfort that not everything is bad and ugly in today's market. Having said that, there are negative flows, is what I understand from FIs, and largely so in the broader market. So some of the large influential desks are having aggressive sell flows from larger FIs in the broader market names today. So that's overall from a flow perspective. From a sector stand, I guess Pharma stands out today, and metal, of course, has been the big sector which is outperforming largely on the back of the underlying assets going strong. And that's one specific which has done well. But Pharma has added in today's market and some bit of buying as well. And in fact, there are some triggers as well for the Pharma stocks, including some of the individual names like Aurobindo, Glenmark, and also that's playing out in some of the individual stocks. But I guess this reaction on the quarterly updates is going to continue, at least in the near term. We saw that what happened in Trent today. It took 7 days or 8 days for Trent to rally 5-6%, and in single days given 10%. So that kind of reactions will happen and will continue. But broadly, from a flow perspective, today is a day when there is selling pressure in broader markets.
What about stocks, Nimesh?
Well, so the first stock on my list is Bliss GVS. It's a small company, 2,000 crore market cap. It's up 10% on very large volumes in today's market. My sense is that could be some corporate development on the cards. A potential M&A is a buzz as far as Bliss GVS is concerned. So that's the first stock. The second name is Inox India. Well, the stock has been consolidating. I understand there was a selling from a larger FI that's getting absorbed by some domestic mutual funds, and one FI entity is a buyer as well in Inox India at current level. So that's the flow there. The third name is Religare. Again, the stock saw a bit of a spike in yesterday's trade. And again, for Religare, there is a strong buzz that maybe some corporate development is on the cards. There is a sense that maybe there could be a demerger on the cards with regards to the various businesses. So that's the buzz as far as Religare is concerned. And the last is Eternal. The stock has actually corrected from the recent highs of 350, but the selling continues. Even today, I understand there is aggressive selling from larger FIs in Eternal.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Mitesh Thakkar. He's back with us to give us his trading calls. Mitesh?
Yeah. So I think, Nigel, we're not closing with strength, neither with kind of weakness. It's come off a bit, but the important point for me today is that we are closing below 26,200. So a mild negative on the index, don't carry longs on the index per se. On stock side, STBT on Oracle Finance, keep a stop at about levels of 76.25, maybe a rupee above that, 76.26. And look for 75.50 as the target. While Petronet is a BTST with a stop at 293 and a target of around 300.
Thank you very much for that. Back to the commodity space. The rally in metals is showing no signs of stopping. Manisha is now joining in. Manisha, give us the latest.
It is a very strong start to metals in 2026. 25 was a year that you saw all-time highs in gold, silver, copper, platinum, and that's exactly what 26 seems to be doing, building up onto those gains. So overnight has been anything like a 3 to 5% of a gain, and in this year we've seen 3 to 10% of gains come in for many of those metal prices. Copper is trading at all-time highs. This is on the back of concerns over potential US tariffs and also a mine in Chile. The workers there are now demanding a part in profit in what copper has seen. Remember, all-time highs, 45% of gains in last 12 months for copper. So labor wants a part in that as well. Aluminum is trading at a 3-year highs. You have China looking to curb production. Also, when you look at key smelters in Iceland, Mozambique and Australia, there are concerns there supporting aluminum prices. Nickel is trading at a 1-year highs. This is after Indonesia says that they're looking at 34% reduction in nickel production going forward. Iron ore, which didn't do so well in 25, also seems to have started 26 on a stronger note, as Chinese steel makers are restocking iron ore ahead of the Lunar New Year holidays in the month of Feb. And then you have zinc trading at a 14-month highs because of global inventories continuing to decline. Silver gained 5% overnight. You have heightened geopolitical tensions and then China export restrictions in this year. All of that supporting silver prices also. Markets from here on would, of course, look at the U.S. non-farm payroll data that comes in on Friday. Further gains could come in after that.
Well, as you said, Manisha, aluminium stocks as well have been on fire, but investors, they are asking, will it rain? What I'm hinting as is what's the buzz in Rain Industries? Remember, the stock in the last 1 month is up close to around 40%. It's still 20% down, though, from its 52-week high. The street seems to be viewing Rain Industries as an aluminium ancillary play. Remember, it produces CPC as well as cold tar pitch. Both of them are used in aluminium production in different proportions. The aluminium segment contributes close to around 42% of Rain Industries' total revenue mix. Spreads, remember, have been improving. The company has been coming out of a rough phase. Remember, the last few years have been rough, but last 2 quarters, they've been delivering numbers of around 600 crores on a quarterly run rate. And now the street is hoping for a recovery, particularly in 2026. If you just pull up the EBITDA numbers. Valuations, there is some support. It trades at less than 1 times price to book and on EV upon EBITDA at around 5 times. This further gets some support because in Rain Industries, you also have a 4.3 million ton cement unit, which is sub 10% of the total revenue, but replacement cost could be as much as around 4,000 crore rupees. They have also laid out a bit of an expansion plan on the cement business. What to track from here on, though? Debt refinancing, debt reduction, that's top of mind. The last reported debt is close to around $800 million odd. And the management has indicated that they're watching the markets closely. They're looking at an opportunity to optimize interest cost. And they've also mentioned there are no major term debt maturities all the way till October 2028. Besides debt reduction, the street will be tracking the spread between GPC, which is the input cost, as well as CPC, which is the selling product, which has improved of late. And also a smaller part of their business is their advanced materials business. 20% of the mix ramping up there is going to be important. In terms of fund participation, ICICI Prudential, under various schemes, they have gone ahead and they've been steadily increasing stake in the company. Time will tell if Rain Industries can participate in this big aluminium cycle that we are seeing. Well, that said, I think we can move on to our next segment and welcome the next management. We have Jay Bala of cashthekiosk.com who joins us on the show. Hi, Jay. Good to see you in. Looking good with that sweater. Looks like, I believe it's quite cold in UK. But wishing you a good 2026, Jay. And hopefully those highs that you were talking about last year, we get out there. So let's address the Nifty first. Where are we headed?
Thanks, Nigel. Happy New Year to you and the rest of the team at CNBC-TV18. The markets are have come to record highs from where we have been pointing to that possibilities since April of last year. But today's price action, rather yesterday and today's price action, are a little bit discouraging. The Nifty hasn't seen follow through to the fresh record highs, and the key pivotal Reliance, after clocking fresh record highs at 1611, it's caving in, and that's not an encouraging sign for the bulls. But that doesn't impact the medium-term picture. We still maintain the 29,000 call that we have been holding since April 2025. But the short term could get a bit volatile. But as long as the Nifty can manage to hold about 25,690, I think it's in a safe zone. But if 25,690 were to break, this new high might be a short-term bull trap. So we don't want to see the markets drop below 25,690. Keep that as an important support level.
Okay, all right, got that. What about individual stocks? Let's get those ideas first out of the way.
Yeah, I think ICICI is trying to offset what Reliance is trying to do on the downside. So I'm bullish on ICICI. The setup there is a breakout from an inverse head and shoulders pattern. The stop loss at about 1335. I think the stock can scale something like 1520 from current levels. So the structure for the banking index as well as SBI is looking incomplete. So, but a little bit of caution because this is a stock that's going to offset what Reliance and HDFC is trying to do. So a sensible allocation here would be a call for the day.
Trent?
Yeah, Trent, I'm mostly negative on most of the FMCG names. Negative in the sense I'm not going to be bullish, and Trent falls within that category. I would anticipate one more low below the December or the 2025 low for Trent. Post that, it has a bottoming out potential. So I would expect Trent to hit somewhere about 3,800, and I would avoid all the FMCG names at current levels. I would treat any bounce within the entire FMCG pack as a counter trend bounce rather than a startup.
Talking about bounce, what about Bitcoin? Where is it headed? Just a few days ago, it was losing its way, and the way it burst up last evening was spectacular.
Yeah, I'm bullish on Bitcoin from a medium-term perspective, Nigel, but I'm not completely sure that 80,000 odds that it saw in the late part of 2025 was the final low for the corrective decline. So let's split it into two halves. In the short term, I'm anticipating a modest break below 80,000, and then resurgence in the medium term back to about 150,000.
Jay, stay on. Need to slip into a very short break. But as we do that, we also want to get our viewers' views coming in from Sunil Singhania, founder of Abacus Asset Manager. He told CNBC-TV18 that India's journey from a $4 trillion to an $8 trillion economy will be aided by new age companies. He also remains bullish on financials and metals. Listen into his views.
We are not saying that everything which is new age or new economy is bad, but, I think there also one will have to distinguish. And we are very clear that we would want to give capital to companies which will use that to grow, not to burn. And therefore, perennially loss-making or cash flow burning companies are something which we should avoid. The other thing is it is very difficult to value these companies. And, more often than not, one gets sucked into a momentum kind of a thing. So I think that is where I would say that we have to basically be a little bit careful. When we grew from $0 to $1 trillion in terms of economy, that was contributed maybe jute and cotton and, textiles and some utilities, some steel. 1 trillion to 4 trillion, the path in terms of the economy, I think the contribution came from private sector banks, IT services, pharma, a lot of consumption-oriented sectors. And it is very clear that when we move from 4 to 8 trillion, I think a lot of these new age businesses will contribute a lot to that journey of 4 trillion to 8 trillion. So you can't write them off. We were positive on 3 sectors and we continue to be positive. 2 of them have worked out well. So all kinds of financials, including some NBFCs, non-fund-based financials, predominantly asset wealth management companies, insurance companies, I think they have done very well. Banks also have been doing reasonably well. Growth rate obviously have slowed down to maybe, low double digits, but very good asset quality. Metals have done phenomenally well for us, and to some extent we were lucky because it got helped by what is happening globally in terms of metal prices. Pharma is one sector where we are positive, which has not worked out in the way we would have liked to, but I think there is a lot of moat there, both domestic pharma, global pharma. I think there's a little bit of overhang of any negative news which can come in from the US front. But Indian pharma has a lot of moat. So I think pharma is one sector where we would like to stick our necks out and be a little bit more overweight.
Okay, that's an important market voice as far as Sunil Singhania from Abacus goes. Ashmit is now joining in. He's, of course, been reporting on the going on in the court with regards to the market coupling case. Ashmit, take it away. What really came through today and what did the court say? We know the next hearing is on the 9th, but what went on in the court and what does it tell us about which way this is headed? I'm not asking you which way this will go, but what did you pick up?
Well, to begin with, important to clarify that the hearing is still underway. The APTEL hearing is still going on. And in the course of the hearing, we're given to understand that the issue that was raised last time on the issue of insider trading, on the issue of possible involvement of CERC officials in making money through the coupling order, that issue came up once again for consideration. The APTEL, which was in fact hearing this matter at the very outset, said that this is an issue that is of concern to them, that they saw a lot of theatrics at the time of passing of the coupling order, that they did not understand why there was such a dramatic regulation taking place, and that if there is in fact something foul this will be something that the APTEL will be looking into. But that's one side of the story. The other side is, importantly, that the CERC councils who were also present, who were also a part of this hearing, importantly, gave an indication that the CERC had wanted for this process to be more fair, had wanted this process to be transparent, had wanted this process to be consultative. And having said that, the CERC lawyer submitting before APTEL that he will be seeking instructions from the Commission on whether there can be a withdrawal of the coupling order altogether. This is an important bit of clarification that the APTEL said that it would welcome. In fact, the APTEL said that if this hearing comes, if this clarity comes before the next hearing, if it comes by Friday, then this could very well lead to a closure of this entire matter altogether. That would also meet any concerns that the IEX, the Indian Energy Exchange, might have raised before APTEL. So that is something that more clarity is awaited on. Will the CERC Council raise this before the Commission? What will be the stance of the Commission? That is something that more clarity is awaited now. But clearly, the last word is yet to be had. The hearing, we understand, still continuing before the APTEL.
If I can just come in here, the issue, from what you heard the CERC, the IEX, the CERC Council say in the court, you know, the issue is that this order, IEX of course is saying that even without all this insider trading, etc., this is without, this should not be done. The order itself should be set aside. Leave that for a moment. What CERC is saying is their stance on whether they'll withdraw, not withdraw, etc., on the basis of this this entire insider trading thing, and so set this aside and pass a fresh order. Is that kind of what the thinking is, or it's like a revisit of the entire matter itself? That whether this needs to be done. Did you get any sense on that?
Well, at this point, the CERC, at least the lawyer appearing before the APTEL, the language used does not link it one way or the other to either the insider trading charges or whether there is a question of natural justice not having been followed, not enough consultation having been done. No reason being attributed as to why this submission is being made by the CERC Council. But nonetheless, the clarity that is coming from them, from at least the CERC Council, is that there is thinking within, at least within the legal team of CERC, that perhaps there should have been a more transparent consultative process. And with that, the submission being made before APTEL, that perhaps there may be a need required for withdrawing the order itself. But this, of course, is a lawyer appearing for the Commission. This is not what the Commission's final submission is. And of course, this is something that the lawyer will be looking to get clarity on from the Commission on what the road ahead as far as the coupling order is concerned.
Got that, because that is essentially the crux of it, right? I mean, if they even if they withdraw it, are they still do they still want to do coupling, market coupling, and will that result in a fresh order without the shadow of all these other charges which have tainted the current order? That clarity, I think, as Ashmit said, the hearing is still underway. We'll leave you to it, Ashmit. And we'll track this one as we we'll keep coming back to you through the course of the evening to get more on this story. It's an important one. Stock, of course, ending strong, ending almost 10% higher. Went up almost 13% at one stage. 146, 147 is where we were at. Markets, by the way, have picked up a little bit from the lows. 72, 73 rupees down. 26,175 is where we are at. And, I think not very much has changed. Oil and gas, both private, Reliance, the OMCs, this is the pressure area, the pressure point in the market. On the other side of the equation, there's metals, PSU banks, which did pretty well. So that's the picture. Lots of these individual casualties like Trent, 8.5% cut after revenue growth continues to slow down. Q1, Q2, Q3. I mean, it's basically been a bit of a declining trend in terms of revenue growth from that company. Lots of other single stock moves up on your screen. Rima.
Well, Pharma was the big sectoral gainer. That ended up nearly 2%. Divi's Laboratory 4.5%. Ipca, Lupin gaining 3.5%. Aurobindo Pharma, Natco, Sun Pharma also higher by 2% On the way up, Apollo Hospitals add that to the entire healthcare space. ICICI Bank closed with strength. Tata Consumer had a good session. HDFC Life, Bajaj Auto up approximately 2%. Trent, Reliance, Kotak Mahindra Bank, Interglobe Aviation, ITC, HDFC Bank were some of the big drags. Markets ending lower now for the second day in a row, with the Nifty defending the 26,150 mark, the Sensex ending around 85,000. We'll take your leave on closing bell, but don't go anywhere. On the other side is Markets Forward.
The Wall Street ends largely lower. The Nifty ends below that 26,200 mark as heavyweights Reliance and HDFC Bank were the biggest drags. Financials outperformed the Nifty, Bank ending 0.25% higher, led by ICICI Bank and State Bank of India. Pharma and autos bad for the bulls.
Trent shares slide 8% after its third quarter business update disappoints the street. Standalone revenue growth moderates to 16.9%, continuing a downward trend from 19.8% in Q1 and 17.1% in Q2.
IEX ends about 10% higher after the CERC tells the Electricity Appellate Tribunal that it will consult and seek instructions on the withdrawal of the market coupling order. Tribunal says it will close the case on Friday itself if the CERC agrees to withdraw the case. Good evening. You're watching us here on Markets Today. Markets Forward, rather. This is your go-to show where we aim to get you all the key data points to get up for the next trading day while summing up what took place in the markets today as well. I'm Mangala Malu, with me, Vinny Motiwala. Good evening, Vinny. The Nifty continues to consolidate near record highs. Yes, we're about 150 points away from its record high, but it's just about 150 points. Today was the weekly options expiry. Option writers were positioned between 26,150 to 26,200, and that's where the Nifty actually moved, tested both sides of the extremes and ended right in the middle of that zone. We were down today, but perhaps not out. The Nifty Bank did well, barring reliance in HDFC Bank. The large parts of the market did relatively okay.
Did relatively okay over there, large part of the market, Mangalam. Good evening to you as well. And absolutely, banks that managed to hold on to gains. We had IT. Pull up the Nifty IT. That also managed to see some bit of a green, right? So no complaining there. The broader end of the market covered up and, came up from the day's lowest point, closing with mild cuts over there of around 0.1%, 0.2% in the trading session. Advance decline ratio, though, largely today ended in the favor of declines versus advances. But that's a roundup of the market. Like Mangala mentioned, it was more in the range that he's talking about, that it ended at just slightly below 26,200 today is what the Nifty ended at. But, well, here's the lineup for you all of what we have in store for you all on the show today. We'll start with the top movers and shakers of the day with Vivek, and then get you why Trent declined in trade. It was down 8%, so more on that front. And then we'll talk about some of the brokerage calls and arguments that came in around that as well. And market coupling case that was heard by the Appellate Tribunal. We'll get you deep dive into that, as well as last but not the least, which are the key market events to watch out for in tomorrow's trading session. On that note, first up, let's go across for our first segment for today. That is the top movers and shakers of the day. And for that, we have Vivek joining us from the Big All. Vivek.
Well, thank you so much for that. Clearly, the stock of the last half hour or so was IEX, sharp mover. But other stocks too made quite a bit of sharp moves today. The entire metal pack continued to remain in focus. Aluminium especially was the theme today. Hindalco as well as Nalco, sharp movers in the session. From the pharma pack, Divi's, Citi today came out with a note. They reiterated Divi's as their top pharma pick, over 4% higher for Divi's. Apollo Hospitals, one of the top movers as far as the F&O space was concerned, today higher by close to 4%. Ather Industries on very good volumes today, one of the top gainers on the NSE 500 index. And MP Photovoltaic, not a name we discuss too often, recent listing. There was an initiating coverage report from Jefferies today highlighting this particular stock has a long growth runway, and also stating that it actually has a significant amount of underperformance or undervaluation compared to peers. On the other hand, quite a few laggards as well. Can't look beyond Trent, that particular name. Growth rates have started moderating. Markets didn't like that, down over 8% today. OMCs, most of the oil marketing companies were under pressure. HPCL, BPCL, ISL, all of them fell in the session today. Swiggy continued to remain one of the top laggards as far as the F&O space is concerned. When you're looking at Wari Energy as well as Premier Energy, both of these names ever since coming into F&O have seen significant underperformance. Yesterday was the day of underperformance. Today, the fall further accentuated. And lastly, Cummins, one name from the broader end of the markets from the capital goods space, down over 4% today. And within this particular sector, Cummins, a clear underperformer coming into 2026.
All right, take that point. Cummins down about 4%. Vivek, thanks a lot for that. But it was the shares of Trent that came under pressure today after reported business updates for the third quarter. The company saw a decline in growth trend since the last few quarters. If you look at the stock, it was down nearly 9% today. Lost about 400 rupees in share value after having fallen 40% in all of 2025. Now, here's the biggest reason why the stock was underperforming. If you look at it, the third quarter update told you that the revenues grew 17%. Now, in an otherwise market, the consumption sentiment that we have right now, 17% is actually good, but not for Trent, because Trent's 5-year CAGR has been 38%. At the start of the year, the company said that they will, sustain 25% CAGR on the revenue. None of the first 3 quarters of this year have the company crossed 20% in revenue growth, and as a result of which the street was disappointed. We got a sell call coming in from Citi as well. They've reiterated that the target of 43.50 rupees as well. And even if you look at the valuation picture, while Trent has corrected about 40%, 50% from the peak, at peak it was trading at around 140 times price to earnings. Over the last 5 years, it's never been particularly cheap. The average valuation has been around 95 times itself. And more importantly, right now after this correction, while the stock is trading at 70 times, if you equate it with the growth, then the price earnings to growth ratio is actually unfavorable, because while the price has fallen, growth has fallen even more. At peak, the revenue CAGR was 55%, so the PEG ratio was 2.5 times. Now, after the stock having corrected, the revenue growth is just 18%. And while the PE is 72 times, the PEG ratio, the price earnings growth ratio, is 4 times. So while the stock has seen price correction, multiple correction, actually on the PEG ratio front, it's actually become a lot more expensive. So to that extent, again, same-store sales growth picking up, recovery in sales given the government boost to consumption, some of their newer formats like Star, Bazaar, Utsa and Burnt Toast doing well would be key triggers for the company. While the risks would be lower than expected consumer sentiment, competition coming in from the likes of Ustar, Shein, Intune and OWN, and by design, Trent has no presence in online fashion. Will that impede growth or not is also one of the questions that the street will ask.
Right, Mangalam, that's important in terms of updates that we should watch out for from Trent. But let's also bring on board our experts for today. Jay Bala, CMT at cashthechaos.com, as well as Sudeep Bandyopadhyay, Group Chairman at IndiTrade. Jay, as well as Sudeep, good evening. Thank you so much for joining in, as always. Jay, firstly, just let's take a quick look in terms of the market levels that we should be keeping an eye out on now. Today, like Mangalam was also mentioning, it's in the 26,150 to 26,200 range. From here on, what are we keeping an eye out on in terms of the levels for the Nifty as well as the Nifty Bank?
Yeah, the key level going forward, Vinny, is 25,690. As long as the market can hold above that level, the markets are safe. But, as an early warning signal, Reliance clocking fresh record highs and then coming in, and Nifty clocking fresh all-time highs and struggling aren't encouraging signs. So you have to have a very tight stop. The short term could get a little bit negative if markets were to break below 25,690. But the medium term picture remains unchanged. I maintain the 29,000 call I have on the Nifty. So if the market were to break below 25,690, the approach to 29,000 might get delayed by a couple of months. So the short term could get a bit turbulent. But so watch 25,690 as a very important level.
All right, that's about Nifty. But do you have a view on Trent?
Yeah, Trent still hasn't bottomed. I believe a final low below the 2025 low is pending for the stock, somewhere about 3,800 to 3,700. Once that's done, we can look at the turnaround for the stock. But as a general sectoral view, I'm neutral to negative on the FMCG pack. So most of the FMCG names are in a medium-term downtrend. So we'll reassess that when a trend comes below 3,800. The possibility of that stock bottoming around that level is reasonably good. So let's wait and watch for it. But at the moment, do nothing.
Point, Jay. Thank you so much for that. 3,800 is a stronger bottom for Trent than 4,100 or 4,050 where the stock is right now. But the stock of the last hour was definitely IEX, rallied about 12% after the CERC told the Electricity Appellate Tribunal that it will have to consult and seek instructions on the withdrawal of its market coupling order. There you see it. The stock settled about 11% higher. Ashmit joins in to tell us what he's picking up. He was at the court. Ashmit.
Well, bear in mind that one issue that has dominated the conversation in the previous hearing as well as this hearing have been assertions that are being made by the exchanges like the Indian Energy Exchange that this order is tainted. The coupling order is tainted on account of insider trading charges. They've cited SEBI reports to say that, in fact, the very author of the report is somebody who's been mentioned by SEBI to have, in fact, profited from, to have made illegal gains from through insider trading, through the crash that happened in the share prices of these exchanges. Now, that is something that even the APTEL today dwelled on. The APTEL said that this is something that even was brought to their attention, that there was a very theatrical process involved as far as passing of these regulations are concerned, that APTEL did not understand the reason behind the drama, and that if there is foul play, found this is something that the APTEL will look at, will take necessary action on. But in response to all of this, we found that today the CERC councils were also present as a part of this hearing. The CERC council, their lawyer, submitting before APTEL that the CERC wanted this entire process to be fair, wanted this process to be transparent, wanted this process to be consultative. And having said that, clarifying before the APTEL that the lawyer will now go back to the commission to seek clarity from the members whether there can be a withdrawal altogether of the coupling order of 2024. This, in fact, is something that was acknowledged by the exchanges. The lawyers for the exchanges said that if that were to happen, then the entire process then just gets resolved. There is no cause for concern. Even, in fact, APTEL taking note of that and saying that if this clarity comes by Friday, which is later this week, if CERC says they're withdrawing this order, then this entire case will not survive. It'll be over in 5 minutes. So clearly all eyes now on the CERC and their decision on whether they choose to withdraw the coupling order.
Thanks so much for that, Ashmit. But also, Sudeep, what's your view for IEX and everything in terms of we'll wait out for on Friday's decision as well?
Well, definitely, it's a very positive development from an IEX point of view. The coupling order was very, very damaging from their business growth point of view. I know the stock price, it was around 220 levels, sharp correction it had seen. And, leave aside today's, upside, which they got about 10%. But it was hovering at a level where it was definitely worth buying the stock from a long-term perspective. And I think if this, coupling order is kind of withdrawn and a fresh consultative process is initiated for some kind of market coupling going ahead, that will be excellent for the exchange as well as all the market participants. The earlier one was brought in very abruptly and which created havoc with the share prices of the exchanges. So I think it's a good development. Let's wait for the final on this matter, hopefully on Friday.
All right. Let's move on. Let's talk about some of the pharmaceutical stocks that were doing well today. Pharma, among the others, were also one of the indices of the day that held out in the green. And in that, Divi's Labs was up nearly 4.5%. Citi maintained its buy rating, raised the stock's target price by nearly 43%. What are the contents of that report, the reasons behind this upward revision? Ekta joins us for more. Ekta.
Well, yes, Citi has a buy with a target price of around 9,140 rupees on Divi's Labs. They think 2026 can be an inflection year for Divi's. The company has a strong pipeline of catalysts over the next 12 months, notably GLP-1 as well as contrast media. Now, various custom synthesis products are also maturing, which may be commercialized in the near term. The generic segment too is expected to witness a recovery in 2026. The quarterly numbers may experience volatility according to them and present forecasting challenges, but the medium to long-term story remains intact. They believe that Divi's revenue and EBITDA can expand by 3 times to 4 times over FY25 to 30, and FY27, FY28 EPS is 10 and 18% respectively ahead of consensus.
Ekta, thank you so much for that. Jay, some fundamental analysts are calling it the bottom for pharma and maybe good times are ahead, valuations are compelling. Divi's Labs has done well over the last few trading sessions. We've seen some recovery, price recovery in pharmaceuticals. Do you have a view on the sector? And if yes, then, what's the best way to play it? Via which stocks?
Yeah, see, I've been bullish on pharma for quite some time now. The stock, the index broke out in July, but it's been struggling to push higher. Yeah, it is not, I would say from a technical perspective, it's reasonably possible that we are getting a breakout in the pharma sector. And I like Divi's as well as Dr. Reddy's from current levels, even Glenmark for that matter. Glenmark is actually more bullish than Dr. Reddy's and Divi's. Dr. Reddy's being at an early stage of the move, potential move, I would say. So I think Dr. Reddy's might be a better play, and Glenmark, because of its leadership, I would rate these two as a higher ranking candidate to play the pharma sector. The pharma sector has been on a breakout, but it's not broken down. It's not broken below supports. It's been on a sideways path since August of last year. So the moment it closes about 23,500, it's likely to surge really higher.
Okay, that's the view on the pharma pack over there. Thanks so much for that, Jay. But let's talk about Bajaj Auto as well. That's in focus, and why we do have a note that's come in here today as well. The stock actually hit a 52-week after that as well, 52-week high after that, and that was MK has upgraded the stock today, and target price has also been raised. Now it's over 11,000 rupees. For more details on this one, Sud is here for that. Sud, over to you.
So Bajaj Auto, since the time it has announced auto sales for the month of December, has been in the focus, and in the last 3 weeks stock has risen as high as 10 to 11%. Now today MK has come out with a note upgrading the stock to buy from add and has increased target price to 11,100 from earlier target of 9,500 per share. That implies upside of 15 to 17%, and the reason there is an upside in the target price because it has increased the EPS estimates for FY27 and 28, that is in the range of 4 to 9%. It believes that Bajaj Auto offers attractive risk reward at the current levels. But what's the reasoning behind the upgrade? First, domestic market share for Bajaj Auto seems to have bottomed out, and in the last 1 to 2 months it has gained the market share, especially in its focus segment of 125cc plus. Second one, export momentum continues. Recently, for third straight month, export sales have been more than 2 lakh units. Next one is electric three-wheeler has been seeing the improvement in the total sales, and also rupee depreciation against dollar is going to aid to the margin. And lastly, there can be an upside from the KTM that MK believes that will also aid to the total growth.
Sudeep, what are your thoughts for Bajaj Auto? Do you think that's the best play that comes in here, or would you be looking at some of the other names?
I do like Bajaj, and I've been liking Bajaj for quite some time. I have been always telling that export is something which differentiates them, and they've been doing pretty well there. The most important thing which have changed, I think, for them is that domestic market as well. I think there they have started gaining traction as far as their chosen segments are concerned, and that's very interesting. EV, they have become the leaders undoubtedly, and they are number one, followed by TVS and others. So I think all this does augur well for Bajaj Auto. Of course, the currency depreciation adds to the bottom line straight away for Bajaj because of the exports. The KTM change of management and complete revamp of the management by Bajaj should going forward help them. So Bajaj definitely are positive. I was a bit disappointed with the Hero MotoCorp performance, earlier, but I'm hoping that there will be a turnaround. So I am, a little aggressively, I'm hoping that Hero MotoCorp can turn around and betting on Hero MotoCorp going forward.
All right, you're betting on Hero MotoCorp. On that note, what we'll do is we'll thank both Sudeep and Jay for joining in and giving us their views on a whole host of stocks and sectors. Take a short break, come back. On the other side, we'll get you the top corporate voices that joined us on the channel today, the key market events that you need to watch out for Trade Tomorrow.
Welcome back to Markets Forward on CNBC-TV18. Now let's get to the top corporate voices that we had through the day. First up, CSB Bank's MD and CEO spoke to us and says that the bank is not using pricing or loan to value as a lever for growth, adding that average LTV is now below 60%, providing a comfortable cushion. Also, he added that the gold loans are a tactical play, while CSB Bank's strategic focus remains on scaling SME, wholesale and retail segments.
Speaking about banks, we also spoke with the management of J&K Bank. They said that they're likely to deliver around 15% loan growth in FY26, aided by repayments of high-ticket loans in the fourth quarter. They also raised their advances guidance from 12% to 12 to 15%. They added that net interest margins are likely to be around 3.7% and ROA at 1.25%.
Oil India Chairman and Managing Director Ranjit says that it will take some time to kickstart and ramp up production even as the company targets drilling 80 wells in this year. He adds that the production outlook in Venezuela looks promising. Rath says that the company is considering increasing its exposure but remains in a wait-and-watch mode.
Right, that's all the corporate conversation that we had on the channel today. But before we wrap up, let's get you some key market events that you need to keep an eye out on in trade tomorrow. Gaurav Javakar, as always, by the big wall. Gaurav.
Well, as when we look at the key events to watch out for is first, let's talk about US market, and we have got a couple of data points from there. First is that non-farm employment change. That is something that we will be watching out for. Second is that the job opening data. So it is really key thing to watch out because we have seen in the past many events have happened in the US. So let's see how the data comes out. And third is that the crude oil inventory. Now remember, there is a lot of action happening in Venezuela as well. So it is also something that is important to watch out for. From the Japan market, we are going to get composite PMI index. So that is something, let's watch out for that. From European market, we will get the CPI data. And lastly, from the Indian market, let's not forget about the first advance estimate for GDP of FY26. Remember, our polls suggest that 8.3% GDP, nominal GDP growth is something that we can achieve. So let's see if India can actually achieve GDP growth over 8% because that will be one of the fastest growing economy again if it reaches over 8%. From the corporate action side, let's not forget about the Sunrise Pharma because board is going to consider and approve fundraising, and let's also not forget that the earnings season have started. So we have got Premier Energy and Infrastructure who will come up with the company earnings for third quarter. So let's see how the numbers come. Lastly, from the global point of view and the macro events which are happening in the geopolitical world, President Trump is going to address the press. So that is something, let's see how he is going to talk about the events which have happened so far. And lastly, House Democrats are likely to convene a special hearing on a 5-year anniversary on the attack on US Capitol. So let's see if at all anything material comes out from these events in the days ahead.
Okay, Gaurav, thank you so much for that. But with that, it's a wrap on this edition of Markets Forward on CNBC TV18. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Indian equity markets end lower for the second day after a choppy session as geopolitical tensions keep traders on the edge. The Nifty slips below 26,200. Heavyweights like Reliance and Trent drag the markets lower. The Nifty Bank, though, ends in the green. Days after his dramatic extraction in a pre-dawn raid, deposed Venezuelan President Nicolas Maduro pleads not guilty to drug and weapon charges in a U.S. court, claims he was illegally captured and is a prisoner of war. Maduro's deputy, Delcy Rodriguez, is sworn in as Venezuela's acting president. The Venezuelan government claims it is police who fired at drones that flew over Caracas without permission. Russia, China and a host of Latin American countries denounce Maduro's capture at the United Nations Security Council, call it a serious affront to the sovereignty of Venezuela. U.S. defends its action, says Maduro's capture is a law enforcement operation and not an act of war. Reliance Industries refutes a Bloomberg report which suggests that shipments of Russian oil were approaching the Jamnagar refinery. Says it has not received any cargo of Russian oil at its refinery in the past 3 weeks. Adds it is also not expecting any Russian crude oil deliveries in January. India's central electricity regulator, under a scanner for the controversial order on market coupling for power exchanges, may consider withdrawal of the order after accusations of insider trading by CERC members come to light. Aptel to hear the matter again on the 9th of January. President Trump doubles down on his threat to annex Greenland, says the U.S. needs Denmark's autonomous territory from a security standpoint. Greenland calls his ambitions a fantasy, and Denmark says a move like this would be the end of NATO. European allies affirm that Greenland's future must be decided by its people. RBI issues amended directions on lending to related parties, aligning norms between banks and NBFCs. The rules are effective the 1st of April and widen the definition of related parties, strengthen disclosure and place greater accountability on boards. Equity investments remain outside the framework, but debt investments invite scrutiny. All of that and more coming up for you in just a bit, but let's start with the day's market action. The Lal Street ending lower for the second day in a row, with the Nifty slipping below 26,200. Heavyweights like Reliance Industries, ITC and Trent were the big drags in our market today. Financials, though, outperformed the blue chips, with the Nifty Bank ending mildly higher. Flat close off its intraday highs, a very choppy session. That's the Nifty for you. The Sensex down about 400 points. The Nifty Bank just about closing in positive territory, and a flat close there for the mid-caps as well. Meanwhile, oil prices edging lower as markets wait the possibility of higher Venezuelan crude output. Traders speculate that President Maduro's removal from power in Venezuela could potentially lead to the U.S. easing its sanctions on Venezuelan oil. SBI researchers forecast that crude oil prices could fall to as low as $50 per barrel by June as fresh supplies hit the market, especially given softer global demand. And in the bullion market, gold prices remain steady after touching 1-week highs. This after U.S. strikes in Venezuela added to the yellow metal safe haven appeal. Expectations of further rate cuts by the U.S. Federal Reserve also supporting prices. Silver also benefiting from the safe haven demand. That metal up about 3%. There has been some action in base metals as well. Copper prices soaring to record highs of $13,000 a metric ton as a strike at a mine in Chile increased fears of a supply shortage. So that's the metal action. Now, a lot of the action in the global financial and commodities market stems from the action around Venezuela. So that continues to be the big global story. Now, deposed Venezuelan President Nicolas Maduro has pled not guilty to 4 charges of drug trafficking and terrorism when he was produced before a court in New York. This came less than 48 hours after he was extracted from Caracas. Maduro declared that he is still the president of Venezuela and that he was captured illegally and that he considers himself a prisoner of war. Meanwhile, Venezuela's Vice President and Oil Minister Delcy Rodriguez was formally sworn in as the country's interim president. Rodriguez said she was pained by what she called the kidnapping of Maduro and his wife.
Protesters gathered outside a New York federal court on Monday, where inside, toppled Venezuelan President Nicolas Maduro stood before a U.S. judge to face charges that could put him behind bars for life. Through an interpreter, Maduro said, "I am innocent. I am not guilty. I am a decent man. I am still president of my country," before being cut off. Maduro faces 4 U.S. federal criminal counts that include narco-terrorism conspiracy, cocaine importation conspiracy, and possession of machine guns and destructive devices. His next court date is set for March 17th. His wife, Celia Flores, faces the same charges except for narco-terrorism. She also pleaded not guilty. Prosecutors alleged that as president, Maduro directed cocaine trafficking routes, used the military to protect shipments, sheltered violent trafficking groups, and used presidential facilities to move drugs. He was first indicted in 2020 as part of a long-running narcotics trafficking case against Venezuelan officials and Colombian guerrillas. The 63-year-old has long denied the allegations, saying they're a mask to take Venezuela's rich oil reserves, which U.S. President Donald Trump has made no secret of wanting.
And several countries have voiced their objection to U.S. military operations in Venezuela. At an emergency session of the United Nations Security Council, nations called for the immediate release of Venezuela's president and his wife from U.S. custody. Russia's representative to the UN called the intervention, and I quote, a return to lawlessness, urging the 15-member council to reject the methods of U.S. military foreign policy, saying there is no justification for the move. China's envoy echoed the charge, saying the U.S. had wantonly trampled upon Venezuela's sovereignty and violated the principle of sovereign equality. China demanded that the U.S. change its course, cease its bullying and coercive practices, and return to the path of political solutions through dialogue and negotiations. Meanwhile, Cuba also condemning the U.S. action against Venezuela, calling the military attack an imperialist and fascist aggression with objectives of domination. However, the U.S. envoy Mike Waltz defended the operation in Venezuela, justifying it as a surgical law enforcement operation, calling out the 15-member council for criticizing the targeting of Maduro, widely considered a dictator in the Western Hemisphere.
There is no war against Venezuela or its people. We are not occupying a country. This was a law enforcement operation in furtherance of lawful indictments that have existed for decades. The United States arrested a narco trafficker who is now going to stand trial in the United States in accordance with the rule of law for the crimes he's committed against our people.
There is no and can be no justification for the crimes cynically perpetrated by the United States in Caracas. We firmly condemn the U.S. act of armed aggression against Venezuela in breach of all international legal norms. In connection with the confirmed reports about the presence of the abducted president of Venezuela, Nicolas Maduro, and his spouse,
allowing such acts to go without an effective answer would amount to normalizing the replacement of law by might, while eroding the very foundations of the collective security system. Today, it is not only Venezuela's sovereignty that is at stake, the credibility of international law, the authority of this organization, and the validity of the principle that no state can set itself up as a judge, party, and executor of the world order are also at stake. Brazil does not believe that the solution to the situation in Venezuela lies in the creation of protectorates in the country, but rather in solutions that respect the self-determination of the Venezuelan people within the framework of its constitution. The events of January 3rd transcend the regional sphere. The attack on the sovereignty of any country, regardless of the direction of its government, affects the entire international community. This and other cases of armed intervention against the sovereignty of a country, its territorial integrity, or its institutions must be vehemently condemned.
We call on the U.S. to ensure the personal safety of President Maduro and his wife and to release them at once. We support the Council in fulfilling its primary responsibility to maintain international peace and security, and we support all efforts by the UN Secretary General, regional countries, and organizations that contribute to promoting dialogue and de-escalating the situation.
Well, the action there in the UN Security Council. Now, the big story back home. India's central electricity regulator is under the scanner for its controversial order on market coupling for power exchanges. The CERC said that it may consider withdrawal of the order, this on the back of accusations of insider trading by CERC members that have come to light by the market regulator, SEBI. Shares of IEX closed with gains of 11%, in fact, were higher through the course of the day, coming off a little bit at close, witnessing the biggest single-day gain since October of 2021. Ashmit is standing by now to explain what all of this means. Ashmit, take us through what transpired at Aptel, what the IEX Council had to say, and where we now head from here.
Well, bear in mind that one issue that has dominated the conversation in the previous hearing as well as this hearing have been assertions that are being made by the exchanges like the Indian Energy Exchange that this order is tainted, the coupling order is tainted on account of insider trading charges. They've cited SEBI reports to say that in fact the very author of the report is somebody who's been mentioned by SEBI to have in fact profited from, to have made illegal gains from through insider trading, through the crash that happened in the share prices of these exchanges. Now that is something that even the Aptel today dwelled on. The Aptel said that this is something that even was brought to their attention, that there was a very theatrical process involved as far as passing of these regulations are concerned, that Aptel did not understand the reason behind the drama, and that if there is a foul play found, this is something that the Aptel will look at, will take necessary action on. But in response to all of this, we found that today the CERC councils were also present as a part of this hearing. The CERC council, their lawyer, submitting before Aptel that the CERC wanted this entire process to be fair, wanted this process to be transparent, wanted this process to be consultative, and having said that, clarifying before the Aptel that the lawyer will now go back to the commission to seek clarity from the members whether there can be a withdrawal altogether of the coupling order of 2024. This, in fact, is something that was acknowledged by the exchanges. The lawyers for the exchanges said that if that were to happen, then the entire process then just gets resolved. There is no cause for concern. Even, in fact, Aptel taking note of that and saying that if this clarity comes by Friday, which is later this week, if CERC says they're withdrawing this order, then this entire case will not survive. It'll be over in 5 minutes. So clearly all eyes now on the CERC and their decision on whether they choose to withdraw the coupling order.
All right, January 9th is when this matter will be taken up again. Ashmit, many thanks for joining us. Reliance Industries has denied a Bloomberg report which claimed that 3 vessels laden with Russian oil were heading to Jamnagar's refinery. Reliance called the report blatantly untrue. The company stated it has not received any cargo of Russian oil at its refinery in the past 3 weeks and is not expecting any Russian crude oil deliveries in January either. Now, India's services output has dropped to an 11-month low in December. This was due to a slow pickup in new businesses and hiring activity. HSBC's India Services PMI, compiled by S&P Global, fell to 58 in December. Remember, a reading above 50 indicates expansion, while a level below 50 signals contraction. The Reserve Bank of India has issued amendments to banks, NBFCs and other financial institutions on lending to related parties. This in a bid to tighten governance and transparency around these transactions. Under the amended directions, equity investments in related parties are excluded from the scope of these regulations. However, investments in debt instruments remain covered. The RBI has also exempt certain NBFCs from these guidelines. These amendments will come into effect from the 1st of April. Shares of Tata Motors passenger vehicles declined nearly 2% in trade. This after its luxury arm Jaguar Land Rover reported a sharp decline in wholesale and retail volumes for the third quarter of FY26. This was largely due to the impact of the cyber attack and the slowdown in production. Thereafter, JLR's wholesale numbers stood at 59,200 units, marking a steep annual decline of more than 43%. Retail sales came in at a reported 79,600 units, down 25% on an annual basis. India's competition watchdog, the CCI, has probed steel giants, including Tata Steel and JSW Steel, for breaching the antitrust law. As per Reuters report, CCI's investigation has found companies were colluding to fix steel prices. The report further states that CCI held 56 executives liable for price collusion between 2015 and 2023. CNBC-TV18 has tried to get a comment from the Competition Commission of India. We're still awaiting one. Time for us to head into a break, but up next, US President Trump doubles down on his threat to annex Greenland. That and more when we return. President Trump has doubled down on his territorial ambitions for Greenland, a Danish autonomous territory. Speaking at a conference, Trump said Washington needs Greenland for national security, cited its strategic Arctic location. Greenland's Prime Minister responded sharply, dismissing Trump's remarks as fantasy. Denmark's Prime Minister warned that a U.S. attack on a NATO ally like Denmark would mark the end of the alliance. Denmark's European allies affirmed that Greenland's future must be decided by its people. UK Prime Minister Keir Starmer said only Denmark and Greenland can determine the island's path. Trump's top aide Stephen Miller said that Greenland rightfully belonged to the U.S. and claimed that nobody would fight the U.S. militarily over the future of Greenland.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place. We need Greenland from the standpoint of national security. Just say this. We need Greenland from the standpoint of national security. And the European Union needs us to have it, and they know that.
If the United States chooses to attack another NATO country militarily, then everything stops. That is including our NATO and thus the security that has been provided since the end of the Second World War. I believe in democracy and I believe in the international rules. Of course, I also believe that you do not change borders by force either one way or another. It is not only the position of Denmark and the Danish kingdom, fortunately, of Europe too. So I hope that the people will also take note of the once again significant European support that we are receiving.
Now, Israeli forces have launched intense helicopter attacks on southern Gaza, killing at least 2 Palestinian officials have said that forces bombed a tent housing displaced Palestinians, killing a 5-year-old girl and her uncle. More than 400 Palestinians have died since the U.S. brokered truce came into effect last October. Ukraine has said that Russia carried out 5 missile strikes on its second biggest city of Kharkiv. Russian President Putin has also been accused of deliberately targeting a U.S. business in Ukraine. This comes as President Trump's senior negotiators Steve Witkoff and Jared Kushner are set to meet Ukrainian President Zelensky and Kiev's European allies in Paris today to discuss the specifics of a peace deal. The United States Health Department has reduced the number of recommended vaccines for children. Ekta now joins us with the contours of the order. Ekta, take us through the vaccines that have been struck off the mandatory list.
In what is being called an unprecedented move, the US has reduced the number of vaccinations it recommends for children to 11 from 17 earlier. Now, under the new policy, vaccines for diseases such as measles, polio, HPV and chickenpox remain recommended for all children. However, vaccines for flu, rotavirus, COVID-19 and some hepatitis shots have been shifted to a shared clinical decision-making model between families and their healthcare providers or their doctors, indicating that those vaccines are now voluntary. The US has also reduced the HPV vaccine schedule to a single dose from the previously routine 2 to 3 doses. This move has sparked criticism on the lack of transparency and involvement in this decision. Critics also warn that the US has a much larger and more diverse population than countries such as Denmark, whose schedule was cited as a model for these changes, and that loosening universal recommendations could lead to lower vaccination rates and increase in preventable diseases such as flu, hepatitis and rotavirus. Now, going forward, experts estimate that the new schedule could possibly reduce the vaccine offtake by 30 to 40% over a period of time, a shift that will be key to monitor in the years ahead for its impact on diseases.
Ekta, many thanks. Senior Congress leader Sonia Gandhi admitted to Sir Gangaram Hospital last night after experiencing respiratory discomfort. The hospital said her bronchial asthma had been mildly aggravated due to the combined effects of cold weather and pollution. She was admitted for further observation and treatment as a precautionary measure and is currently stable. TMC MP Derek O'Brien has moved the Supreme Court challenging the special intensive revision of electoral rolls in West Bengal. The plea asked the apex court to stay the finalization of electoral rolls on the 14th of February. The petition has alleged that 58 lakh voters were removed from the draft rolls without notice. It also claims that the removals were arbitrary and violated procedures. Former Union Minister and Congress leader Suresh Kalmadi passed away at the age of 81 after a prolonged illness. He served as Union Minister of State for Railways and was the former president of the Indian Olympic Association. Leaders across parties have expressed their condolence. Mahindra has launched the new XUV XO starting from 13.6 lakh rupees. Bookings for the XUV 700 successor will open on the 14th of January with deliveries beginning the same day for higher variants. Shivani brings us the latest on Mahindra's new offering.
Well, this is the all-new XUV 7XO from Mahindra & Mahindra. I am here in Jaisalmer where Mahindra has just unveiled this premium SUV, the 7XO, which is the successor of the XUV 700. Now, starting at 13.66 lakh rupees, the XUV 7XO builds on the success of the XUV 700 and brings in several segment-first features, including the world's first Da Vinci suspension system, India's first ICE software-defined vehicle, and a coast-to-coast triple-screen layout. Let me just show you. This is the triple-screen layout here. As you can see, and this, by the way, is across variants. The model also comes equipped with level 2 ADAS with dynamic visualization, underlying Mahindra's intent to mainstream high-end technology. From a business strategy perspective, Mahindra says it will calibrate production based on the demand visibility, but expectations are that the interest in the XUV 7XO could be as strong as the 700 saw at the launch.
Well, that's the latest there from Mahindra. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome. You're watching Commodity Champions and I'm Manisha Gupta. Well, 2025 was a great year for the lab-grown diamond segment. 2026 has begun on a positive note. The Bureau of Indian Standards has notified new standards that align with global practices, laying down comprehensive technology and disclosure requirements for natural and lab-grown diamonds. Under the new standard, India is officially adopting the term laboratory-grown diamond and laboratory-created diamond while disallowing misleading or outdated descriptions such as fake or artificial. The move is expected to boost consumer confidence, enhance credibility and ensure transparency at the point of sale. The standard also clarifies that the term diamond refers only to natural diamonds, while laboratory-grown diamonds must be clearly disclosed. Let's look at what the lab-grown diamonds compared with the natural diamonds in India. 1 carat of natural diamond is priced anywhere between 70,000 to 5 lakh rupees, while a 1 carat lab-grown diamond typically ranges from 20 to 80,000 rupees. This significant price advantage continues to drive wider adoption, especially among younger buyers. The lab-grown market in India stood at $450 million in 23-24 and is expected to grow to $1.2 billion by the time it's 2030. Highlight the long-term potential, and of course, global lab-grown diamonds accounted for just about 5% of the markets in 2018, but the figure climbed to 20% in 2024. What is driving this change and how will this segment fare in 2026? For that conversation, we are now joined by Pooja Seth. She is founder and MD Limelight Diamonds, and Nirav Bansali is CEO Prism Jewelry. Thank you so much for joining in and a very happy 2026 to both of you. Nirav, hi, let me start with you first. And this is a segment that has continued to grow and grow quite strongly at that. So much so that almost everybody started talking about lab-grown diamonds in 2025. What is your sense? What are the kind of numbers that you would want to share with the viewers?
So, Manisha, Happy New Year to you too, and thank you for having me over here. Like you mentioned earlier, lab-grown diamond is really making waves all over the world, and in India also it has caught on really well. A lot of new players are jumping into it, and not only new players, but incumbent players like Tanishq has also just opened their new brand store Beyond. So I think there's a great opportunity in this space for consumers as well as the manufacturers and the industry as such.
If you look at the numbers, Nirav, for the longest time we've been saying on how when it comes to natural diamonds, it's just about 11% of a penetration. When it comes to lab-grown diamonds, what is the kind of penetration that India has seen and what is the number that the world is working with?
So we have just started in India in this space. It's a very new space, and you can say just in the last 1.5 years, we are seeing a lot of traction in this space. But if we go by the numbers that we have been seeing in America, in terms of like natural diamonds and lab-grown diamonds are almost at par in America. And whatever happens in America, India, I think, follows it in a few years' time. So we can expect a lot of growth in terms of volume. Value, the prices being lower, I think it will still be a long way away where it can catch up in value. But in volumes, definitely we can see it reaching almost like 50% of the volume that we are doing currently in India in the next 5 years' time. In terms of number of stores, if you ask me, just a guesstimate that there could be anywhere between 500 to 1,000 new stores coming up in India in next 5 years' time.
500 to 1,000 new lab-grown diamond stores in India in next 5 years. Pooja, hi. I do understand when I look at your numbers as well. You kind of doubled your store numbers in a matter of a year or two. How has 2025 been for you? How many stores old are you? And what are the plans going forward?
Firstly, hi Manisha, wish you and everyone a very happy new year. And yes, I think 2025 has been rocking and shining for the lab-grown diamond sector and for us here at Limelight. We were at 29 stores at the end of FY24 and we are currently at 55 plus stores operational. I think the consumer sentiment in India has rapidly changed and the acceptance for lab-grown diamonds has significantly gone up and we are seeing the awareness and the acceptance not just in tier 1 or metro cities but also tier 2 and tier 3 cities catch up. There's a huge amount of diamond aspiration that still remains unfulfilled in India, and I think lab-grown diamond sector is going to kill it and nail it in times to come.
All right. Nirav, what would you say works for the lab-grown as an industry? Is it affordability or is it sustainability?
I think it's a mix of both. See, most of the women aspire a diamond, but it's an expensive thing. Not everybody can afford it. But in India, with this lab-grown space, I think that affordability can be extended to a very large audience. Like Pooja said, at tier 2, tier 3, they really aspire a diamond, and this category will fulfill those needs over there. And even the sustainability part is catching on very well with the younger audience. Today, they are all wanting to know what is the source of the supply, from where it's coming. So sustainability as well as affordability, they both are playing in favor of lab-grown diamond space. Having said that, in India, the natural diamond space is also doing extremely well. Jewelry per se is doing well. So I think there is a very, very good opportunity for both the lab-grown and natural to grow. But in terms of percentage growth, lab-grown is really going to kill it and nail it, like Pooja said.
All right. Love the usage of coin words there. Pooja, you know, when we look at the overall markets there, well, yes, we have seen a lot of growth coming into the markets therein. You know, when it comes to designs or caratages or price point, how are you looking at now 2026, and what is your, mantra going to be going forward? As Nirav said earlier itself, that now you have Tanishq inside as well. Earlier we were talking about smaller companies, corporates perhaps getting into it as well. Absolutely, clearly now nobody wants to lose this market share.
Yeah, so I think, just seeing our experience over the last few years, what we've realized is that consumers are looking at lab-grown diamonds, as an alternative, especially for, wedding-related jewelry, bridal jewelry, occasion wear. Engagement rings is, of course, a very large section for us. And the basic mantra for every consumer is that we don't want jewelry that sits in the lockers. We want to wear jewelry. It is for utility and the ability to make differentiated designs, to change differentiated designs, to transact on lab-grown diamonds is becoming a far easier option for consumers, and that's what we are seeing as a big pickup. I mean, we are seeing consumers say that I want to wear jewelry on someone's 75th birthday party, I want to wear it on someone's 25th anniversary, I want for Karwa Chauth, I want for Diwali parties, I want new jewelry every single time I'm going out for any occasion. And to be able to do that with the natural diamond segment is, of course, extremely, hefty on the pockets, whereas lab-grown diamond enables you to, get amazing necklace sets within 4 to 5 lakhs, which becomes extremely, doable and exchangeable over time.
Oh, absolutely does that. Nirav, how would you look at it's the certification part of it as well? You have natural diamonds, you have lab-grown diamonds, you have fakes as well, which do not cost anything at all. And then comes in the certification part of it. How aware and how would you say that the markets have evolved in sense of understanding that?
So what we have noticed is that the market is really very much aware of this category and the differentiation. Earlier, we didn't know whether India is ready for it. But today, after our experience in this space in the last 1.5 to 2 years, we are seeing consumers who are very much aware of it. And they really want to buy a lot of jewelry, a lot of diamonds, and they don't mind buying these lab-grown diamonds. Before 2 years, it was a taboo word. People were not sure, fake, this, that. But now with clear distinction coming in, even the BIS standards coming in, even established players like Tanishq coming in, this category is now developing into another parallel category and a way of a different type of jewelry in this space, which is also available to consumers, and consumers are willing to buy it. There is no stopping or there is no hesitation in this space. What used to be 2 years back, I would still say it's in its infancy. It has many years to go, but the pickup and the growth in this space is very, very fast. So I think in the next 2 to 3 years, we'll see a lot more people very comfortably buying this jewelry. And also with the price affordability, the design that we can create in this space is much more easier because we can really experiment with different designs. And there are a lot of use cases for this category. Like you want to go for destination wedding and you want to take very expensive jewelry. You can take this jewelry. Or somebody is having 4, 5, 6 solitaires and now they want to experiment with a different shape, a different size, maybe a pink diamond that is available over here. Or maybe they want to buy engagement ring and they couldn't afford a 2-carat engagement ring earlier, but now they can, instead of that, they can give a 4-carat engagement ring.
Oh,
so there are a lot of use cases in this thing. So market is evolving, customers are finding their space. There's going to be a lot of ifs, buts, and which category, which color, which caratage, which material. But all in all, said and done, it is a different category that is worth of exploration by the consumers, and there is a big opportunity for businesses also in this space as much as in the natural. This category also is a very important category.
Oh, yes. Earlier, it was about once in a lifetime or important milestone is when people bought jewelry or diamonds. But now it's a lot more occasions, and it's basically buying it for self-purchase, which really seems to be picking up right now. There's one thing that I want to ask you, both of you actually, and Pooja, you go first. With so many more players coming into this market with more designs and more push and more campaigns and marketing, how would you look at 2026? What are your plans for this year now?
Sure. So I think we have had a great start to the year. We have recently announced, our fundraise. We have also announced a strategic vertical integration that, again, differentiates Limelight from the rest of the competitors. We are now going to be an entire rocks to retail story. So right from growing the diamonds to sort of, studying it in jewelry and retailing it from Limelight stores is going to be the next phase of Limelight in this year and going forward. And we are aiming at 100 stores in 2026, and we have a clear target of 200 stores by 2027. I think the fact that incumbents have also entered the market, perhaps it was inevitable for them to enter, but great timing. It has already sort of legitimized the category in many ways. It's given a lot more confidence to the sector, to consumers, and I think it's only going to sort of shape up bigger and brighter from here, and Limelight is poised to sort of take the biggest advantage of it, given our wide scale presence already in India across 45 cities.
Neera, what is your sense? Because there are various reports that do suggest that the lab-grown market in 2018 was 5%. 2024, it's at 20%, and it's growing at a much larger space right now. How are you looking at this growth continuing one, and what are your plans now for 2026?
So definitely we are also bullish on this space, and we are looking at this space, and it's going to grow, continue to grow the way it has been growing, and even maybe faster than that. Coming to our business, we are into both the spaces. We are into natural as well as into lab grown, and we are very, very bullish on both the spaces. We are expanding in our B2B business, the Prism Enterprises business that we are supplying to all these Indian retail space, because those Indian retailers in the natural space are also expanding very, very rapidly, and there is a great traction in that space. So we are also putting up new manufacturing units and looking to expand our natural business. And coming to our lab-grown retail space, Firefly, there also we are very aggressively expanding, though we are not as big as Pooja's plans, but we are looking to end this current year at 50 stores and next year 100.
Neera, you deal into both. How difficult was it to come from naturals and foray into lab-grown?
It became very easy for me because I am still a naturals person. So I look after the natural vertical. And while my son, Adit and Ayush, they came fresh into this business, and they were very convinced on this product. And they think that with their generation and with the ethics part and the affordability, they really don't believe that natural is going to do as well as the lab-grown space. And they are extremely bullish on that space. So both of them are very aggressively looking at that space. So for us, it is a very clear distinction. We just have lunches together where we just discuss what each of us do. They are growing on their path. So whatever numbers I have given are the numbers that they are really putting into it. But what I am seeing is that both the businesses have great potential, but lab-grown is really going to be the story for the future for the next few years in India.
Pooja, how would you look at Mr. Bansali as a competition?
No, absolutely. I think competition today is the best thing the category can have. It just enables the market to grow and become bigger. And, of course, we've all seen Firefly, catch up in the last few months. And I think Titan coming in with Beyond is now going to be the biggest game changer for us. And it's very, very exciting to see so many brands come up in the category. It enables a huge amount of customer awareness and education, which is still required. Like Neera sir also said that we're still at a very nascent stage in India in terms of the market understanding and penetration. And the more people talk about lab-grown diamonds, the more people educate about lab-grown diamonds, the bigger the market it'll be. And we'll all have a huge pie to share from.
Oh, absolutely. If you look at the numbers, the last year the number was $25 billion. This year is rather 2024 was $25 billion. 25 was $30 billion with an expectation that 2032 can take the lab-grown market to $75 to $100 billion as well. So clearly strong growth there and a lot of people coming in as well. So this is all the best to Firefly and Limelight for 2026, hoping that you will achieve all those numbers that you've been talking about. Thank you so much for joining us on the show. And on that note, it's time for a break, but don't go anywhere. On the other side, a special conversation with Bhavik Mota of Maersk is lined up. Stay tuned. Welcome back. You're with us at Commodity Champions, and joining us now on the show is Bhavik Mota. He's Director Head of Ocean Markets, South Asia at Maersk. Bhavik, hi, thank you so much for joining in. It has been an interesting 2025, and the way 2026 has started, it just promises to be more volatile. But take a step back and tell us about 2025 on what really has been the global scenario when it comes to exports and imports as a performance.
Thank you. First of all, thanks for having me here, Manisha. I think India's containerized trade has shown quite a dynamism and resilience in 2025, with our data revealing significant growth both on export and import, underscoring India's position in the global trade. If you look at the numbers, primarily from an export perspective, almost a 13% growth on our numbers, reflecting our strengthening manufacturing capabilities and export competitiveness. It also kind of showcases our relationship, which are quite robust now with the Western countries. So if you look at the growth into the US, it's around almost 17%. If you look at growth into Europe, it's almost 20%, which is quite significant, which are one of our key markets. Of course, part of this growth is, the way the market has grown from this part of the world. Part of this is also our inducement of capacity or recalibration of capacity. And if you remember when we met last time, we did launch our Gemini service, the East-West network, which was revamped with the intention of providing world-class schedule reliability. As of date, we are hovering at around 90%, and that was the ambition compared to the industry average, which is at mid-60. So all of this has really boosted growth into this market. Also, if you look at the sector-specific growth, right, we have seen almost double-digit growth into retail and apparel industry. Pharma has been a very, very significant growth trajectory that we have seen. And apart from that, the appliance and commodities, which have also grown quite. And all of this growth indicates that, the India's growth export basket is diversified, and we are not dependent on a single category. And this really creates resilience against the global shocks.
Well, that's about exports. But what would you say about imports as well? And would you say that this has been an equally strong performance when it comes to imports into the country?
In fact, import has done relatively well compared to exports. On import, we have seen almost 20% growth year on year. China being one of the evolving growth partners, almost 15% growth. US also double-digit 20% growth coming in. Of course, from the Western economies, what we are seeing is a lot of recyclables coming in, the metal scrap waste paper, which is very much required for the raw materials into the import. And it signifies the importance of growing manufacturing capabilities and a strong domestic consumption market that we have in this part of the world. But we are seeing a quite robust import portfolio coming in this part of the world.
Bhavik, let's talk about the US markets then. And 2025 was difficult in sense of tariffs there. And when you say that the US and India numbers still show on the positive side, what exactly are we looking at? And if there is a hit, then on what segments?
So if you look at US, right, it's one of the biggest trading partner for us. If you look at the numbers, almost 1/5 of our exports are to Europe. So it's a very, very important export market. If you look at the year in totality, we have seen great growth into retail and lifestyle, which is the biggest segment, followed by pharma, and a little bit of metal, mining, and machinery. One sector which has taken a bit of beating, so to say, is the fisheries segment. It's the shellfish, which gets exported out of US. If you talk to most of the customers, collectively they say it's around a 25% impact. The large players are still able to get contracts with the large retailers in US, but the smaller players have really struggled to find their foot into the US market. But what they're doing smartly is, of course, finding alternative markets. And what we have seen is significant growth of seafood into Far East, especially into China. So while not 100% has been recovered, they have to find their way out still, but at least we are enabling our customers to find alternative markets and then helping them to basically evolve in the landscape, which is very, very dynamic and volatile at this point.
Really. Bhavika, if you look at 2025, it also is a year that India is looking at a lot of FTAs and BTAs. So as we see, as the trend has been, and I've been talking to you about this earlier as well, every year shows us that India has found a new destination, a new partner in sense of better, bigger numbers as compared to previous year. What would you say 2025 through us in sense of a new partner, better numbers?
Yeah, so if you look at purely the emerging partners, right, apart from the usual Europe and US, where we are seeing a growing trend is East Africa for a change, a massive impetus of commodities, be it rice, sugar, soya, combination of our growing relationship with India and Africa as a continent. Also, the importance of food security, where we are taking an active part. So that is one emerging trend, which was not there in the prior years. We're also seeing, while auto has been very subdued, and auto is one story which in the first 6 months was super solid, come tariff in the second half, subdued demand in Europe, given inflation and all of that. Overall trajectory has been quite low, so it's not the top of our market. But if you look at the two-wheeler segment into Latin America and Africa, double-digit growth. So that's an emerging trend that we are seeing. And what I just mentioned before, right, in terms of China, now that people are finding alternative, the seafood exports that we are seeing into China, into Japan and all, it's quite significant. So these are 2 or 3 very specific trends beyond the usual export trends that we have seen over the past many years.
Bhavik, I remember the last time we had a conversation, it was also about on how Maersk looks at India as a very important market, the kind of investments, partnerships that you're doing in here. How would you say 2025 panned in that regard? And how are you looking at this market from here on, near term, longer term as well?
So if you look at, as I said, India containerized trade performance, right? It's basically a story of resilience, diversification, and strategic adaptation. So for Maersk, in specific, India is a very, very critical market, a growing market. The number speaks for itself, right? And despite global uncertainties and the policy headwinds around tariffs and what have you, Indian businesses have shown the ability to able to grow, diversify the portfolio, find the alternative markets. We've also seen growing, emerging new trade partners coming in a way, and then of course continuing strengthening relationship with the major economies. So as Maersk, when we move into 2026, we have quite hopeful and positive about the India growth trajectory, particularly if Red Sea normalizes, tariff kind of stabilizes, so to say, and Maersk is of course committed to support all the businesses to be able to grow and create a massive footprint in the global market.
Bhavik, thank you so much for joining in and making sense of what really is Maersk doing, and of course trends going forward when it comes to shipping in and around India. Appreciate your time. Thank you.
Thank you, Manisha.
Hello and welcome to News Center. I'm Parikshit Luthra. The extraction of Venezuelan leader Nicolas Maduro in an audacious pre-dawn raid over the weekend has sparked a global diplomatic row. Washington maintains Maduro's capture was a law enforcement operation and not an act of war. The deposed leader, who appeared before a U.S. court, pleaded not guilty to narcotics and terror charges. He maintained he was a prisoner of war. Russia, China and a host of Latin American countries denounced Maduro's capture at the United Nations Security Council. They called it a serious affront to the sovereignty of Venezuela. Even France, a permanent member and a longtime ally of the United States, appeared more circumspect. It said that United States actions were counter to the principle of a peaceful resolution of disputes. We will be discussing the ushering of the Monroe Doctrine that draws inspiration from the Monroe Doctrine. Former U.S. President James Monroe in 1823 had asserted that Western Hemisphere was the U.S.'s sphere of influence by warning European powers against further colonialization or interference. We will come to that in just a bit. But first, here's a snapshot of the fireworks from the emergency meeting of the UN Security Council.
There is no war against Venezuela or its people. We are not occupying a country. This was a law enforcement operation in furtherance of lawful indictments that have existed for decades. The United States arrested a narco-trafficker who is now going to stand trial in the United States in accordance with the rule of law for the crimes he's committed against our people.
Allowing such acts to go without an effective answer would amount to normalizing the replacement of law by might, while eroding the very foundations of the collective security system. Today, it is not only Venezuela's sovereignty that is at stake, the credibility of international law, the authority of this organization, and the validity of the principle that no state can set itself up as a judge, party, and executor of the world order are also at stake.
And joining us now to take the discussion forward are former Foreign Secretary Kawal Sibal and Senior Fellow with ORF's Strategic Studies Program, Rachel Rizzo. Thank you very much, ladies and gentlemen, for joining us. Ambassador Sibal, if I can come to you first. There has been condemnation for U.S. actions in Venezuela. How far do you think the United States will go now?
Well, Trump has said that he's going to run Venezuela. He has said that in case the current president does not do what the United States wants, the U.S. can take further action. He has clearly said that the oil reserves of the biggest in the world, of Venezuela, belong to the U.S. The Secretary of State, Rubio, has questioned why Venezuela should sell oil to Iran or China or Russia, who are U.S. adversaries. The U.S. has said that the Western Hemisphere belongs to them because they live in it. So it's quite clear that U.S. could even go further in terms of taking action against other regimes. Trump has directly threatened Colombia with action, and also has said that the days of Cuba are numbered, and he's reiterating his claim to Greenland. Right. So there is no check and balance either within the U.S. system, which is based on checks and balances, or internationally in the United Nations or elsewhere. And the United States being a very powerful country, the expectation always is that it will continue to uphold the international order, but the current administration actually is not at all committed to the current international order and wants to reform it, change it, not reform it really, to break it down so that they can assert U.S. primacy at the global level.
All right. Rachel, to get you in, when it comes to reactions from European leaders, they've not been unanimous. Some, like Italy, have gone on to say that US's actions were in self-defense. Why do you think we see this difference in reaction? We had Europe strongly condemning Russia's actions in Ukraine, but when it comes to US's actions in Venezuela, of course, Maduro was not considered a legitimate leader, but this is United States going into another country, arresting a foreign leader, bringing him to US soil. This is complete disregard of rule of law. So why do you think we're getting this tepid response from the European Union this time?
Okay, so there are a few things at play here. This decision makes a lot more sense when you view it through the lens of domestic law rather than international law. The United States has designated the so-called Cartel de los Soles a foreign terrorist organization, which then allows the Trump administration to go in and nab Maduro on narco trafficking charges. So there's that. But in terms of the European response, I mean, the EU, European nations are really good at registering their distaste, saying that they are going to monitor the situation closely. But I think the reality is that there's not much Europe can do about this. I mean, when you look at the Italian response, certainly someone like Giorgia Meloni is very much more in line with Trump and his team than perhaps other European leaders. And so I think that there's a lot of frustration on behalf of the Europeans that they're trying to deal with Ukraine and Russia negotiations, while at the same time now having to deal with Trump going into a foreign country and arresting a foreign leader. So of course that there are going to be mixed responses. I mean, no one has to think that Maduro was a good guy, a good leader. He was neither of those things. But the question is, what can Europe really do about it? And I think that their responses are limited because their positions or their options are pretty limited as well.
Right. We heard the U.S. ambassador to UN, Mike Waltz, speaking at the Security Council meeting, Ambassador Sybil, and he said that these vast oil reserves were under an illegitimate regime, and that's why U.S. has gone and taken control of this. But by doing this, what is the kind of message U.S. is sending out to others? For example, to the likes of Putin, to Xi Jinping? Or do you feel they do not have the powers or the ability to act in the manner the United States has done?
I think the two situations are not parallel at all. Neither China nor Russia has gone ahead and abducted a sitting president on the grounds that he's involved in narco terrorism. Yes, Russia is involved in a serious military conflict with Ukraine, and China has designs on Taiwan. But they are not using the kind of arguments that the United States is using, that the Western Hemisphere is theirs. They have revived the Monroe Doctrine. They have said that they cannot accept the presence of foreign powers, whether Russia or China, in Latin America. So what does this mean? That they would like to control the politics of all the Latin American countries, interfere in their internal relations. The fact, of course, is that there is a lot of drug flow that is going on from some of these countries to United States. But nobody has given any real evidence that Venezuela was a big source of drugs to the United States, so far as this so-called something of cellulose is concerned, which was just mentioned. The Justice Department actually has now withdrawn that from their charge sheet because this cartel doesn't exist anymore. So it's all trumped up. In any case, assuming that Maduro was not a democratic leader, was an oppressor, and who's to determine all these things? It's not for United States or anybody else to judge these things. It is for the people of Venezuela. And if the international community has to react, then there should be some mandate given by the United Nations under Chapter 7 after there is sufficient proof that action is required. Even the UN Secretary General, in his opening remarks at this UN Security Council meeting, has said that when it comes to narco-terrorism and other charges, there are methodologies to deal with this, implying that the methodology used by the United States in violation of international law is not the right ideology. And with regard to illegitimacy and stuff like that, how is Al-Jalani a paragon of virtue? And he was received at the White House with due honors. And he's the man who's associated with Al-Qaeda, Al-Nusra. He's been killing Americans. So these kind of double standards cannot be accepted or justified. a sheer exercise of brutal power by the United States, and because the United States will never be subject to any sanctions by anybody. So the world expects the United States to actually behave in a responsible manner and preserve the international order as best as possible in cooperation with others, rather than these solo things about abducting foreign leaders from their soil.
Right. Ambassador, I'm going to come back to you. Rachel, what kind of geopolitical issues could this now trigger? One issue, of course, is China wanting to assess what kind of exposure Chinese banks have to the Venezuelan economy, because they were one of the biggest lenders. So be it Russia, be it China, be it Europe, what kind of issues could it crop up in geopolitics in 2026?
Well, I mean, I think that what you said is correct. Foreign countries that have significant investments in Venezuela are probably looking at them pretty closely at the moment and thinking, what happens next? But I think everyone is thinking to themselves what happens next, because I don't think even the Trump administration has a clear idea of where they go from here, especially that Vice President Delcy Rodriguez, who they hope is going to be a pliable leader, has said that Maduro should be released and sent back to Venezuela. So there's a lot of difficulties here at the moment. When it comes to, the issues that we're looking at in Europe, we've seen the Greenlanders measure and voice their displeasure with this move, because Trump has said over and over again that the United States, quote, needs Greenland for its national security. And unfortunately, I think Trump has shown thus far that a lot of what he says actually isn't bluster. And so I don't think that we can discount Trump's comments about Greenland and say, oh, that's impossible, it'll never happen. I think it's unlikely still. But I think that we need to look closely at what happens next in a place like Greenland and how Denmark and other Europeans respond to this, because I think it's very much a live issue.
Right. So clearly, we have to take Donald Trump very, very seriously. He has shown that in 2025 also. You cannot often take his comments to heart or emotionally, but you have to take it very, very seriously. Ambassador Sybil, coming back to you, we've had a difficult relationship with the United States in all of 2025. No word on the trade deal. How should India see these developments? How do we need to bring in more realism into the very fundamentals or the pillars of the India-US foreign policy?
We have to find some way of tiding over this very difficult period. Let's see what happens in the midterm elections, whether Trump's wings are clipped or not. The fact remains that the United States is our most important partner. And going forward, we need to maintain very close and productive ties with it, because if the relationship is good, we can gain a lot from it, and so can the US gain a lot from it. So we should not take any precipitate action or have any emotional reaction. Look very carefully what we should do and not do, and not respond to Trump's provocations, because he's very unpredictable and he can step up the ante. As you know, in a recent clip I've seen, which you would have seen, he has threatened additional tariffs on India, because he says it's very easy to impose more tariffs on India. So he could well do that. But at the same time, on fundamentals, we have to stand our ground without getting involved into a kind of a public dispute, an exchange of harsh words with him. So lie low, protect your fundamental interests, give concessions where it is possible to do so, but stand firm on our fundamental interests. And as I said, wait for internal developments in the United States to see whether this kind of a roller coaster policy of destruction that Trump is pursuing will actually be somehow contained within the U.S. system.
Right. Absolutely. And perhaps the midterm election will be a litmus test of that. I'll request both Rachel Rizzo and Kanwal Sybil to stay with us. We're taking a short break. But next, when we return, we'll be discussing US's remarks on Greenland the bigger ramifications, why United States is trying to go after Greenland. Is it to broaden America's map or to go after oil reserves there as well? Welcome back to News Center. U.S. President Donald Trump has once again set his sights on Greenland. Trump said the United States needs Greenland from the standpoint of national security. His comments came after U.S. conducted a military operation in Venezuela's capital, Caracas, and extracted President Nicolas Maduro and his wife from the country.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place. We need Greenland from the standpoint of national security. Just say this, we need Greenland from the standpoint of national security. And the European Union needs us to have it, and they know that.
And speaking to CNN, Trump's Deputy Chief of Staff Stephen Miller asserted that U.S. should control the territory. He insisted that nobody is going to fight the U.S. militarily over the future of Greenland. Earlier, Miller's wife, Katie Miller, shared a map of Greenland adorned with red, white and blue colors of the American flag, sparking an uproar on social media. Greenland is the world's largest island located in the Arctic with a population of about 56,000. It is a semi-autonomous territory of the Kingdom of Denmark and therefore part of NATO. Much of Greenland's economy is based on fishing, but there has been growing interest in its natural resources, including rare earth minerals, uranium and iron. With ice sheets melting due to global warming, these resources could soon become more accessible. Greenland is home to both Danish and American military bases. China and Russia have also been building their Arctic military capabilities in the recent years. Greenland's Prime Minister Fredrik Nielsen has responded to Trump's comments by saying that's enough. He said, and I quote, "No more pressure, no more insinuations, no more fantasies of annexation. We're open to dialogue, we're open to discussions, but this must happen through proper channels and with respect for international law." European countries, including Finland, Norway and France, have expressed their support to Greenland and Denmark, saying that borders cannot be changed by force. Danish Prime Minister warned that US's invasion of Greenland would be the end of NATO.
If the United States chooses to attack another NATO country militarily, then everything stops. That is including our NATO and thus the security that has been provided since the end of the Second World War. I believe in democracy and I believe in the international rules. Of course, I also believe that you do not change borders by force, either one way or another. It is not only the position of Denmark and the Danish kingdom, fortunately, of Europe too. So I hope that the people will also take note of the once again significant European support that we are receiving.
Former Foreign Secretary Kanwal Sibal and Senior Fellow with ORF Strategic Studies Program Rachel Rizzo are still with us. Rachel, do you think that an invasion of Greenland is very imminent, considering what has happened in Venezuela? And would leaders of Europe, the leaders of Denmark, try and find a diplomatic way out?
So, no, I don't think a military takeover of Greenland by the United States is imminent, because I think that the logic that Trump uses to govern his decision-making over the Western Hemisphere is different than the logic he would use toward Europe or Greenland specifically. Now, he has said over and over again that the United States needs Greenland. This is not a new idea. The first time he floated it was in 2019 during his first term, and then earlier last year in 2025, the idea became sort of resurgent, and you had a lot of comments from the Danish Prime Minister, the Greenland Prime Minister, different European leaders saying exactly what these clips before just said, which is that borders cannot be changed by force. So Greenland does not need to be a part of the United States for the United States to benefit from it in terms of national security. So I think what we need to look next is what sort of deals is the Trump administration looking for? What exactly do they need in terms of Greenland? We already have ballistic missiles there. We have a military presence on the island. And as you said, there are rare earth minerals in Greenland, but it's a frozen piece of land. I mean, we're looking at hundreds and hundreds of billions of dollars and years in the making. This is not something that would happen overnight. So I think it's concerning. And it's something that we have to watch closely, but it's not something that's going to happen overnight or imminently.
Right. And Ambassador Sibal, the day Donald Trump takes any kind of actions to annex Greenland, which has been speculated, that will mean the end of NATO, isn't it?
Well, I think certainly it will cause a severe tensions within NATO and the potential breakup of NATO, because the European reaction would be very severe. As it is, Europe is feeling left out in the negotiations the United States is having with Russia. There's a lot of angst about this. They are ganging up together to see how they can either persuade the Americans to accept their inputs into a potential solution, or independently support Ukraine with money and arms, and of course build up their own defense and other capabilities so that they can have real strategic autonomy. This is the direction in which they are going. So there will be very severe repercussions if the United States did that. But there are a couple of things. One, Trump just said in the clip that you showed us that there are Russian and Chinese vessels all over the place. This is complete nonsense. This is how they build up a narrative. The Arctic hasn't melted yet.
It's about critical minerals and oil again.
No, he talked about, no. He said there are Chinese and Russian ships all over the place. It's not true.
Yeah.
Let the Arctic ice melt, let the northern route get developed, and then we'll see Russia is building more icebreakers, this and that. When the route gets open, obviously Russia will dominate because they have the largest seafront to this area. That is true. But the United States, as has already been mentioned, has a base there. It can have more bases there. It can enter into agreements to exploit minerals and this and that. But remember, the rare earths and all are extremely polluting. And Greenland is pristine territory. So are they going to ruin the environment of Greenland so dramatically by having large-scale mining operations in that area? This is very dramatic and very worrying in terms of the thinking that we see at the highest level in the United States. And of course, Europe will be caught in an extremely difficult position. As it is, their narrative regarding Russia has been totally undermined by what Trump has done in Venezuela. And if they go ahead and change the borders of Denmark by incorporating NATO, then this whole theory that you cannot change borders will fall flat on the ground.
Right. Rachel, my final question to you. There have also been some reports that there is a thought in Denmark that when it comes to leveraging the natural resources of Greenland, perhaps it's better to tie up with a country like United States than let China be there and exploit those resources. Do you think Denmark government would try and find a way out of this, some sort of win-win partnership with Donald Trump on this year to prevent any kind of untoward incident?
Absolutely. I mean, I think that's right. I think that, as I said before, when Trump says something, it's important to take him seriously, not literally. I think actually you said that. And so when it comes to Greenland, when it comes to needing Greenland as a strategic asset, a strategically located asset, as an island full of potential natural resources, he's basically laying out a case for why the United States would potentially need it and what the United States would want from it. So I think basically what he's doing here is he's sending a message, not just to Europe, but to Denmark specifically, saying, listen, here's what a potential deal could include. And the conversations that happen over the coming months and year, I think will very much look exactly like that. Really, what does the relationship with the United States and Greenland look like now, and what should it look like in the future? I don't think there's a clear road to that. I think the Danes are rightfully very angry at the threats Trump is leveling at them and at Greenland. But at the same time, Europe is a little bit hamstrung because they don't have that much strategic leverage when it comes to the United States. The United States actually has strategic leverage over Europe. So I really see a scenario where Trump could really force them into a deal. But that doesn't mean it's a deal that wouldn't work for them. It could be strategically sound on both sides. So this is something that I'm certainly going to be watching closely over the coming weeks and months.
All right. Thank you very much, Rachel Rizzo and Ambassador Sybil, for joining us for a very interesting discussion on the global ramifications of U.S. actions against Venezuela and the latest remarks on Greenland. And we have to take whatever Donald Trump is saying very, very seriously. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Hello and welcome to our special broadcast. I'm Timsi Jaipuria. With less than a month to go for the union budget, corporate India and tax experts have laid out its wish list. The industry has called for simplification, more relief for the middle class, and reduction in criminal provisions. Remember, last year's budget focused on relaxing tax slabs under the new tax regime. The finance minister also announced tax exemptions for those earning up to 12 lakh rupees per annum. So what can the industry expect this year? We are now joined by Charanjot Singh Nanda, President of the Institute of Chartered Accountants, Amit Maheshwari, tax partner, AKM Global. Also with us, Akhilesh Ranjan, former member at Central Board of Direct Taxes. Gentlemen, thank you for joining us on this program. Let me come straight to Mr. Nanda first. As President ICAI, I'm sure you must have submitted your suggestions to the government as to what can be done in this upcoming budget. What tops your wish list when it comes to especially the middle class, the corporates, because that has been the focus of the government?
Madam, it is customary for the Institute of Chartered Accountants of India to present a pre-budget memorandum to the Finance Minister, taking into consideration certain issues. So two issues which have been making a great mark. First is joint taxation system of married couples. We have asked for that aligning both the exemption schemes. You are aware that there is a tendency to transfer the income or asset to a non-earning spouse. So we want a straightforward system whereby we have said that the standard deduction can be doubled from 75,000 to 1,50,000. The exemption limit basic of 4 lakh can be 8 lakhs. And then the slabs can also be accordingly taken care of. More so, we have requested them that the surcharge, which is above 50 lakhs, can be increased above 1.5 lakh. It is not double because earlier the proposal was that it will be increased from 50 lakh to 75 lakhs. So taking that into account, we have proposed that if we could ultimately ask for the surcharge above 1.5 crore rupees. So this will equate the entire system. You are aware that a lady who is in home, who's a home lady, she also works and the income of the husband is used for the homely purposes. So parity and equality, it would be better if the joint taxation system of married couples be made. The non-earning...
What about corporates?
Madam, about corporates is separate. We have made a suggestion. We have made a suggestion for tax-neutral business reorganization in LLPs. We are asking that LLPs be made, but the tax rate of companies is 30%, while it is for corporates it is 22%. So we are calling for a special tax regime in companies under section 115BAA. The tax rate is 22%. So we propose for companies, for LLPs also, it should be 22%. Secondly, a very important thing, with respect to amalgamation, when transfer of capital asset is made in corporates, there is no capital gain tax while it exists in LLPs. So if we want LLPs to come and have the ease of doing business, we have to very, very clearly indicate that there shall be no capital gain tax if a capital asset is transferred.
Coming to Mr. Ranjan now, how do you see these suggestions? Do you think there is enough merit in these suggestions, the two suggestions that Mr. Nanda has said, that which tops the list when it comes to the personal income tax and especially for the middle class, and secondly for the corporates? Do you think government can consider them? Does the government really have the room to actually accommodate, plus the surcharge, what he has been suggesting, that it should be hiked, the limit of levying a surcharge should be beyond 50 lakhs, it should be 1.5 crores. Do you think government has that much of room to accommodate all these suggestions?
Yes, thank you, Timsi, and thank you for having me here. There are countries which do follow the family system, where a married couple can return their income together. And I'm not so sure whether the government here will think about that. Firstly, what do we hope to achieve? Mr. Nanda has mentioning maybe double the exemption limits, have more relief for the family. Well, I think the government has done quite a bit on the personal income tax rates. Last year that you just mentioned, and there was a whole lot of relief, in 30% slab kicking in only at 24 lakhs, which is a huge thing. 12 lakhs being the minimum threshold. I don't think that the government really thinks that the personal income tax is heavy for the individual. So that's one reason why I don't think that they will want to consider any such change. Of course, we must remember that it should not make a change just for the sake of making a change. The idea is to what is to be rectified, and that's the thing to be thought about. So
So what is to be rectified according to you?
Well, actually, it's nothing. When I say rectified, I mean what next. Now, we have already done a lot in personal income tax and corporate tax. A lot of changes have been made. What India now needs is essentially three things, according to me. One, stability and predictability of the tax system. There should not be frequent annual changes. We have seen changes in the personal income tax structure for each of the last 3 years. People are now so confused as to know which rate really applies. I think it is very important to have a stable tax system, first of all. Secondly, we need to have simplification. Now, simplification doesn't mean rewriting the Income Tax Act in simple language. That's only making it easier to read. Simplification means simplifying the tax structure. So, for example, why do we have things like a new regime and an old regime for personal income tax? Why don't we have just one regime and have calibrated and selected exemptions and incentives out there? Thirdly, we need to build trust between the government and the taxpayers. That's the most important step that the government has to see now. And that can be brought about by things like decriminalizing the tax defaults, by introducing measures of accountability, by making people aware that, look, the government is actually appreciating your tax contribution. So those are the three main areas, according to me, which need to be addressed. There's of course things like disputes and tax certainty, which is a part of trust.
I'll come to the dispute part a bit later. Coming to Amit Maheshwari, how do you see these suggestions, and especially when it comes to the corporate side, because you handle a lot of corporate clients also, and what's on your wish list? Do you think can the government consider some more cuts?
Yeah, so good evening, Timsi. Good evening to the channel viewers. So I just wanted to highlight a few points which probably are very practical, and I would tend to agree with Mr. Nanda. The Institute has made some very valid suggestions. So this joint married couple taxation, which is treated as one wholesome unit, I think it has a lot of merit. There are a couple of advantages. So one biggest thing is that in terms of succession planning, most of your wealth advisors tend to tell you that please have assets in joint names, and that is something which I think everyone should follow. And typically we have seen clubbing of income provisions getting triggered. We see it in a lot of property transactions, though that is outside the clubbing provisions, but we see that the properties are in joint names. But even for financial instruments, that is required. So that is one biggest advantage, which makes inheritance and succession plannings a lot simpler. The other thing is that you have cases where one individual, even though they might be earning, they might have losses, and the other, the husband might have profits, and the wife might have losses. So those can be clubbed, and a lot of tax optimization and efficiency can be brought in. I think the overarching principle is that you should try to avoid unnecessary planning mechanisms or these complexities where the unit can be treated as a whole. And the same thing applies even for, there was a demand of the industry for group tax consolidation, where you have different entities which can be consolidated and a group tax return could be filed. So I think just akin to that concept, I think this concept has merit. Obviously, whether that will the government would agree to that or not, but I think it is a very valid suggestion. And yes, obviously, consequently, the slab rates, exemption limits all need to be increased. to do that. But I think it can be as an optional regime. It's not necessary that you impose it on everyone. It can be an optional regime. But I would probably agree with Mr. Nanda and the Institute of Chartered Accountants, which has it's a pretty valid suggestion. On the corporate side, and I think on the individual side,
on the corporate side.
yeah, okay. So on the corporate side, I think, like Mr. Ranjan said, I think that's definitely there, that the need of the hour is to build more trust, and the government has certainly done its bit, and there's few changes which have come in, which might be very progressive, and the new Income Tax Act, even though it does not have very fundamental changes, but they have tried to simplify the act. So we believe that the LLP tax neutrality is definitely, the reorganization is definitely required. Like Mr. Nanda said, there are a lot of provisions under the Income Tax Act wherein the LLPs are not treated at par with the Companies Act. So they have tried to give more and more benefits to the companies, like for example, startups, when they carry forward their losses under erstwhile Section 79, that has not been extended to LLPs. You don't have the presumptive taxation. So I mean, there are certain things which probably, apart from even the tax rate, where they need to bring parity and make LLPs more lucrative, because it is an excellent vehicle. Right now, especially for foreign investors, it does not work because the profits of LLPs tend to be exempt, and they are not able to get a credit which they are able to get when it is a company dividend. So I think there is definitely merit in those suggestions as well. And
I'll stop you, Amit, over there. Time for a short break, but don't go anywhere. The discussion continues on the other side. Stay tuned, especially when it comes to the dispute resolution mechanism, which has been much awaited. And as both Charanjot Singh Nanda and Amit were saying, on LLPs. We'll be back shortly. Welcome back. You're joined by in this special broadcast, and we are back with our guests, Mr. Akhilesh Ranjan, former member CBDT, Charanjot Singh Nanda, president of ICICI, and Amit Maheshwari, who's also the tax partner at AKM Global. Coming back to the point that both the CAs were making to the government and coming to the government, former member CBDT first, as we say, ye dil always mange more cuts, and that's what they are looking for be it for corporates or for the middle class. Mr. Ranjan, do you still think, as you said, that a lot has been done on the personal income tax side? We saw the government going the extra mile to make the new regime even more lucrative. Do you think that when it comes to the corporate side, when it comes to the points that both the CAs were making, that LLPs are not treated equally, corporates get a much better rate to file their returns, do you think there is still merit on that side? And also, on the dispute resolution, an ask which has been there pending for quite some time now, that almost every industry association has been talking about, that there needs to be a more robust and a better dispute resolution mechanism that needs to be seen into the picture. We've seen in the past few dispute resolution schemes, but they did not actually excite the corporate sector to end the legacy disputes, which helps both the governments and the industry.
Right, that's right. So, well, it's true that even after carrying out a number of reforms on the corporate tax side, there are still certain areas, certain anomalies which need to be rectified or clarified. I think the things like the treatment of LLPs is one thing. Of course, an LLP is a partnership ultimately, and the Indian law treats partnerships very differently from corporate entities. So while there is some merit in saying that we have created something called a limited liability partnership, which should have more of corporate tax features, I think there is also a need to ensure that there is a distinction between the two types of entities. Corporate entity is a juridical entity and holding property in its own right. So, but then yes, there is merit in trying to align these systems. Similarly, on things like demergers, there are some gray areas, some areas which need to be smoothed out. So there are these areas in corporate tax which need to be addressed, and I think these issues are all known to the government, and let's hope it's a matter of time that they come up with clarifications. On the dispute resolution, now that's a big one.
Yes.
That's, as you said very rightly, every industry chamber is talking about it, every corporate is talking about it, because people are quite really fed up of the amount of litigation out here and the years it takes, the period it takes to resolve an issue. So, and the government has also been trying. There have been so many dispute resolution schemes in the recent past. I think it's high time now that the government shifted its focus from dispute resolution to dispute prevention. That's the theme that I think is catching on globally. There are already systems in place in many countries where one can resolve or come to an understanding on a tax dispute before it reaches the courts. I think India needs to think about a proper system of prevention of disputes. We have mechanisms like the Advanced Pricing Agreement, APA, which is doing extremely well. All corporates are vying to.
But still, I'll pause you there, because still there's a hefty amount that is logged when it comes to both the government's due or the benefit that the industry can get in the dispute mechanism that is there at CIT appeal, at various levels, and the amount is so big that every year it just keep on accruing with interest and penalty, which no one likes, be it the government or the industry, be it the taxpayer or the taxman. So there has to be a solution to it, which, as you rightly said, that these matters are before the government and it is very well known to the government. So what is holding the government back from coming up with the actual new revised, say, earlier we saw Vivad Se Vishwas. It was a scheme which did decent, to be precise. How do you think can this be reshaped and given it as a boost, be it to the tax collections or to the taxpayers?
Now, that's a very difficult question, and I'm sure neither anyone in the government nor anyone here would be able to give a good answer as to what sort of scheme should the government come out with. We have had the Kar Vivad Samadhan scheme. We have had the dispute resolution scheme of 2016. We have had the Vivad Se Vishwas scheme. All these schemes have made a dent. They have resolved a certain number of disputes. They have brought in some revenue for the government. But the problem really is that the tax law is always a law which gives rise to disputes. Unless we can control the generation of disputes, there is not much hope of trying to address it only by thinking of resolution. The resolution, of course, we can have more and more schemes, but there is a limit to what sort of schemes one can have. I mean, what can one expect the government to say? That, all right, we will not go against the ruling of any court. I mean, that they have already said that the monetary limits have been enhanced to a very high level now. You don't go to the Supreme Court unless there is a 5 crore tax effect out there.
Yes.
It's a huge thing.
So there are limitations, as you are saying.
So the government has done its bit and said that, okay, we will not appeal, we will not do litigation. But then the law is that the taxpayer also cannot stop from carrying out litigation. So I think we have to somehow...
Coming to Mr. Nanda on that, sir. Sir, coming to Mr. Nanda on that, as you said that the government has done its bit by not appealing in many cases. Sir, what more is on the wish list, apart from the much talked about dispute resolution, the equal treatment for LLPs, or for the middle class joint filing for the married couples? What else is on your wish list?
Madam, on the principle of equity, we would suggest that decriminalization of certain prosecution provisions be undertaken. I would give an example. For example, if TDS is not paid, that ultimately tends to be a prosecution issue. We should stop that. In case, if there is a failure to produce books and documents as per notice served on direction issued to the assessee by assessing officer, that is precisely under 268(5). So that should not be, we have to be very equitable when a prosecution has to happen. So we suggest that in these two provisions, we have suggested that to the government in pre-budget memorandum, that it should be waived. Now coming on to the removal of dual penalty for the same default and bringing down the quantum of penalty in line with the nature and extent of default is very important. I'll give an example. For example, a person is misreporting the income. It attracts a penalty of 200% of tax payable, which is correct. But apart from that, you have two more penalties. Now, if a wrong entry has been recorded in the books of account, 100% of that entry has to be taxed. That will be part of the taxable tax. And other than that, if it is an international taxation transaction which has not been reported, then 2% of the transaction value has to be taxed. So it results into dual penalty for an offense which has been conducted once. So we propose that all these things need be rationalized.
Yes. Mr. Nanda, a point very well taken that decriminalization should be on the government's top list. Coming to Amit Maheshwari, give me in a very crisp and short answer, what could be your two best suggestions that government can actually act on? What could be the two best suggestions that you would like to put forward, which you think government can easily do them? I think you're on mute.
I'm sorry. I think coming to what Mr. Ranjan was saying, is very difficult to say what the government can do. But one thing is for sure, that prevention is the answer. And I think the more accountable you make the officers, the less disputes will arise. A lot of times taxpayers have very good success obviously in appeals and tribunals. So I think the prevention of disputes should start at making the officers a lot more accountable. I think that's the number one thing which the government can do and they should do. Even in this right now, in this what we are seeing in the current cycle, there are hundreds and thousands of show cause notices being issued with very short time periods. Orders are coming in where the assessees, taxpayers, submissions have not been taken care of. So I think the disputes start at the at the assessing officer level. So that should stop at least. If some accountability can happen, that is very important. And I think A couple of other points which was shares like the APA. I think it obviously helped in bringing the transfer pricing disputes dramatically. But I think having them more time bound, that's very critical. I have seen cases in black money when you have FAIU notices where it could eventually lead to prosecution under the Black Money Act. You have thousands of taxpayers lying in the lurch who do not know whether their submissions, their investigation have been closed or not. I think,
Amit, I'm on a very short deadline, so I'll come for a closing remark from Mr. Akhilesh Ranjan. Since he has been a taxman, probably he could give a closing remark as to what can be expected from the upcoming budget.
Right. So as far as direct tax concerned, as I said earlier, I think the minister has already been talking about simplification. Minister has been talking about predictability and stability. I think the government is on that path already, but it's just that some further actions have to be taken. So we have now rewritten the law. I think what is required is a simplification of the system as such, as is what I was saying. And most importantly, for building trust, Amit just mentioned about some measures like accountability. I'm all for that. I think that is something that the government should look at. We have a citizens' charter. It's there in the statute, but there is no way of enforcing that. There has to be some way in which accountability can be introduced by making that charter more effective. If we can build that trust with the taxpayer and show the willingness of the government to come forward, I think a lot of compliance improvement can be seen, and that's what the government really needs now. With a very moderate tax structure.
So definitely the ask is for further simplification, equal treatments where entities are equal, and yes, most importantly, if more cuts can be given, then it should be for the middle class. And with that, it's a wrap on this special broadcast. Thank you for watching and stay tuned. More is being lined up on the other side. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Indian equity markets end lower for the second day after a choppy session as geopolitical tensions keep traders on the edge. The Nifty slips below 26,200. Heavyweights like Reliance and Trent drag the markets lower. The Nifty Bank, though, ends in the green.
Days after his dramatic extraction in a pre-dawn raid, deposed Venezuelan President Nicolas Maduro pleads not guilty to drug and weapon charges in a U.S. court, claims he was illegally captured and is a prisoner of war. Maduro's deputy, Delcy Rodriguez, is sworn in as Venezuela's acting president. The Venezuelan government claims it is police who fired at drones that flew over Caracas without permission. Russia, China and a host of Latin American countries denounce Maduro's capture at the United Nations Security Council, call it a serious affront to the sovereignty of Venezuela. U.S. defends its action, says Maduro's capture is a law enforcement operation and not an act of war. Reliance Industries refutes a Bloomberg report which suggests that shipments of Russian oil were approaching the Jamnagar refinery. Says it has not received any cargo of Russian oil at its refinery in the past 3 weeks. Adds it is also not expecting any Russian crude oil deliveries in January. India's central electricity regulator, under a scanner for the controversial order on market coupling for power exchanges, may consider withdrawal of the order after accusations of insider trading by CERC members come to light. APTEL to hear the matter again on the 9th of January. President Trump doubles down on his threat to annex Greenland, says the U.S. needs Denmark's autonomous territory from a security standpoint. Greenland calls his ambitions a fantasy, and Denmark says a move like this would be the end of NATO. European allies affirm that Greenland's future must be decided by its people. RBI issues amended directions on lending to related parties, aligning norms between banks and NBFCs. The rules are effective the 1st of April and widen the definition of related parties, strengthen disclosure and place greater accountability on boards. Equity investments remain outside the framework, but debt investments invite scrutiny. All of that and more coming up for you in just a bit, but let's start with the day's market action. The Lord Street ending lower for the second day in a row, with the Nifty slipping below 26,200. Heavyweights like Reliance Industries, ITC and Trent were the big drags in our market today. Financials, though, outperformed the blue chips, with the Nifty Bank ending mildly higher. Flat close off its intraday highs, a very choppy session. That's the Nifty for you. The Sensex down about 400 points. The Nifty Bank just about closing in positive territory, and a flat close there for the mid-caps as well. Meanwhile, oil prices edging lower as markets wait the possibility of higher Venezuelan crude output. Traders speculate that President Maduro's removal from power in Venezuela could potentially lead to the U.S. easing its sanctions on Venezuelan oil. SBI researchers forecast that crude oil prices could fall to as low as $50 per barrel by June as fresh supplies hit the market, especially given softer global demand. And in the bullion market, gold prices remain steady after touching one-week highs. This after U.S. strikes in Venezuela added to the yellow metal safe haven appeal. Expectations of further rate cuts by the U.S. Federal Reserve also supporting prices. Silver also benefiting from the safe haven demand. That metal up about 3%. There has been some action in base metals as well. Copper prices soaring to record highs of $13,000 a metric ton as a strike at a mine in Chile increased fears of a supply shortage. So that's the metal action. Now, a lot of the action in the global financial and commodities market stems from the action around Venezuela. So that continues to be the big global story. Now, deposed Venezuelan President Nicolas Maduro has pled not guilty to 4 charges of drug trafficking and terrorism when he was produced before a court in New York. This came less than 48 hours after he was extracted from Caracas. Maduro declared that he is still the president of Venezuela and that he was captured illegally and that he considers himself a prisoner of war. Meanwhile, Venezuela's Vice President and Oil Minister Delcy Rodriguez was formally sworn in as the country's interim president. Rodriguez said she was pained by what she called the kidnapping of Maduro and his wife.
Protesters gathered outside a New York federal court on Monday, where inside, toppled Venezuelan President Nicolas Maduro stood before a U.S. judge to face charges that could put him behind bars for life. Through an interpreter, Maduro said, "I am innocent. I am not guilty. I am a decent man. I am still president of my country," before being cut off. Maduro faces 4 U.S. federal criminal counts that include narco-terrorism conspiracy, cocaine importation conspiracy, and possession of machine guns and destructive devices. His next court date is set for March 17th. His wife, Celia Flores, faces the same charges, except for narco-terrorism. She also pleaded not guilty. Prosecutors alleged that as president, Maduro directed cocaine trafficking routes, used the military to protect shipments, sheltered violent trafficking groups, and used presidential facilities to move drugs. He was first indicted in 2020 as part of a long-running narcotics trafficking case against Venezuelan officials and Colombian guerrillas. The 63-year-old has long denied the allegations, saying they're a mask to take Venezuela's rich oil reserves, which U.S. President Donald Trump has made no secret of wanting.
And several countries have voiced their objection to U.S. military operations in Venezuela. At an emergency session of the United Nations Security Council, nations called for the immediate release of Venezuela's president and his wife from U.S. custody. Russia's representative to the UN called the intervention, and I quote, a return to lawlessness, urging the 15-member council to reject the methods of U.S. military foreign policy, saying there is no justification for the move. China's envoy echoed the charge, saying the U.S. had wantonly trampled upon Venezuela's sovereignty and violated the principle of sovereign equality. China demanded that the U.S. change its course, cease its bullying and coercive practices, and return to the path of political solutions through dialogue and negotiations. Meanwhile, Cuba also condemning the U.S. action against Venezuela, calling the military attack an imperialist and fascist aggression with objectives of domination. However, the U.S. envoy Mike Waltz defended the operation in Venezuela, justifying it as a surgical law enforcement operation, calling out the 15-member council for criticizing the targeting of Maduro, widely considered a dictator in the Western Hemisphere.
There is no war against Venezuela or its people. We are not occupying a country. This was a law enforcement operation in furtherance of lawful indictments that have existed for decades. The United States arrested a narco trafficker who is now going to stand trial in the United States in accordance with the rule of law for the crimes he's committed against our people.
There is no and can be no justification for the crimes cynically perpetrated by the United States in Caracas. We firmly condemn the U.S. act of armed aggression against Venezuela in breach of all international legal norms. In connection with the confirmed reports about the presence of the abducted president of Venezuela, Nicolas Maduro, and his spouse.
Allowing such acts to go without an effective answer would amount to normalizing the replacement of law by might, while eroding the very foundations of the collective security system. Today, it is not only Venezuela's sovereignty that is at stake, the credibility of international law, the authority of this organization, and the validity of the principle that no state can set itself up as a judge, party, and executor of the world order are also at stake. Brazil does not believe that the solution to the situation in Venezuela lies in the creation of protectorates in the country, but rather in solutions that respect the self-determination of the Venezuelan people within the framework of its constitution. The events of January 3rd transcend the regional sphere. The attack on the sovereignty of any country, regardless of the direction of its government, affects the entire international community. This and other cases of armed intervention against the sovereignty of a country, its territorial integrity, or its institutions must be vehemently condemned.
We call on the U.S. to ensure the personal safety of President Maduro and his wife and to release them at once. We support the Council in fulfilling its primary responsibility to maintain international peace and security, and we support all efforts by the UN Secretary-General, regional countries, and organizations that contribute to promoting dialogue and de-escalating the situation.
Well, the action there in the UN Security Council. Now, the big story back home. India's central electricity regulator is under the scanner for its controversial order on market coupling for power exchanges. The CERC said that it may consider withdrawal of the order, this on the back of accusations of insider trading by CERC members that have come to light by the market regulator, SEBI. Shares of IEX closed with gains of 11%, in fact, were higher through the course of the day, coming off a little bit at close, witnessing the biggest single-day gain since October of 2021. Ashmit is standing by now to explain what all of this means. Ashmit, take us through what transpired at APTEL, what the IEX Council had to say, and where we now head from here.
Well, bear in mind that one issue that has dominated the conversation in the previous hearing as well as this hearing have been assertions that are being made by the exchanges like the Indian Energy Exchange that this order is tainted, the coupling order is tainted on account of insider trading charges. They've cited SEBI reports to say that in fact the very author of the report is somebody who's been mentioned by SEBI to have in fact profited from, to have made illegal gains from through insider trading, through the crash that happened in the share prices of these exchanges. Now that is something that even the APTEL today dwelled on. The APTEL said that this is something that even was brought to their attention, that there was a very theatrical process involved as far as passing of these regulations are concerned, that APTEL did not understand the reason behind the drama, and that if there is a foul play found, this is something that the APTEL will look at, will take necessary action on. But in response to all of this, we found that today the CERC councils were also present as a part of this hearing. The CERC council, their lawyer, submitting before APTEL that the CERC wanted this entire process to be fair, wanted this process to be transparent, wanted this process to be consultative, and having said that, clarifying before the APTEL that the lawyer will now go back to the commission to seek clarity from the members whether there can be a withdrawal altogether of the coupling order of 2024. This, in fact, is something that was acknowledged by the exchanges. The lawyers for the exchanges said that if that were to happen, then the entire process then just gets resolved. There is no cause for concern. Even, in fact, APTEL taking note of that and saying that if this clarity comes by Friday, which is later this week, if CERC says they're withdrawing this order, then this entire case will not survive. It'll be over in 5 minutes. So clearly all eyes now on the CERC and their decision on whether they choose to withdraw the coupling order.
All right, January 9th is when this matter will be taken up again. Ashwit, many thanks for joining us. Reliance Industries has denied a Bloomberg report which claimed that 3 vessels laden with Russian oil were heading to Jamnagar's refinery. Reliance called the report blatantly untrue. The company stated it has not received any cargo of Russian oil at its refinery in the past 3 weeks and is not expecting any Russian crude oil deliveries in January either. Now, India's services output has dropped to an 11-month low in December. This was due to a slow pickup in new businesses and hiring activity. HSBC's India Services PMI, compiled by S&P Global, fell to 58 in December. Remember, a reading above 50 indicates expansion, while a level below 50 signals contraction. The Reserve Bank of India has issued amendments to banks, NBFCs and other financial institutions on lending to related parties, this in a bid to tighten governance and transparency around these transactions. Under the amended directions, equity investments in related parties are excluded from the scope of these regulations. However, investments in debt instruments remain covered. The RBI has also exempt certain NBFCs from these guidelines. These amendments will come into effect from the 1st of April. Shares of Tata Motors passenger vehicles declined nearly 2% in trade. This after its luxury arm Jaguar Land Rover reported a sharp decline in wholesale and retail volumes for the third quarter of FY26. This was largely due to the impact of the cyber attack and the slowdown in production. Thereafter, JLR's wholesale numbers stood at 59,200 units, marking a steep annual decline of more than 43%. Retail sales came in at a reported 79,600 units, down 25% on an annual basis. India's competition watchdog, the CCI, has probed steel giants, including Tata Steel and JSW Steel, for breaching the antitrust law. As per Reuters report, CCI's investigation has found companies were colluding to fix steel prices. The report further states that CCI held 56 executives liable for price collusion between 2015 and 2023. CNBC-TV18 has tried to get a comment from the Competition Commission of India. We're still awaiting one. Time for us to head into a break, but up next, US President Trump doubles down on his threat to annex Greenland. That and more when we return. President Trump has doubled down on his territorial ambitions for Greenland, a Danish autonomous territory. Speaking at a conference, Trump said Washington needs Greenland for national security, cited its strategic Arctic location. Greenland's prime minister responded sharply, dismissing Trump's remarks as fantasy. Denmark's prime minister warned that a U.S. attack on a NATO ally like Denmark would mark the end of the alliance. Denmark's European allies affirmed that Greenland's future must be decided by its people. UK Prime Minister Keir Starmer said only Denmark and Greenland can determine the island's path. Trump's top aide Stephen Miller said that Greenland rightfully belonged to the U.S. and claimed that nobody would fight the U.S. militarily over the future of Greenland.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place. We need Greenland from the standpoint of national security. Just say this. We need Greenland from the standpoint of national security. And the European Union needs us to have it, and they know that.
If the United States chooses to attack another NATO country militarily, then everything stops. That is including our NATO and thus the security that has been provided since the end of the Second World War. I believe in democracy and I believe in the international rules. Of course, I also believe that you do not change borders by force either one way or another. It is not only the position of Denmark and the Danish kingdom, fortunately, of Europe too. So I hope that the people will also take note of the once again significant European support that we are receiving.
Now, Israeli forces have launched intense helicopter attacks on southern Gaza. At least 2 Palestinian officials have said that forces bombed a tent housing displaced Palestinians, killing a 5-year-old girl and her uncle. More than 400 Palestinians have died since the U.S. brokered truce came into effect last October. Ukraine has said that Russia carried out 5 missile strikes on its second biggest city of Kharkiv. Russian President Putin has also been accused of deliberately targeting a U.S. business in Ukraine. This comes as President Trump's senior negotiators Steve Witkoff and Jared Kushner are set to meet Ukrainian President Zelensky and Kiev's European allies in Paris today to discuss the specifics of a peace deal. The United States Health Department has reduced the number of recommended vaccines for children. Ekta now joins us with the contours of the order. Ekta, take us through the vaccines that have been struck off the mandatory list.
In what is being called an unprecedented move, the US has reduced the number of vaccinations it recommends for children to 11 from 17 earlier. Now, under the new policy, vaccines for diseases such as measles, polio, HPV and chickenpox remain recommended for all children. However, vaccines for flu, rotavirus, COVID-19 and some hepatitis shots have been shifted to a shared clinical decision-making model between families and their healthcare providers or their doctors, indicating that those vaccines are now voluntary. The US has also reduced the HPV vaccine schedule to a single dose from the previously routine 2 to 3 doses. This move has sparked criticism on the lack of transparency and involvement in this decision. Critics also warn that the US has a much larger and more diverse population than countries such as Denmark, whose schedule was cited as a model for these changes, and that loosening universal recommendations could lead to lower vaccination rates and increase in preventable diseases such as flu, hepatitis and rotavirus. Now, going forward, experts estimate that the new schedule could possibly reduce the vaccine offtake by 30 to 40% over a period of time, a shift that will be key to monitor in the years ahead for its impact on diseases.
Ekta, many thanks. Senior Congress leader Sonia Gandhi admitted to Sir Gangaram Hospital last night after experiencing respiratory discomfort. The hospital said her bronchial asthma had been mildly aggravated due to the combined effects of cold weather and pollution. She was admitted for further observation and treatment as a precautionary measure and is currently stable. TMC MP Derek O'Brien has moved the Supreme Court challenging the special intensive revision of electoral rolls in West Bengal. The plea asked the apex court to stay the finalization of electoral rolls on the 14th of February. The petition has alleged that 58 lakh voters were removed from the draft rolls without notice. It also claims that the removals were arbitrary and violated procedures. Former Union Minister and Congress leader Suresh Kalmadi passed away at the age of 81 after a prolonged illness. He served as Union Minister of State for Railways and was the former president of the Indian Olympic Association. Leaders across parties have expressed their condolence. Mahindra has launched the new XUV XO starting from 13.6 lakh rupees. Bookings for the XUV 700 successor will open on the 14th of January with deliveries beginning the same day for higher variants. Shivani brings us the latest on Mahindra's new offering.
Well, this is the all-new XUV 7XO from Mahindra & Mahindra. I'm here in Jaisalmer, where Mahindra has just unveiled this premium SUV, the 7XO, which is the successor of the XUV 700. Now, starting at 13.66 lakh rupees, the XUV 7XO builds on the success of the XUV 700 and brings in several segment-first features, including the world's first Da Vinci suspension system, India's first ICE software-defined vehicle, and a coast-to-coast triple-screen layout. Let me just show you. This is the triple-screen layout here. As you can see, and this, by the way, is across variants. The model also comes equipped with level 2 ADAS with dynamic visualization, underlying Mahindra's intent to mainstream high-end technology. From a business strategy perspective, Mahindra says it will calibrate production based on the demand visibility, but expectations are that the interest in the XUV 7XO could be as strong as the 700 saw at the launch.
Well, that's the latest there from Mahindra. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Health tech company Future Cure Health mops up $11.5 million led by Carnelian Asset Management with participation from other investors. Fresh funds will be utilized to expand access to the diagnosis and treatment of vertigo. Homegrown beer startup Proust records strong growth in FY25 with revenue surging 2.7 times. Also claims to have achieved EBITDA break-even during the fiscal year. Revenue from operations rose 174% to 115 crore rupees. Growth was led by a steep rise in sales volume. Beauty and personal care brand Bella Vita reports a profit of 25 crore rupees in FY25, a sharp turnaround from a loss in FY24. Improvement comes amid strong revenue growth and better cost efficiency. Managed care provider Even Healthcare gets $20 million in fresh funding. Round was led by existing investors Lucky Groom and Alpha Wave. Proceeds will be used to expand its hospital footprint in Bangalore and scale its managed care hospital model. Used car marketplace Cars24 acquires vehicle information and management platform Car Info. This is Car24's second acquisition in 12 months. The acquisition brings Car Info and its other app Bike Info into the Cars24 ecosystem. Well, those were the headlines we've been tracking for you today. Hospitals are among the toughest businesses to build. Capital intensive, slow to break even, and often rewarded for keeping patients longer. But Bengaluru-based Even Healthcare is challenging that model. The company has raised $20 million in fresh funding, more than doubled its valuation in under a year, and claims its first hospital reached operating break-even in under 6 months. So can a managed care model that prioritizes recovery over occupancy build a sustainable healthcare business in India? Joining me now is Mayank Banerjee, the co-founder of Even Healthcare. Mayank, welcome to Startup Street. You've just raised $20 million and more than doubled your valuation in under a year. Where does this capital go next? More hospitals, deeper care teams, or scaling tech-led monitoring and recovery at home?
Hi, Shruti. Thank you so much for inviting us. And in terms of where this capital is going next, in all 4 of the areas that you highlighted. We'd love to build out our hospital footprint, invest a lot more in our preventative care and our clinical team, as well as obviously the tech layer that sits across the entire company and enables everything to work.
All right. You describe Even as a managed care hospital, not a traditional one. In simple terms, Mayank, how is this model structurally different from how hospitals typically make money in India? And how did that help you reach operating break-even in under 6 months?
Really good question. So I think the number one mindset that we have is our doctors that we work with, that we're fortunate enough to work with us as employees. They're paid fixed salaries and they're actually incentivized for good clinical outcomes, not necessarily the revenue that they generate. Now, what this translates to is better outcomes for the patients, better outcomes for our insurance members that we work with partner insurers as well. And overall, what this means is because we already have members in areas around our hospital, if they choose to trust Even, visit our hospital, if they absolutely need to, the hospital gets to break even more quickly, as you've already seen, and our members and our patients get a better experience.
All right. So, Mayank, essentially, our model is designed to reduce what hospitals are usually incentivized, to maximize admissions, long stays, repeat visits. But doesn't that cap revenue growth?
It's ironic to be saying this on a business show. I think we care about patient experience a lot more than we care about revenue growth. We believe that as long as you concentrate on patient experience, more people will come, more people will become members, more people will choose to visit our hospital, and the revenue growth will take care of itself. Maybe that's a terrible answer, but it's at least how we think about things.
No, it's not a terrible one for sure. But, early break-even is impressive, Mayank, but hospitals are capex heavy. As you expand in Bengaluru, how do unit economics look at scale? And what's the biggest execution risk, Mayank, you're watching as you move from asset light to asset heavy?
So on the unit economics front, we built the hospital in under 6 months. We've gotten it to break even in just under 6 months. And so I guess from an IRR perspective, as a hospital, we are miles ahead of, let's say, a lot of benchmarks, at least. That's really, really important for us. And I think in terms of the execution risk, it is precisely that, the execution part of it. I'm very fortunate to work with some of the most talented people who know how to build and run hospitals. People like Dr. Chandrika, Animesh, Dr. Benita, Yash is our unit head, and Chandran Bhavesh, who are leading kind of a lot of the growth sides. So very much down to the team. And yeah, we plan to double down over the next 6 to 12 months.
Sure. You just mentioned that you plan to double down in the next 6 months, but how many hospitals are we talking about? Will it be in Bengaluru only, or are you looking at a pan-India expansion? Give us a sense of your expansion plan.
So for the next 6 to 12 months, it will be focused on Bangalore and Bengaluru. Beyond that, we're incredibly excited about doing what we can for patients all over India. We have some plans there. We hope in the next couple of years, 2 to 3 years, we're able to expand from one hospital to maybe 15 to 25. They will be all over the country, and it will be where we have a strong membership base that we can support.
And what about revenue targets? You've broken even in under a year. What about turning fully profitable, PAT positive? When do you think that will happen?
Again, we care about patient experience and ensuring great experiences for our members and our patients. That's what we're concentrating on. As a company, we're in a fortunate position that as long as we stay focused on that, the revenue follows, as do the profits. Part of the reason for this round is investors really believe in how we are doing things. And I think for the foreseeable future, that will be where we are focused. Internally, revenue targets are something that we care a lot less about than how many lives can we improve.
All right. Alongside the funding, even healthcare has also released early clinical outcomes from a tracked cohort across its hospital and care network. Mayank, zero unplanned 30-day readmissions, zero post-operative infections across 350 plus surgeries. Tell us, how tightly controlled is this cohort, and can these outcomes scale across hospitals?
So that's probably the area that I'm most excited about. Obviously, we've been able to get it down to zero at the hospital where we run it end to end. I think one of the things that we have been doing with some insurance partners is actually running this program on some of their portfolio. And even there, we've seen about a 50 to 60% reduction in readmissions. And that's without us running the facility, but it's simply with our clinical team supporting people post-discharge. And that's on many thousands of lives and claims. So I think the bit that we're probably most excited about is not only how amazing our results can be when we own things end to end, but also the kind of impact that we have in partnership with other insurers, and we hope in the long run other hospitals as well.
All right. Mayank, even healthcare has also reported a 92% online revenue retention rate. In healthcare, that's rare. So tell us, what keeps patients coming back?
We try really, really hard for them and try and look after them. I think the average member for us engages with us between 6 and 8 times a year.
Okay.
Which, if I think about my healthcare journey, maybe I speak before even, I would have spoken to a doctor once or twice, max a couple of years. And I think that's really the big difference. Proactive care, where we try and stay in touch with our members and our patients and see how we can help them, is something that people seem to like. And once they've tried it, as you said, they seem to renew, which we're super excited about.
All right. Now, let's talk about managed care. It has worked in markets like the US, but India is very different. So what, according to you, won't translate here? And what gives you the confidence that this model can work at scale?
I think the opportunity in India is to do something way better than the US. I think what won't translate here is what I think is a broken US healthcare system, right? Today, India probably has the best digital financial infrastructure in the world. And we hope in the next few months and years, it will have some of the best digital healthcare infrastructure, thanks to the efforts of the Honorable Prime Minister and the various government efforts there. I think we have a chance to build the world's best healthcare system in India, one with principles of kind of patient care and managed care at its core. And that's what we hope to do in the coming decades.
You know, we have the union budget right around the corner. 1st of Feb is coming close. What will be the big ask from the finance minister?
Very good question, actually. I would say that the government is doing a great job. I think continuing to invest in the digital infrastructure in particular. Right now, we are focused on Bangalore. We very much hope to expand, but our biggest success has been combining digital healthcare, which is brilliant for retention and regularly speaking to people in a way that's convenient, but then also saying, if things escalate, if there is an acute episode, we also have the physical infrastructure as well. And I think the true opportunity in India is to do the best things in the world across both the physical side and the digital.
All right, you know, you spoke about how you've built this digital infrastructure as well. So, you know, let me go back to your fund deployment plans. One of the big plans is scaling tech-led monitoring and recovery at home. If you can take us through your tech edge, what is it?
So I'm fortunate that I'm not the person that gives us the edge. My co-founder worked at Google DeepMind. He has a PhD in machine learning. And we have been fortunate enough to work with a team that have worked at some of the, I think, most esteemed organizations in the country and in the world. It's less thinking about it as a standalone tech effort, but rather how can technology enable doctors to do better jobs? How can it enable patients to more easily get in touch with doctors and ensure that even our kind of support teams are able to leverage their own human judgment to 10 times as many people as they would otherwise have to do. And I think that's really how we think about it.
All right. Mayank, before I let you go, one final question. If even healthcare succeeds at scale, what fundamentally changes for an Indian patient, let's say 5 years from now?
Hopefully they're not a patient and they are way less likely to be a patient and actually have a need to go to a hospital. That would be success for us. If you're someone that is worried about your health but finds it hard to keep on top of it, our job is to make it incredibly easy for you and ensure that you can lead a longer, happier life with the people you care about.
All right. On that very positive note, it's time for me to wrap up our conversation. But many thanks, Mayank, for joining us on Startup Street today, and wish you the very best with all your growth plans.
Thank you so much, Ritu. Thank you so much for having us.
Moving on the hot seat today, actor and entrepreneur Samantha Ruth Prabhu is expanding her business footprint once again with her latest venture, Truly SMA, an affordable premium apparel brand. Speaking to my colleague Shilpa Ranipeta in an exclusive interview, Samantha explains what drives her investments across a diverse portfolio spanning fashion, wellness and food, and her idea behind her second stint with fashion after having launched Saki in 2020. Take a look.
I have so much love for Saki. It was my first ever venture that I invested in, and I learned so much. I learned so much about the fashion space. I learned I was able to engage with a large community of women, and that taught me so much. And with Truly Smart, it's completely different from Saki, and it is a progression in the sense of who I am today. So I would say that about Truly Smart. And I'm excited to start this journey with everything that I have learned so far. Truly Smart is in the affordable premium everyday wear segment. I think what Truly Smart truly stands for is being yourself. And we don't really chase trends. We're about functional pieces that scream quality, and with new age designs that, we bridge the new age designs with quality at affordable pricing.
How involved are you operationally with the day-to-day of Truly Smart, whether it's design decisions, supply chain, marketing, all of that?
Part of everything, and a very, very active part. Every day there's a discussion on what to do better, on customer feedback, on positioning, on future collections. There's always a group that's active at Truly Smart. And
your business portfolio otherwise also beyond acting is quite diversified. You have fashion, then you have wellness with Urban Kisan, Secret Alchemist, Gattaca. Then you also have an early learning center. how do you decide which sector or space to invest in? And is there like a unifying philosophy behind all your ventures and investments?
I've taken a step back from just endorsing brands. So whether it's Truly Smart or Secret Alchemist or Acom or Gattaca, I now have skin in the business, which means a lot more responsibility, and I take responsibility for it as well. I am very, very sure that I would like to be a part of businesses that improve the quality of life for those around me. Any sector, but mostly it boils down to the wellness sector, right? So I feel very, very passionate about health, wellness, and improving the quality of those around me. And I think that from a person who did not have so much confidence in herself to now being the person who bets on herself 100%. Like this. So I think that that's the journey that the last 15, 16 years of my life have been, from being a very unconfident girl to now going like in the opposite direction, the opposite extreme of like, if you have an idea and you believe in the idea, then put all of your efforts, your money into that idea and bet on yourself. And I think that's what my life has become about.
Samantha, a large part of your portfolio is wellness, whether it's Urban Kisan, Nourish You, Secret Alchemist, Gattaca. So, has it been your own tryst with health that guided these investments?
It definitely did come from the struggle, my own personal struggle. It came from an obsessive need to get better. So I realized that if I was looking for these products, other people must be looking for these products as well. And that brought me to Secret Alchemist and to Gattaca and to Urban Kisan. So these founders were already working on something that I was starting to get really passionate about. And we hit it off, and it has been a dream run ever since. I am so proud of all of these businesses and all of these founders and how hard they work. They're truly passionate people. They truly have their heart in the right place, and they truly want to build quality products. And I think that's where the sync comes so naturally. I'm working so well with so many different groups that I'm surprised myself as to how well I'm working with all of these founders, touchwood.
You also started a production house with Tralala Moving Pictures, and you already have one movie out and one with Mayante Bangaram is on the anvil. So what led you to start a production house of your own? How's it been doing? And just trying to understand, is there a gap that you're looking to bridge with Tralala?
I think women in the industry are always looking for more and not getting enough. We're always looking to do more, to do better scripts, to do more fleshed out characters, but that hardly ever happens. And we're always waiting and praying for luck. So I think it was about time that instead of praying and wishing for it, like go out there and do something about it. So hence Tralala, yeah. And Tralala means brown girl in the ring.
You recently spoke about how Tralala will focus on pay parity as well. This is actually something Deepika Padukone also recently took a stand on. So tell us more, help us understand your idea of pay parity here.
Yeah, Tralala will is working very, very actively to, if it's equal amount of experience, it's equal pay. It's as simple as that.
Well, that was Samantha Ruth Prabhu on her latest venture, Truly Smart and More. It's time now to take a short break, but coming up, Arya.ag adds 725 crore rupees to its kitty to expand climate-smart agriculture and its farmer-centric platform. We speak to founder on the other side. Stay tuned.
Well, in what's brewing today, integrated grain commerce platform Arya AG has raised 725 crore rupees or around 18 million US dollars in equity from GEF Capital Partners. Founded in 2013, the company operates across 60% of India's districts, enables farmers and FPOs with end-to-end solutions spanning farm insights, storage, finance, and market access. Now, with this fresh capital, Arya aims to deepen farmer engagement, accelerate climate-smart agriculture, and significantly reduce post-harvest food losses, while also scaling a profitable and equitable agri-value chain. Joining me now to discuss this funding and the company's growth outlook is Prasanna Rao, the co-founder and CEO of the company. Prasanna, thanks very much for your time here and congratulations on that fundraising. Start by telling us about the kind of valuation you raised the Series D sum at and how exactly are you going to deploy the 725 crores?
With respect to the deployment, I think primarily, we are looking at deploying funds to increase the democratization of technology at the farm gate. That would be one of the areas in which the funds would be deployed. Apart from that, I think deepening of our storage-linked services and the embedded finance on storage would be one of the areas in which we would be deploying these funds. The other area that we are clear where the funds would be deployed would be to see how we can connect smallholder farmers and their organizations to buyers at scale, and specifically for differentiated produce.
Okay, and what kind of acquisitions are you talking about? What will the average size of the investment be? Anything already on the radar that you can tell us about?
So we are looking at investments specifically in technology that is affordable, specifically technology that could be used by farmers and their organizations and other small players in the agri ecosystem closer to the farm gate in an affordable manner. So, certain areas that we are looking at specific investments on is on storage technology, which enables farmers and other smaller players to store without the availability of a physical warehouse. So hermetic storage with IoT and AI is one area that we are looking to invest in. Apart from that, Arya has actually deployed the blockchain technology to tokenize the entire storage volume that exists on the platform. We also want to invest in technologies which could enable transactions of these tokens on a blockchain for increased assurance. So these are two very broad areas that we think we would be investing in. But the whole idea of these investments would be to see how we could bring technology closer to the farm gate.
So Prasanna, today as you operate, 60% of Indian districts with 12,000 warehouses, we understand. Where do you expect these numbers to be by, say, FY27, and how much capital intensity is involved in the kind of expansion that you have planned?
So our model is absolutely capital light, and that's what gives us the flexibility to expand without deploying or being capital intensive. We look at warehouses that are already constructed. We have strong tailwinds from various government initiatives which help us access fresh and new storage capacity for agriculture. And hence, when we look at expansion, we've been growing at an average rate of about 30 to 35%, and we believe that over the next couple of years, we will maintain the same rate. This is with respect to our volumes, but you would see a much faster growth with respect to our profits. Past few years, we've almost doubled profits every year. So the idea is to grow profits at a much faster pace as compared to the top line. And with respect to geographical expansion, our thought is that we would be going deeper into the districts where we operate currently. So you would see that while you may look at an increase of about 20 to 25% in the number of districts, it would primarily be further deepening within existing districts to make sure that we have a much more efficient model in operation as compared to just going and straightforward expanding across geographies.
Well, since you speak of financials, you reported 300 crores in net revenue in the first half of this fiscal, profits of about 31.5 crores. What is the full year FY26 and FY27 revenue and margin looking like?
So, for as revenue is concerned, we are looking at close to about 600 crores with respect to the revenues, the net revenues for the platform. With respect to the profits, our thought is that we should be looking at a profit of anywhere between 55 to 60 crores in profit.
Okay, in terms of numbers, how many farmers are currently using your climate-smart data-led solutions, and what is the target increase, both in farmer count and acreage, say, over the next 2 years?
Our thought is that we expand our reach with respect to farmers through the relationships that we have with their organizations, which is the farmer-producer organizations. And with the kind of farmer organizations that have come up, we're very, very confident that we should be able to grow this by at least 100% over the next 2 years.
Got that, Prasanna. Finally, you've enabled about $1.5 billion in loans through your partners so far. Post the Series T funding, what is the annual lending run rate that you're targeting? And also give us a sense of how your default rates look like for these loans compared to, say, the traditional agriculture lending that is done by banks, NBFCs, etc.
In terms of the loans, you're right, we enable or facilitate disbursements of about $1.4 to $1.5 billion every year. And out of this, close to about, and which is say, if I were to look at the numbers in crores, of the total about, say, 12,000 crores of loans that we help disperse, about 3,000 crores is done through our own balance sheet, that is our own NBFC. And the whole idea has been to see that we create a model which is risk contained, which ensures that credit is disbursed in a completely transparent manner, in an affordable manner, to the segment that we are talking about, which is specifically the smaller players in the agri ecosystem.
All right, Prasanna, we'll leave it at that. Thank you again for your time here on Startup Street, and we wish you a very happy 2026.
Hello and welcome to this special Outlook 2026 on CNBC-TV18. Well, we're going to decode what lies ahead for Indian markets, economy and more. Before we get started with our guests on the program, let's go across to Mangalam Malu, who's standing by with the results of the mega CNBC-TV18 market poll. Mangalam, take it away.
Well, as we do at the start of every year, we poll a bunch of experts, the market makers, the decision makers, and all of them on what their outlook for 2026 is. And this time as well, we reached out to 50 experts across funds, brokerages, financial institutions, and this is what the street is really looking at. Last year was a 10% return for the frontline index. Dollar adjusted, it was mid-single digits, and a serious underperformance as compared to the world. So we started with what the street is expecting in 2026 for Nifty returns. About 55% said 10 to 20%. About a third of them said 0 to 10%. and very few expect a negative return. So the street is expecting some optimism, but expectations are fairly grounded. The second part, where should investors be positioned? Should it be large caps, mid caps, small caps, or micro caps? Remember, last year, mid caps and small caps were serious underperformers. But this time, preference for large caps is fairly high. 41% of experts say large caps still offer the best risk reward. This despite the sharp underperformance that we saw in mid and small cap indices in 2025. More than that, the street, while it is positive on mid and small cap, as we move lower down the market cap, we see the enthusiasm clearly tapering off, with literally no one vote coming in for micro caps. If you look at the sectors as well, financials have been the favorite for all the market experts we speak to on the channel, while some also speaking about tech and pharma as contra bets. But this time around, if you look at the results of the survey, nearly half of them are still pinning their hopes on the financial space, with metals and other sectors also finding some favor. Tech and pharma still, however, remain selective bets rather than broad consensus calls. What could be the driver of the market in 2026? Will it be geopolitical, India-US trade deal, earnings, or others? Well, while everyone talks about India-US trade deal as of now, earnings, that's something that will be the biggest driver of the market. Nearly 2/3 of the experts say earnings will be the single biggest determinant for markets next year. Trade deals and geopolitics, yes, they do matter, but fundamentals back at the center of the story. And speaking about trade deals, on the US-India trade deal, the start of last year, everyone was fairly optimistic. That didn't happen. This time around as well, people are fairly optimistic. Nearly 2/3 or 3/4 of them believe that the deal will happen in the next 3 months itself, with some expecting within 6 months. In fact, no one thinks it is not likely this year. So that's the one thing that we have to monitor in 2026. What about commodities? Last year was big for both gold and silver. The street believes that outperformance may perhaps not continue. They're betting on what? Copper and aluminum. Copper and aluminum, nearly 68% outperformance, 18 and 13% for gold and silver. This is a clear reflection of infrastructure, manufacturing, energy, transition themes that are taking place. What are the risks now? These are qualitative questions that we ask them, and the most used or frequently used words that came in terms of biggest risk to equities next year: geopolitical developments, the US markets, concerns around AI. Will that bubble or trade unravel? And Donald Trump's policies. That is something you can never take off the table. And clearly, the biggest swing factor when it comes to budgets, that's the one thing that we ask at the start of every year. What are the things that they will be watching out for in terms of announcement coming in? And here too, the market wants a couple of things. They don't want much tinkering with capital gains taxes. That's exactly what they're expecting. A fiscal stimulus coming in to boost consumption, higher government spending, and no removal or changes in STT, STCG, or LTCG. So those are a bunch of important, insightful data, opinions, and expert calls coming in for 2026. The big outlook, the CNBC-TV18 poll, it looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
Mangalam, thanks very much for that. Joining us now on the program are Ikigai Asset Managers is Pankaj Tibrewal, and Demeter Advisors is Ashwini Agarwal. We're going to talk about what's ahead for the markets in 2026. So I'm going to start off with a poll of market participants on Nifty returns for 2026. Our poll showed that a majority expects 10 to 20% return this year, that is 2026. Around 32% expect returns ranging between 0 to 10%. And what we're going to do, Pankaj and Ashwini, is go over the poll quickly, and ask you whether you agree with the findings of this poll. And maybe on the second half, on the other side of this, we can discuss some of those reasons in greater detail. Pankaj, let me start with you. Do you agree?
I think I'll be more in the camp of 10 to 20%. In the sense that we expect earnings to start improving from 27 onwards, which is FY27. FY26 was a digit earnings growth for Nifty, and that should be helped by banking, autos, and some of the other sectors. And we believe that FY27, we should look at about 12 to 13% earnings growth. And in that sense, our sense is that market finally should track the earnings momentum as you move into FY27. So my bet will be on the second part between 10 20%.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Well, Pankaj, I want to quiz you about a couple of sectors, and very few people were positive on metals as a counter call at the start of last year. But I recall you telling me that. And you came on the channel numerous times, you said metals, that's the counter call that we have. You're bang on. Now, the question is there more to go?
I think absolutely. We believe that the broader commodity cycle is starting to unfold itself. And it's not driven by anything on demand supply only. It's also geopolitical. Don't forget that the supply of commodities has been in very few hands. And all the incremental changes which are happening globally, whether it be AI, EV, or new tech, all require commodities which are very supply concentrated in few countries. And these countries are using commodities as a geopolitical tool for negotiations. So we believe that it will be a new cycle which will be unfolding in front of us. We have seen that in the form of gold and silver last year. It's spreading across broader commodities now, especially non-ferrous. And over a period of time, ferrous should also see some momentum coming in. So our broader call remains that metals should be one sector which should be part of the portfolio as you move ahead.
Got that? No, absolutely. Let's just go through a few more of our poll questions before I can ask you your specific ideas, etc. So let's just put up question 2, right? Which is the category to bet on in 2026? And just quick answers, and then we can discuss these. Large caps, mid caps, small caps, or micro caps? 40% said large caps, and about 32% said mid caps, 27% small caps. But large caps is top of the list. Pankaj?
So Prashant, I'll just take 2 minutes to explain.
I will come back. I want to, because there are 10 questions, I want to just quick answers, and then I'll come back to you.
Yeah, my bet will be mid and small caps combination of that.
Okay.
From bottom-up perspective.
Ashwini?
Agree with that view. I will also be in the camp of mid to small caps, bottom up.
Okay. The third question, sectors to bet on, right? And there was financials, tech, pharma, capital goods, metals, etc. 50% basically saying financials. The others are tech, pharma, capital goods, metals. Pankaj?
I'll add 2 more sectors to it, which is not the flavor of the season right now. One is consumer durables, and the second is chemicals.
Consumer durables and chemicals. Ashwini?
I agree with the view that financials will continue to do well this year. I think a lot of the underperforming sectors from last year, some names in the consumer sector, some names across the board, I wouldn't be sector specific, but I would focus on the cohort of stocks that are down 30-35% over the last 1 year and look for bottom-up opportunities there.
Okay.
Very sector agnostic.
Okay, all right. What about the key market drivers? Ashwini, you go first. What will it be? The India-US trade deal? Will it be geopolitics? Will it be earnings? What's your take?
I think nominal GDP growth, some uptick in inflation, stabilization of the US dollar versus INR. I think these would be the key to drive the market sentiment. If nominal growth picks up and the USD INR stabilizes, I think that's positive both for earnings growth and for foreign flows, and that's something I would look out for.
All right, Pankaj, what about you?
I think earnings will drive the overall momentum back into the market and FI flows returning back. I think we have seen 5 years of negative FI flows. I'm very hopeful that this year India will start seeing FI flows back.
All right, and I think, Pankaj, you have pointed that out as well, that earnings are set to recover. Upgrades are more than downgrades, I think, in your newsletter as well. Ashwini, coming across to you, this is going to be a difficult one, but by when do we see a India-US trade deal? We thought we'll be first. We're still waiting by. Do you think it's in 3 months or 6 months?
Nigel, I have no idea. I would bet on 3 months. That's my hope, but it's a hope. There's no clarity on this at all.
Difficult one, Pankaj, to you, though. I'm hoping it's in the next few days. What do you think?
Beyond our pay grade.
Okay, 77% of those polled up on your screen say perhaps in the next 3 months. I mean, that's expectation. But markets are made up of all kinds of expectations. But this is the one. Like question 6, right? Top commodity asset class. Gold and silver did phenomenally well. The graphics will come up. Copper and aluminum, 68% said copper and aluminum is the commodity asset class for 2026. Pankaj?
Completely agree to that. And also will add the other bulk commodities like iron ore and coking coal. I think incrementally you will see every nation negotiating with the globe on commodities they are strong in. So I think we are entering into a cycle where geopolitical, repercussions will be very huge, and that will weigh on commodity price.
Ashwini?
Agree with that. Copper and aluminum. My sense is that real assets will see appreciation this year. A throwback to global uncertainty, which typically helps people focus more on real assets.
Okay. The one big announcement to watch is the question that we asked. That is capital gains, fiscal stimulus, something to do with STT, STCG, or is it higher government spending, and the results will come up. Pankaj, what would you say?
So if you ask me one risk which investors should be prepared for in 2026 is the global debt and deficit. I think very few will recognize that global debt has now moved to $346 trillion, and it is increasing at a pace of $660 billion every week. And that's something which is insane. In my view, at some point of time, if foreigners decide not to fund any more of US treasuries and the US yield starts to spike up, I think that's a very big risk investors are carrying into 2026.
And the budget, Pankaj? One big announcement?
Budget, I think budget, as the government has shown in the last budget also, should not be negative. I think it should be positive, and the feedback which has gone from the marketplace that please support the domestic investors. So I don't think anything negative should be coming out in the budget.
Ashwini, what about you? Budget?
I'm hoping that we'll hear more noise on privatization, which will release resources for the government to invest into infrastructure. The spending has become more consumption-oriented and less investment-oriented, which worries me. And I'm hoping that privatization will provide the resources to change some of that.
Well, time for a quick commercial break. Don't go anywhere. We're right back on Outlook 2026. Welcome back. This is Outlook 2026. You heard the mega market poll that we conducted. Lots of questions, lots of answers, but some clarity shining through. Pankaj, let me come back to you. I promised you I'll come back to you on your rationale. You always work with lots of data. And you had, on that question on mid-caps, small caps doing well, which is what your bet is for 26, right? Go on. Just explain that point briefly.
So, Prashant, if you look at last year, though the indices showed you single-digit gains, but the breadth of the market has been extremely poor. And this kind of a breadth I am seeing after almost 5-6 years. 18-19 was that kind of a year which we saw last year. And just to put two data points in perspective, though the NSE 500 is almost at a touching distance of 52-week highs, but if you look at the median drawdown, it's about 20%. And also the divergence between the indices have been very huge. So let's, for example, take the Nifty mid-cap, small-cap 400, which is 250 of small-cap, 150 of mid-cap. The indices since October 24 has given a headline returns of almost 2%. But the median return of that indices is negative 6.5%, which means a divergence of about 8%. And that is not only this index. You look at any other index, that's the similar story. And if you do an equal weighted index of NSE 500, it's negative 3% for the year, calendar year 2025. So the point is that very narrow leadership has taken the index higher. And our sense is that if earnings momentum starts to improve, which we are seeing for the last couple of quarters, we will see the broad basing of the market. And hence, you should see many mid-cap and small caps which have been delivering strong growth with balance sheet and cash. But only caveat which I would like to pick is it won't be a runaway rally for the last 4 years which we saw post-COVID. I think it will be very bottom-up. Please don't forget the basic hygiene of balance sheet, cash flows, good promoter, good businesses. I think people should not chase too much of narratives. I think that can fall flat in 2026 because it will be a volatile and unpredictable year.
Okay, all right. Pankaj, quick fire to you then. Will India outperform in 2026?
My hope is yes, that after almost we saw the worst performance against emerging markets since 1994. We have underperformed by 28%. India is completely out of flavor. You speak to any foreigners, they will give you meetings just for relationship. But when India comes in, they have zero interest. I think that's a very, very big contrarian indicator that if something goes wrong globally in terms of AI valuations, US markets, I think India will find its flavor back among FIs.
And broader markets outperform the headline index in India?
I hope so. But I will say that it will be a bottom-up stock pickers market. You have to pick your bets very, very, carefully. It will not be a runaway rally, which we saw from 2020 to 2024.
And is gold closer to the peak? And between the two, gold or silver, what do you like?
I think geopolitical, these kinds of events will make sure that gold and silver both are bidding out.
Okay.
But there's such a sharp outperformance. Don't forget that we have seen sharp drawdowns in the past also. Okay. So investors should brace themselves for frequent, very sharp drawdowns as well. So don't, if you have an asset allocation process, just follow it. Don't get overboard on it.
And you were positive on metals, I recall, and auto ancillaries. And some of the stocks have started doing well. Would they qualify as the top themes for 2026?
I think precision engineering as a theme will be one of the biggest themes to bet in India. Globally, most of the large OEs, whether it be Airbus, Boeing, defense companies are looking at these companies. And most of the auto companies, a few of them, are pivoting themselves from pure auto to industrials and precision engineering in these sectors. I think they can create huge value as you move into for the next 3 to 5 years. And few of the bets are part of our portfolio.
You want to name a few?
So we have been talking about, for example, Sansera. We have been talking about Happy Forging. And all these are through their capex. And incrementally, the growth has started coming from aerospace, defense, industrials. And our sense is that many of them will see accelerated growth as you move ahead, because they are just pivoting them from a pure cyclical sector, which is auto, to other sectors which are more structural in nature from a growth perspective. So these are some of the names which are part of the portfolio. Don't take it as a recommendation to buy and sell, but we're just giving as a thought that precision engineering will be a great theme to play as you move ahead into the next 3 to 5 years in India.
I remember Sansera very clearly, Pankaj. I think was it about 1,100 rupees when you spoke about it, I think on the editors roundtable and maybe even earlier. So it's done well. Back to 1,900 rupees, I think almost at a new all-time high, I think, Sansera and others. So the theme is something you've been highlighting for a while. I just have one other sort of setup, and we'll just pull the graphics up in a bit. So while we do that, Ashwini, one sector, and which I think you track closely as well, is textiles. And of course, I mean, it's been bombed out because of this India-US thing. I call Gokuldas the India-US trade deal indicator, and that's back at 750, almost 750. What's your sense, Ashwini? Any hope?
So there are two issues there. One is underlying US consumer demand, where I think there is some uncertainty. It's been surprisingly strong, notwithstanding all the anecdotal evidence one is getting about job losses and about inflation being higher than what is measured in official statistics. But, if that were to turn down for some reason in the United States, that's a risk, for the sector. The second thing is what's going on, with tariffs in other parts of the world and the deals that India is signing. I think, textiles as an export opportunity for India will continue to do well. I think the companies would be well advised to look for a global customer rather than be overly dependent on the US is my take. I remain reasonably constructive from a medium-term perspective because we really have, durable competitive advantage in this area. Yeah. And my belief is that, when stocks get sold down, they should be looked into, and evaluations are appealing. One should be willing to purchase them. So in that context, if something's done poorly, that's always an opportunity to at least investigate, if not invest.
Yeah, no, absolutely. One other way, and there are so many ways in that sense to look at things, right? One, and Nimesh put this data out. He did this last year, I remember 2024, and he's done this on the editors roundtable last Friday. Simple thing. Look at the big laggards of the year gone by and see if some of them can flip on the other side of performance tables in the new year. So these are the biggest sectoral laggards of 2025. Real estate, 18% down for the year. The IT index is down 15%. And of course, I mean, there's other stuff as well. But these are the two big ones, right? 18 on lower on real estate, IT down about 15%. And then stock-wise, the biggest laggards. Trent is down 40%. But of course, I mean, Trent was up very big in 2024. So it's kind of flipped on the other side in 25. TCS down 22, ITC down 17, HCL Tech down 15, Wipro, Infosys, Power Grid are some of the other big laggards. And any cues from out of this which strikes you as useful, Pankaj?
So the way we have our framework, Prashant, is that we look at that demand is very hard to predict. Just to give you a data that 7 out of the last 11 years, India Inc. top line growth has grown in single digits and lower than the nominal GDP growth. So top line growth is becoming very difficult to predict. And hence we take a call on margins. And we look at sector by sector where the margins are at an almost all-time peak or where the margins are below their averages. And in that, the margins which are at all-time peak are sectors, for example, hospitals. Clearly, that sector has got re-rated significantly over the last few years. And margins, there is a risk on margins. But when you look at some of the other sectors, for example, consumer durable we spoke about, the margins are closer or below averages this year and the last year. There's been huge competition, weather has not supported. And the second is chemicals. After almost last 4 years of non-performance, margins are very, very low. So I think when trajectory starts to improve in these sectors, you can get earnings growth plus re-rating on multiples as well. So our bet will be that have this framework of margin and top line growth. Top line growth is difficult to predict, as we have seen in the last 7-8 years. I think what we can take a call is the margins. And I think in that's consumer durables, power, metals that way, that was the reason we were contra positive at the start of the last year. And similarly on chemicals, I think that story is yet to play out. But we believe that 2026, you could see some of the events unfolding itself, which will be positive for chemicals as you move ahead.
We have to wrap up on this edition of Outlook 2026. Ashwini and Pankaj, thank you very much for staying with us. Viewers, don't go anywhere. More news and updates on the other side.
And welcome to our special show, Outlook 2026. Today, we're taking a closer look at India's household debt story using the latest data from the Reserve Bank of India's Financial Stability Report. Now, India's household debt has climbed to 41.3% of the GDP as of end of March 2025, up from a 5-year average of about 38%. Now, this tells us Indian households are borrowing more and borrowing more consistently. Although compared to some of the peers in emerging market economies, India is still relatively better placed. What's interesting is how households are borrowing this money. Nearly 46% of household loans are now consumption loans. So things like personal loans, credit cards, and consumer durables are being bought on credit. Loans for asset creation, like housing and vehicle loans, now account for about 36%, while only 18% goes into productive purposes like education, agriculture, or small business loans. On the savings front, net household financial savings have recovered to about 7.6% of the GDP in FY25 from 5.2% in FY24, but it is still below the pre-pandemic level. Now, overlay this with RBI stress test, which shows asset quality could improve from 2.2% as of September to 1.9% by March 27 under the baseline scenario, and capital levels will remain strong, reassuring that banks, NBFCs, mutual funds, insurers, they all remain resilient even under the most severe scenario. And we have a more nuanced picture emerging here. So today, the key questions are, is India's household borrowing becoming a risk? Are banks adequately prepared if consumption-led stress emerges? And does rising debt reflect confidence or compulsion? To discuss this, I'm joined by Dinesh Khara, former chairman of State Bank of India, and Madan Sabnavis, who is the chief economist at Bank of Baroda. Gentlemen, thank you so much for your time here, and a very happy new year to the both of you. And thanks again, for joining us on this 1st of January. Mr. Khara, let me begin with you. Household debt rising to 41.3% of the GDP, and most of this is actually to just finance everyday expenses and lifestyle. From a banker's perspective, do you see this as just credit deepening, the natural flow of things, or signs of more stress build-up potentially?
First of all, thank you very much, Ritu, for having me on your show, and also my heartiest greetings to all your viewers for the new year. Well, what you talked about, the increase in the household debt, and more so when we compare it with the previous 5 years, yes, of course, it's a paradigm shift, I would say, and it is also a behavioral shift in terms of how the retail consumers are being addressed. Part of it is attributed to the convenience with which this kind of a retail loans are also available. So I would say that it's a mix of both. So I think so long as the debt is going up, is not as much of a challenge. If at all, it can be repaid in good time. That is something which is more important to really monitor. And if at all, what we have seen is that, of course, when it comes to bureaus and the borrowers who are there, the quality of the borrowers are certainly improving. And part of it is also attributed to an effort made by the borrowers to ensure that their credit history remains strong. So I think this is the kind of a context in which I would like to really look at this number. But yes, having said that, it is equally important that there should not be reckless lending by any of the institutions, be it NBFCs, be it bank, or be it the digital lending. So there also one need to really have a point of caution. And if at all, it can be linked up with the ability to repay the loans. That could be the best of the scenario.
Important point there, Mr. Khara. Quality of the borrower and the lending profile, both of that needs to be kept in mind for context, and we'll get to that in just a bit. Mr. Sabnavis, to just bring you in, you've been an observer of the economy for a long time. This rise in household debt, what does it tell you about the state of the Indian consumer at the moment? Is borrowing driven more by income confidence or income stress? And, can we really take comfort in the idea that India's leverage is lower than other emerging market peers?
In fact, Ritu, I have a slightly different view out here, because if you look at developed countries and if you look at their evolution, I think a lot of it has been driven by consumerism, and consumerism has been supported a lot by leverage. So I don't think it's anything odd to see retail loans actually increasing, the personal loans going up, even for consumption purposes, because we should remember that consumption is one of the links to overall GDP growth. And today, when we say that consumption is not increasing, one of the factors is that, okay, there is high inflation, incomes are not increasing. So I think what is critical is that finance that is borrowing from banks or any other financial institution is a means to get access to this kind of consumption, which I think is a positive thing from the point of view of the economy. This said, I think as far as banks are concerned, you need to be a bit cautious in terms of lending. You should not get reckless, because normally there's always this tendency that when there is a certain wave which is going, like we saw earlier for infrastructure, there was a tendency to overextend loans to a particular segment. So here, I think when we have seen prudential regulation from the point of view of the RBI and intervention like what they did a couple of years back for the unsecured personal loans, I think that is something which is very important. So I would say this is a necessity to see the economy grow. As you said, if they're doing it for a home or for an automobile, there is directly a good which we're seeing there. But even if it's for a non-durable good, I think it is something which does help the economy. But important part is banks have to be cautious, and the regulator has to be alert all the time.
Absolutely, Mr. Sabnavis, an important point there. Of course, developed markets like the US, very heavily consumption credit led. But, Mr. Khara, from the FSR data RBI has released, we can again see these unsecured loans, they still form 53% of the total retail slippages. And this is after what Mr. Sabnavis was just telling us, that there are prudential steps that have been taken. The risk weights on unsecured lending were increased. And most of this is also still coming from private banks. In that context, the shift in credit mix more towards consumption, less towards productive sectors. Is that something that should sound a note of caution at all?
Now, see, the point is that what you mentioned in terms of when you look at the slippages, well, aggregated level slippages, yes, of course, that's a matter of that we need to be watchful. But having said that, we also need to really figure out that which are the entities where the maximum slippages are seen. And perhaps, if at all their underwriting models will be subject to more critical review, then perhaps, we can fathom the reasons for the kind of stress which is seen there. This is a reality. And of course, as I mentioned that, when the banks and financial institutions are lending, their underwriting models have to really keep in mind the ability of the borrower to repay such loans also. So that is a very, very critical component. Lending on the one side will help in terms of building up the book. But yes, of course, if at all it's not a good lending, then perhaps, the kind of provisions which are required to be made, and eventually, we have seen that in the private sector bank space, a good number of such loans have been sold out or maybe provisioned also, and also they have been sold out to ARCs also. Yeah. So I think